MACD, SMA. If you continue to rely on these things, you will not be successful. You will not be successful on the charts. You have to understand that the charts can only go one of two ways, up or down. Okay? The candlestick. I want you guys to understand that these candlesticks can only move in two directions, up or down. And everything is based off of levels. Why do you think you see price reacting at the same area? For example, say you have market going in an uptrend, okay? And market found an area of resistance, okay? So an area of resistance is going to be an area where people decide to sell at, okay? So you're going to have sellers here. If price decides to come back up, price has a good chance to short at that same area, okay, of resistance. Since people sold there the first time, has a good chance to sell there the second time, okay? And then you're going to have areas of support. And these are going to indicate buying zones, okay? And even if it doesn't congruently happen like this, a setup can commonly look like this. I call it the support mirror, resistance mirror, or the stack mode mirrors, okay? So you might see a setup that looks similar to price might come up, it might rally past the resistance, you know, come back down, and then mirror the resistance, you know? Very common. You have setups like this for a downtrend type of setup. And then for an uptrend type of setup, could definitely look like this. Price might bounce here. And then price might come back up and then validate it again. So even though it invalidated at this area here, it decided to come back up over here and then go in an upwards direction. Okay. So we have to understand the market is a vertical chart. You're looking at a vertical chart. That's why I do not want you guys to fall into the indicators traps. Okay. Now, there are going to be some pretty good indicators. Okay. Volume. Okay. A lot of people don't even know what volume is. What is volume? Volume is going to be the amount of orders placed at a specific area or time. So volume is the amount of orders placed at a specific area or time. That's going to be volume. So that's the term you always hear. So you want to be buying at key areas of support, okay, because it's going to have most of the volume there. You want to be selling at key areas of resistance because most of the volume is going to be there. Now, let me go ahead and give you guys some secret sauce here. Way more powerful than indicators. Okay, understand that sometimes in the market, resistance can be broken and turned into support. Okay, resistance can be broken and turned into support, and then price can bounce in an upwards direction. Just the same way, support can be broken and turned into resistance. Okay, so resistance can be broken and turned into support, and support can be broken and turned into resistance. Even if it doesn't happen this cleanly, it can happen something like this. And price might run through there, come back up, turn this resistance here into the support later on. Okay, go to the support area, support, say price decides to run under here, come above it, and then come up again, boom. This area of support made this area of resistance, created here. Okay. So I make it simple for you guys, man. I do not want you guys to be struggling. Okay. There's going to be times life is going to be hard. The charts are going to be hard. People are going to be doubting you. People are going to be hating you. And there's going to be times you might not even believe in yourself. And all that doubt has to be killed. Okay. And indicators equal doubt. If you have to rely on indicators to trade, then you can't be a profitable trader. Okay, if you can't just look at the chart and be like, okay, I see why price bounced here, 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 and here, then you cannot be a profitable or successful trader. You will continue to struggle. You will continue to go through hard times. Okay, and it's going to be very, very hard for you to elevate. And the indicators are what's holding you back. So I want you guys to do this. Okay, for a year, no indicators. Okay. No indicators. Just read the candlestick chart clearly. Read it raw. Read it raw. Okay. That's what I need you guys to do. So for a year, no indicators. And I want you guys to just go hard, man. Go hard. Put in 16, 20-hour study sessions. Live on these charts. Understand every single micro reaction. Understand why price bounced at every single area that it did. Understand why price sold off at every area that it did. We have to get the full congruent picture. We want to get to the next level, and we're pushing harder than ever. We're not stopping for nothing. Okay, this is real therapy for me, guys. Just sitting here teaching you guys these charts. I'm so passionate about this. You know, I live for God, and I live to just get people out of financial poverty. I don't want to see anyone struggling. I don't want to see you guys blowing up your accounts or committing suicide over the markets or just going through any financial hardships. I want you guys to be successful. I want you to get to the next level. And I want you to win. Okay? And I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay? Follow your heart. Okay? If God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay, whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay, follow your heart and follow your setup. Okay, you tell yourself, I'm only going to play break and retest. Okay, if you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than the trend lines? Okay, that's the things. You have to follow your heart and follow your setup, and most importantly, follow God. Okay, you can get successful. Investing, it's important in this world. Okay, the more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay, faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay, investing in the stock market is crucial. It's important, and don't let anyone else stop you guys from doing it. I'm very, very passionate about teaching this, and if you want to learn more about it, and if you want to get a free stock watch list, I should see you at stackmode.net. Stay prayers to God, keep grinding. Catch you in the next one. Peace. Class, let's go and let's jump into it. How working on your trading discipline helps you think long term. Understand that process is going to be greater than the process. We gotta focus on the discipline. God tells us to be disciplined, be patient for a reason. You can't think you're about to get rich overnight. Okay, it's going to be a consistent journey. It's going to take you day after day, grind year after year, and being disciplined decade after decade. if you're thinking this is a get rich quick scheme, if you think you're about to just come into the market and get rich overnight, I recommend that you guys go find something else. Okay? But if you're ready to grind out this process, be here year after year and generate wealth and transform your entire self as a human, let's go on the show with the lesson with discipline. So short-term versus long-term focus. So the gambler's mindset. So gamblers decide to focus on the next trade. Okay. So they focus on the next trade. Okay. And the immediate P&L. So you can't do that. Okay. Yes, you can focus on the next trade. Don't let this trade destroy you if you decide to take a loss. Okay. But you can't just immediately focus on the next trade. Okay. Whether you take a L or you take a win. Okay. Whether you lose or win, you have to pause for a second. Don't immediately try to take another trade. If you lose, don't try to take another trade trying to make some more profit back. And if you win, don't try to take another trade trying to make even more. That's greed. All right. Don't try to just trade immediately again. Relax. Okay. Don't let any emotions destroy you and just focus. And don't let any emotions trigger your trading material. Okay. No greed, no fear, no FOMO. You don't enter off of any of that. You enter off of strict criteria. If you're going to be break and retest trader, you're going to wait for resistance to be broken, turn it to support and take it up to the next level. Okay. And your outcomes, right? You should not be having extremely random results when it comes to how much you're losing. For example, if you're losing different amounts each time variously, okay, and it's random, not calculated, you're gambling. You should know exactly how much you're going to lose when you put down the trade. And stop asking yourself when you get onto the market, how much can I make today? Ask yourself, am I going to stick to my plan? Does this setup look like an S plus criteria setup that I want to go ahead and take? You're not going to make money every single day in the market. So remove all of these short-term mindsets. The short-term gambler's mindset is not going to get you anywhere but just being sad, okay, with no money in your bank account, because that's all where it left me when I was a gambler. Okay, destroying my account, chasing the next one, even making really good profit over and over again, destroying my account. Okay, not being able to keep it, not being able to consistently grow it. Okay, so, and then I had to really develop the trader's mindset and start understanding that this is a whole left to right chart. Okay, these stocks are out for decades, year after year. The whole market is meant to be played long term. So it's about keeping your account alive, taking trades that's going to keep your account alive, and prioritize those trades instead of just trades that's going to make you money. Okay, so focus on the system's edge. So instead of focusing on the next trade when you win or lose, having a frantic mindset, focus on the system edge. Reflect what you did wrong, or journal your trades, and then go ahead and see if you could stick to that for the next 100 trades. Okay, if it was a win, stick to that. Okay, stick to that system and keep doing that for at least 100 trades. If it was a loss and you stuck to your setup criteria, you could do the same thing. See if that system, that edge truly doesn't work. You can't just swap system and edges because of a couple of losses. Okay, you have to really understand your market edge, grind it out, fix any kinks, and stick to it. Okay, switching edges every 2 seconds, switching to this indicator, that indicator is a big reason why people don't end up becoming profitable. If you're going to be a break and retest trader, you only trade break and retest till the end of time, for example. So long-term traders are also driven by logic. They don't trade off of emotions. They understand their probabilities. They understand they're not going to win every single trade. They understand that their risk management is going to be imperative, and they know exactly how much they're going to lose in case they take a loose. Okay, so in case they take a L, and in case they lose, they know exactly how much they're going to lose. And they have a consistent equity curve. Okay, low drawdown. They don't let their trades suffer too much. They play with the stop loss if needed. Okay, which is an automatic order that's going to close your trades when needed. And they make sure they play for sustainable growth, growing your portfolio over time. And they ask themselves, am I following my trading plan? Or how much am I risking today? Okay, instead of just wondering about how much am I going to make today, ask how much am I risking? Does this calculate between 1 to 10% of my account? Okay, and if so, then you can go ahead and implement that within your strategy. And long-term survival is achieved by prioritizing capital preservation over just immediate gain. Okay. So discipline, it's going to be the foundation of process, and that's with anything. Okay, whether it be praying to God. Okay, pray to God every single day. Okay, requires discipline. Working out requires eating healthy, eating clean, working out Monday through Friday, for example, 5 days a week. And discipline isn't just about winning. It's about making every action replicable and measurable. And a strict entry-exit criteria is going to be needed in order to participate within the markets within a logistical way. So if your setup doesn't meet all of your criteria defined in your plan, you don't trade. Okay, and this prevents emotional entries and revenge trading. So make sure that you have your risk limit intact. Okay, know exactly how much you're going to lose, know exactly where you're going to enter, and know exactly where you're going to exit. Okay, once you have these three things in place, you can go ahead and take your trade. Okay, and some non-negotiable stop losses. A 1% risk, let's say for example, per trade limit ensures that no single loss can derail your multi-year trading trajectory, and the soft loss is going to be extremely needed. Okay, so your risk limit can be between 1 to 10% of your account. Okay, and consistently journal. Okay, I'm going to drop the Stackmode app too, where you guys can go ahead and journal. Use a physical journal, Notion, Discord, whatever, and you can document every single trade, even winners with high fidelity, and they ensure that you have the data needed to make objective long-term improvements. Even if you fall into a season where you feel like you're not hot anymore, you feel like you're not winning like you need to, you can go ahead and check your journal, check out the profits, and just go ahead and replicate what you were doing then. Okay, don't change anything. Be as consistent as possible year after year, and chill out. So the bridge control. Risk control is going to equal longevity. Okay, so why does 1 to 10% of your account per trade? Okay, why does that discipline force long-term thinking? And this is because you're not instantaneously ready to destroy your account over one trade. Like, you know what, I'm going to use all the money in this account. It's either I win or lose, forget it. Okay, no, you're not building any edge like that. You're not working on yourself like that. Everything is a grind, and survival is going to be paramount. If you risk 50% on one trade, you must make 100% on the next to break even. And disciplined risk management, 1 to 10%, makes the next trade a simple statistical event, not a catastrophic recovery event. Okay, so you guys don't have to trade within a sense like, oh, I just lost this amount, I just traded with 60% of my account, and then you only have 40% of your account left. So say you lost 60% of your account, right? Then you only have 40% of your account left. Then you're about to trade with all of that, trying to make it back. Okay, and you're gonna have to put on multiple trades, and your emotions are gonna be all over the place. But if you lose 5% at a time, 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 and then you win 40%, you're good. Okay, you're good. You have to stick to that type of structure. Understand the logic is going to be in front of you. Protect your edge as well too. Your trading system is going to work over hundreds of trades. You have to focus on the long term, and discipline ensures that you execute enough trades in a consistent manner for your statistical edge to actually materialize. Inconsistency destroys your sample size as well too. Okay, don't just start losing yourself once you start making some money. Don't start throwing on more size than need to be. Don't start taking setups you wouldn't normally take, and focus on yourself and be blessed with the ability that God has blessed you with. Okay, and just keep growing it by staying locked in, staying disciplined, and staying down. Okay, keep reinvesting your profits into more different plays. Okay, keep being disciplined within the real life. Don't spend money that you don't have. Okay, and take your time and enable compounding. Compounding growth is the engine of long-term wealth, and discipline prevents large drawdowns that stop the compounding process. A small, consistent gain preserved is infinitely more valuable than a huge volatile gain followed by a huge loss. And the drawdown trap. To recover a 25% loss, you need to gain 33%, okay, which is going to be pretty manageable. So to recover a 50% loss, you need to gain 100%. And to recover a 75% loss, you need to gain a 300% win. Okay, so discipline is the tool that locks you out of the drawdown trap, forcing your focus onto the next consistent decision after you've reflected, after you've journaled. Okay, and if you follow your criteria, you're going to stick to that plan, not the last emotional mistake. Okay, don't just hop into a next trade as soon as you lose. Okay, relax, take your time, reflect on it, and then come back stronger. So the metrics of longevity. Expected value, EV, expected value formula. You have the win rate times average win minus the loss rate times average loss. So expected formula, okay? Expected value formula is a long-term forecast, and EV tells you what your average profit per trade will be. And over a large sample size, let's say for example, took 500 trades, okay? You can go ahead and check to see what your average profit per trade will be, okay, once you calculate everything will be. And depending on your contract size as well too. And discipline is essential because it's only the factor that's going to ensure your actual performance that meets your theoretical EV by controlling the inputs, okay, your average win and loss. So the disciplined trader's EV, let's say they have a win rate of 45%, for example. Okay, you can have a win rate of around 90% if once you get pretty good. Okay, something I've tested myself. April had a really consistent month, posted every single trade on my Discord and stuff like that. And average R, okay, the risk to reward. Okay, let's say they have a 2-to-1 risk to reward on average. Okay, that means they're doubling their money. So let's say they took a trade for $50, they're making $100. Okay, a trade. Okay, so that's going to be a 2-to-1. So the EV is going to be positive. The system has an edge. They're making money consistently. They have a good win rate, and their account is growing over time. So let's go over the inconsistent trader nullifies EV, and the emotional trader destroys EV by changing the variables. They move stop loss, which then destroys all your percentage equity curve, which then increases your average loss. I know when I was moving stop loss, destroying everything, it was definitely messing up P&L. And they cut winners short too. Stop having so much anxiety. What did you enter the trade for? You got to really trust the intellect that God bless you with. Stop closing your trades early. That's cringe. All that fear, all that anxiety. You're trying to get rich. No risk, no Rari. Stop being scary. And stop chasing low quality trades. Okay, that's really going to decrease your win rate. Okay, we're here to win. We're here to put in some trades that are going to be high quality, expecting us to safely make some money, inshallah. And without discipline, the EV formula becomes meaningless, leading to random destructive results. So make sure you guys are doing everything within a structured, unbiased formula. So the final step, treat trading as a business. Some of you guys are taking it as a game, as a mini game, scalping on the 1 minute, 5 minute time frame, having fun, smiling, cheesing, losing all of your money. Okay, when you're a trader, you got to understand that you're the boss, you're the CEO, and your role is to not predict the next price move, but to manage your capital, execute the business plan, okay, in order to catch the price move that you want the directional bias based off of, and then analyze your performance, okay, consistently withdraw certain amounts. Let's say I make $1,000, I'm going to withdraw $500. Then I'm going to take 30% of that and put it away for taxes. You have to understand you're your own boss. You have to be structured with even the money that you're making. And daily discipline is the only thing that's going to ensure success. Focus on the 10 steps, okay, you must take today. Focus on the process rather than the 10,000 other ones that you hope to make tomorrow, okay? So focus on the 10 steps. Don't focus on the $10,000, okay? Focus on the 10 steps, okay? Focus on what you need to do. What's stopping you from getting the $10,000, okay? Your discipline. Get more structured. Lower your ego so you can stop blowing up your account. You can start actually growing it and start winning. Okay, come to me for mentorship if you need. Head over to Stackmode.net if you're struggling in trading. And have a compounding mindset. Okay, I'll give you guys a free call as well. And understand that small positive discipline returns executed consistently are the only reliable path to long-term wealth creation. And longevity is going to be the true goal. And think in centuries and act within seconds. So, say prayers to God. Keep grinding. Catch you guys in the next one. Once again, you can head over to Stackmode.net for all trading education. Peace. Class, are you guys investing or are you guys gambling like a casino? Let's go and let's talk about the difference between disciplined trader versus the gambler. Each scenario is going to go ahead and represent the scenario that we should be doing, which is A, being disciplined, being humble, not having ego, making sure we're being persistent and consistent within our investment methods. Or a gambler, someone who doesn't play within their risk parameters, does anything, overtrades, is emotional. And let's talk about the difference between the two. And which one are you? So the gambler's mindset. Focus on instant gratification, which is going to destroy you. Anything that comes super quick could definitely be lost extremely quick. Things take time to build, have to be planted like a seed. Okay. And the gambler's mindset, trader and investor, is going to seek quick, massive returns. And they view the market as a zero-sum game of luck, often driven by the excitement of large immediate payouts, instead of thinking of consistently trading the market year after year after year, generating income so they could stop trading effort and exertion for income. Instead, they could make their money, make the money. Instead of having that mindset, they're thinking, okay, let me just make this quick play real quick and try to pull out $10,000 from this trade instantly without any experience or anything like that. And the gambler's mindset trader is going to have irrational hope. They believe they can predict short-term price movements through gut feeling, hype, or just any type of randomness to the trade, ignoring historical data, quantitative metrics, or technical analysis, just buying things based off of the fact that, you know, I think it's going to go up. I think it's going to go up. Okay. And without any true fundamental analysis behind it, make sure you have data behind why you want to get in, whether it be a technical data on the charts or fundamental data. Be like, you know what, this company's doing well. They just put an earnings report out of X, Y, and Z. I think the company's profitable. You know what, I think this dividends PE ratio is going to be worthwhile getting into due to the fact that it's pretty good, okay, compared to other dividends. Okay, so just examples here, but you can go ahead and use logical formations before you just enter in any trade. For the gambler, it's just going to be entering anything, and you don't want to be doing that. Plot your trades logically and take your time. And they treat capital as lottery tickets. And each investment is seen as an all or nothing bet. Never take your whole check. Never take all of your business income and invest it into one play. Don't do that. Okay, take your time, diversify, have risk into it. And that means that they often risk an unmanageable percentage of their total capital on a single position. Okay, so don't do that. Make sure you guys are controlling where your income is, spread it out, have it in different investments, and keep stacking cash. Okay, and the disciplined trader mindset, focus on statistical edge. Okay, and they view the market as a long series of probabilistic outcomes, expecting not to win every single trade, but definitely expecting that, you know what, I can only lose the trade when I close too. So having that mindset is really going to keep you in the game. If you're here to trade year after year after year, stocks, cryptocurrencies, etc., go up year after year after year. So the goal is not to win every trade, but to execute a positive expectancy model of over 100 plus trades over the course of a couple of years, gaining data, and then having an edge. And disciplined traders are going to be process oriented and understand that success is measured by adherence to a predefined trading plan, not by the single of an outcome of a single trade. So even if you make a whole bunch of money on one trade, you're still going to be disciplined. You're still going to be waking up, praying to God, being consistent, being humble, not losing sight of the plan. Okay? You can't just make $10,000 on one trade, right? Which might happen. Sometimes you catch a gap up and things like that. It might be unintentional money. Okay, but you can't do that and then play with a whole different position size the next day that's way over leveraged, not in any calculations of your risk parameters, thinking you're the best trade ever just because you hit one trade. Relax, okay, withdraw, take a step back, breathe, pray on it, be grateful, and then come back with a logical, process-oriented mindset and make the next trade. And the disciplined trader focuses on capital preservation and just cash preservation in general. And the primary objective is to protect existing capital, okay, which is risk management, with profit generation as secondary. Independent outcome and losses are budgeted expenses. So for example, the gambler buys a volatile stock based on a Reddit post, for example, or Instagram post, instead of actually looking at the chart, doing their own statistical and fundamental research, making their own analysis, which you should be doing, expecting it to double overnight, right? And the disciplined trader buys the same stock only after confirming its consolidation near a key support level in a trend, allocating less than 1 to 10% of their capital per trade. Okay, letting their money make the money, letting it stack up, and letting their capital just always generate. So the edge, the chance versus quantifiable advantage. So the gambler's edge. The gambler operates with non-existent or poorly defined methodology, and their decisions are typically random and highly discretionary and impossible to replicate or backtest. And no validation. They never test their strategy. They remember big wins, okay, and have confirmation bias, thinking that, you know what, it's going to do this over and over again. Now, I understand that if you find a strategy that works or some technical analysis that falls into place repeatedly, that's amazing. But don't expect this to work 100% of the time. Don't have an idealistic view of this will work, this will work, this will work. Don't think that you're really going to lose, but be comfortable with losing. You should only be investing in that you're cool with losing in this way, that if you win, you're not going to be emotional. Same thing if you lose, and that's going to go ahead and be able to cancel out any anxiety or fear that you're having on the markets. So the gambler is going to be following a million ways too, and trades based on news headlines, social media chatter, or recommendation from unreliable sources without performing due diligence and doing their own research. Don't do that, okay? Don't be a sheep. Do your research. Make sure you want to invest in something that you believe in, something that you feel a connection to. Be like, you know what? I think this is a good strategy. I think this is a good investment. I think this play is strong. And go ahead and get into it. And unseen rules. Entry and exit rules change mid-trade, and the plan is subjective. So if they say, you know, I'll sell when it feels right, or I'll hold until I'm even, instead of having logical checkpoints where they want to exit their trade and enter their trade. And we'll talk about the disciplined trader edge. The disciplined trader must have a statistically verifiable edge and a set of rules that over time yields a positive expensive T, okay? So their win rate is high, okay? And their average win percentage is high, okay? And even if they take a loss, their whole account is not going to be destroyed due to the fact that being a disciplined trader means that you're not trading with more size than you should be trading with, meaning that even if you lose, your account's not going to be destroyed. Why? Because you're trading between 1 to 10% of your account. And the disciplined trader backtests and optimizes their strategy if anything is wrong. And strategy is going to be rigorously tested and studied and backtested over decades of historical data. And the trader knows the system's maximum drawdowns and expected monthly return range. And the disciplined trader has a written plan. Every scenario is detailed in a formal trading plan. And this documents defined setups and valid market conditions, risk rules, and exit mechanisms. Okay?
The trader is going to calculate certain mathematical expectancy of their system, be like, you know what, my win rate is this percentage. There's certain trading journal programs that can go ahead and calculate it, and I'm working on the Stackmode app right now, which is going to help you guys calculate your trade journal as well too. So risk management, annihilation versus preservation. And this is arguably the most critical divergence. And a trader's long-term survival is entirely dependent on rigid risk control, which a gambler fundamentally ignores. So I'll talk about the gambler's capital allocation. So averaging down, they panic when a trade moves against them and buy more to lower their average cost instead of just staying on business on their position. Okay, be like, you know what, I lost. Let me go ahead and have a set place where I should be closing at, and if it exits there or if the price hits there, I'm gonna go ahead and close and exit for a loss. Okay, but instead, when the moves are going against them, they're gonna add more with that gambler's mindset, trying to convert the small loss into a big win. Instead, that small loss just turns into an even bigger loss most of the time. Okay, turning into a catastrophic concentration of risk. And sometimes playing with no stop loss can be bad. So it depends on what you're investing in and how you're investing too. If you're on futures and Forex, you should be trading with stop loss. Why? Because margin call is a thing. You don't want to get margin called by the broker and other broker money. So play with the stop loss, especially if you're on futures and Forex. Okay, stop loss in crypto, you can get away with no stop loss, depending if you're buying and holding, same thing with ETFs. But for futures and Forex, definitely stop loss. Please do not gamble on futures and Forex, playing with leverage especially. And they believe that the market must come back, all right? And they refuse to accept a small loss, often leading to a margin call or a total account wipeout, which is most of the time only possible on futures and Forex. The gambler is also going to trade with emotional position sizing. And their position size is determined by current emotion or desire for profit, not mathematical risk. And they often risk very, very high percentage of their accounts, 10 to 50% of their account on one trade. And the gambler faces ruination probability. And that's the mathematical certainty of eventual losing all your capital due to oversized losses and emotional decisions. Now let's talk about how to be a disciplined trader. So a disciplined trader position size. So they have a fixed percentage risk. They never risk more than typically a fixed small percentage of their total capital per trade. Okay, so if you have $1,000 in your account, okay, and you're risking 1 to 10% of your account per trade, you're gonna risk between $10 and $100 of your account per trade, okay? Keeping your risk in place. And let's say stop loss. So a stop loss is placed before the trade is entered. So once again, especially if you're on futures and Forex, you gotta know exactly where you're gonna exit at and where you're gonna enter at. And it defines the point where the trade idea is invalidated and the risk is contained. And the risk position is sized. So the position size is calculated based on the distance between the entry price and the stop loss, ensuring the monetary risk does not exceed the 1 to 10% rule. And the disciplined trader ensures that even a string of 10 consecutive losses will only deplete the account by 10% if you're trading 1%, but if you lose 10 trades in a row, and I recommend 10%, 5 to 10% of your account if you're more experienced, because 10 trades, then you could destroy your entire account. But you shouldn't be losing 10 trades in a row realistically. Now, research and information processing. The gambler's information flow. You don't want to be trading like a gambler. So the gambler prioritizes novelty and social proof. Over objective data, information is consumed for emotional validation rather than strategic input. There's a reason why God says don't gamble. Gambling is wrong. Okay, it's bad. It's the reason why is because you don't have any jurisdiction in it. Okay, you're not trading with any logical output. You're not making monetary decisions with any logical output behind it. Okay, just throwing your money into the void, hoping for the best. This is not what we want to be doing. So hearsay and media hype. So they trade based on unqualified tips, sensational news stories, or expert predictions on cable television. Don't trade like that. Do your own research. Hop on your charts, hop on your broker, make your own analysis and decisions. And superficial charting. They may use rudimentary technical analysis. Okay, so you might draw random lines, okay, but ignore volume, market structure, or context. And their analysis is descriptive, not predictive or actionable. Okay, so you can go ahead and mark out something, right, that may look bullish on the 15-minute, but then on the weekly time frame, it's a whole different story. Okay, so you can't just look at one time frame either. Don't trade like that. Don't just look at one view. Look at the whole global perspective on every single time frame, and then make your decision. So lagging indicators. So you can only get in indicators after price has already done its thing. So indicators are going to be pretty late. And getting it late is not always going to be a bad thing. Sometimes it's going to make it more confirmed within a trend scenario. But getting in certain indicators is just, it's not going to be it. Okay, like MACD, for example, it's very late. A lot of indicators are just pretty late. They can be used for confirmation, but you don't want to be relying on that. Okay, understand how the wicks work, support and resistance, and read how the chart needs to correlate. So the discipline trader. So the discipline trader uses a multifaceted, systematic research process to validate setups that align with their quantifiable edge. Okay, know what you're getting into. If you're going to trade break and retest, you're going to trade some break and retest. If we're going to trade reversals, you get in a reversal. Okay, and get some data behind it. Study your setups, back test it, paper trade it first. Make sure it works before you start putting money into the market. And the discipline trader is going to utilize a blend of TA, technical analysis. You can go ahead and look at your patterns. If you're looking for break and retest, put your volume into play, make sure it's something people trade, and look at the momentum. Okay, see how it's moving. And relevant fundamental analysis, see if it's a profitable stock, see if it's something that trends heavily, to really form a complete picture. And track the events too. Know when earnings is going to be too. You don't want to get into a trade and the earnings is the next day. Okay, that's going to be a form of gambling. Make sure earnings is pretty far away and then make your decision. Even if you're a long-term investor, wait till earnings happens first and then go ahead and get in. And they're going to always be on top of the economic data releases or any stock or company releases that's going on, or any type of negative news that could affect the price movement as well too. Okay, you can convert to couple of news sites which lets you fact it, like forexfactory.com. You can fact check and see all the news and the data reports and put that into correlation. And that helps a lot with futures, for example. And TradingView, for example, shows you all the stock news, and a lot of brokers do too. And look at the market structure. Focus on the who, what, where, and why of market movements. Why is price making resistance here? Why is price making support here? Okay, ask yourself these questions before you get into the trade. Put everything together in your brain, lock it in, and then go ahead and make your trade. And work on the directional bias of the higher time frames. Be like, okay, I want to get in the trade here because of X, Y, and Z, and then make your decisions. And the trader's analysis really answers, okay, why do I want to get in here? Okay, what's my maximum loss? And I understand we're on the charts trying to make some money, but don't lose yourself, okay? Take your time, build up your capital, be disciplined. Because if you full port your account in one trade trying to make some money, you're going to be wishing that you were disciplined and you took your time. So I'm telling you guys, being disciplined is going to be the most worthwhile decision in the long run. So impulse versus automation. So the gambler is going to be trading based off of impulse. You got to pretty much be a robot if you want to be a successful trader. So the gambler is going to be chasing the market, entering super duper late on big giant candles, getting in the trend late and just missing the whole thing. Okay, and getting pulled back on, getting wicked back on, and just living in drawdown. And they often buy at the high or sell at the super low after the move is already completed, catching the final remaining scraps and pieces. Okay, so revenge trading. After a loss, they immediately enter a new larger position to win back the money. And this is the fastest way to accelerate capital loss. Okay, don't do that. Okay, don't do that. If you take your loss, you gotta get off. Okay, plan yourself a better trade. Be like, what? Why did I get into this trade? Did this trade really make sense? Okay, and if it did, okay, cool. Accept that loss. Take a better one. Okay, or try again. Play something with better volume. Okay, there's probably some reasons why the trade didn't work out. Because if you notice, once you start playing S plus setups, they're gonna work out a large percentage of the time. Not every time, but a very, very, very large percentage of the time. So ask yourself, why did I lose before you just get in the trade again, trying to make some money back? And keep a record too, okay? Know how much you're making, know how much you're losing, know how consistent you are, because it's really gonna help you go back and see, well, I've been slamming, well, I've been crushing it. And a lot of brokers keep track of that, but you guys can keep track of it too. So the discipline trader, you gotta be like a robot in the game. You gotta get up, be a robot, okay, grind. And the most disciplined person, the most robotic person when it comes to keeping their emotions stable is gonna win, okay? You can't be letting fatigue, emotions, anger, fear, anxiety, and none of that get to you. Okay, you got to be a boss, stand on business, and get to it. And execution is for a disciplined trader, and it's robotic and unemotional. And the moment the trade is entered, all necessary parameters, the stop loss and the target, are set. And strict adherence. Traders are only taken when the market offers a setup that perfectly matches the criteria in the written plan. Okay, the edge. And let's talk about the trade journal. Every single trade is logged with the entry, exit, reasoning, psychological state, and a chart screenshot. And this data is used to iteratively improve the edge over time. Okay, you can go back, be like, whoa, okay, I was crushing it here. Let me stick to this. Why am I changing it up? Let me invest into this. Okay, this led me to a positive equity curve at the end of the year. Okay, let me stick to this. Okay, it's gonna help you guys keep your data, and you're gonna have a positive expectancy focus, wanting to crush your goals and be a better you, and just be better every single day. And you'll understand that the goal is not $10,000 profit today, but the statistical certainty that $10,000 will be achieved by repeating the process over a period of growing your seed, stacking wins, stack mode. Okay, take your time. Okay, it's not a race, it's a marathon, and be in the game for decades, years. Okay, don't just lose your account overnight trying to make a FOMO trade. Relax, be disciplined. I'm telling you, it's going to be worth it to be disciplined. When you're chilling on the beach, when you're driving in the Lamb, when you're doing what you want to do, when you're chilling in your house, okay, when you're put up because you stayed down and you were in stack mode, you're going to be cheesing hard. Okay, it's going to be worth it, inshallah. So let's say, for example, the trader reviews their journal and finds their system has an 80% win rate, okay, on Tuesdays. And they use their objective data to confirm their edge. Let's say news is on Tuesdays and they notice that the news correlates with their edge, and then they go ahead and keep trading that, and they find a profitable way to make some money, for example. And let's say the gambler, okay, they review their account statement, sees a negative balance, leading to frustration, more reckless trading, booting up their account more, whole check into it, okay, and just losing their whole mindset, okay, and not sticking to a consistent edge, which is going to help you grow your account over and over again, okay. Take your time. So, psychological mastery, detachment versus attachment. Trading is 80% psychology. I'd really say like 90%, okay? Because there's been times you can really give someone really good levels, and if they don't know when to close, or if they're greedy, they can still destroy it all, okay? So the final differentiation lies in how losses and profits are internalized. So the gambler, they're really attached to the outcome, okay? They have way too much greed. They're fiending to win every single trade, and they're very impatient, wanting to make a trade every single day too. You're not gonna trade every single day. It's not realistic. They close profitable trades early too, destroying the risk to reward because of the fact that they're scared, okay? It's why you gotta trust God, okay? Relax, okay? Only trade with what you're okay with losing. You're gonna be cool. Let the trade play out, and if you see something, believe in it. And they hold losing trades for too long, okay? Now, if you see your trades going in the opposite direction and it's way past your stop loss, okay, you could go ahead and close your trade, especially if it's way past your stop loss. You got to. Don't hold something that's clearly not gonna go ahead and reverse anytime soon. That's ego trading. And that's viewing losses as a personal failure or an indictment of their intelligence. And this fuels revenge trading and their need to prove the market wrong, which could lead you to throwing more funds into a loss. And mood swings. They experiences extreme emotional volatility with deep before on wins, okay, extremely happy, cheesing hard, jumping up and down. But then when they lose, crashing out, sad, okay. Be stoic. Whether you win or lose, just keep going. Stack mode, put 50% away, keep 50% in your account, keep stacking it up, keep going, go on to the next trade, okay. Keep getting richer, keep getting better. And the disciplined trader, they're attached to the outcomes. They have a sense of neutrality built into them. Okay, and you got to accept that a single trade is meaningless. Even if you make way more money on one trade than the other, that doesn't mean that that trade was better than the other. Did you stick to your process? Did you stick to your rules? Were you grateful? Okay, and stay humble after your wins. It's really going to keep you guys focused on the process, and which is really going to get you to the next level, inshallah. So the focus is on executing the edge perfectly, regardless of the P&L, profit and loss, and learning from losses. A views of a losing trade that adhere to the plan as a successful win, okay? So even if you didn't make any money on the trade, if you stuck to your entry plan, you stuck to your stop loss, you saw what you needed to see and it just didn't work out, that's a win. Okay, keep yourself mentally balanced, keep yourself mentally good, and understand that losses in life and on the market are just tuition for you to learn from experience and go forward, okay? And objectify, okay? They use if-then statements to govern their actions. If price has stop loss, then they're gonna exit. If price turns resistance into support and they're looking for a long, they're gonna enter. Okay, if price hits resistance, they're gonna exit. Okay, so you guys are gonna go ahead and have some parameters set. Like, you know, if price does X, Y, and Z, I'm gonna do X, Y, and Z. Okay, and that's gonna help you trade logistically, robotically, and play the chess moves correctly. And mental discipline is gonna be important. The disciplined trader sees a loss, not as I just lost $1,000, but I just incurred a 1R loss. You know what? It's okay, which is budgeted. I planned for this, and it's statistically necessary for the system to eventually produce 2R, 3R wins. Okay, so when you lose that 1,000, but then you make 4,000, you're not gonna be mad. You're gonna be like, you know what? I'm happy I only lost 1,000. I'm glad I didn't just risk my whole $10,000 account trying to make a whole play. Okay, because I just stayed within my risk, caught a nice trade, and I didn't blow my account even though I took a loss, and I made it back the right way. So don't be a gambler. Gamblers are driven by emotion. Don't be drinking alcohol. Don't be doing nonsense. Don't be trading with the mindset of, I'm going to come on and make some money. Nah, come on with the market and be like, you know what? I'm going to make some good financial decisions. I'm going to come onto the market. I'm going to enter because I have some logical parameters on why I'm about to enter. I'm going to enter because support is at this area here. You know what? Price doesn't want to go below here. This is safe. Let me go ahead and take this trade here. Oh, resistance just turned into support. Let me take this trade here. Okay. Take the money out of the picture. Focus on the charts. Take your focus off the P&L too. Okay. Get your eyeballs off the P&L. Don't be staring at that. Look at the chart. And the disciplined trader, focus on statistics. Focus on getting better. Okay. Understanding that the ability to even trade in itself and make some money just looking at the screen is a blessing. Okay. Straight from God. God is great. Okay. So let's go hard. Let's keep going. Let's keep pushing harder than ever. So don't focus on the money. Professionals focus on the process, the discipline behind it. And to succeed, you must first manage your risk, and only then can you manage your profits. Stay prayed up to God, keep grinding, and head over to Stackmode.net for all trading education. Catch you in the next one. Peace. Hey class, we're going to be talking about the future of cryptocurrency. Let's go ahead and let's break down Web3, AI, and the interoperability of the whole blockchain and decentralized technology space. Let's jump into it. So let's talk about Web3. It's the ownership revolution. So Web3 is the next evolution of the internet, and it's characterized by decentralization and user ownership of data and assets. And it's the big shift from renting to owning. So right now, we currently use the Web2 system, and it's run on centralized platforms like Google and Meta, and they own your content and data, which is susceptible to hackers and certain things like that as well. But Web3, what the future is going to go ahead and concur. Users own their identities, data, and digital assets via NFTs, tokens, and the blockchain decentralized system, which means that transactions have to operate via autonomous codes called smart contracts, instead of a centralized system like banks, where transactions have to be confirmed by a centralized intermediary. And the transition empowers individuals and reduces reliance on large tech intermediaries. So decentralized finance, also known as DeFi, it's financial service uses smart contracts systems without banks. Okay. And DAOs stands for decentralized autonomous organizations, and their governance run by code and token holders. So Web3 is a really, really big shift. It's putting power back into people's hands. So instead of having your money being declined, let's say, for instance, you wanted to send money to someone in a different country. Let's say they built your website, for example, and, as online business increases, people from other countries are also going to be participating as well too. And quick way in order to send transactions, invoices, whatever is cryptocurrency, okay? Without any intermediaries, no fees, no wire transfer fees, and no ability to get declined. You try to send like $1 million USD to someone in Thailand, bot, right? It's going to be a lot different, okay? You're going to run into fee issues. They might think that it's fraud, and it's a large chance that the transaction just won't go through. Okay. But whenever you're sending it via cryptocurrency on the smart chain system, it's not worried about that. Everything is automatically being run through. Think of it kind of like a vending machine. When you go up to the vending machine, you put in that dollar, you get what you want. Okay, that's how cryptocurrency works. But when you go to the drive-through, the person has to hand you the food. Okay, the person could drop the food. The person could do a lot of stuff to the food. Okay, they could crumble up the food and throw it away. There's a lot of stuff that can happen. Okay, but if you go up to the vending machine, you put in your dollar, you're gonna get that. Okay, so it's up to the person whether or not they really want to give you your food, even if you paid. So that's the traditional centralized system. But decentralized is gonna be the vending machine system. If you put in that dollar, it's going to automatically give you whatever you selected. Okay, it's a lot more efficient, it's quicker, and no deception or human emotions can even cultivate in the existence of your transactions. Okay, and you're dealing with money, you're not trying to be worried about getting your transaction declined. Okay, you're a human being, you got stuff to do, you got bills to pay, I'm sure you have people to take care of. You're trying to get from A to B. Okay, so cryptocurrency is going to be a good place to run transactions and large invoices relatively quickly. So doing big deals via cryptocurrency is going to be a really, really good way to quickly do transactions without having to wait for banks to confirm it, freeze your account, etc. So interoperability. All right, let's go and let's talk about breaking down the walls. So blockchains currently exist as walled gardens, and the future requires them to talk seamlessly. So the problem fragmentation, a part of it. So assets and data are locked onto the native chain, so such as Ethereum and Solana. And high friction is involved when moving tokens between the chains, and developers are limited to one single ecosystem. Okay, but as time progresses, as more development and coders implement different types of technology in order to make things more efficient, I can see things changing within the future. And users have fragmented digital identities across different chains as well too, making it extremely secure. So the solution, crisscross communication, and protocols are building bridges and standardized layers, also known as layer zeros. And bridges allow asset transfers, okay? So whenever you're trying to swap a meme coin, for example, let's say you hopped on Phantom Wallet, Coinbase, whatever, okay? If you're gonna go ahead and get Pepe the Coin Frog, right? In order to purchase Pepe the Coin Frog coin, you need Solana first, okay? So Solana is gonna be the first asset you're gonna need in order to buy a meme coin, for example. And that's gonna be a bridge. And layer zero is gonna be the infrastructure, like Cosmos or Polkadot, for example. And it's designed to connect independent chains. And the goal of it to provide a single fluid digital economy where value can move instantly and people can get what they want. So let's say, for instance, if you wanted to exchange USD for, once again, Thailand's currency, right? Thailand's currency is going to be bought, for example. Okay, let's say Swiss, okay? Or if you wanted to exchange Thailand bot for the Swiss franc, okay? Say if you're swapping certain things like bot from USD currency, then the bridge is going to go ahead and what's to be allowable with the asset transfer class. And layer zero, that's going to be the infrastructure like Cosmos, Polkadot. And that's designed to connect the independent chains and link everything all together. And the goal is for really to provide a decentralized space where it's single, fluid, and it's a digital economy where value can move instantly and people can exchange for what they want. So if you're going to the currency exchange, it could take some time. There could be fees and quite some other things involved when exchanging one currency to the other. You're also going to need another bank account system. Okay, in some cases too, if you're not getting all cash, and just a way to go ahead and spend that other currency as well too. Whether you're just getting a cryptocurrency card, you're going to be able to spend that all across the world as long as they take Visa, for example. Okay, so if you were to get like a Coinbase card that provides Visa or certain other brokers provide it too, then you can use that all over the world and use that to spend money. Okay. And AI and crypto. Okay, AI can monitor blockchain data for anomalies and instantly detect fraud or exploits of smart contracts. So certain things too, like bank hacks, can be susceptible due to certain errors, okay, and things like that. Certain transactions that could be completely legitimate could be declined, okay, due to human error as well too. But when everything is being dealt with via the smart contract system and AI, everything's going to be a lot more automatic and things are going to be seamless, okay, transitional, and stuff is not going to be as barrier locked. And AI models manage vast liquidity pools, optimizing lending rates, and they execute complex low latency strategies, implementing quick transaction swapping too. Okay, so even if you do $1 billion transaction from one person to another, it's all going to be automatically calculated, and it should be in one person's wallet within a couple of minutes or hours. And autonomous DAOs, and AI can automate repetitive governance tasks, and it deals with the treasury management, proposal filtering, and it just makes DAOs more efficient. And AI becomes the intelligence layer running on the decentralized foundation of Web3 in general. And the converged ecosystem, so powering the future, and universal access. Let's talk about interoperability. Developers build once, deploy anywhere, and utilize liquidity and user base across every single chain. Okay, so whoever's developing a token or enhancing the Web3 space in general, everything is going to be seamless. Okay, and when it's on the decentralized space, it's power back to the people. Okay, once again, that's what we talked about. And dApps, they evolve their own functionality and security protocols based on real-time data analysis. And users can also retain sovereign control over assets which interact with intelligent cross-chain applications. And this trio of systems creates an internet that's smart, seamless, and owned by its users. Okay, so instead of transactions being declined, instead of superpower or someone being able to control a whole pot of the pie. Everything is being dealt with power of the people. AI is really going to keep everything stable and safe. So no human superpower can take over one area of the finance space. Okay, so Web3 is going to bring fairness back to the global economy. And Web3 is the foundation. So the blockchain provides trustless ledger for ownership and transactions and a safe place to keep your money stored as well too. And interoperability is scalability, and the ability for chains to connect determines the speed of adoption and utility in general. And the next generation of innovation lies at the intersection of decentralization and machine intelligence. So if you want to learn more about cryptocurrency or the whole decentralized finance, DeFi, or blockchain space, head over to stackmode.net, step right up to God, keep browning, and I'll catch you in the next one. Peace.
What's going on, class? We're going to be talking about options mistakes that we just have to avoid, inshallah, if God wills. Okay, we don't want to be destroying our portfolio, destroying our future, destroying our dreams of buying the house, buying the car we want, living how we want, paying all of our bills and clearing our debt, etc. Okay, avoid these mistakes to avoid destroying your future. Okay, we got people to protect and provide for. Okay, and even yourself, you got to provide for yourself. Okay, so let's go and let's jump into the mistakes that we just absolutely have to avoid. Let's jump into it. So mistake number one, having a gambler's approach. So one, you gotta know how options work, okay? You gotta know what you're doing. You gotta know what expiration date you wanna buy, etc., okay? So the problem that people have when they come onto options is that they see people posting, okay? They see people making big flips, big giant profit flips, etc., and then they're like, whoa, options is gonna be crazy. And they come on with a lack of information expecting certain results. So don't have a gambler's approach, have a logical approach. Know where you're going to close at. Okay, if you're going to take a long trade, okay, you should know that you should be purchasing a calls contract. Okay, if you're going to wait for an area of resistance to be broken and turn into support and then take it up to the upside, then close at an area of resistance. Know where your take profit's going to be. Know where your entry's going to be. And most importantly, know where your exit's going to be. Okay, don't just hold your trade forever and cook your trade past certain areas, because there's going to be a lot of things that come into play with options, such as theta. And theta is going to be part of what's called the Greeks. Okay, and theta controls time. Okay, so theta controls time. So keep that in mind. Okay, so there's going to be things we can do to get past this. So have a good time horizon. Okay, even if your take profit isn't that many points away, try and buy contracts at least, I'll say 3 months to 2 years out. Okay, and that's going to be called a leap contract. Okay, you want to be buying leap contracts. Okay, you don't want to be buying 0 DTEs, you don't want to be buying a week out, etc. Okay, due to the fact that you're going to be fighting time. Even if you're right, you're still going to be fighting time. Let me tell you guys a story. There's been times where I made $900, I think $30 in a day. Okay, I hedged on a Jay Powell speech. Okay, hedged on a Jay Powell speech, and I was up. I told myself I had a 0 DTE SPX contract. Okay, if you've ever played SPX, it tracks the S&P 500, but it's just a really boosted up version of it on options pretty much. Okay, compared to the SPY. So I had SPX contracts. They were boosting up. I'm up around $930. I'm thinking I'm going to hold all day, not understanding how theta works, not understanding how the time works on the options. So due to me thinking that, came back to the trade, and the trade was then in the negatives. Okay, so I went from up being almost $1,000 in a single day to coming back negative a couple hours later. Okay, due to the fact that I got eaten up by theta. Yes, the trade continued in a certain direction, but as the day decided to decline and go on a further downtrend, okay, the market decided to flatten out, killing the 0 DTE contract. Okay, so if a transaction that you buy for a contract is looking to expire on the same day, okay, you can't expect to hold for a long time. You can't see your trade out the way that you want it to. So make sure you guys are buying at least 3 months to 2 years out. Okay, it's gonna really, really be important. And having a gambler's mindset is gonna be the most fundamental error. And options trading offers high leverage, okay, due to the fact that an options contract, it lets you play with 100 shares.
Okay, keep that in mind. So options trader offers high leverage, which attracts speculators. Okay, speculators is when you're playing off directional bias, and on options, that's how you get paid. Okay, you're getting paid based off of choosing the right direction. So if the current price is going to be at 50, you think price is going to go to 52, okay, and you buy a 51 or 52 strike price contract and price hits there, you're going to go ahead and make some money, inshallah, if God wills. Okay, so that's how it works. So anyone who treats options though like betting and has a lack of repeatable tested strategy means that your results will be entirely random and often negative by the end of the year. And why it fails. Okay, you could have inconsistent and entry exit rules. You got to know where you're playing at. You got to know why you're playing. Okay, ask yourself why and where when it comes to the market. Okay, where am I going to close? Where am I going to enter? And why am I going to enter? Ask yourself these questions before you press buy or sell. And traders enter on a hunch, right, and exit based on panic or greed sometimes, leading to inconsistent P&L, profit and loss. When you're just closing wherever, you're destroying what's called your risk to reward ratio. Okay, so if you risk $100, you want to try and at least be making $400 or at least $100. Okay, so then you would double your money. Okay, so 100 plus 100 is 200. Okay. So, put that into mind and do your risk to reward. Okay, you can play 1 to 2 risk to reward, 1 to 3, okay, 1 to 4. Do your math. So, but just try and at least make your return back. Whatever that you risk, if you risk $750, try and make at least $750 back. Okay, so that's going to be a really a 1-to-1, I'll say. Okay, just try and make at least your risk back. So, and journal as well too. Okay, put your trades in the Discord and your notes, your physical notepad, whatever you want to do. Okay, I'm creating the Stackmode app, generating it right now, where you guys can go ahead and track all of your trades as well too, coming up very soon, inshallah. So, you can have some emotional decision making can happen sometimes in the market. Don't do anything that you don't need to be doing. If you're invested heavily into a shares play, okay, don't just pull out your money. Okay, keep it. Okay, if you believe in your view, if you believe in your trade, you can't be disrupting your process because you want to take out some money and be hasty and do something real quick. Go grind and go get some more money. And when it comes to pure candlestick formation, if you see market just going a big upwards direction, a big burst, and you don't have any logical plan around it, no area of resistance where you want to close at or support above current price or any type of plan behind the trade, just don't take it. Okay, and the solution, right? Define your edge. Okay, figure out what you like. Okay, do you like calls? Okay, you know that market's going to be an upwards trend. There's a reason why market goes in upwards direction. They put jobs in the economy, and the company pays taxes, okay, which feeds the government, okay, and then the government can help the people, and it's a big cycle. So there's a reason why these stocks want to go up in upwards direction. So choose for focus. So ask yourself, are you an income trader? Okay, do you like cover calls and puts, or are you a volatility trader? Where you like straddles and strangles? Okay, stick to one initially. And never enter a trade where the potential loss exceeds the potential gain. Okay, just don't do it. It's not really worth it at all. Okay, take your time. Okay, make sure you guys are getting at least try to get at least a 1 to 2 risk to reward ratio, 1 to 3 risk to reward ratio, and at least a 1 to 1. Okay, never try and go negative with certain things if you want to earn on a good trade. Now, if you lose, but try and make some money on your trade. Try and go for at least a 1 to 3 minimum if you want to start growing your account. And specify the maximum duration that you want to hold for, okay? Because the longer that you have, the more of a risk to reward that you can get, because you can have bigger take profits. You can use your higher time frames to look at your take profits, okay? You can use your weekly time frame, your daily time frame, your 4-hour time frame, and set take profits weeks and weeks and weeks away. Grind in real life, wake up, pray to God, go work out, keep building yourself, keep working on yourself, and then boom, trade hits, take profit, take the next play, take the next play, take the next play. Since you've been working on yourself so much, then inshallah, if God wills, you have some more capital. Put that into the next play and just keep going hard. So we'll talk about the Iron Condor. So a structured strategy is like the Iron Condor. Okay, it's a non-directional, and it relies on the stock not moving too much, meaning expecting it to go in a flat direction. Okay, and your strategy must detail how far out of the money you place the wings.
the expiration date, and the precise profit target, for example, 50% max profit, and where you would close the trade regardless of the market movements. Okay, so keep everything in mind like that. So mistake number 2, right? The silent killers. Let's understand theta. Theta pretty much just equates to time. So options are decaying assets. So as soon as you buy it, it has an expiration date. You can hold shares forever, but options are leveraged. So if you're right in a certain amount of time, you will get paid. And options are decaying assets. And unlike stocks, time is going to be an enemy to the buyer and a friend to the seller. The rate of decay is known as theta, and it accelerates rapidly in the last 30 days before expiration. And the theta trap for buyers. Okay, sometimes there's going to be a steep decay curve, and an option may lose 20% to 30% of its value in a final week due to theta, even if the underlying stock price remains favorable. And buying too close to expiration. Trying to maximize leverage by buying 0 DTE, all right? And 0 DTE means 0 days to expiration. It'll expire at 4 p.m. Eastern time, New York Stock Exchange time, and then can't be held overnight. And you have to reopen it again. Okay, or 7 DTE. Options increase the risk of total capital loss exponentially. And the implied volatility rate, crush. The implied volatility measures market expectations of future stock movement. And options prices surge when the implied volatility is high, usually before earnings reports or major news. And if you buy an option high IV, an expected event passes without a massive move, the IV would crush, causing the options value to plummet, regardless of the stock's minor price change. And some practical fixes. Options bought with the 45 to 60 days to expiration offers a better balance between theta decay and market responsiveness. And if your IV rank is high, right, say above 50%, consider selling the options. And strategies like spreads, okay, are going to be in the play too. And if IV rank is low, it's generally better to buy a premium in general. Okay. So, mistake 3, the blow up risk. So using too much of your capital on a single trade. So make sure you guys are trading between 1 to 10% of your account per trade, okay? And choose whatever percentage that you want and just stick to that, okay? Don't over leverage. Even if you hit a big giant chunky play, you make the most money in the world, okay? Stay between your risk parameters, okay? If you have $1 million, then the max that you ever want to trade with is 100,000, okay? You need to be doing it like that, okay? Break it down, okay? Break it down. Or I'll say 10,000. Yeah, 10,000, and break it down like that. Okay, decide how you want to trade and how you want to grow your portfolio. So options provide phenomenal leverage, which is their double-edged sword. And a beginner often uses 50 or 100% of their available capital on 1 or 2 trades. Now, if you know what you're doing, you're depositing your money in certain ways, like, okay, I'm going to use all this money for options, then that's different. Okay, but booting up your account, where you have shares and everything, and then just showing your account on a couple of trades or bad decisions, it's just not. Okay, so believe in the high probability of return justifies the risk. And this single mistake accounts for the fastest depletion of trading accounts. Okay, please do not overexpend your risk. Take your time. Do not use too much capital over your trade at once. Okay, spread out your trades and grow the wealth over time. Get rich slow. Okay, it's important to take your time. It's important to just stay down, wake up, pray to God, and just grind. Okay, keep putting the money away, keep investing, and I promise in a couple of months, the play that you're investing to, whatever, okay, just give it time. Inshallah, it'll pop. Okay, you have to give it time though. You can't rush by trying to use your whole account unless you structure your account like that. Okay, but if you know that you're trying to keep your account alive, don't just put it all into one giant trade. Try and spread it out. Diversify a little bit. So all of your capital can't just be tied to one underlying asset. And if that asset faces unexpected news, the entire account can be at risk. And sometimes there could be margin calls on spreads. Now, selling options or spreads without sufficient collateral means a sudden unfavorable move can trigger a margin call, forcing liquidation at a loss. And trading the farm. So risking more than 5% of your total account value on any single trade is mathematically unsustainable. Okay, so you could do 5 to 10% if you want, but 1 to 5% is going to be strong too, as a short losing streak could really wipe you out, honestly. Okay, but if you're losing more than
if you lose 10 trades in a row and you blow your account, then yeah, I understand how you could lose 10 trades in a row, but 5 trades gives you a lot more trades. Okay. So the 1% rule of risk management. So the gold standard, right? Never risk more than, I'll say, 1 to 5% of your total trading capital per trade. And these mean that if your account is $10,000, your maximum potential loss in your position, it should be around $1,000. Okay. $1,000 if you're doing 10%, or it should be $500 for 5%. And this ensures that you can sustain a long sequence of losses while preserving your capital for future high probability trades. And this is for you to have protected stocks, choose trade structures with limited risk, like defined spreads, and trade smaller and with more manageable positions. So calculate your max loss as well. So before every trade, determine the absolute worst case scenario and ensure that your trade is meeting the 1 to 5% rule. Okay. So keep majority of your capital in cash if you're not sure that you want to trade, and then you can deploy your positions when you take your time. So mistake number 4, right? The hope and pray method. Okay, we wake up, we pray to God every single day, but we can't just make horrific, horrible decisions. And bad traders set a trade and then just ignore it. Okay, we gotta know where we want to close at. Okay, you can't just hope the trade is gonna work out. Okay, you gotta have a logical plan before the trade is even placed out. So make sure that you have a highly active process that involves a strict entry, exit, and stop loss criteria. And don't hold your winners too long. Close at take profits. So letting a trade run all the way to 100% max profit is rare and inefficient. You expose yourself to accelerated theta and assignment risk for a minimal additional gain. Okay. All right. So we pray to God every single day. Okay. We ask for hope. We ask for strength. And we're going to ask for wisdom to not make bad trades. Okay. We don't want to be buying at all-time highs and then expecting it to go up. Okay. There's certain things. Okay. Take Jesus, for example. Jesus did not jump off the cliff. Okay. Due to the fact that just didn't test God. Okay. So there's certain things that we just don't want to do as human beings. That's just a bad decision. Okay. We want to pray for wisdom. So cut your losses too. If you know your trade isn't going to work out, if you know you need to chop it up, chop it up. Don't hold past stop loss, especially on Forex and futures. Get margin called. Okay. So take your profit too. Take profit at certain places and make sure that you guys know what you're doing. And the unforeseen cost, okay, ignoring regulatory and tax complexity. So the IRS and other tax authorities, right, treats options differently than stocks. Furthermore, the risk of assignment or exercise of an option can create unexpected financial obligations, especially when dealing with short sold options. So the tax headaches. So certain options like those broad-based indices such as the SPX or NDX are at a tax beneficial of 60% long-term and 40% short-term rate, regardless of the holding period. Okay, and this is the macro factor ignored by many traders, so keep that in mind. And trading options can easily trigger complex wash sale rules, preventing you from deducting a loss if you reestablish a similar position too quickly, leading to unexpected taxable gains. And avoid risk at expiration. So when you're selling options, there's always a risk that the options holder will exercise it, forcing you to buy for a put or sell for a call. And the underlying stock, this could be especially dangerous when a stock closes exactly at the strike price. Okay. And for the solution for that, always close short options, even those worth just a few pennies, before market closes on expiration Friday to eliminate assignment risk if that's how you're selling options. And the tiny commission is going to be worth avoiding the overnight risk of being assigned thousands of shares of stock. So some key takeaways, right? Develop a mechanical, repeatable trade plan with defined entry and exit and management rules so you know what you're doing whenever you're putting down some size. And respect theta. Theta means time in options world. Can be mindful of the time decay. And trade strategies that benefit from high implied volatility when selling and the low implied volatility when buying. And adhere to strictly to 1 to 5% maximum of your account, okay, per trade to protect your capital from inevitable losing streaks. And you can close soon winners. Okay, you could trim Okay, make sure you guys know where you want to close your trades at. Okay, set take profits. Okay, if you have 10 contracts, make it to where you can close 6 contracts at this area, 2 contracts at this area, 2 contracts at this area, if that's how you want to play it. Okay, and know the rules. Understand the tax benefits of Section 1256 and actively manage assignment risk by closing short positions before the expiration. Trading is a marathon. It's not a sprint. Okay, stay prayed to God. Keep grinding. You can't give up. Okay, whenever you feel like trading's hard, when you feel like you want to give up, you got to keep pushing. Okay, you got to wake up, pray to God, ask for wisdom, ask for strength, and keep persevering. Okay, I don't care if you blow in your account. Wake up, get 2 jobs, grow your business, keep grinding, keep making plays, and keep studying. Don't ever give up. Stay prayed to God, guys. Catch you in the next one. Allah is amazing. Head over to stackmode.net for all trading education. Peace. Hey, what's going on? We're going to be talking about the psychology of a crypto trader, how things go, and how we can manage our emotions and avoid FOMO. FOMO is going to be fear of missing out. And it's pretty much going to be like, say, for instance, a candle burst straight up, and you're going to be emotional. You're going to be excited to get in because you're going to be thinking money, 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 instead of thinking discipline, 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 discipline. So I'm going to be talking to you guys about how you can manage your emotions and turn those cringe emotions into discipline. So this is going to be a deep dive into the cognitive biases, emotional pitfalls, and some practical strategies we can do to maintaining mental resilience in volatile markets, such as the cryptocurrency one. Let's go. So the emotional roller coaster. The cryptocurrency market is a unique ecosystem, distinct from traditional finance, due to its 24/7 nature. So the stock market operates Monday through Friday, and same thing with Forex, okay? Forex and crypto, Forex, stocks, and futures, I meant to say, all operate Monday through Friday. Cryptocurrency operates 24/7. Okay, so whenever your levels get hit, as far as your take profit, say you're in a long trade, okay, and you're trying to close at an area of resistance above current price, okay, if take profit gets hit at 2 a.m. in the morning, you need to have your alerts set on your phone, okay? Your alerts are going to be a big use, okay? So what you can do is get on your phone, okay, or do it from your computer, whichever one, and just get the app of whatever brokerage you have, or get the TradingView app, okay, whichever one. Then from there, whatever stock that you're on, find the level that you want to close at, okay? You should know where you want to close at. You should know where you want to enter at, okay? And you should know where you want your stop loss to be, which is going to be a place where your trades is going to automatically close, okay? And you should know where you want to automatically close for a win as far as an exit. So if your take profit gets hit, you need to get up and close your trade, okay? You cannot be lazy when it comes to cryptocurrency. If you're deciding to play a 24/7 market, you need to be ready to 24/7 close your trades and manage your trade. Okay, so if you don't have limit orders set as far as stop loss orders and take profit orders set, then you need to make sure you're on top of it. Set your alerts and do what you need to do in order to succeed. So it's a lot different from the traditional finance system due to the fact that it's 24/7 once again. Has rapid price swings, and the influence of social media can make certain cryptocurrency coins or tokens or meme coins just skyrocket due to its popularity. And the more popularity something has, inshallah, a lot of the times the market cap is going to increase. Higher the market cap, people are going to trust it. Okay, the more trust something has, a lot of the times more value it's going to have, because people are going to feel more comfortable with parking tons of money within there. Okay, don't go into a state of euphoria whenever you're trading too. So even if you're making large amounts of money, okay, you're seeing your bank account go from $100 to $1,000. Let's say you held the trade for a good while. Okay, you're like, whoa, cryptocurrency, you did yourself a nice withdrawal. Okay, put 30% away for taxes. Okay, every time you withdraw, put 30% away for taxes. Whatever your withdrawals amount is, put 30% away for taxes in some different bank account. Okay, really 50% of that in a whole other bank account. Keep breaking down your money like that. So this environment amplifies human emotions, turning every price chart into psychological battleground. And understanding the emotional psyche of the market is going to be the first step towards achieving a disciplined mindset. Okay. So euphoria is going to be a state you can get into, especially once you start making money, just like I explained. So euphoria can be a state of overconfidence when prices start to soar within an upwards direction, often leading to reckless decisions and over leveraging. And it's the moonshot mentality that precedes a sharp correction. Let's talk about anxiety and fear. The immediate reaction to a market downturn, It's a psychological response to losing money, often triggering panic selling. Okay, so if you see market dumping down and you're in a long position, relax. Okay, if you don't have your stop loss set, okay, just understand that, you know what, I'm risked in for this. Okay, make sure you have your risk management in place and understand that drawdown might be inevitable sometimes. Okay, you're never going to just enter in and always see profit. Sometimes it's going to be drawdown, but by the time you close your trade, it should be in profit. The trade is only over whenever you close. If you're in drawdown, that's fine. Okay, make sure you mark your levels of support below current price or resistance and tell yourself, you know what, okay, if price breaks these levels, I'm going to go ahead and close. Okay, don't panic though. And denial. Now, if price decides to break your levels, you have to close, because that can lead to denial. And that's the refusal to accept that the market's falling, which causes you to hold onto a losing position in the hope of a miraculous rebound, or hodling with no plan. Don't do that. Okay, that's trading out of desperation, not of a logistical plan, and which is going to lead you to a cycle of despair, which is something I put myself in when I was being ego-driven and not learning from my mistakes instantly. And that puts you in the final stage where people sell at the lowest point of the market. Let's say they're in a long position and market decides to dump. Okay, people are just selling way past their stop loss, selling at the lows, and just blowing up their account, all because of the fact that they were overconfident in the first place. Okay, let's say they had a nice winning streak, thinking they were the best trader of all time, started taking some losses, couldn't really handle the stop losses, started doubling down. That could lead you to denial. Okay, denial could make you double down, put on more size than originally needed, and then you could lead into a cycle of despair, blowing up your account. Okay, so don't do that. Stay disciplined. Only thing that should ever change is the contract amount. Your setup criteria should always stay the same, no matter what. It should always stay the same. So fear, uncertainty, and doubt. All right, God got you. You're gonna be cool. Okay, even if you go back to zero, you can run it up again. Okay, you're not trying to go back to zero, but understand you can run it up again. So it's a powerful psychological tactic used to spread negative information and create panic in the crypto world. Okay, fear, uncertainty, and doubt often come from the form of news, report, social media posts, or regulatory rumors that intentionally mislead. Okay, so if you ever see like the little posts like certain amount of money was wiped out within the crypto market today or stock market today, ignore it. Okay, market is going to go down. Market has to go down in order for it to bounce back up. Okay, it's not just going to go up in a straight direction forever. Okay, price might want to come back and retest at an area of resistance below current price and sweep up higher, breaking new highs. Okay, it has to create liquidity. It has to gain ammo in order to break up further. That's all price is doing when it's going down. You have to think of it. People are in from like $100 too. So if price is at $100,000 and it dips down to $70,000, that's just people taking profit from whoever's in at $100 a share or $100 at value, whatever you're in. Okay. And this manufactured fear can cause otherwise rational traders to sell their holdings, creating a self-fulfilling prophecy of a market crash. And the whole time it's not. It's just leading to a new low that people are going to go ahead and buy who actually understand the charts. And if you want to understand the charts more, head over to Stackmode.net. So you can learn to differentiate legitimate concerns from baseless rumors. Check multiple reliable sources and question the motives behind sensational headlines. Now, if they said something like cryptocurrency is banned, okay, so that'd be really, really, really different. Okay, and stuff like that, where actual laws are in place, okay, then that news is different versus just like, oh, a good crypto market lost $3 billion in the market today. Market has to dip down. Okay, all this is people selling. So fear, uncertainty, and doubt exploits the human brain's natural aversion to risk, and we're wired to avoid danger, and a perceived threat to our finances can override logic. And fear, uncertainty, and doubt as a strategy. Large institutional players or manipulative groups can strategically release FUD to drive down prices, allowing them to accumulate assets at a lower cost. So once again, it's just people willing to just buy the low again. So for example, there's been a China ban rumor going around, and for example, people would say that China bans crypto. Okay, and despite being old news or misinterpretation of the policy, these rumors repeatedly trigger sell-offs due to widespread fear, and traders who sell based on this FUD often miss out on the subsequent rebound and miss out on the lows. Okay, so do your research and read the chart. Okay, don't just go off of news. Read the chart. And FOMO is perhaps the most dangerous emotion for a crypto trader in the first place. It's the anxiety that an exciting or profitable event is happening somewhere else. And it's a feeling driven by the fear that you will miss out on a significant opportunity. In the trading, FOMO often leads into buying an asset at its peak, just as its price is about to correct. So a primary driver of FOMO is social proof. Okay, don't hop on a trade just because you see your friend hop on a trade. Do your research. Make sure it's something that you would get into. Make sure it's a trade you would make. And a primary driver of FOMO is when you see others celebrating their gains on social media. You feel a strong urge to join them, believing their success is a blueprint for your own. And the urgency trap, the feeling that you must act immediately, now, today. And the price chart shows a vertical ascent, creating a false sense of urgency, overriding the logical process of market analysis and risk assessment. So you don't got to trade every single day. You don't got to trade immediately. You can wait for a certain level that you want to. Get in there, do your thing, take your time, be patient. And scarcity. Okay. Now, Bitcoin, for example, is going to be a limited resource. Okay. So the idea that a particular asset is going to the moon and you need to get in before it's too late is going to be a powerful psychological trigger. Okay. So Bitcoin is going to be a good example of that. It's kind of like a gold or diamond. Okay. That's just digital. So that's all Bitcoin is. It's kind of like, yeah, digital gold and diamonds. And it's just a limited resource. Yeah. But certain other meme coins example might be trying to trigger a rally. And during a meme coin rally, a trader might see thousands of posts from different people. Sometimes people hack influencers. Sometimes people run ads that are paid ads, okay, in order to spread the meme coin. Okay. And I've spoken with these individuals. Okay. It's not something that you want to get into. Just invest with things that have a future, market cap, and companies involved into it. Try not to play meme coins. I don't recommend it at all. Okay. So with meme coins, the investors, you can also see a large percentage of the pool who's invested into it. Let's say the people who created the meme coin, they own 60% of it. So what they're going to do is get in at the bottom. And by the time the meme coin goes up, okay, by people getting in, by the time ads explode, by the time influencers start posting, etc., they're going to be up a crazy profit. Because remember, this is the left to right chart. So they're going to be in from the start, the jump. So since they're in from the jump and you get in at the highs, they're going to go ahead and sell. And since they own 60% of it, they're a whale. Okay, and what a whale is a shareholder with a lot of value. So since they own a large percentage of it, if they sell, it's going to go ahead and dump too. Okay, so by the time they make bread, and it's trading. So if someone's making money, someone's losing. And if someone's losing, someone's making money. So whoever got it at the highs, by the time they said that the meme coin would be decent, would go ahead and get what's called rug pulled and pulled back on. Okay, and the people who got it at the bottom, who created it, who own a majority of it, would go ahead and make money. So a trader might see thousands of posts from people, okay, trying to make it seem like the best investment of all time. And it's not. Okay, do your research on actual things that help the future out, that help people out, and try your best to invest into that. Not meme coins trying to make some quick bread. So loss aversion and sunk cost fallacy. So these are two cognitive biases that are often intertwined with each other. And loss aversion is the psychological tendency to prefer avoiding losses over acquiring equivalent gains. And for a trader, this means the pain of losing $1 is far greater than the pleasure of gaining $1. Okay, so you're not even feeling your wins, okay, but you just want to keep losing. Okay, so you want to keep losing due to the fact that you're not satisfied with how much you win. Okay, so sometimes you might make some money within the market, right? And I've had some traders be like, you know what, it's not enough, and keep trading, keep trading, keep trading. And then the loss comes, and then they're super salty. It's like you were already up bread, but you just weren't satisfied with it. Okay, and the discipline and the consistency is what's going to get you to be satisfied with your P&L. If you don't like the numbers you're seeing right now, be consistent for a couple of months, and they will change, inshallah. Okay, so the sunk cost fallacy is also the belief that you already have invested a certain amount of time, money, or effort into an asset, and you should continue to invest in it, even if the asset is clearly failing or not a productive asset. Okay, don't do that. Don't hodl. Invest into a position that you know is going to have some future value, and hold it until your take profits get hit. Once your take profit get hit, go ahead and close. And have your stop loss set. No, you know what? If price decides to go to this level, I'm just out. And loss aversion in action. Holding on to a position for months or years, hoping for a return or break even, this prevents capital from being reallocated to a more profitable asset. Okay. So this money could be going into something that's profitable, something that's actually holding some future value and helping out in society and human beings. And you can go ahead and make some breakthrough there. Okay. So money is going to be available through the future. And sunk cost fallacy, let's talk about an example of it. So for example, let's say you were down 50%. Okay, and then you say, well, you know what, I'm already down 50%, so I might as well hold. Okay, I remember our first trade ever. Me and another person I started to trade with, we making like 3 figures a day, like $500, $400, like our first trade, completely oversizing and stuff like that, just playing some spy zero to T. And I remember the one time we held our trade down to negative 100%. Okay, and if you're on options, you know that means the contract goes worthless. Okay, and when that happened, we were extremely shocked because we were just making good money. Yes, we didn't know how to withdraw and stuff like that. It wasn't on a logistical system, so of course the money just went to zero. Okay, so it went to negative 100% for contracts. And I remember I was outside getting some work done on my car and looking at the position, and I was like, okay, you know what, the money was already gone. So, and I remember seeing like, you know, I'm down, let me just keep holding in case it sweeps up. And little did I know, it went to negative 100%. So that's not going to be the mentality. Okay, unless you size for that. Okay, let's say if you're on options, for example, the contract costs $70, you're okay with losing $70. Okay, then that's different. But if the contract is $300 and you only want to lose $70, and it's $70 stop loss gets hit and you don't close and then you lose $200, you're going to be mad. Okay, or sad. Okay, don't let that happen. Just follow your rules. Okay, follow your rules. Follow your rules. Because this rational thinking ignores the money that's already gone and that's holding an unprofitable asset. Okay, and manage your emotions. Here's some practical strategies. Okay, pray to God you're on the charts clicking buttons and being able to make money on the screen. Okay, so be grateful and don't lose yourself. And combating emotional trading requires structured and disciplined approaches. It's not about eliminating your emotions. We're all human beings. Only God is perfect. But it's about controlling your emotions and preventing them from dictating your decisions. And here are proven strategies to build your mental resilience. So once again, pray to God and be thankful that you're able to make money on the charts in the first place. And then develop a trading plan. If you're a retest trader, play your retest parameters. If you're a breakout trader, play your breakout parameters. If you're a reversal trader, play your reversal parameters. Okay, do what you need to do. Trade how you want to trade. If you're a trend line trader, trade your trend lines. Okay, do what you need to do. Okay, once you find your profitable strategy, go ahead and stick to that. Okay, farm it, run up your bread, but stay consistent. Okay, don't oversize. And if you're futures and forex especially, you don't want to get what's called margin called. And that's when you have to have a certain amount of money in order to open a position in the first place. And if you don't have that money available, you can get what's called margin call. So be careful and set your stop losses, especially on forex and futures, because if you get margin called, you can definitely owe the broker money, and you're not trying to owe the broker money or go to court for no reason or worry about the law. Okay. And do your own research as well too before you hop into anything. Okay, because if you get in a trade because someone else said it'd be good, you're going to be upset at them. Okay, so you can only be upset at yourself. Okay, do what you need to do and get in what you believe in. And the 24/7 nature of crypto can be exhausting, so set alerts, use time to your advantage, and step away from the charts. Okay, go grind bread in real life, go grind your business, do whatever you need to do in order to get some more comfortable, so then you can put some more money back into your account. Inshallah. And the power of journaling and mindfulness. So a trading journal is a critical tool for self-awareness. And it's not just a record of your trades, but a log of your mental state, emotions, and the rationale behind each decision. Reviewing this journey and over time, day by day journal helps you identify recurring emotional patterns and correct them. Okay, or see positive behaviors. Okay, positive or negative behaviors, either one. So log your thoughts, log how the trade made you feel, log how much money you made, log how you were thinking, okay, log how you were feeling, okay, were you feeling happy, were you feeling sad, okay, were you feeling pretty neutral after the trade, okay, depend on however the trade went, let me know in the comments below how trades normally go for you guys and how you like to structure your journal. So mindfulness and meditation. So these practices can train your brain to observe thoughts and feelings without immediately acting on them. Okay, this is why it's really important to wake up and pray to God. Okay, it's gonna bring a lot of gratitude, bring a lot of discipline, and just come on to the charts and come into the world with just a humble mindset. Okay, we can make 100 M's and we're still gonna come on and do the same thing every day and grind hard. Okay, like we have zero. Okay, we're still gonna be disciplined, still be hungry, and the only thing that's gonna ever change is our P&L. Okay, regular prayer and breathing can significantly improve your ability to stay calm and rational during market volatility. Okay, you can ask God for any assistance if you're feeling any type of anxiety. If you're questioning yourself and feel like it's not for you, you're good. Okay, God put trading in your brain for a reason. Okay, we're all blessed with intellect. It's like Quran says, and you're gonna be fine. Relax, stay focused to the plan, and don't give up. Okay, let's talk about social media. Okay, detox from it. Okay, get off of social media. If you feel like it's ruining your brain, get off of it. If you post on social media, post and get off of it. Don't scroll. Don't sit there and look at this stuff. Okay, just post and get off of it. Okay, a lot of the times it can be nonsense. And only trade what you can afford to lose. Okay, this is the golden rule for a reason. Don't be trading with your rent money. No trading with grocery money. Okay, no trading with any money that we need to survive. Okay, because it's going to be horrific if you were to take a loss, you'd be sick. And question everything. Okay, be a skeptic. Question the narratives you see, the price action you observe, and most importantly, the emotions that you feel. A healthy dose of self-doubt can prevent irrational decisions. And celebrate your process, not just your gains. A positive reinforcement loop can be built by celebrating good decisions, following your plan, sticking to your stop loss, ignoring FUD regardless of the outcome, and pushing forward. Okay, ignore the FUD regardless of the outcome. No fear. Okay, no doubt. Just keep going. Keep going. Trust God and keep going. No fear and no doubt within your mind, your heart, your soul. Okay, just keep going. And the journey to becoming a successful crypto trader is really a psychological one. The technicals are going to be extremely easy. I have a lot of technical videos, or you guys can head over to Stackmode.net for all trading education. You guys can also get my free trading ebook, free course. Okay, it's going to be a lot of stuff you guys are going to be able to get there. And the market is a mirror. It's going to reflect your mental state. Okay, if you're an impatient person, it's going to show you. If you're not humble, it's going to show you. And by understanding and managing emotions like fear or doubt and FOMO and overexcitement, you transform yourself into a reactionary participant into a disciplined, strategic investor. And the ultimate goal is not to predict the market, but to master yourself. Stay prayed to God. Keep grinding. Catch you in the next one. Peace.
You cannot trade futures like a regular stock account. You're playing with leverage, and you gotta understand the deposit system. So think of the initial margin as the VIP cover charge. It's the specific amount of cash you need to get past and open the trade. But once you're inside, the rules change completely, and that's where maintenance margin kicks in. And this is your lifeline, and it's your health bar. The second your account equity dips below this specific number, the broker doesn't ask nicely or care. They're going to forcibly close your position to stop them from losing money, and then you're going to be left with nothing. Or sometimes your account could go past your stop loss or liquidation amount, and your account could go into the negatives, making you owe money to the broker. So I'm going to show you how to calculate what margin is and understand. Let's head over to it, inshallah. All right, let's go and let's talk about futures trading margin. Okay, the deposit system of trading. So what is margin? So margin is not a fee. It's pretty much a good faith deposit. So say for instance, when you're signing up for a credit card, okay, sometimes the credit card company might ask for an initial deposit of like $100, but then the credit card would give you $500 worth of credit to spend. Futures works very similarly. So here's an analogy. So, or you could say you wanted to rent a super expensive console. Okay, you could put down a deposit to prove that you won't break it. And if you return it safe, okay, then you get the deposit back and you get to use the console. Okay, so futures is pretty much like a trading loan almost, but depends if you're using it for day or overnight trading. Okay, there's going to be two different costs. So if you want to hold the console overnight, it's going to be a different cost than it is for just using the console during the day. And futures contracts are huge. Okay, you don't need the full amount to use it during the day, but you're going to have to cough up more money if you want to use the console overnight. Okay, so let's learn the difference between the money you need to start initially and the money that you need to use futures contracts overnight. Let's jump into it. So let's talk about the power of leverage. So controlling big things with small amounts of money. So leverage allows you to control a massive contract value with a small account balance, okay, and the magic multiplier in it. Okay, so imagine having $1,000 but being able to buy $20,000 worth of Bitcoin futures. Okay, in that instance, the math would be a 20x leverage. Okay, and the catch. So it makes wins bigger, but it also makes losses happen quicker. So it's like driving a race car that goes super duper fast, okay? But if you crash, then it'll hurt way more than crashing like a bicycle, for example, okay? Because a bicycle, you're on it, you're going pretty slow, okay? But if you're driving super duper fast in like a SRT and you crash, then that could put your life at risk, okay? Just because the amount of speed and power that you're controlling, okay? So futures, yes, you can turn up an account, turn $50 and $10,000 to $10,000 or etc. Okay, whether you're trading crypto futures, normal futures, or whatever. Okay, but you can also quickly lose that $10,000 by making the wrong decisions. Okay, so leverage gives you a lot of power to turn up your account, but you can also turn down your account just as quickly if you're not disciplined. So initial margin, it's going to be really, really important. It's the minimum amount of cash that you must have in your account to open a new trade. Okay, so the math involved into it. It's usually a percentage of the total contract value. Okay, for example, like 5% or 10%. Okay, so if you have $4,000 in your account, but the initial margin is 5,000, okay, it wouldn't even let you trade. Okay, it would say access denied, and the trade would not be able to be entered down. Okay, but if you have $1,000 in your account, but the initial margin is 500, you would be able to open up a trade. But here's the catch. Okay, if your account goes beneath that $500, your account would be what's called liquidated. Okay, and when your account gets liquidated, then they take the remainder amount that's underneath the $500 and put your account to zero. And the dangerous part about it is that if price decides to clip past your stop loss or clip past underneath your initial margin value, okay, if you go underneath the initial margin value, your account could potentially go into negatives, okay, then you'll owe the broker money, etc. Okay, and they'll definitely be wanting that back, whether through suing you or whatever. Okay, so decide here, okay, what the initial margin is, and try to make sure your account has more value than that. Okay, you do not want to get liquidated for no reason. It's just a loss of currency, pretty much for no reason. Okay, it's happened to me. Okay, when I wasn't too sure what margin was when I first started trading futures, so it's not something I want you guys to go through. So the maintenance margin, okay, keep your account alive at a certain level. So the definition of maintenance margin, okay, it's the minimum amount of equity that you must maintain to keep the trade open after it starts. Okay, and lower limit, okay, this number is usually lower than the initial margin. Okay, and daily fluctuations. So as your trade loses money, your account balance drops. Okay, and you still must stay above this line. Okay, so keep in mind, even while you are in a trade, your account balance will fluctuate, and it still matters. If your account fluctuates underneath a certain amount that whatever you're trading requires, then your account will be liquidated. Okay, let's say you're trading the NASDAQ, okay, the NQ futures, okay, on Trade of 8 as of 2025, the day margin, I believe, is $1,000, okay. So if you're in a trade, okay, and your account goes underneath $1,000, then your account has a potential chance to be liquidated. Okay, and they would just take all the money underneath that, okay, and your account would be at zero. Okay, and you do not want that to happen. So futures, it's a lot of power in it, but you can also destroy your account just as quickly. So I really will show you how disciplined you are. Okay, so keep your account above the margin amount, and also know that margin amounts can fluctuate too. So a lot of people, I'm not too sure, know this. So margin amounts fluctuate, especially on news dates. So dates like CPI, PPI, Consumer Price Index, certain rates. So you can check all the news out on sites like Forex Factory and stuff like that. But a lot of the times, and on certain brokers, margin can change. Overnight margin can change, especially depending on if there's news or not. Okay, so keep heed of that. Okay. Pay attention to the margin at all times. I do not want you guys to get liquidated and lose money for no reason. Okay. We got too many things to hold down, too much business to handle. Okay. Keep on top of your numbers. Let's head over to the next slide. So again, margin called. Okay. So when your account's on low fuel, it's on E. Okay. And if your account balance falls below the maintenance margin level, it's gone. Okay. They will take every dollar in your account, and it hurts. You do not want that to happen, because it's not even like you lost the trade and then you blew up your account. No, you didn't have your account at the certain threshold, and they took the rest of your dollars. But rightfully so, though. If you break the agreement, they'll take the rest of the money. Okay, if you agree to have $50 in your account in order to trade a micro contract, okay, and your account goes to $48, they're taking that. Okay, and your account's going right to zero or into the negatives. So keep heed. Okay, and the demand. The broker will demand you to pay or deposit more money immediately to bring the balance back up, because you lied to them. Okay, you broke the broker's heart. The broker was like, wow. Okay, and there's plenty of times. Okay, once again, I broke the broker's heart. Okay, I got liquidated a few times, especially very, very early in my futures career. Okay, didn't really understand margin. Didn't understand overnight margin, especially tried to hold overnight. Okay. And then through that, I learned. Okay. And I'm grateful I get to come on here and let you guys know. Okay. Because you do not want to get liquidated. And if you don't add the money instantly, the broker will forcibly close your account, close the trade, and really want their money back. Okay. So for example, if you borrowed a bike, okay, or if someone loaned you your car, okay, let's say you had a rental car. Okay, and you said, all right, I'm going to go ahead and give you $500 in order to drive the rental car. But you can't let the gas go below a quarter. Otherwise, the car will literally blow up. Okay, let's say you're driving the car, you're having a nice time. The gas is at like 2 quarters. You're not tripping, you know, you're still having a lax day. You're vibing out. Okay, the car is at a quarter. Okay. You're still vibing out, you're chill. You forget, okay? You're not on top of your business, okay? And then boom, you look at it. Account car underneath a quarter. And then it blows up, okay? So I've blown up my account by looking at the trade profit numbers instead of looking at the actual margin numbers, okay? A couple of times. So don't let that happen. Don't get too lost up in the charts, especially when your account's already on its last legs. Just, it's all right. Pray on it. Boss up, hustle up some new money on, okay, and put it back into your account, and then you guys can run it back up again. Don't try to trade on a quarter, okay? Don't drive the car on a quarter. Don't do it. It'll blow up, okay? If you know the margin amount is $600, don't try to trade with $670, trying to trade with the little $50 stop loss, because you're not taking things into account when you do that. You got to pay broker fees, and then there's going to be slippage on your stop loss, etc. A lot of other things that come into account while you're trying to micromanage every single number, trading out of desperation and survival mode. It'll really come bite you in the back. Okay, don't do that. I'm telling you, it's a lot of things that you might not realize. Okay, trading, hustle up, okay, boss up a bit, and then come on the charts. Okay, there's plenty of times I've had to take a step back, okay, get right with God, get right with myself, okay, have a new perspective on the charts, and came back way stronger, okay, whether if I didn't like my results, or plenty of times where I was really, really happy with the money I was making in the market, and I had to just control myself, okay, because I know what I did in the past, okay, I would make a bunch of money from the market, and then just blow it all up. Okay, so plenty of times in the market where I've had to make some good money from the market and pause, especially trading futures. Okay, I would hit like some really nasty trades and just pause. Okay, just watch the market for a couple of weeks, for a couple of days, and just being really patient on the charts with yourself and in life. It's really gonna help you. Okay, so even if you make a bunch of money from trading, don't feel bad if you want to just take a couple of days away from the charts. Okay, or if you want to just take a couple of weeks to just study the charts, see how price action moves, hold on to that money, reinvest that money, that's going to be fine. Okay, you're not in no race with nobody. You're not in no competition with nobody. You're in your bag. Okay, get in stack mode, stay down, okay, and figure out what works for you guys. Okay, once you start getting your criteria down as far as your entry criteria, things get a lot easier. But one thing you do not want to do is trade out of desperation. Okay, because if you do that or try and trade when your account's on its last legs, when it comes to futures, options, everything else, you can kind of do that. You can throw in like your last bit of money, and especially on options, since the profit potential is unlimited and your account could potentially flip. But futures, do not play with your account like that, because then you're going to end up losing more money in the long run, paying off margin call fees. Okay, and I do not want that for you guys, inshallah. So let's head over to the next slide. So initial versus maintenance. Okay, here's a side-by-side comparison. So initial margin, okay, it's going to be at the very start. Okay, it's going to be the entry. Okay, and it's pretty much just going to be telling the broker, like, yeah, you know what, I have the money in order to be in this trade right now. Okay, so always keep extra money in your account. Never trade right at the limit. Okay, or a small win will blow your house down. Just please do not do that. Okay, don't do that. And then maintenance margin is going to be during the trade. Okay, so that's going to go ahead and be it. So some key takeaways. Okay, leverage. Okay, it's going to be really powerful, but can also be dangerous if you are not disciplined. Okay, do not lead with your flesh. Okay, pray to God for discipline and stay focused. Even when you start touching that good money, stay focused. Okay, and the initial margin is going to be your entry ticket. Okay, and the maintenance margin is your survival line. Okay, and liquidation, it happens when you run out of money. Okay, and you don't meet the maintenance margin. Okay, if they tell you, yo, we need $500 in order for you to have this trade open, and they don't care if you're in a trade, if your account goes underneath that $500, goodbye. Okay, you're not allowed to trade with this right now, and you owe us some money. Okay, so it's like that. Futures is very ruthless, very hardcore. The most hardcore instrument, futures, is the discipline instrument in itself. Okay, shares, you can get rich by not looking at the charts. Plenty of millionaires created by people who just hold stocks. Plenty of millionaires by people who just hold cryptocurrency. But I don't believe there's any futures millionaires by anyone who doesn't look at the charts. Okay, it's not something you could just throw a bunch of money into and try and just make a bag. No, futures is very, very different. You have to know rules, have to play very intricately, and you have to just really just change yourself completely as a person. Okay, so stay safe, trade smart, and head over to Stackmode.net for all trading education. Stay prayed up to God and keep grinding. Peace.
Investing, trading, all of it is forever, guys. So I want you guys to think about plants for an example. What do plants need? Water, sun, good soil, consistency, 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 and you'll get the plant that you want. Whether it be a beautiful rose bush, a giant oak tree, a blueberry bush, whatever you want. It comes through consistency. Investing is forever. It's forever. Don't think you're going to hop in this game, run up a couple of bands, and then hop out. That's for the quitters. Investing is forever. When you guys hop into this journey, when you guys start hopping on these charts have been around since before I've been alive. I'm 22 years old right now. And before I've been alive, people were trading Forex. People were trading certain stocks, etc. And I assume, inshallah, if God wills, that after I'm gone, people will probably still be trading the markets if the world is still going and flowing. So investing is forever. Don't think so quick, so instantaneously, so fast. When I was a day trader, I got consistent. It took me some time, lots of failure in the beginning. And that's why I thank God I'm able to come on here and coach. I'm so passionate about it. And I'm thankful I get to make some money in the process, of course. I'm here to be fully transparent. Yes, I make money in the process coaching. Yes, I make money selling my trades. But I'm also really, really humble to the fact that I get to help another person learn a skill so they can feed their families, so they can help somebody, so they can pay their bills on time. So yes, I get to thank God, all due to God. Without God, I'm nothing personally. So thank God. Thanks to doing this, I get to coach you guys, make some money in the process. But I also want you guys to avoid a lot of hardship that I've gone through. And one of my students on a call that I was just on the other day, actually really told me that. Well, he was like, he laughed. He was like, I'm thankful you went through it. And I'm like, I'm thankful too. Like, for real. Like, it sucked going through it at the time. But now being able to tell you guys certain things like, hey, you might not want to get in at all-time highs right now because you're probably going to get dumped down on. So being able to tell you guys little tidbits and stuff like that, or, hey, market's dumping right now. You might not want to be in along. Let's wait till buyers step in. Being able to analyze certain emotional factors based off of anxiety, rushing. And I understand why people want to get in and rush trades. You're trying to touch some money on. You're trying to touch some money on. I'm trying to touch some money on. We're all trying to touch some money on. Okay? You're not alone. You are not alone. I promise you, you are not alone. You're trying to touch some money on. I understand. But in order to touch some money on, one, we got to pray to God so we can be healthy, okay, mentally and physically, so we can even think, so we can get some money on. So be humble to God. Really, really, really important factor. No matter how much money you start touching, stay humble to God. Don't change your ways. Don't change your ways as a person. Don't start treating people badly. Don't start disrespecting people. Even if they hurt your feelings, break your heart, whatever. There's no need to disrespect people. You know, I'm not perfect. There's times I've definitely made mistakes, but don't let the money change you even when you do start touching that big bag, because it is easy to start thinking, well, you know, whoop-de-whoop, or I'm better than people, or why aren't people doing X, Y, and Z? And everyone's going to live their own life, but if you want your network to be full of grinders, full of investors, full of people who care about taking care of their families, stay around that. Don't try and change your whole life, start investing, and think you can hang around the same people. Because I'm telling you, it's going to be frustrating. Okay, and when you start changing and leveling up mentally, you don't want to be disconnected while you're there presently trying to enjoy yourself, but you're not going to be on the same mental space. Instead of you guys going to McDonald's, you're going to think, well, I got food at home. Why not just buy some Bitcoin or some shares? Why not buy this options play? Why not load up a futures account? You know what I'm saying? Your mindset changes when you start investing. So the people around you, if they're not on the same wavelength and journey, it will and it can frustrate you. But don't let it get to the point where you just start disrespecting people. But yeah, like, don't, like, you know what I'm saying? Sometimes people are broken spirited. Like, if people are broke, they're broke spirited. Like, for real. That's really what I think. Because it's not even about money. It's just, you're waking up every day. And I think it's just abusing the body that God has gifted us with. Because how are you not waking up every day and grinding? How are you not putting some money away for your family so they can eat? So how are you not trying to get a bigger home for your family and a safer home for your family so they can live in a better environment? You know what I'm saying? So I do understand the frustrations, but if you're an investor, if you're a hustler, you're a grinder, and you're ready to change your whole life around, your whole life is going to change. You're going to be a really consistent person, okay, inshallah, especially when you start praying every day. Working out Monday through Friday, 5 days a week is a really, really good way to build consistency, let off a lot of stress, and really just stay mentally focused. And investing constantly. As soon as you get some money, buy some shares. As soon as you get some money, buy some crypto. As soon as you get some money, buy an options play or whatever that you planned out. Boot up your account. Okay? Do what you need to do. Try not to waste your money on prop firm, because ownership is really the main priority. You can sell your shares whenever and put it right back in your bank account. Prop firm, they have little parameters that are set up for you to fail, because prop firms only make money when you buy a challenge. So, of course, they're going to make things very difficult and hard for you so you fail. On the other hand, we're going to go ahead and have your actual live account. could pull out your money whenever, whether it be your crypto, shares, futures, whatever. You could just pull out your money. Okay? You can pull out your money whenever. So, think about it. Ownership. Ownership is the reason why you want to trade. Okay? You don't want to just have money to have money. You want to throw your money into the asset river so you can have ownership, so you can have more houses, so you can own more percentage of a company or an ETF, so you can get paid more dividends maybe one day. Okay? You want to have more ownership of more Bitcoin. So when Bitcoin goes extinct, Bitcoin is not infinite, if you didn't know that. And when Bitcoin goes away, you're going to have Bitcoin. Ownership is what we're investing and trading for. Okay? Ownership. Think about it, guys. Okay? You have money just chilling in your savings account. Why? What is that doing for you? Ask yourself, if you have money sitting in the savings account right now, what is that doing for you? Or your checking account. Why is it there? Because once I turned on my brain, I personally try and just live off of the credit card. Okay? All money goes into assets. And then take the money out, pay off the credit card with the assets or income that's flowing in, pay off the credit card. And when tax time comes, take money out the assets, pay your taxes. Why is money sitting in your checking account when houses get more expensive year after year after year after year? When food costs more year after year after year after year after year? There's no more dollar menu at like McDonald's and stuff. Okay? Not everywhere. Prices fluctuate per city. Because of why? Inflation. So why is your money just sitting around? People like to complain. Stuff is just getting more expensive every year. Do something about it. See, and that's broke to me. It's not even about money. It's just don't hang around complainers. Investing is forever. So you're the one who's going to do something about it. Inshallah, you're the one who's going to take care of your family. If you're watching this right now, you're the one. Okay? And you can't fail. Inshallah, you got to keep going until you die. Don't stop. Don't let any relationships affect your mental. Don't let any people around you affect your mental. Don't let any loss of any funds affect your mental. Okay? Stay focused on God and stay strong. Because this journey is going to be a long one. You're setting up right now to be the provider, whether it be for yourself or your family or your loved ones. If you're investing, you're probably doing it to give your family or yourself a better life. So be ready to be a provider. There's going to be days where it's going to be frustrating. It's going to be days where you're going to check your P&L. It's going to be red. It's going to be days where you're not going to be making some money. And that's okay, because it's forever. It's about staying consistent. It's about staying resilient. It's about coming back every single day and not giving up, no matter what. Because I'm telling you, whoever doesn't give up wins. The people who stop, the people who quit, the people who think it's a scam, the people who don't have self-control, who don't pray to God, okay, all going to be failures. All going to be failures. Because until I started praying to God, that's when I started winning. As soon as I started praying to God, I started winning. Okay? Until I started praying to God, like, I just wasn't winning. Okay? But then as soon as I started praying, started winning, started getting healthy. Was able to lose 100 pounds in 8 months. I just privated the short just because it had some explicit pictures. I don't think it's very, halal content. But yeah, I'll stuck for Allah. I don't want to be showing myself like that on the internet. Also, watch how you guys present yourself too. When you guys start running up money, because whoever's watching this right now, I know you guys will go far, inshallah. So if you're watching this right now, watch how you present yourself too. Watch how you present yourself on the internet. Don't just be out here balling and flexing on everybody. Motivate. Okay, because we're all on this earth for a reason. So whatever keeps you going on this earth, do that. And try and inspire the next person so we can all just be happy on this planet. All right, because that's really what it's about. Yes, we're here to get some money, but I'm telling you, investing is forever. The big plays will come as long as you stay consistent, you stay focused, you keep taking the same type of setups, you keep putting the same money away. I don't care if you have $1 million in shares, $1 million in Bitcoin. As soon as you get $20, if you put $15 into it, that mindset is the reason why you got to that $1 million. Keep stacking it up. Don't get that big ticket and then blow it and then go back to zero. Don't do that. That's something I had to learn from. Okay? Run it up, stay consistent, stay prayed up, keep your mental straight, and keep what you got. Don't lose what you got, whether it be relationships, whether it be your money, whether it be your plays. Don't lose what you got. Don't lose what you got. Okay? I love you guys so much. Head over to stackmode.net for all trading education. Stay prayed up to God. Keep grinding. Free ebook and course there too, if you guys want to check that out for free. You guys can book a call with me for the first time for free. Let's break down whatever you're going through. Let's break down an investment plan for you. I want to get you guys focused. I want to get you guys set up with a full financial parameter and a full financial system so you can be successful in this world. Inshallah. The stuff is only getting more expensive and they don't want you to suffer. Love you guys. For real. Peace.
Alright guys, it's Stackmode Cursor. Today we're going to be talking about the cover calls and the Iron Condor. We're going to understand how these market structures work. We're going to deconstruct the mechanics and the risk profile of the cover call. We're going to analyze the structure, profitability, and adjustment techniques for the Iron Condor and determine the appropriate market environments for deploying each strategy. Okay, let's go and let's jump straight into it. So, the cover call is perhaps the most fundamental income generating option strategy. It involves holding a long position in an asset, like 100 shares of stock, for example, and simultaneously selling a call option against that same stock. The term covered is the key, as your long stock position acts as the collateral. And the goal of it is to generate premium income, right? To generate some cash flow against a long stock position, essentially lowering your net cost basis in shares. And it performs best in neutral or slightly bullish markets in general. So let's talk about the two-part mechanics, right? It's a two-part trade. So leg one of the trade is, let's say you're long. So you would have to buy at least 100 shares of the underlying stock, okay? Whatever that you wanted. And then leg two, you would short. Then you could sell one call option contract, which represents 100 shares. So a call option contract represents 100 shares. Same thing with the put option. It represents 100 shares per contract against the long shares. So we'll talk about the strike price and expiration. So the call option is typically sold out of the money, meaning that the strike price is above the current strike price. So it usually has an expiration date between 30 and 60 days out, and this balances the maximum time decay benefits while minimizing the chance of early assignment. So the key concept of it, right, is capping the upside. So by selling the call, you're going to be granting someone else the right to buy your shares at the strike price in exchange for the premium. So you agree to cap your potential upside profit at that strike price if the stock rallies significantly. So understanding the payoff structure is going to be vital for proper application. So the premium received shifts the entire risk reward profile. So it turns a traditional stock holding into a defined risk income vehicle. So let's talk about the max profit, right? So the max profit. This is realized if the stock closes exactly at or above the strike price at expiration. And the break-even point is the original stock purchase point. So the premium acts as a buffer against the decline in the stock's price. Okay? And as far as the risk involved into it, right? So the core risk is that the stock rallies past the strike, right? Let's say in hindsight, that would lead to your shares being called away. A sign at the strike price forcing you to sell them and forego further upside. So, as far as downside exposure, the strategy still retains the full downside risk of owning the stock, minus the small premium collected. If the stock falls drastically, then the loss would be significant. And if the stock price So if the stock price approaches or crosses the strike, a common adjustment is to roll the option. And this means buying back the currently sold call, right, for closing it, and selling a new call with a later expiration date and or a higher strike price. And this action can often be done for a net credit, extending the trade and potentially capturing more upside while avoiding immediate assignment in general. So the Iron Condor, it's a sophisticated non-directional strategy and is designed to profit from a stock remaining within a defined price range over a specified time period. And unlike the covered call, the Iron Condor defines both maximum profit and a maximum loss at the outset. making it a pure defined risk trade. So as far as the market view, right? Strictly neutral or low volatility. And you're betting that the market will not keep that in mind. You're betting that the market will not move significantly in either direction, up or down before expiration. You're thinking that the market's going to remain pretty flat. So structure. An iron condor is essentially two separate credit spreads combined on the same underlying asset. So a bear call spread, right, for upside defense. Okay. Because you sold out the money calls, plus you bought further out the money calls. Okay. So you could do things like that. And let's say a bull put spread, okay, for downside descent. Let's say you sold out the money puts, plus you bought further out the money puts, okay? Building that defense, building that buffer. So the goal is to maximize the premium received from selling two inner options, right? It's the body of the iron condor. And it's minimizing the cost of the two outer options, right? It's the wings, which define the maximum risk in general. And let's talk about the power of time decay, theta. So if you're an options trader, you guys may have gotten destroyed by theta before. You might have been up some good profit at a point of time, and then your trade just absolutely plummeted down to the ground because you didn't close at a certain point of time, right? And that's because of theta. Theta is going to be part of the Greeks in options, and it can be something that can make or break a really, really good trade. So keep that in mind, and make sure you guys are buying months out whenever you're buying options, at least months out to years out. And the strategy thrives on the erosion of option value due to the passage of time. And since you're a net seller of options, okay, since you're a seller of options where you're collecting the premium, you benefit directly from theta decay, which is accelerated in the last few weeks before expiration. So if you're selling options, then I recommend you guys have lower expiration dates, okay, because you're betting for people to take wild bets and for them to lose. But if you're buying the options on speculation, I recommend you guys buy many months out, okay? So this is the reason why it works, okay? Because people who don't know that, who don't know about theta, you're pretty much taking gamblers' money. So anybody who wants to gamble and bet market in wild ways and wild numbers, okay, with wild expiration dates that are really close, you would go ahead and exchange money with them fairly. And a fairly grasped iron corridor, you must see it as four distinct transactions working together to create a single bounded payoff zone. And each leg is going to be crucial for defining risk and maximizing credit. So let's talk about the call side, right? The bear call spread. So a short call, it sells premium and initiates the upside profit boundary. And a long call, it buys cheaper premium and it defines the maximum loss on the upside. And the purpose of it protects against a large move up, defining the risk to the upside. And let's talk about the put side, right? Puts is going to be if price is going in a downwards direction. Calls is going to be if market wants to go in an upwards direction. So short put is where you sell premium and initiates the downside profit boundary. And a long put is where you buy cheaper premium and it defines the maximum loss on the downside. And the purpose of it protects against a large move down, defining the risk to the downside, preparing yourself. So max profit condition. So the maximum profit is simply net credit received when initiating all four legs. And this maximum profit is achieved if the underlying stock price closes between the two short stock prices. All right, so the short call and short put at expiration. And in this scenario, all four options expire worthless and you keep the initial premium collected. So the iron condor's defining feature is that the risk is fixed and known before the trade is placed. And this is fundamental to professional portfolio management. So the max loss calculation. The maximum possible loss is determined by the width of one of the credit spreads, and a call spread width or put spread width minus the net credit received. So for example, if the call spread width is $5 and you receive a $1.50 credit, right, the max loss would be $5 minus $1.50. So that would equal $3.50 per share, or $350 per contract. Because remember, for options, whenever you have decimal numbers, you gotta multiply them by 100. So that's just doing the math by that. And the upside break even, let's talk about. So short call strike price plus the net premium received. If the stock closes above this point, then the trade would lose money. And downside break even, right? Short put strike price minus the net premium received. If the stock closes below this point, then the trade would lose money. And the safe zone. The profit tent is going to be the area defined between two break-even points. And the wider the distance between your sold strikes, the wider the tent. Compared to the width of your protected wings, the larger your potential profit, but the lower of your probability of success. Okay, so keep that in mind. So both strategies are going to be crucial for a well-rounded option trader, but they're going to go ahead and serve entirely different purposes and thrive in different market cycles. So we'll talk about the iron condor versus the covered call. Okay, for the market bias. Okay, neutral to slightly bullish. Okay, and iron condor strictly neutral. Okay, risk for covered call. Okay, the stock downside is going to be uncapped. But for an iron condor, the risk is going to be defined and limited. Big upside here. And the max upside, capped at call strike price. But the iron condor is going to be capped at the net premium received. And the primary benefit for the covered call is going to be for consistent cash flow for a low cost basis. But the iron condor is going to be a high probability of small profit, building a consistent, more stackable window. And by combining these strategies, you can equip yourself with the tools to generate income and profit from the consolidation. Okay, covering a much wider range of market behaviors and profiting from the market. So we've explored the mechanics, the risks, the benefits, how the iron condor works, how the covered call works. If you want to learn more about options, head over to stackmode.net. Stay prayed to God. Keep grinding. Catch you in the next one.
All right, so we're going to go ahead and talking about the bear market. Okay, so pretty much whenever cryptocurrency starts heading in a downtrend, okay, sometimes that's going to induce panicking. Okay, it can induce a couple of emotions, such as like panic selling. Okay, certain things, whether you want to feel like you might want to dump your entire portfolio, okay, because of how many negative trades that you've taken within a certain bear market cycle, right? Or if your portfolio's down, okay, but we don't want to do that. Okay, let's not think of the market that way. Let's think of the market logically. Okay, so just like we always cover and talk about, there's benefits to making sure that these markets go in upwards direction. Okay, cryptocurrency included. This is something that governments hold, many people hold, hedge funds hold, and just people with large quantities of money hold. Okay, so cryptocurrency, it's not going to be something that's going to be useless. Okay, it's going to be something that's going to be instructing and providing power back to us, the people. Okay, so it's something that people are investing into due to the fact that people can easily send money from one person to the other, okay, without having any bank intermediaries in the middle of it. Okay, so if you want to send a wire transfer, for example, okay, from $1 million from one person to another person in China, a lot of times that transaction might not easily go through, okay, without being first approved by the bank. Cryptocurrency removes the whole bank in the middle, okay, and works on its whole blockchain system, okay, letting people make their transactions on their own accord. So if someone wants to sell $1 million in cryptocurrency to a person in China, they can go ahead and do that easily and instantly using the decentralized space. Okay, so let's jump into it. So cryptocurrency has many uses. If you see market going in a downtrend, all it is people selling as well too. Okay, just like we see this chart right here. Okay, this is the left to right chart. So if people got in at this low down here, okay, and market starts going in upwards direction, of course when market decides to fall down and correct, okay, people call it a bear market, but of course it's going to fall down and correct though. People got in way back here and they're going to go ahead and take profit. So when people are taking profit, getting their money out, that's going to cause the shares to fall down. Okay, so all the crypto supply will fall in a downwards direction the more people sell. Okay, so whenever we see market going in a downwards direction or a bear market, okay, that just means market's going in a downwards direction, which also means people are just selling. Okay, but these are going to be opportunities where market's also going to go on discount. Okay, so if something is $50 right now, okay, and it's something that you want, and then it goes on sale, and you see it on sale for $20, okay, you might even get two of those things, okay, due to the fact that it's on sale now. Okay, so think of crypto market dumps like that. Okay, think of things going on sale. Okay, market has to go up in order to come down. It can't just go up in a straight line forever. Okay, it has to work in a staircase formation. People have to buy, people have to sell. Hence why it's called trading. Okay, when you're winning, somebody's losing. When you're losing, somebody's winning. Okay, so let's cover the mindset and
really just understand how we can prepare for when market's going into downtrends. Okay, so let's define the bear market and root causes. So a bear market is generally defined as a decline of 20% or more, okay, from the recent highs, marked by widespread pessimism, low confidence, and a sustained decline in prices and trading volume. Okay, and key definitions. So the 20% rule. So why subjective? A 20% drop from the all-time highs signals market distress. And in crypto, drops of 70 to 85% on certain things like meme coins and stuff like that can be common during major bear cycles. So that's why you don't really play meme coins and things like that. It's not really worth it since they just don't have enough value. Okay, and they can easily just go ahead and fall in opposite directions without much of a backbone behind it. Okay, versus something like Bitcoin, where that's a lot less likely to happen. And the more actually it dips, the more people are going to buy. Okay, people are putting in $300 million orders plus, etc. Okay, anytime Bitcoin dips down. Okay, so it's way different. So it's going to be sometimes too where certain cryptos go cold, okay, and they start consolidating. So what consolidating means that it starts going in a sideways direction, okay, not much price action up or down, and you want to stay away from those. Okay, so you want to trade something that goes in upwards direction year after year and is getting percentage year gain, okay, making your money more money, making it a stable investment. So watch what cryptos we invest in, okay, and primary catalyst. All right, let's talk about it. So some macroeconomic factors. So global inflation that can affect crypto prices, interest rate hikes by central banks, and traditional asset market declines often correlate with crypto downturns. Okay. Excessive leverage cleansing. Okay. Overly aggressive market buying. Okay, with borrowed funds. So there's going to be times where people can trade Bitcoin with borrowed funds, right? With something called leverage. So just like, futures, there's going to be things called crypto futures. Okay. And on crypto futures, you can trade with the same leveraged amount. Okay. And any leverage amount, depending on the broker, goes up to like 500x and stuff like that. Okay. And sometimes when market decides to go down, okay, it creates instability. And bear markets, meaning markets going in a downwards direction, it purifies the market by liquidating these highly leveraged positions. Since the more leverage that you're playing with, the smaller that your stop loss is going to be. Okay, meaning that your trade has to close at a certain area automatically versus if you're playing with no leverage. Okay. So regulatory uncertainty. So major government crackdowns or unclear legal frameworks in key jurisdiction can trigger broad market fear and lack of trust within certain cryptocurrency markets. Okay, so we saw in 2022 COVID area during the SEC, okay, the government exchange for securities, okay, they were having some problems with the crypto sphere, but since then things have been passed, things have been regulated, and as we can see, crypto is now shooting into new highs constantly with tons of optimistic future ahead of it. Okay, and let's talk about project failure and exploits. So the collapse of large projects like major stablecoins or exchanges lead to contagion and a severe loss of investor trust. Okay, so if you see certain things like certain exchanges fall down or certain brokers where a lot of people invest in just shut down randomly, that could put some fear into the market. More fear into the market, less people are going to be investing. Okay, but that's just things that could happen. But just like a bank, banks have random maintenance where you can't pull out your money. Okay, so anything has its cons, anything has its pros. Okay, only thing's perfect is God. Sometimes things are going to shut down, just is what it is. So psychological game, right? Conquering FUD. So investment success during a bear market is going to be 80% psychology. Okay, really 80%. I'll say like 90% plus. Okay, because you can have really the best levels on the screen. Okay, and I've done some tests with certain students. Okay, you can give somebody the best levels, but they don't close where they need to close. Okay, due to the fact that their analogy or how they process it in their head might be completely different. Okay, so trading is really going to be psychology and how you look at the market. Okay, so mistake number one. Okay, so mistake number one that people make, this is the main reason why people will remain unprofitable. Okay, their stop losses are going to be too tight. Okay, way too tight. Okay, causing them to panic sell. Okay, so selling assets at low prices locks in permanent losses. And the single best way to lose money in a bear market is to sell everything when despair is the highest. Okay, sometimes you got to sit and you got to hold through certain periods expecting price to sweep up. Now, I'm not saying hold every single trade, just certain past the worst dump of all time or past your stop loss. But if you have a calculated trade that you have planned and it starts going in the red, it's part of the game, okay? And the game is really about who can survive when market's in drawdown or your account is in drawdown, okay? And who can't, okay? Because whoever's going to sell all the positions when market's in drawdown for a loss, their account is never going to grow, okay? You have to be able to sit there and stomach through it. There's times I've had tons of time. This is why time is going to be one of the biggest factors in trading. This is why crypto is really amazing, okay? When you're trading cryptocurrency, you have time. Okay, cryptocurrency, as soon as you buy, you can hold it forever until the end of time. So you have time. So if you sell, okay, that's going to be on you. Okay, there's no time running behind you. As soon as you buy some spot cryptocurrency, okay, when you just buy crypto on a normal broker, okay, and you can just buy and hold without any leverage, okay, and no leverage buying cryptocurrency, just being the normal way, it's called spot. So when you do that, okay, you can decide like, okay, I'm going to sell in a couple of years. Okay. It's not as easy to do that with other instruments. Okay. Other instruments can be time gated, such as like futures, for example. Okay. Futures, each contracts, they have expiration dates. Okay. So things can be a little bit different. So let's talk about tactic number one, right? The zoom out. Okay. We got to zoom out. We got to get the whole long-term perspective. This is why we use our higher time frames. Okay. Time frames we're going to be using. Okay. Some great notes here. Time frames that we focus on. Weekly. Okay, we're going to use our weekly time frame. We want to see everything on the larger, higher time frame scale. Okay, after we check out our weekly, maybe for take profits. Okay, and take profit is where we close the trade out. Okay, say you got it at an area of support. Okay, and you close in an area of resistance above current price. You can go ahead and do that. Okay, so you're going to have the weekly. You're going to have the daily. Okay, and then you're gonna have your 4-hour time frame. Okay, then you're gonna have your 4-hour time frame. Okay, so using those time frames all together is really gonna help you put your trade into perspective and be like, okay, this is the type of setup I want to be taking from now on. Okay, and these are the type of trades that I just take. Okay, so that's what you want to focus on, okay? Weekly, daily, and the 4-hour. So let's talk about zooming out. So the HODL view. So we're going to focus on the long-term vision, okay, of 3 to 5 years plus. And all major crypto bear markets have been followed by new explosive bull market cycles, okay? Look at the monthly or the yearly charts, okay? Not the 5-minute charts. Okay, tactic number 2, okay, reduce obsession, okay? We should be grinding in real life, stacking up some bread, okay, putting some money away, okay, and just growing our capital in the real life so we have more money to come put into the markets, okay, but constantly checking P&L, seeing how much money you're up and down, it's not what we want to do, okay, focus on the charts, okay, you could look at the charts, see where it's at, but even that, don't turn it into unhealthy obsession, okay, take your time, check your charts out, maybe once a day, a couple times a week, okay, but don't sit there, stock on the position every minute, okay, constantly checking the price feeds, lead to anxiety and they lead to impulsive behavior. So set clear rules and limits and then step away from the daily chart fluctuations. So it's really about a battle of just you versus you at a certain point. So quote for perspective, right? Be fearful when others are greedy and greedy when others are fearful. Okay, so when everyone's scared, price is going in downwards direction. As soon as it starts making a curl on your weekly or daily, you can go ahead and get in, buy that, and then you buy the low where everyone's fearful. And then by the time it's at all-time highs, that's when you're going to start seeing the posts like, oh, everyone, and then everyone's going to start buying at all-time highs. Okay, it happens constantly every single cycle. So when we know how to sit through the bear market cycles and buy certain dips, we're going to be able to prepare and be a lot further ahead than other people due to the fact that we can analyze something so simple. Okay. So accumulation through DCA. So let's talk about DCA. So DCA stands for dollar cost averaging. Okay. So DCA, it's dollar cost averaging. What is that? Okay, it's one of the most powerful tools for risk mitigation and capital deployment in volatile bear markets. And it needs the need to time the bottom. Okay, and let's talk about the DCA mechanism. So fixed schedule. So investing a fixed dollar amount, let's say for example $100. Okay, at regular intervals, let's say weekly or monthly. Okay, that's going to be DCA. Okay, when you're just regularly putting away a certain amount of money, okay, that you can, okay, pay your bills, get some groceries, and then you can invest. If you're gonna say you're gonna invest $1,000 in Bitcoin a month, okay, then go ahead and do that. Okay, if you can do more, then do more. But DCA means just take a percentage of your money, okay, break it down and put it into some cryptocurrency or whatever investment. Okay, I don't care if you get $10. Okay, go ahead and break it down, put 7 of it into crypto. Okay, just having that type of stack mode mindset is going to help you grow your currency and help you stack way, way, way faster. Okay, and your portfolio will flip in no time. And shalom. So reducing the timing risk. So, and also keep yourself broke. Okay, so if you keep yourself broke, it's a strategy I notice a lot of people do. Okay, it's something I definitely do. Okay, I don't keep any money in my checking account. Okay, after I pay my bills, I get my big lump of groceries. Okay, I do what I need to do. Okay, I buy what I want to buy. And then from there, every dollar that I have the rest, okay, I'm going to pay my credit card. Okay, and then after that, I'm just going to invest. That's all I do. I put every single dollar into investments and I just keep myself broke. Okay, I paid my rent. I got groceries, so I'm not going to starve, thank God. Okay, and I did everything I need to do. So I'm good. So I can keep myself broke and I'm going to survive. Okay, so keeping yourself broke whole time you got money stacked away in investments is going to be a really, 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 really good thing to do. Okay, just changing the whole mindset. Just, you know what? I don't need to go get this coffee today. I'm going to bring some coffee from home. I'm going to take this money and I'm going to invest. Okay, so it's something personally my wife really helped me out with. Okay, just changing the whole mindset of everything. Okay, changing the whole mindset of everything and really understanding like, okay, you know what, let's not eat out today. Let's stay down, groceries, and the rest of this money is investment money. Okay, because this stuff, it adds up quick. It's easy to spend $40 on a DoorDash meal, $50 on a DoorDash meal for 2 people, okay, quickly. Okay, but $50 worth of groceries, it really goes a long way. Okay, so it goes a much further way. Okay, so it's about just staying down, making the right decisions, and then we can go ahead and ball later. So, yeah, so the compounding effect, right? So this strategy becomes exponentially more effective when asset prices are depressed, okay? As your fixed investment buys a larger portion of the supply, okay? So when market is in a downtrend, okay, and market's about to make that curl in the upwards direction, okay, and then we have cash to just stack and throw in there, and you buy, okay, even if you don't have all the cash in the world to buy at the low, as it curls up, you can keep adding, okay, and that you hit your trade, okay, and it's just about mindset. Then from there, take that capital, and then you can go ahead and deploy more cash into there and just keep stacking your wins over time. Nice. So thriving the strategy. All right. So let's talk about some fundamentals there. So bear markets separate speculative noise from real technology. Okay, so this is the time to ignore hype, okay, and focus exclusively on fundamental analysis and your technical analysis. Okay, so when market's in a heavy downtrend, let's say there's a speech from a president or something like that that has dropped the market. Okay, we want to be looking once again on our weekly and daily time frames primarily. Okay, and we're going to be looking for that V curl up. Okay, we want market to make an area of support. Okay, and then we want to see market start to curl up, either after a couple of days from the daily or a couple of weeks from the weekly. Preferably weekly curls are going to be really, really nice. Okay, because that means price really wants to reverse. Okay, if you start seeing 2 weeks in a row, price action, price filling in the V, okay, a lot of the times that's going to be the setup you would like to take. Okay. So, and we're going to ask ourselves too, if something is going down, why is it going down? Okay, was there any bad news behind it? Okay, did something happen? Okay, and let's think about utilities and use cases. So does the token or protocol solve a genuine, tangible problem? So we'll talk about Solana, for example. Okay, Solana, you need it to trade meme coins. Okay, so that point alone, Solana has value. Okay, if people want to create their own cryptocurrency coin, okay, they gotta generate some Solana first if they want to make their own meme coin. Okay, but then we'll take something like a random meme coin that's just a joke. Okay, it doesn't have any community behind it, no nothing. Okay, just a random meme coin. If it goes down to 0, okay, a lot of people wouldn't be surprised. Okay, because does it solve any genuine, tangible problems? But then you're gonna have something like Ethereum, for example. And Ethereum was created due to the fact that Bitcoin is limited. Okay, so one day Bitcoin will be gone. So people still want to trade cryptocurrency, so that Ethereum was created. Okay, so Ethereum has its purpose there. And instead of using power to create it, like Bitcoin's using power to create it, Ethereum is created using computers and smart contracts. So it's a lot more power efficient for the earth and it's healthier. Yeah, so Ethereum actually has real uses compared to certain other things like random just joke meme coins. Okay. So, because if something has a real use and it dips down, people are going to be hounding to buy that dip. Okay, the second something valuable dips, people are hounding, buying tons of it. Okay, the second Bitcoin dips, people putting in hundreds of millions of dollars worth of orders, whether it be governments, BlackRock, any type of companies, anybody. Okay. So, talk about the cryptocurrencies team. So, is the development team public, experienced, and actively building during the bear market? Okay, and you could check certain GitHub commits too. So certain cryptocurrency coins, okay, even though they're dipping down, they're working on tons of stuff on the back end, okay, looking to progress the future forward. And the community and governance behind it. So does the project have a vibrant, resilient community and a clear decentralized government model? Okay, so just like Bitcoin has tons of community behind it. You got companies such as MicroStrategy, also known as MSTR, okay, big representative of Bitcoin. Okay, things like that. Okay, and also have, once again, governments, US government, other governments, etc., participating in buying Bitcoin and other tokens as well too. So the tokenomics of everything. Okay, so analyze the supply schedule, vesting periods, inflation and deflation mechanics, and allocation of the team versus the public. Okay, and blue chip versus speculative asset, right? So blue chip cryptocurrencies, they're going to be our big heavy hitters. Okay, our Bitcoins, our Ethereums, XRPs, etc. Okay, and these assets, they have the deepest liquidity. Okay, and liquidity is going to equal money. Okay, and money equals the amount of people. Okay, the more money something has, the more people are trading it. The more people are trading it, the higher liquidity it has. Okay, so liquidity is going to mean money. So they have the highest and deepest liquidity and have proven recovery patterns over multiple cycles. For example, Bitcoin's 80% drop in 2018, followed by a new all-time highs. Okay, so people, once again, if something's a valuable resource and it dips down, people are going to be hounding and fiending and hungry to buy the dips, because I know I definitely am. Okay, I just bought some Bitcoin today. Okay, so speculative meme coins. So assets with high returns during the bull run are often the first to lose all liquidity in a bear market, okay, making them highly dangerous accumulation targets. So focus on protocols with established ecosystems. Okay, for example, layer 1 networks and major DeFi apps. Okay, so let's get assets with high returns. Okay, during the bull run, the first to lose all liquidity in the bear market. Okay, so focus on protocols with established ecosystems, things that have been around for a couple of years, okay, and has some value. Something you can sleep on your investment. So that's one thing we want to think about in trading, you know? So sometimes we hop on the markets, we think about money. You know, that's the right mindset. We're trying to run up a bag, but sometimes we got to play it safe. So the safest trades, a lot of the times, what people don't know is the safest trades, a lot of the times, is what's going to make you the money. Okay, focusing on discipline, being as safe as you possibly can with your money inside of your account. A lot of the times that'll lead you to running up that big bag. Okay. So people are going to claim that market's going into a bear market when all it's doing is going in a downwards direction. Okay. It's people who think that market's going to run up infinitely, going up forever. It's extremely unreasonable. Okay. Market's going to obviously fall down, correct, even if it's a hard correction. You have to understand that there's people who've been invested in years, months, and many more days before you even thought about it or even got in. Okay, so we have to think about those players and how long they've been waiting to close. Okay, so that's why quote unquote bear markets happen. Okay, markets just selling off due to the fact that there's too much supply. Okay, people who got in way in the beginning of time are holding so much of it. They're like, all right, I'm going to take my money and do something with it. Okay, and hence, and then a succession of everyone doing it at the same time, okay, leads to a bear market, leading price to go in a downwards direction. So staking, okay. So we'll talk about this in a second. But understand that the goal is really to increase your total asset count while the prices are low. So this is why I really promote the V. Okay. So market, it's going to fall by itself. Okay. Market's going to do its thing. And the left side of the V is going to be market falling. Now, once market makes a bottom of the V is when we want to look for a setup. Okay. Look on the weekly or the daily, look for the bottom of the V, and then catch the rest of the V gap fill. Okay. That's what you're going to be looking for. Okay, catching the rest of the V gap fill. So you want to buy something at a low ideally and catch a sweep up. Okay, buy something at a low and catch a sweep up. Okay, because if you buy something a lot of the times, okay, especially if you're like an options trade, if you buy something at super all-time highs, okay, you can expect to get pulled back on. Okay, but understand that, yeah, certain positioning, it really does matter. Okay, especially if you're gonna buy certain things that you're not expecting to hold for years and years, is especially if you're trading something like leverage crypto. Okay, then we want to go ahead and think about that. Okay, so yield farming. Okay, so providing liquidity to decentralized exchanges to earn trading fees and governance token. Okay, so that's going to be one of the things that some people do too. Okay, and that's going to be something that's just involved, but we don't really have to worry about that. Okay, as well as staking and then stablecoin allocation too, allows you to earn low risk, low yield while maintaining purchasing power for potential market dips. Okay, so there's going to be certain things you can do. Yield farming, you can pretty much kind of like the bank, get APYs, annual percentage yields on your money. Okay, if you invest in a certain cryptocurrencies. Okay, so you can do that. That's a potential option. I don't really recommend that. Buying spot or just buying normally in a normal broker is going to be just a lot safer too. Okay, because certain of these yield farm coins can go down and then you're not going to get certain of your returns that you expect back. But some of them do provide nasty returns like 40% per year and things like that on your money. So yeah, that's some things in the cryptocurrency space. So, okay, and then but market will always recover. So even if market decides to go in a downtrend, okay, if something's a valuable asset, it's putting a smile on people's faces. Inshallah, if God wills, it'll hit a sweep back up. Okay, so following every 70%, right, major drawdown in Bitcoin, for example, people were thinking, oh, it's the end of the coin, it's the end, like it's over. And Bitcoin has not only recovered, but has gone on to achieve significantly higher all-time highs every single time. Okay, and the bear market is not the end. It's simply just the consolidation phase where people are just getting a opportunity to buy in. Okay, so it's just an opportunity. So bear markets are an opportunity, hence why a large amount of millionaires were made in the 2008 recession, for example. Okay, how were millionaires getting made in one of the worst times for people? Okay, but it was really just the worst time for people who weren't investing. Okay, if you were investing during that time, you would have been able to make some really, really, really great money. So yeah. So this is why we take advantage of any dips now. Okay, any dips, we're going to go ahead and buy the lows, and then you can catch the whole sweep back up. So the bear market, it's just not the end. Okay, it's not the end. Especially if something is valuable, inshallah, you could expect to sweep up. So essential risk management and security. Okay, so self-custody is key. So let's talk about some crypto things right now. So let's talk about keeping our crypto safe. Okay, so keeping your crypto safe is gonna regard in a couple of things. So if you keep your crypto in a broker like Cash App or Coinbase, Kraken, or things like that, okay, they're safe, but if these brokers happen to shut down, then you lose access to your cryptocurrency, okay, or something like that. Okay, so you're not going to have access to certain things. Okay, so what you can do eventually, okay, you can keep it on a broker like these for now as you stack up, but I advise once you get past like 4 figures to the 5 figures range, then go ahead and start. You can still buy on these exchanges, is what they're still useful for. But after that, I recommend moving your coins to what's called a cold wallet. Okay, so you could either use it's going to be a hardware wallet, where you can actually physically plug it into a computer and then you can get access to your crypto. So those can be destroyed. That's the only bad thing about that. So again, we talked about certain things like the guy clearing the landfill, okay, looking for his cryptocurrency. Okay, so things like that are going to come into play. So you can actually just use a seed phrase. There's going to be certain things like Phantom, okay? Phantom on the Apple App Store. It's really, really good. It's just going to be like a ghost icon, okay, with like some eyes. And there it's going to be backed up by a seed phrase. And the seed phrase is going to be a 12 to 24 word seed phrase. And yeah, you can go ahead and just either write it down on pieces of paper, email it to yourself with a secure key, and just keep the code, spread it out somewhere. Okay. So you can do things like that. Okay. So cool. So now we're gonna be good. Okay. So we're gonna focus on bear markets and we're gonna be waiting for curls. Okay. We're not gonna think of bear markets as bad. We're gonna eyeball them. We're gonna see opportunity in that. Okay. We're gonna see the good in it. All right. So cool. So that's gonna go ahead and be that. Hey class, we're gonna go ahead and jump into it. Here's how to start investing with only $100, okay? So instead of buying McDonald's, instead of buying liabilities, which are gonna be items that we just don't need to be buying right away, let's get in stack mode. Let's invest, let's put some money into stocks, some dividends, and I'm gonna go ahead and show you guys how we can invest with just $100. Let's jump into it. So the power is starting small, and the biggest obstacle isn't the amount of money, it's the delay. So start today, okay? Start today. I don't care if you guys have $50 even, okay? Just start today, okay? Start today. Start doing multiple things to increase your income so then you guys can go ahead and invest more over time, okay? But instead of just having your money being lended out by the banks, and while the banks invest with your money that's sitting in the bank account, you should be investing yourself, okay? So you can invest in things like stocks. It's gonna be things like ETFs, and certain things that pay dividends, which is going to be quarterly money that you get just by investing, okay? So find certain plays, do your research on certain stocks that you like, do your research on certain ETFs that pay out certain dividends and that move in a positive direction, okay? And understand that the biggest obstacle isn't the money, okay? The real reason people don't make money within the market, even if you have $1 million in your account, some people it's still not and they are profitable. That's because they struggle with discipline. They don't know how to find the right plays. So make sure you guys do your research first, and then you're going to be able to understand that, okay, the amount of money I have isn't really that subjective. It's really about the trades that I'm making. Am I making confident trades? Am I making informed trades? Am I making sure that my take profit is relative to wherever my entry is? Okay, do I know where I'm going to exit? Do I know where my stop loss is? Okay, once you start understanding all those things, you'll understand that discipline within the market actually equals the profits, okay? So even though you're talking about $100 or starting small, forget about the money, okay? I'm gonna go ahead and just give you guys the full truth. The real reason people don't succeed in trading is because they're trying to get rich too quickly, okay? It's about discipline, grinding day after day, and growing and compounding your account by being disciplined, okay? Waking up, praying to God, okay? Studying each setup and taking it trade by trade. Don't try to rush anything and stop thinking or stop trying to get rich overnight, okay? It's gonna take building, grinding, and you should be able to fall in love with the process. That's how you'll really get to where you wanna achieve, inshallah. So the time matters, not the amount. The most powerful variable in compounding is time. Starting with $100 now beats starting with $1,000 next year. Do the magic of interest compounding on itself, okay? So just start with your $100 now. So instead of being like, oh, you know, I'm gonna go ahead and wait for it with you, just start now. Okay, go ahead and drop that money in your account and don't wait, okay? Time is not guaranteed either. You don't know when you're gonna pass, and just start going hard. We don't have time to think about anything else. Just start going hard and build the habit. Investing $100 consistently every month builds the discipline needed for long-term success, and it trains you to save and automate before the amounts get larger. And overcome fear. Starting small limits your downside risk while providing valuable real-world experience. And you learn how the market works without the fear of major losses, okay? So study the market, paper trade, know how the market works before you start throwing even more money into it, okay? So I'm just gonna keep it 100% honest with you guys the whole video. The market is gonna make you guys humble. Okay, you have to self-reflect. Don't think you're going to come into the market with ego. Okay, don't just try to throw all your $100 into a 0 DTE play. Okay, take your time. Okay, throw it into a long-term play, really get the grasp of the market, generate some more income, and then keep funneling your profits. Even if you do win a day trade, right, funnel that into long-term trades, okay, whether ETF, stocks, whatever, okay? This way your money's gonna always be making you money. Understand that money's a tool, not just a tool to go buy nonsense, okay? Money's a tool that feeds us, okay? We use it to pay our rent so we can have a roof over our head, or pay a mortgage, or buy the house, okay? And it's also used as a tool. Use it for your business, use it for your account to make more money, and real estate as well too, okay? So even though it's a small amount of money right now, cultivate your mindset into thinking, okay, I need to start understanding how I want to distribute my money. Even after you make some profit, make sure you always withdraw at least 30% of whatever money you make, whether it be at stocks, your ETFs, your business, whatever. At least put 30% away for taxes, okay? I personally try to put 50% away of all my profits away. This way, after I pay taxes, I have overhead, okay? But you guys can go ahead and manage it how you would like. So step 1 and 2, the right broker and account. So step 1, pick a commission-free broker. So a broker is going to be a place where you're going to be able to buy certain stocks. You're going to be able to buy ETFs, okay, which are exchange traded funds, which are normally like a collection of stocks and stuff like that. And you guys are going to be able to invest. And you need a modern brokerage that allows you to buy stocks and funds for free. You guys can go to my free course at stackmode.net. And I have many guides on how you guys can go ahead and set up your broker account. So a lot of brokers have small commission too, which means that when you put down a trade, you're not going to be getting destroyed by fees. This is also why it's important to be putting down trades within a logistical basis. So you shouldn't be spamming a million trades a day, because fees can also eat up your profits. And fractional shares, okay? Fractional shares are also going to be something where you can invest with not the full required amount. So say a stock, say Stackmode stock costs $500 a share. Okay, a Stackmode stock costs $500 a share. Even with $100, you'd be able to buy a fractional share of that, okay? So you could just be able to buy a fractional share and you'd be able to own it. So instead of owning a full share, you'd own like a 20th of the share, okay, for example, something like that, okay? And you can use Fidelity, Charles Schwab, and Vanguard. So, and open a taxable brokerage account. First tax account is a simple individual taxable brokerage account, and it's the easiest to set up and fund, okay? So go ahead and set up a just simple individual account if you're not trading with the LLC, which I think you need at least $100,000 in certain trading profits to show in order to trade with an LLC first, okay? So make sure you guys can withdraw your money too within a pretty quick and simple way, like instant debit card in case you ever need to get your funds out, and have certain goals too, okay? So what to buy? So you guys can buy low cost index funds like ETFs. So for new investors, diversification is going to be protection, okay? So it says don't buy single stocks here, but I'm going to go ahead and just block this part out here. It's not true, okay? You can buy single stocks. Single stocks are going to go ahead and be something that's going to go ahead and be worthwhile. But reason I do say that is because you guys need to know how to read the chart. And this is what we're going to go over here in just a second, okay? Reading the chart is going to be imperative. Do not buy single stocks if you do not know how to read the chart, okay? So the goal of ETFs, they let you own a small piece of the entire US stock market. And for recommendations, they let you choose ETFs, also known as exchange traded funds. And some popular choices are like the VOO, VOO, and that tracks the S&P 500, and that's the 500 largest US companies. The NASDAQ 100 is going to be the largest 100 tech companies, and Dow Jones 30, also known as US 30, also known as YM, is going to be tracking 30 companies. And VTI as well, it tracks the entire US stock market with over 3,000 companies. And the magic of fractional shares as well too. So in case you don't have enough money to buy the full ETF or stock, okay, and you can go ahead and either buy $100 in shares, or you can buy fractional shares, okay? So you can buy a small cap stock. When a VOO costs $400 per share, then you wouldn't be able to buy a whole share because you only have $100. So fractional shares let you buy $100 worth of VOO, giving you 0.25 shares. And $100 divided by $400 equals 0.25. and all growth and dividends apply to that fraction, immediately diversifying your first investment. Now, I need you guys to just make sure that you're knowing how to read the chart before you invest into those normal stocks, because what you might do is just buy at all-time highs and then get pulled back on, or you might not see profit for a long time. Okay, so in just a moment, once again, we're going to go over how to just read the chart quickly. So your simple investment action plan. So 1, fund consistently. So commit to transferring money automatically. If $100 is too much, do $50. And consistency is more important than the initial amount. Consistently put money in your account, consistently stay down, live way below your means, and just keep investing, letting your money make more money. Ignore what everyone else says. Don't listen to what certain people say. Okay, it doesn't even matter. Okay, just live your life. You know what you're doing. You know what you have in the stash, and you're in stack mode right now. You can't let anyone tell you anything. Okay, only God can judge you. You're good. Okay, and automate the buy. Use your broker's auto invest feature to buy your chosen ETF. Okay, also for like VTI, for example, immediately after your deposit hits, and this is called dollar cost averaging. So you can go ahead and do auto investing if you want to. You could do that with certain things too, like Bitcoin, certain cryptocurrencies. You're also going to be able to invest into, as well as dollar cost averaging. So just when you are investing, make sure that it's a consistent thing. Yeah, you can't just put $100 in something and expect to get rich immediately. Okay. And you can't really expect to get rich immediately at all. So you need to be understanding that you have to be constantly funneling money into this. So that's going to be your start, and start building your pool. Turn that $50 into $5,000. And don't forget that a lot of this is going to be saved too, because especially when you invest in something that goes up within a positive direction, okay, a lot of the times your money's just going to be growing positive equity. And ignore the noise. Okay, have a 20-year view on the market. Check your portfolio quarterly, not daily. Your time horizon is in decades. As short-term market drops are buying opportunities, not reasons to sell. Okay, so buy the dips, and just in a second, I'm going to show you guys how to identify the dips. Okay, so you need to be being patient when it comes to waiting for your trades. Okay, so when you're waiting for your trades, you need to understand 2 things. Okay, 1, okay, have a goal behind your trade. Okay, so I'm going to go ahead and just show you the types of setups that I like to take. Okay, so 1, we're going to go ahead and talk about how if market, especially if I'm investing in something I'm expecting to go in an upwards direction, and that's the whole goal of investing. You're trying to make money by buying and holding, okay, getting percentage equity curves and positive gains on your original dollar. Okay, so there's going to be 2 things that you need to know whenever investing. 1, okay, when it comes to the stock market, cryptocurrency market, ETFs, whatever, understand that the goal of them is to go within an upwards direction. There's people behind these stocks, people behind these cryptocurrency tokens, coding, putting in tons of effort, investing into it behind the scenes, putting in a lot of grind and effort in order to grow the company or cryptocurrency token. Okay, so they're definitely trying to get their piece of the pie and have their token go up or have their stock go up. So know that an area of resistance is always trying to be chased and broken. Why? Because price cannot go up until price breaks an area of resistance. And what areas of resistances are going to be areas above current price. And you can download things like TradingView to read the charts. And you can see areas above current price where you see price decided to make a dramatic downfall. So we're going to have an area of resistance here and an area of resistance here. Once price decides to pass these areas, price wants to try and progress to the next area. Now, understand that price can also reverse areas of resistances, and also know that price can break past areas of resistances and turn it into support. That's going to be one of the safest things you guys can look for when it comes to buying at the right time. So if you ask me, so Chris, how do we know when it's going to be a good time to buy? So check this out. 1, you're going to be needing to use your higher time frames. I like to personally use my daily and 4-hour time frames for almost everything. Okay, then from there, I'm going to go ahead and analyze my trade. I like to go ahead and look above current price. Okay, make sure something has a good resistance above current price, because I know at least price has something to chase. If price is at all-time highs and there's no area of resistance above it, okay, there's not really much it can do. There's not really much progression it can make. Okay, so price has to have an area of resistance above it in order for it to chase something. Price can keep going at all-time highs, but you're not going to be able to play structurally. So check this out here. So just like we talked about resistance, and that involves an area where people want to go ahead and sell whatever they're invested in. Okay, and we have to remember that this is a left to right chart. So people got in from way over here, for example. So eventually, of course, they're going to go ahead and sell in areas like up here, an area of resistance like right here. Yeah, an area of resistance here, area of resistance here. Okay, and an area of resistance up here. Yeah, and opposite of resistance, there's going to be something called support. Okay, so you're going to see this area here where price decided to tap at this blue line and then go within a upwards direction. Okay, so this is going to give us an area of support. And up here is resistance. So whenever you see price making a top and then falling in a downwards direction, that's resistance. Whenever you see price making a bottom and bouncing in upwards direction, that's support. And remember what I just told you, resistance can sometimes be broken and turn into support, even if it takes a long time to come back to the area of where the resistance was. So check it. So price can come over here, okay? And we could see price create an area of support over here, okay? So once again, this is support because price went in a upwards direction. And then we can see up here, price decided to create a heavy area of resistance. And we're using our higher time frames because it gives us an ability to see absolutely everything. Resistance. Okay. So that's going to go and be that. So we can go ahead and see over here something. Okay. Check this out. So we can see that this area of resistance created over here. Okay. We can see resistance got created. The price fell in a downwards direction and then bounced up. Okay. As we can see, price decided to also create retest here. So price broke the resistance, turned it into support. I like to call the first tap of what I call break and retest. Okay, where price breaks resistance, turns it into support, or price breaks support and turns it into resistance. That's the recommended model I recommend you guys play at any times. Okay, so when this happens, then you can go ahead and wait for resistance that was broken to be pulled back to. And if support gets held, then I recommend you guys go ahead and invest. Okay, you guys can go ahead and invest and try and take the sweep all the way back up to the upside. Okay, and catch your sweep like that. So investing is really going to take patience. If you are struggling to learn how to read the chart, I give you guys a free mentorship call at stackmode.net as well. So start now. Now that you know how to read the chart, no excuses. Go ahead and jump in and make sure that you guys have a broker installed. You can use Webull, Robinhood, any broker that just works for you. Okay. And you could buy ETFs, you could buy stocks, okay? You could buy penny stocks, okay? Just buy something that you've done intense research with, and you can go ahead and get investing like that, okay? Step right up to God, keep grinding. And once again, if you guys need investing help, head over to stackmode.net. Catch you in the next one. Peace.
Bitcoin mining is the network's backbone, and it's not just about earning crypto, it's how Bitcoin's created in the first place. Miners use powerful computers to solve the puzzles. They secure the blockchain with an immutable new block each time, and this process is the global security system that prevents double spending and fraud, and it verifies all transactions across thousands of independent computers, replacing a central authority. Without miners, Bitcoin wouldn't even exist, and it would collapse, but with them, it's become one of the most secure financial systems on Earth, powering the trust and transparency of decentralized money. Let's go and let's talk about how Bitcoins are created and why the government owns it. Inshallah, if God wills. Let's go. So, class, welcome. Let's go and let's talk about how Bitcoin is created in the first place. So Bitcoin is generated by mining it. Okay, Bitcoins don't just spawn out of thin air. And as you know, Bitcoin is also a limited cryptocurrency. So other cryptocurrencies for the most part are going to be infinite, but Bitcoin is actually going to have a limited amount of currency. Okay, there's only 21 million Bitcoins that exist. Okay, and each one of them is created by getting mined. So what happens is a computer, okay, and the computer is obviously powered by resources. Okay, so certain countries take more power than others to create certain Bitcoins. Okay, so if you're in a country that charges a lot for power, then you'd be paying more on your electricity bill in order to mine the cryptocurrency. Okay, and what you would need is a super powerful computer with a graphics card that can handle the Bitcoin mining. Okay, so what a graphics card is, it's a piece of the computer that's external. Not all computers have external graphics cards. Some have inbuilt graphics cards, which is why they're slower than others. But what you need is a really powerful computer. And then from there, you'll be able to load up the Bitcoin mining software and it can go ahead and get created. We're going to talk into the technicals, exactly how everything works. Bitcoin mining is super duper cool.
you might even want to do it and see if this is a good way that you guys might want to generate some income. Depending on what country you're in as well too, you'll be able to save a lot of money on power, and you could potentially mine yourself or create yourself a Bitcoin for way less than buying it. So let's jump into it, class. So what is mining even in the first place? Mining is not digging dirt. Bitcoin miners aren't digging into the ground with actual pickaxes, digging into the dirt, looking for resources. No. Okay, so what it is computers mining Bitcoin via a software. Okay, and the job is to secure the network and process transactions. Okay, so it secures the network by making everything decentralized. So in a traditional bank system, let's say you wanted to send a wire transfer, for example, right? The bank would be able to decide whether yes or no if the transaction wanted to go ahead and get approved or declined. Within a decentralized network, such as sending Bitcoin, things like that don't occur. Since everything is done by smart contracts, okay, everything is autonomous and automatic, done by computers, okay? And that's what Bitcoin mining comes into place too. Even creating Bitcoin, instead of just clicking print on the dollar like they do with fiat currency, Bitcoin actually has to go through a whole process in order for a Satoshi to be created in the first place, okay? So Bitcoin mining helps keep Bitcoin decentralized. The reason why the US dollar fails is because they just go up to the printer and click print. Okay, there's no real strategical process that goes from start to finish for the most part that keeps its base value cooked in. Yes, you can just print more dollars, but that would inflate the other ones. Since there's a finite amount of cryptocurrency, there has to be a secure process in place in order for it to be created, for it to be fair for everybody. And mining is the way it's done. Let's keep going. So think of the blockchain network as a public notebook. So you might have heard of what the blockchain network is. So the blockchain network is pretty much a public copy of everything that's been done, every transaction that's been created, every Bitcoin that's been mined, and every transaction that's happened. Okay. So the blockchain is pretty much going to be a verifiable place to where you can see if your transactions were even completed as well. Okay. So within the blockchain, you'll be able to put in your, let's say, address. Let's say you did a transaction. You could copy that transaction address, put it onto the blockchain or some type of blockchain checker, and you could see if there were any confirmations. Okay. Confirmations are pretty much going to go ahead and let you know when your transaction is ready to be completed. Okay. Either the money has been sent over and it's about to hit somebody's wallet. Okay. Or it's on the way to hit your wallet. Okay. Depending on the situation. So the blockchain is a public notebook that everyone has a copy of. And mining is the process of adding a new page, okay, which is a new block to this notebook. So page 1, right? Let's say Alice sent some money to Bob. Okay, let's say they sent 5 Bitcoin. You're going to be able to see that. Okay, you'll be able to see the Bitcoin addresses, etc. And you'll be able to see when the transaction was sent, how much Bitcoin or how much cryptocurrency was sent. And you'll be able to see the miners working on certain things as well too. Okay, you'll be able to see when Bitcoin transactions have been implemented and grounded into the blockchain. Whether a big whale is buying or selling, the blockchain shows us everything. Okay, keeping cryptocurrency really, really safe. So proof of work. So once again, Bitcoin, it's not created like the dollar. You don't just go up to the printer and click on print over and over and over again. It's created by POWs, also known as proof of work. So to add a page to the notebook, computers must solve a super hard math puzzle that requires a pretty powerful computer as well too. So make sure you guys have a good graphics card inside of your computer before you think of doing anything like that. Okay. So to add a page to the notebook, you got to have a super powerful computer, and then the computer has to do calculations and try to guess the number. Okay. So imagine guessing a number between 1 and 1 trillion. Okay. You have to guess randomly. So computers then make trillions of guesses per second to find the random number, okay, which is going to be the hash, okay? So that's how the proof of work works. And that's pretty much all the work that the computer is doing. The computer is constantly running calculations, trying to find and guess the correct numbers in order to generate a Bitcoin, okay? And that takes a lot of power, a lot of resources. So make sure you guys are watching your energy bill before you think about getting into this. So this is exactly what I mean. You need a powerful computer, okay? Your computer has to be good. It can't be a weak computer, okay? So understand that you cannot mine Bitcoin from your laptop, okay? You cannot mine Bitcoin on a laptop. anymore. Okay, so these with, you know what I'm saying, with the screen, a little keyboard, not cutting it if you want to mine Bitcoin. Okay, get yourself a real strong desktop with a real graphics card before mining Bitcoin even crosses into your brain. Okay, so you need specialized machines called ASICs. An ASIC stands for an application specific integrated circuit, and they do one thing: guess numbers for Bitcoin. Okay, they're loud, hot, and they use a lot of electricity. Okay, so before you guys think about just putting it into your room, keep all of this into play. Okay, keep all of this into play. Same for Airbnb owners as well too. If you guys have Airbnbs, what people are doing is signing up for Airbnbs and mining Bitcoin at Airbnbs in order to save money on power bills and stuff like that. Or people are also even moving to other countries in order to save on power bills too, so they can mine Bitcoin for a lot cheaper. So keep all of these things into play and understand that the future is really changing a lot. People are starting to get a lot more equipped and doing a lot more strategical moves to mine all the Bitcoin as possible before it goes away. So what's the point of this? Like, why do it in the first place? So the reward, right? The winner who solves the puzzle first gets paid in brand new Bitcoin. Okay, a brand new Bitcoin. So Bitcoin is created by whoever has the best computer, right, and is solving the most problems. Okay, the more computers you have solving more problems, okay, the more Bitcoin that you're going to accumulate in the first place. Okay, so it's going to be either one computer or a whole room full of computers. Okay, and what they're doing is they're doing math. Okay, 2 plus 2 equals, okay, and then whichever one of the computers can find the hidden number, okay, goes ahead and generates the Bitcoin. Okay, after you find the random number, or one of the computers generates it and finds the right calculations, then a hash is going to go ahead and get created. Okay, then from there, you're going to go ahead and get paid within your Bitcoin. And you keep doing that, keep doing that. Now, the computers do have a high chance, once again, to consume a lot of power, which means that the resources inside of the computer, processor, graphics card, RAM, etc., have a high chance to go out and combust. So before you think about doing this, make sure you guys have some money to the side to pay your bills, maintain everything. So I don't want you guys going broke to do this. But this is how Bitcoin is created by computers solving complex math, looking for a specific number. And once again, the more you have, the more Bitcoin you'll be able to generate. Since the more computers you have, inshallah, if God wills, the quicker you'll be able to look for hash codes, and the quicker those computers will be able to solve different types of calculations. So what's the point of this? Why is it essential for security in the first place? So it's costly to cheat, right? So to fake a transaction, you need more computer power than all other miners combined, making it pretty much obsolete, not even worth it, and not even, once again, not even worth the while. So immutable. So once a block is buried under other blocks, it's mathematically impossible to change it, because the way that Bitcoin works is that the computer is hunting for hidden numbers. Okay, it's hunting for random numbers and it's trying to guess the correct numbers. So the chances of it being faked or created within a false context would pretty much be almost impossible. Okay, since there's so many numbers and it's looking to guess the correct one, and it's decentralized. So no single boss controls the ledger. So no people can just be like, you know what, we're going to decline this transaction. We're going to approve this transaction. Oh, you want to send $10,000 to somebody in another country? You know what, we're going to go ahead and decline this and shut down your bank. Okay, that's happened to people. Okay, and that's not fair. It's not fair. There might be money you might need to send to somebody in another country to help send your family some money, to help pay your employees or whatever. Cryptocurrency is such a beautiful blessing on this earth. God is the greatest, you know? It's being able to send $1 million to somebody the next day. Boom. Just like that, snap of a finger. And nothing is even remotely concerning, okay? It's beautiful. We want to be focusing on buying as much cryptocurrency as possible, guys. Focus on it, okay? Focus on it. So no single boss controls the ledger, guys. It's decentralized. We're all in this together as a family. And thousands of miners protect it together. Okay, the cryptocurrency community is really a family. They just want people to send money and collect their money freely, without any restraints, without any cringe blockages or anything like that, without any 3 a.m. shutdowns. They just want people to send their money borderless all around the world and spend their money all around the world. God is the greatest. You know, to be able to live in this type of time period where we can have this type of decentralization, it's really a blessing. Okay, take advantage of this time period, guys, and let's keep learning about cryptocurrency. So let's talk about the wall of energy. What is this? Okay, so it's a feature, not a bug. So people complain about energy use, but that energy is a wall protecting the money. So you have to understand that the printers, okay, if they just keep printing the dollars, inflation is going to continue to increase. Okay, which is why the US government, for example, is running to cryptocurrency to kind of save its tail. So energy equals real world cost. Okay, you can't really fake that. When that mean power bill gets sent over to you, you got to pay that. That just is what it is. Okay, it's kind of hard to dodge that because it costs real actual money, electricity to mine, and you need an actual account too. You can't just be like a fake person. You got to actually go sign up for the power account, put your card on there, etc. So because it costs real money, electricity to mine, you're incentivized to play by the rules, keeping it safe and free though for everybody. Okay, free for everybody to jump in, I'll say. Okay, because some things are going to be gate kept through certain other things, but as far as just the freedom to start, anybody can start. Okay, you might just need the ASICs computer, pay for the energy, but as far as just the freedom to start, anybody can start. So if you cheat, you waste electricity and you lose money. Okay, so it's pretty much not going to be worth it at all, because the point of this is to gain some Bitcoin. So inshallah, you can maybe see some profit. So keep everything stable and keep everything well-rounded. Make sure you have everything planned before you just start trying to do anything. Okay, so let's talk about the life cycle, right? So a broadcast. So if you send one Bitcoin to a friend, the network is going to hear it. Okay, the blockchain is going to see it. You could see if the transactions were completed via what's called confirmations. Okay, so compete. Miners then race to solve the math puzzle, the hash, to box up transactions. Okay, and then verify. The winner shows their proof and everyone checks it instantly. And this keeps it secure. Okay, this page is glued to the notebook forever, also called the blockchain, and then the miner decides to go ahead and get paid. So that is the full 1, 2, 3, 4 cycle of how Bitcoin mining actually occurs. Okay, so the computers are looking to solve the hash puzzle. Okay, after the computer solves the hash puzzle, then the miner will go ahead and get paid in Bitcoin, inshallah, if God wills. So keep it simple. All right, y'all. Happy Bitcoin mining. I pray you guys do well. If you want to go set up a rig or set up your own basement, do it. Okay, be ready to pay that electricity bill, but I believe in you guys. If you're interested in Bitcoin mining, head over to stackmode.net for all trading education, and I'll teach you guys and we can talk about absolutely whatever. Stay prayed up to God, keep grinding, and I'll catch you in the next one. Peace.
To survive volatile markets, discipline is essential, more so than strategy or indicators. Volatility punishes bad habits, not just bad trades. When a trade moves against you, or price runs, an undisciplined trader panics or chases entries, making them unpredictable, not the market. Discipline distinguishes consistent traders from the gamblers. It means that you stick to your plan, you manage your risk, and you wait for confirmations and wait for the right entries, even when your emotions urge you to break the rules. Long-term success requires self-control, as the most dangerous factor in a volatile market is an undisciplined person trading. And it doesn't matter how much you've made either. A season of having low self-control can wipe out months of progress. Let's talk about how we can train our mind to make the right and righteous decisions in the market, inshallah, if God wills. Welcome. This session will not focus on charts or indicators, but on the single greatest detriment of long-term trading success and success in general, whether it be in business, on the charts, wherever. Discipline is the separation factor, which is going to separate from who's successful and who's not, who's going to be sticking to their stop loss, who's going to be adhering to their risk management, and who's going to be able to take the setups that they said that they're going to stick to. Self-mastery and emotional control, whether in the business world, on the charts, is going to be the separating factor between who's successful and who's not, and who's going to be winning within this world. Let's go and let's jump into the presentation. So the volatility trap, right, where most traders fail and fall in a downwards direction. Volatile markets, like cryptocurrency, amplify human emotional biases. Same thing with futures, leading to impulsive and destructive decision-making that quickly can drain capital. But it doesn't have to be that way, I really promise you. When the market is volatile, it's extremely bearish, which means markets falling in a downwards direction quickly. Or if market's extremely bullish, which means markets going in an upwards direction quickly, you need to be prepared for either sides. Okay, if you're telling yourself you want to invest into some spot cryptocurrency, right, which is where you're going to be making money when price goes in an upwards direction. So If market is volatile and it's making a certain low, you need to think of that as a positive. If market's dumping down really, really fast, you shouldn't think, oh my gosh, I'm losing all my money. No, that's going to be an opportunity for market to collect more ammunition and sweep back up further. You have to understand that no matter how low the market's dipping, when you're trading a good asset that puts a smile on people's faces and helps the future, within a couple of weeks, months, or years, inshallah, a lot of the times, and you could check out some old price action to see if I'm lying, you'll see price recover way past where it fell below, okay, and previous all-time highs as well. In order for price to keep breaking into new all-time highs, market has to fall in a downwards direction. Market has to come down in order to go back up. It has to collect ammo and collect liquidity. So don't fall into FOMO, okay? There should be no fear of missing out, okay? The fear of missing out causes traders to enter late and buying near the top based on social media hype, ignoring their own analytical framework, and doing things like that. Buying based off of hype is going to destroy your P&L. You should be looking at the chart. You should be knowing what type of economic decisions or factors happen within the world to base your assessment on how much you're going to invest, okay? Once the SEC laws started getting passed and Bitcoin started becoming a more government-friendly asset, it started going up to new all-time highs. We started seeing 100K plus get passed. So analyze what's happening within the world and on the charts before just making a certain decision, before you just sell everything or buy quickly. And fear, uncertainty, and doubt, FUD. This can lead to panic selling at the bottom during a market correction, okay? Make sure you guys are trusting God. You guys don't need to be panic selling. You don't need to be making yourself lose money quicker than you need to. Sit on your trade and wait for the trade to cook. Wait for take profit to get hit. And locking in losses just before a rebound hits is what keeps people unprofitable. Wait for market to hit your take profit before you close your trades. The majority of you are losing money within the market because you're selling too quickly. You think you're going to hit your take profit overnight, the next day. No, sometimes trades are going to take days, weeks, months. That's why I tell you guys to do everything on your higher time frames, okay, to remove that cognitive bias from you from the smaller time frame. You need to have your higher time frame bias and understand that the market is going to take months, weeks, years, and days in order to get to where it needs to be. So don't sell off of a quick couple of days worth of price action. Stay on your trade. And two key psychological phenomena drive irrational exits and entries, okay? Trying to avoid loss. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain, okay? So humans prioritize survival mode, but don't just think losses as survival mode. When you're down in your P&L, don't think that you lost. You only lose your money when you decide to close your trade, okay? When you exit the trade, then you are going to be out of your money, okay? Until then, market can continue to do whatever it wants. Hey, not saying to sit there and hold trades forever, but a lot of you are losing because your stop loss is way too small. So if you're on options, I recommend your stop loss be the contract itself. Try and buy 1 to 2 years out, okay? Buy a leap contract, and this way you can sit on your contract for some time. Same thing for your shares. Try and hold your shares for some years. There's also going to be some long-term tax benefits for crypto and shares when you're holding your trade for over a year, meaning that they want you to hold for a long time. Same thing with futures too. Don't get destroyed by the prop firm cycle. Boot up your own live account, have enough margin, and hold your trades overnight. This way you can play the real structure and you're not going to be taking any trade on the block, destroying your account much quicker than you would trying to conform to somebody else's rules, or even worse, trying to make some quick profit. That's never how we want to think on the market. Never think quick in the market. Okay, and confirmation bias. Seeking out only the news and opinions that support a trade that you already entered, ignoring clear signs that the market trend has reversed. Okay, not everyone knows everything. Okay, read the chart and do your own economic decision making when it comes to getting in and out of trades. Okay, and you gotta have a plan. Lay out your blueprint. Okay, if you're a break and retest trader, wait for resistance to get broken and turn into support. Okay, if you're a reversal trader, wait for support to get formed and catch the right side of the V into an area of resistance or support above current price. Okay, have a blueprint. Know what you're buying. Okay, if you tell yourself you want to buy $500 or $1,000 worth of Bitcoin every single month, you got to do that regardless of where the price is, because you're trying to DCA, and DCA means dollar cost average. Okay, stick to your plan. I don't care what you're trading, futures, crypto, options, it doesn't matter. Having your blueprint and developing an ironclad plan that you pretty much never break is going to set you apart from every other trader. Discipline begins before you place a single trade, and an ironclad trading plan removes emotions by codifying exactly when you enter, when you exit, and how much risk you're going to manage. Okay, if you have $1,000 account, for example, right? If you have $1,000 account, you should not be trading with more than 10% of your account at a time, ever, which means that no single one of your trades should ever be more than $100 if you're trading on $1,000 account. Okay, try and trade between 1 to 10% of your account at a time. This way, you're going to have a significant advantage in many, many ways. Okay, make sure you have that advantage. Okay, to stick to 1 to 10% of your account per trade. Do not break this rule. I don't care how much your account is up or down, try not to ever break this rule. And define entry and exit criteria. Your plan must specify clear, objective, technical, or fundamental conditions for both entry and exit, and never enter a trade based on gut feeling or instincts. Make sure you guys have definitive, structured layouts and boxes checked. Be like, okay, market did this. Okay, market did this. Okay, cool. I think I'm ready to get in. And have a rule-based entry. Okay, here's an example. I will only buy asset X if the daily RSI is below 30, for example, or I will only buy asset B if the V formation is starting to form and curl in an upwards direction on my daily or 4-hour, or I'm only going to buy asset C if market hits this certain price and I'm going to buy the dip. Okay, see how you want to structure your plan and stick to it, and stick to your time horizon and review your schedule. Define whether you're a scalper, day trader, swing trader, or an investor. Okay, do you like to trade for ownership? Then maybe you need to look towards crypto and shares. Do you like to trade based off of speculation? Then maybe futures and options are going to be based for you. Or you could take that futures income and put it into crypto and shares. That way you guys are going to be able to get that speculative money based off of your skill quickly, and you're going to be able to take that and put that into ownership. This way you're going to be able to leave some crypto for your family if you ever pass, God forbid. Okay, or you'll be able to leave some things down for the future. Okay, so your future you is really, really, really going to be happy that you sat on your investments. So make your future self happy and plant your seed. Okay, think of it like a big tree. You got to plant it. Okay, water, sun, water, sun, water, sun. Okay, that's how you have to grow your account. Make sure you guys are getting the proper water and sun every single day. Okay, rather in real life too, you got to keep your emotions based. Okay, make sure you guys ground, try and get some outside time if you can. It's not good to live like a rat, especially in today's generation with all this technology and stuff everywhere. If you can, especially before the market, if you're a day trader or something, have some outside time, get some oxygen, touch some grass, touch some plants, take a walk, and really work on your mental health. Getting closer to God is going to be one of the easiest ways to get better mentally. Okay, it's going to give you the full layout on how to be a good person here on this earth. Okay, and keep yourself from being mentally sick. Keep yourself from hurting yourself. So when you lose a trade, you're gonna be like, oh, I'm broke, I want this and that. No, you gotta relax. Okay, you gotta chill. Even when you lose a trade, understand that sometimes you're gonna lose. It's how you handle that loss, and it's how you prepare for the loss too. And you must stick to your chosen timeline and resist checking shorter time frames if you're a long-term trader. Okay, don't be caught up on the 15-minute bias if you're on the weekly and daily time frame. Okay, your take profits aren't gonna hit as quick as you think all the time. Give it time, let your trades cook, and take your time. Protect that capital of yours, okay? What are you trading for? Some of you open up your broker account and just start losing all of your money, okay? You're not on the market to lose money. And the main reason you guys are losing money is because, one, you're closing your trades too early, especially my futures and options traders, okay? You're just gonna literally delete capital like that, okay? My crypto and shares traders, you guys are a little more stable, okay, due to the fact that you understand ownership. Ownership a lot of the times is going to make you profitable, especially when you're owning something that puts a smile on people's faces and helps the future in many, many, many ways. And the prime directive, right? Capital protection. Okay. The most important rule in trading is not how much you can make. It almost kind of doesn't matter, but it's how little you can lose and how healthy you can keep you alive year after year after year, month after month after month. Risk management is the mathematical enforcement of discipline. Extremely important to make sure you guys are trading within your 1 to 10% of your account rule. Okay, as you get better, you know, you can increase from 1%, but I recommend you guys even start off with 1% when you're first starting trading. Okay, this is really going to help you guys just get down to the motions of, okay, you know what, take profit gets hit, boom, let me go ahead and do this, let me go ahead and do this. Okay, But as you get better, you can increase it to like 5% and then even 10% at the max. 10% is going to give you 10 trades before you blow your account. Okay, 5 trades, 5% is going to give you 25 trades of your account before you blow it up. Okay, and then 1%, you're going to have 100 trades. So depending on your percent, it's going to determine how quickly you're going to be gaining profit, but also how quickly you'll be losing profit too. So think about that. If you have a higher win rate, extremely high win rate, feel free to go up in your percentages within the 1 to 10% range. And a non-negotiable stop loss, right? Extremely, extremely important. If you say you're going to close your trade here, okay, I don't care if it's a stop loss or a take profit. If you say you're going to close your trade at a certain area, close the trade. Some of you guys are literally extremely undisciplined and you're wondering why you're not making money from the markets. Take profit literally gets hit. You got to close at that certain area before you get reversed on. Okay, it's not like you're just, oh, I'm going to close here. I'm going to close at this area of resistance because I want to. Oh, I'm going to put my stop loss here underneath this area of support because I want to. No, if price were to clip past underneath that area of support, price might fall down dramatically. And if you're a long, that's not what you want. Okay, same thing if you're in a long. If you win, you hit take profit, close at an area of resistance or support above current price. Okay, make sure you guys catch your gap fills. Get your money. Some of you guys are just losing your trades since you want to hold way too long. You gotta know where you're exiting at. You gotta know where market wants to temporarily reverse in order for it to continue its flow. Understand the staircase method and head over to Stackmode.net. I have a free course for you guys so you guys can understand the charts and market a little bit more, and tons of free videos too. A stop loss order that's pre-planned, right, is really going to help you out. You're going to know, okay, if market goes here, market will instantly close out my trade, or I'm going to close out my trade here. Okay, and it's where you admit the trade idea is going to be wrong at. And in volatile markets, a stop loss must be placed the moment the trade is entered. Okay, because market can make an extremely fast move and you might not be ready for that emotionally. You might have a $500 stop loss. Okay, but if you didn't set your stop loss, say you were like, oh, I'm going to close manually, and market decides to go down and turn that $500 loss turns into $1,300 loss because the candle was so fast, you might freeze. Pause, you might panic, and that's not what I want for you. Order if you can. This way, when market hits that order, it'll automatically close your trade the best that you can, and it's going to prevent catastrophic loss and help you protect against unexpected flash crashes or major news events, which definitely happens. Especially if you're on futures or forex, you don't want to be getting what's called margin called. Okay, this is going to be something where you might be owing the broker money if you go below their requirements, so keep that in mind. Okay, and never risk more than a small fixed percentage of your total trading capital. Once again, stick to 1 to 10% of your account per trade. If you have $10,000, your maximum loss on any one trade should be capped at $100 to $1,000. And this ensures that a string of losses will not wipe you out and allows your edge to play out over many trades instead of just getting destroyed instantly and quickly because of a bad couple of emotional decisions. Okay, you gotta callous yourself. Think of yourself like a turtle shell. You know how turtles have that shell? You gotta put the shell over your account. Have the protection so you're not out here getting swooped up and eaten by every single bird and shark in existence. Okay, take your time, protect your account. Emotional detachment, right? The zen of trading. This is why it's really important. Wake up. I pray to God instantly. Okay, I read Quran and I just am in a way better mindset. I'm in a calm mindset. I'm in an entranced mindset, and I'm ready to succeed for the day. And once a trade is entered according to your plan and stop loss is set, your primary job is to watch the market execute the strategy without interference. Place down your trade, hold. Okay, you're either going to hit stop loss or you're going to hit take profit. Okay, you're going to hold until either one of these. And it's really cringe too. Don't close your trade before stop loss or take profit gets hit, because what you're doing is destroying all of the math. You're destroying the risk to reward ratio. Okay, let's say you're taking a trade, right, and you win a 1 to 4. Okay, let's say you risked $100. Okay, if you risked $100 and you hit a 1 to 4, that means you would have made $400. Okay, so that's $300 in profit. Okay, so hitting your risk to reward ratio is going to be important for growing your account within a mathematically correct way. This is literally how the math of the market works. If you're making more than you risk, you will become profitable. Okay, you will become profitable, inshallah, if God wills. You have to make more than your risk. If you're risking $200, okay, then you should be at least trying to make $400 at the minimum. Okay, and that's going to be a 1 to 2. Okay, since you're going to be doubling your money within an asset.
Okay. That way, if you take another loss, you'd at least cushion. So try and at least always trade for at least a 1 to 2. You should at least always try and double your money within a trading scenario before it's closed. And once a trade is entered according to your plan and stop loss is set, you have to watch either take profit or stop loss gets hit. Please don't be touching your trades with your hands, because if you're impulsive, you're emotional, and you're led by your flesh, you're going to destroy absolutely everything. So overcoming impulsivity, impulsive decisions, and moving a stop loss further away, adding to a losing position, right, doubling down, or exiting too early are the quickest ways to violate your discipline. And mental reframing exercise, right? When you feel panic or greed, physically step away from the screen for just 5 minutes, okay? Go pray to God, go breathe, okay? Take a step outside and ask yourself, do the market conditions violate my original trade thesis, or is just this noise right now? And if the thesis is intact, you must adhere to the plan, okay? You gotta adhere to the trading plan. Why are you breaking your trading plan? You say you want to go put your mom in that big crib, okay? You say you want to take care of your wife and your kids, or you want to take care of your kids or whatever. You want to take care of yourself. You want to go get the lamb, yet you hop onto the market, breaking your discipline, breaking your trading plan, not taking the setups that you said you were going to take. We don't have time for this. We got to go harder, okay? We got to go harder. When you feel panic, when you feel greed, you have to understand that that is the enemy. That is the devil. And we have to pray these emotions away. Okay, A'udhu minash-shaytanir rajeem. Okay, it's very important for us to pray this away. This is just the devil trying to attack you guys, so you guys get pulled back away from the goals and dreams that you want to attack, that you want to feel and be attached to. Okay, the devil does not want you to be happy. Okay, but understand that God loves this. God wants us to be happy, and this is why God even talks about in Quran about spending moderately. Okay, you have to know how much you're risking, and you have to stick to your plan. And the art of taking profit is extremely important. Greed causes traders to hold winning trades past their logical target. And this is something that's happened to me. Okay, I'm trading straight P&L at one point in time. Okay, looking at the money. Okay, I remember I hit this one really good trade on C3AI, and I've started seeing the bands go up. Okay, start seeing the money go up. I've hit plenty of trades like this. And the next thing you know, instead of me trading based off of the chart, I start trading based off of P&L. And guess what? Since I'm greedy, and since I was trading with my eyeballs focused on the money instead of on the chart and focusing on my discipline, everything was taken away, or my win was not nearly as big as it should have been, due to the fact that I didn't stick to my logical targets. And I don't want you guys to go through that either. Your plan must include defined profit targets. For example, target 1 at 2R or target 2 at 3R. Okay, where you sell a portion of your position to secure gains, ensuring that you never let a winning trade turn into a loss. And make sure you guys also set your stop loss to above break even or certain levels too, to even keep the trade going and flowing.
And only God's perfect. So if you make a mistake and overtrade a certain day, at least care about what you did. Journal down how you felt. Journal down the emotions you were feeling when the trade was in your face. Were you close to take profit, but did you close your trade too early, ruining your risk to reward, leading you to take another trade and then crash out your account? Or what type of scenario led to you losing that trade or overtrading in certain scenarios? When you really write it down, you're able to visualize and see your mistakes. It's a lot harder to repeat them over and over again. Discipline is really a muscle that has to be trained, and the trading journal is the feedback mechanism that allows you to objectify your performance and eliminate certain weaknesses, especially when you have your numbers jotted down. If you see certain things that you're doing is leading you to lead certain results that's not making you happy, then you need to change some certain things up. And your journal needs to capture certain things. Make sure you have your pre-trade analysis, how you're feeling before the trade, why you entered, and make sure your criteria is met before you press buy or sell. And talk to yourself. How do you feel emotionally? How did you feel before, during, and after the trade? It's really crucial for identifying certain biases, especially when market changes certain directions. You know how to pinpoint certain issues that you're having. And violations. Did you adhere to your stop loss and your take profit rules? And ask yourself why. And talk about the market context too. Did you take a long? Did you take a short? And note the macro environment. And do your weekly and monthly review. Treat this review like a performance audit. When you're trading, you're your own business. So identify your most frequent violation and need to cut certain things out. If you're constantly moving your stop loss, your issues and strategy, you got to stop being led by your flesh. You got to be way more disciplined than that. If you want to touch that big bag, even when you touch that big bag, it doesn't really matter. It's about keeping it. You're not going to be able to keep it if you keep moving off impulse. Okay. Your loss aversion and lack of conviction in your plan can really lead you to certain areas that you don't want to be led to, such as overtrading. When you overtrade, one tiny loss can lead into a whole destruction series of your account. And it's a lot harder to bounce back from that, just from one tiny loss, especially on things like prop firm, where you're chasing certain parameters. So detach from the money, focus on the charts, and be more disciplined. And trading small is really going to help you in certain areas too. If you notice you're feeling a high amount of pressure, like I have to win this trade, you probably shouldn't be in it. Okay. If you lose the trade, you should be completely comfortable. And just like the previous slides we talked about, staying within that 1 to 10% risk management parameter percentage field is really going to help you out. Okay. It's going to be a lot harder to blow your account when you're not going over 10% of your account per trade. Okay. You could do 5%, have 25 trades, and that's a lot of trades before you blow your account. You shouldn't be that inconsistent, truthfully. You got to wake up, pray to God, and be consistent with every dollar that you generate. You also got to be a little more loose within the markets too. You got to stop being so restrictive. Having super tight stop losses and trying to micromanage every piece and point of price action is a good way to lose all your money and be frustrated. Okay. Play with much bigger stop losses and give your trades some time. Sit on it for some days, some weeks, some years, and really let your money sit. Okay. If you're going to invest, you can't be desperate for income. One thing I recommend you guys do is hide your balances. On all your brokers, you should have the ability to either hold down your number, and this way, even if you're down, you're not going to be tripping. Okay. You could be down 50%. You're not going to be in anxiety. You're not going to be in survival mode, because I can assure you within a couple of days, weeks, or months, price will reverse and go way past wherever your original take profit was. Okay. Market has to go down in order to come up. So you can't have certain emotions, especially in volatile markets. If market's moving super quick, you can't feel like you have to close your trade instantly, because you're not going to be able to see the bigger picture. Being on the higher time frames, your monthly, your weekly, and your daily is really, really important. Because if you're too zoomed in on your smaller time frames, that fast price action is going to look like the scariest thing of all time, especially when it comes to futures, forex, and things with margin like that. But it's really not that bad. So I really recommend you guys stay on your 4 hour plus, turn on your extended trading hours, of course, but try and stay on your 1 hour on like the lowest time frames a lot of the time. Because when you're on your super small time frames, price action, especially during volatile days, news days, etc., it's going to look a lot quicker than it needs to be. And on the 4 hour, it's going to look like a normal trade, or going in a completely different direction than you might think. On the 5 minute, you might be looking at a bearish scenario, and then on the 4 hour, market's going in an uptrend. Okay. So you can't go off of your lower time frame bias. I truthfully believe it's there just to get your emotions riled up, especially when it comes to future scalpers and things like that. You have to know your higher time frame bias, and don't get tricked about that. Okay. There's plenty of people who are successful within the market who just buy and hold, who never even taken a look at the charts. Okay. So before you tackle volatility, you have to build the discipline to execute your plan. And you have to get those psychological parameters down. It's really, really, really psychological, the charts. You can be really, really good technically, but if you don't close at your take profit, it won't matter. Or if you feel like you're better than closing at your levels, then you'll definitely get punished, reversed on certain areas, and get what you deserve. Market is also very, very fair. So if you're disciplined, you wake up, pray to God, you close at your levels, I can assure you 99% chance, just like my students, you'll see a very, very, very successful upwards equity curve in your account. But if you're undisciplined, getting greedy, even when you've hit your take profit, trying to trade past that, it's not about the money. Okay. If you break your cycle, break your consistency, and start averting from your plan, it's going to build into you. And then that's going to build into bad habits. That's going to lead to you being overconfident in certain scenarios. That's not logical, leading you to overtrade. And when you crash out your account, you might be frustrated on the market, but you should just be frustrated at yourself. Okay, I don't want you guys to go through that cycle. That cycle can be really, really hurtful, especially when you've been grinding your business, grinding at work, and putting that money into the market, expecting to make some money, and then you lose everything. Okay, I don't want you guys to be going into debt, going through frustration, losing your account. So please just wake up, pray to God, and plan your trades. Okay, promise me, if you guys watch this video, plan your trades before you put a single dollar into whatever. I don't care if it's Bitcoin, options, Forex, futures. Promise me you'll plan your trade. Okay, don't ever just trade thinking that, you know what, I'm going to get in this making some money. No, have a technical plan. Know when you'd exit, know how much you're going to invest, know how you're going to close your trades as far as take profit and stop loss wise, and have this process repeated, especially once you find your positive flow. Once you find your flow, I don't care if you're taking break and retest. If you're a breakout trader, I'm not going to tell you guys to trade one way, because different things work for everybody on the planet. It's the cool thing about life. Okay, God gave us all individual separate brains for us to do separate things. If you're a breakout trader and that's working for you, you need to stick to that.
If you're a reversal trader and that's working for you, you need to stick to that. You can't get on YouTube, see what this person's doing, and then change everything even though something's working for you, okay? Find your process, find your flow, find what you like to trade, and then stick to that year after year after year after year after year. Think of it like working out, for example. You can't get on the floor, do 20 push-ups and 6 crunches and get a six-pack. It takes days and days and days of eating consistently, eating clean, okay, working out consistently, getting the proper sleep, making sure your bones and your muscles regenerate properly. You have to treat your account, your income, or your business the same way, okay? You have to be consistent. You can't have $10,000 in Bitcoin and then think $20 is not a lot, okay? This is why I say you have to detach from the money. You could have 5 million in Bitcoin and still, when you get $5 extra, throw that into some Bitcoin. It's about the habit. Okay, I'm telling you, when you build that habit and you start thinking and planning and doing your actions for the future you, the current you will be a lot more happy and you'll be leveled up a lot quicker. Okay, so head over to Stackmode.net for all trading education. Catch you guys in the next one. Stay prayed up to God. Keep grinding. Peace. Let's talk about DeFi. We'll talk about how decentralized finance changes absolutely everything. No more bank systems, no more getting your transactions declined. It's just a peer-to-peer transaction system where if you send your money, it's going to go ahead and get directly sent to the other person using the blockchain system. We're going to go ahead and talk about what DeFi is, what cryptocurrency covers, and how it works. Let's go and let's get to it. So what is decentralized finance, also known as DeFi? DeFi refers to the financial systems built on the blockchain technology, primarily Ethereum, also known as ETH or ETH. And that operates without intermediaries like banks or brokers, which means that when you send transactions from one person to the next, there's going to be no middleman involved like the banks in order to decline your transactions. So everything is autonomous, which means everything is automatically done on the blockchain system using smart contracts. Okay. So everything is blockchain based, which runs on the decentralized networks, which means no banks are involved or brokers, and it ensures transparency and immutability. And smart contracts, the automatic process used in order to direct cryptocurrency from one person to the other. They're self-executing contracts coded to handle transactions automatically. And they're permissionless. Anyone with internet access can participate with no KYC required. Okay, cryptocurrency can be traded all over the world globally. So if you're trying to run a business and you're trying to get paid in any country, you can transfer currency from one person to the next. And it's open source. The code is publicly audible, fostering trust. And unlike traditional finance, DeFi eliminates middlemen, reducing costs and increasing accessibility. And for example, a farmer in the developing country can borrow funds without a bank account involved. Why DeFi matters. Let's talk about the bigger picture. DeFi is reshaping finance by democratizing access, enhancing efficiency, and fostering innovation. It's a $100 billion plus industry as of 2025, and it's continuously growing, especially as laws get passed, governors and hedge funds start participating in Bitcoin, as well as companies as well too. Financial inclusion. 1.4 billion unbanked people globally can access services. And speed and cost. Transactions settle in minutes with fees often below $1 versus high bank costs in order to wire transfer, like $25 for example, or something like that for a wire transfer fee. It also gives you full transparency on the DeFi network. All transactions are on-chain, okay, verifiable, and you can go ahead and see if something's been confirmed, which means the transaction has most likely hit the other person's wallet, or it's on its way, or it's going to say unconfirmed, which means it's still on its way, but it's just still in the void. Okay. And innovation. New financial products like yield farming emerge rapidly, where it replaces APY, also known as average or annual percentage yield. Okay, and that's where you pretty much invest your money and you're expecting it to make money year after year by just holding a percentage of your income in there. So certain bank accounts have like a 0.5% API, for example. Okay, so let's just say, for example, I don't know if it's 100% accurate math, but save $100 in a 0.5% APY account for 1 year. Next year, you'll have $120. Okay, so you profited $20. Okay, so cryptocurrencies and DeFi involves new financial products like yield farming. Yield farming, so instead of 0.5% APY, they have percentages that go from like 5% to over 100%. So let's say you could potentially invest your money from $100. The next year it's $100,000 or something like that. Okay, or $10,000. Okay, so any type of example, but there's going to be volatility included into it too. Your money can definitely crash down, and sometimes it can crash to zero. So more risk involved, but there's higher ceiling cap in order to make profit quicker. So for example, Uniswap, it's a decentralized exchange that allows users to swap tokens without a central authority. And in 2024, it processed over $2 trillion in trading volume. Okay? And trading volume is pretty much the amount of money and the amount of people that are flowing within the market. So core components of DeFi. DeFi is built on several key pillars that enable its functionality. Understanding these is crucial for grasping its potential. Let's talk about the blockchains. Blockchains is where Ethereum dominates, but Solana, Binance, Smart Chain, and others support DeFi. And wallets, non-custodial wallets like MetaMask allow users to control their funds extremely quickly as well too. So you're going to be able to transfer your cryptocurrency from one place to another and operate your NFTs, etc. Okay, anything on the DeFi network. Smart contracts automate lending, trading, and more. Okay, so instead of having banks confirm your transactions, smart contracts operate and do everything scientifically. And stablecoins, assets like USDC are pegged to fiat, reducing the volatility. Okay, because a lot of the times, $1 is still going to equal $1. Even if inflation comes, it's still going to pretty much work the same. And decentralized exchange, DEXs, platforms like Curve enable peer-to-peer trading. One person, once again, gets one amount of money sent to the other person without any middleman involved. And these components work together to create a trustless ecosystem. And for instance, a user can deposit USDC into Aave and earn interest via smart contracts and withdraw via MetaMask, all without a bank. And key DeFi applications. DeFi offers a range of financial services, each transforming each forward to traders. So let's transform the most impactful ones. So lending and borrowing. Platforms like Compound allow users to lend crypto to earn interest or borrow against collateral. For example, you can earn 5 to 10% APY on stable coins. So which means, for example, if you have $100 in a stable coin with a 10% APY, okay, next year you might make $1,000, okay, something like that, for example. And trading. DEXs like SushiSwap allow token swaps without intermediaries, where you can just go ahead and swap your cryptocurrency from one to another quickly, instantly. You get what you want, whatever products you want to trade, how much bread you want to send. And yield farming. Stake assets to earn rewards, and users provide liquidity to pools and earn tokens. And Uniswap's Uni rewards. And staking. Lock tokens to secure networks like Ethereum 2.0, earning 4.7% annually. Okay. And insurance. Nexus Mutual offers decentralized coverage for smart contract failures. For example, MakerDAO lets users lock ETH to mint DAI. It's a stablecoin, and users control the system via governance tokens, embodying DeFi's ethos. And a lot of times, the people who get a lot of the power is going to be large investors. So it can turn centralized sometimes, depending on who's the biggest investor, but things like that can change. Let's talk about the risk and challenges in DeFi. So while promising, DeFi has significant risks that users must understand to participate safely. There's sometimes some smart contract bugs. Bold vulnerabilities can lead to hacks. An example, the 2020 Yam Finance bug drained $750,000. And liquidity providers lose value if token prices diverge, and affects yield farmers on Uniswap. And governments may impose rules, impacting DeFi's permissionless nature. And there can be high gas fees involved. Ethereum transactions can cost $10 to $100 during congestion. And scams, rug pulls, and fake projects can be common too. Sometimes social media influencers can go ahead and try and create a meme coin, and they're going to go ahead and be a large holder of it, say like 60%, and they buy in at the bottom. Okay, by the time they start promoting it, the chart goes up. Since they're at the bottom, they hold a lot of the liquidity. By the time they sell, it's for a profit. Once it starts going up, okay, market's going to go ahead and crash since they hold a large percentage of it. Okay, so be careful for rug pulls, anything like that. It's how people just make quick money, and it's not a good way to make money. And getting started with DeFi. So are you ready to dive in? Here's a step-by-step guide to participate in this DeFi safely and effectively. So we'll help set up a wallet. You can go ahead and install your MetaMask or Trust Wallet, Phantom, whatever, secure your seed phrase. That's going to be your like 12-word phrase in order to get back into your account in case you ever lose any password or anything like that. Keep it hidden. Don't give anyone that phrase. Okay. Lock it up and encrypt the password. Do what you need to do. Okay. Make sure you keep it safe. So you can connect to DeFi apps as well. You can visit Aave, Uniswap, or Compound via their D apps. You can go and buy Ethereum as well too on exchanges like Coinbase. And research projects, you can check audits on RugDoc or Community Trust Scores. And you can also start small. So start with $100 to learn mechanics before scaling and stuff like that, for example. And for example, to lend on Aave, connect your MetaMask, deposit USDC, and earn interest instantly, all without a bank. In the future of DeFi, DeFi is evolving rapidly with potential to disrupt traditional finance further, since people can send money all across the world easily without getting any holds or anything like that. So what's going to be next? Let me know what you think in the comments below. So some layer 2 scaling, solutions like optimism reduce fees and boost adoption. Okay. Layer 2 scaling is going to be a big thing that brings a lot of solutions and fixes to a lot of issues like high fees. And there can be cross-chain DeFi bridges like Polkadot, which enable multi-chain ecosystems. And banks explore DeFi for tokenized assets. A lot of banks are starting to get hip. Standard fiat banks, traditional currency banks, they're starting to get some information with crypto. Okay. So compliant DeFi may emerge to satisfy the regulations, and AI integration can also progress how things are too. And it's projected that by 2030, DeFi can manage 1 trillion assets per industry forecast, reshaping global finance. So for example, Aave's flash loans. Flash loans allow borrowing without collateral and are repaid in one transaction. And it's used for arbitrage, and they've enabled 10 billion plus in volume. Okay. And Yearns optimizes yield farming automatically, moving funds to high yield pools, saving users time and maximizing returns. And DeFi enables innovative financial strategies impossible in traditional systems. So how does DeFi stack against banks and brokers? What's the point of even using it in the first place? Access. One, access and speed are going to be the big two. Because one, you can send your bread instantly as soon as you want to anybody. It's global. And traditional finance also excludes the unbanked. And DeFi transactions settle in minutes versus days for banks. At certain times, you can go ahead and just wait a couple minutes or hours. Inshallah, you'll get your cryptocurrency. And DeFi fees are lower, though gas fees can spike up, making your profit or whatever you send or receive a little bit higher or lower depending on what you're doing. And trust, DeFi relies on code. Traditional finance relies on institution, which we've seen in the past can crash. Okay, autonomous code, also known as smart contracts, control everything within the cryptocurrency space and the decentralized network. So yeah, so for example, sending $1,000 internationally via banks, $1 fee on some banks, and DeFi does it in minutes for $2. Okay, so it doesn't even matter. So ethical and social implications. DeFi's permissionless nature raises questions about responsibility and impact. So inclusion. It empowers undeserved communities but risks exploitation without education. And decentralization. It reduces reliance on corruptible institutions, but it may enable illicit activity. And Ethereum's proof of stake, POS, reduces energy versus proof of work, which is what Bitcoin uses in order to be created. So it exchanges power in order to create the Bitcoin. Okay, but proof of staking is using autonomous contracts in order to create the cryptocurrency like Ethereum, for example. And DeFi's potential to the bank is huge, but scams highlight the need for user education. So make sure you know what you're doing. Make sure you're not getting scammed out of your seed phrase, wallet code, or anything like that. Once again, do your education before you do any investing or sending a bread. So, what excites you about DeFi? What concerns do you have about it? Are you investing in cryptocurrency? And if you want to learn how to trade cryptocurrency, head over to Stackmode.net. Catch you in the next one. Stay prayed up to God. Keep grinding. Peace. What's going on, class? We're going to be talking about Forex trading fundamentals. We're going to be understanding what a pip is, what a lot is, and how Forex leverage works, and what leverage is in the first place. These are going to be the three pillars of position sizing and risk management. Welcome to the class. Let's jump into it. So let's understand what a pip is. A pip stands for percentage in point. Okay. So that's what pip is short for. PIP stands for percentage in point, and it's the smallest standard unit of price movement. So the definition: a pip is the standard unit used to express the change in value between two currencies. For most currency pairs, a pip is equivalent to the fourth decimal place. Okay, so for example, dollar 0.000, and then the fourth decimal place, so then 1. Okay, so for example, and a currency pair is going to be something like USD JPY, for example. Okay, something like that. That's going to be referred to as a Forex pair. And many brokers now quote prices to a fifth decimal place. And this fractional pip is often called a pipette or a fractional pip, allowing for tighter spreads and more precise execution. And calculating the pip value, USD quote currency. Okay. And the monetary value of a pip depends on two factors: the currency pair, just like we talked about, this is the currency pair, USD, JPY, etc., and the size of your trade, and that's going to be the lot size. That's going to be the amount of money you have allocated into the trade, whether you want to be at $10 worth of size or $100 worth of size. Okay. So for example, let's say you're trading Euro USD. Okay, let's say you're trading this pair. If Euro USD moves from 1.0001, let's say Euro USD is at that price, okay, to 1.10002, okay, that's a 1 pip movement. Okay, so the fourth decimal place changed from 1 to 2. That's going to be +1, so that would be a 1 pip movement. Okay, and 1 pip is equal to 0.0001 per unit of base currency. And an exception: pairs involving the Japanese yen, okay, JPY, are typically quoted only 2 decimal places. For example, a USD JPY, a movement from, let's say, 150 to 150.1 is going to be 1 pip. Okay, so instead of the fourth decimal place, it would be just the sen. Okay, so which would be the second decimal place. So the concept of a lot. What is a lot in the first place? So this is going to determine what the trade size is going to be, how much money you're going to be putting into the trade. And it's the volume that determines the profit and your loss scale. And a lot defines the currency units that you're trading. And since currency moves in tiny pips, large volumes are necessary to generate meaningful profit or loss. And the 3 standard lot sizes. Okay, a standard lot. Okay, it's going to be 100,000 units of base currency. And let's say, for example, be $10 per pip. Okay, a mini lot. Okay, 10,000 units of currency. Okay, and let's say it'll go ahead and be, for USD pairs, $1 per pip. And for a micro lot, let's say 1,000 units of base currency, okay, and it'll cost you 10 cents per pip, okay, of USD fiat. So the fractional representation used in trading platforms is 1.0 equals standard lot. Okay, and 0.10 equals mini lot, and micro lot equals 0.01. That's a micro lot, and beginners should start with micro lots 0.01 to manage the risk. And the importance of lot size: a 50 pip move in your favor is $500 profit with the standard lot, but only $5 profit with the micro lot. And choosing the lot size correctly is the first step in risk management. So I'm going to give you a deep dive into what leverage is in the first place. So it's going to be margin trading. Margin trading is when the broker is pretty much going to let you have a minimum amount of money, okay, and then you can go ahead and trade pretty much with over that. And it could be a double-edged sword of buying power. So here's the definition. So leverage is the ratio of the capital used in a trade to the amount of money required to open that position. which is called margin. And common ratios are going to be like 1 to 50, okay, where it's going to be have like a 50x multiplier, okay, on your currency, okay, 1 to 100 or 1 to 500. And this is the required amount, okay, and the required amount is going to be margin, and that's a collateral amount that your broker temporarily locks up from your account to maintain the leverage position. So let's say you want to trade with $5,000, okay, in hindsight, worth of leverage, right? But you would have to have a minimum of $500 in your account, okay? And let's say you go under that. Let's say you go to 480, right? Then if you don't have that full 400, you don't have that $500 minimum, right? And you go down to the 400s, then your account can be wiped down to zero and liquidated. And depending on how quick the price move that happened, that puts you underneath the minimum, okay, you could potentially owe the broker money and go into the negatives. So be careful. Margin can be a lot of power, but it could also bring a lot of destruction. You don't want to go into debt and stuff like that for no reason, okay? Something I've struggled with for making just bad decisions. I don't want you guys to go through it. So power and peril. So the power of leverage. With 1 to 100 leverage, a trader can control 100,000 standard lot position by only pulling up $1,000 of their own capital. So, and leverage is going to come with this. And if that 100,000 position loses, let's say 100 pips, okay, $1,000, the entire margin instead of $1,000, for example, is going to be instantly wiped off, leading to a margin call or automatic stop out by the broker, okay, causing you to either A, owe the broker money or just set your balance to zero sometimes. And higher leverage means smaller required margin, but drastically increases the risk of rapidly depleting your account balance. So don't trade close to margin. Make sure you guys have way more money than the margin requirement. This way you guys can trade without even having to worry about this. So here's an example, the trade calculation. Let's combine a pip, lot, and leverage in a single trade. So let's say we have a $5,000 account. Okay, let's say God bless us with a $5,000 account. Okay, and the leverage we're going to be trading with is 1 to 200. Okay, let's say we're trading USD, CAD. And the volume we're going to be trading with for this example is going to be 0.5 lots. Okay, so that's going to be mini. So calculate the position size and the margin. So the trade units, okay, so I'm trading with 0.5 lots. So I'm going to go ahead and take the 0.5, okay, and I'm going to go ahead and know, okay, so take that into 50,000 units, okay. And then from there, I'm going to take that 50,000, okay, and I can go ahead and take that by the 200, okay, and I got the 200 from the leverage amount, okay, and that's going to go ahead and give me $250, okay, so 50,000 divided by 200 is $250, okay, and for the pip value, okay, I'll take that 50,000, okay, that I got from that 0.5 times 100,000, that's where I originally got that 50,000 from, okay, then I take that, divide it by whatever the leverage is, okay, that's 250. So then I'm going to take the pip value, okay, so for the pip value, I'm going to go ahead and put that as 50,000, okay, because 0.5 times 100,000, it's going to go ahead and be 50,000, okay, and times 0.00001, okay, equals 5 units of CAD, for example, okay, and the value is going to always be in the quote currency. And for USD value, if the CAD USD exchange rate is 0.75, for example, the pip value is 5 CAD, so times 0.75, okay, so it's approximately 3.75 USD per pip, okay, and if the trade moves 20 pips in your favor, then you can go ahead and determine if you're going to be profitable or not, okay, by just keep on calculating certain costs, or you can go ahead and put it into a profit or loss calculator. A lot of brokers too will show you if you put down a take profit limit order, okay, you can go ahead and see how much you're going to make on certain areas too. So risk management, the crucial connection. So use pips and lots to control exposure. Effective forex trading is not about predicting the market. It's about controlling your risk. And this is achieved by linking lot size volume to your tolerance for pip loss, and the 1% rule in lot pricing. And the golden rule, never risk more than 1% of your total trading capital on any single trade. And for a $10,000 account, your max risk should be $100, for example, or $1,000, okay? Once you start getting better, you can trade between 1 to 10% of your account. And assume your strategy requires a stop loss, okay? Especially on Forex and futures, since you're going to be trading with leverage a lot of the time, you don't want to get margin called. So make sure your stop loss is going to be at a place that's going to be before you get margin called, okay? So you don't lose your money for no reason. And calculating the max pick value. So put it in Forex calculators, and understanding the math is really going to help you put your risk management into place. So the risk adjusted lot size. So let's say a micro lot is 10 cents a pip and a mini lot is $1 a pip. To achieve the $2.50 pip required value, you would open a 0.25 lot position, okay, which is 25,000 units, which is 2 standard lots plus 5 mini lots. And responsible trading reverses the calculation. Determine your risk percentage and your stop loss, okay? Then calculate the correct lot size, and never choose the lot size arbitrarily, okay? Do your math, put everything in calculators online, okay? Stay productive to God, keep grinding, and that's what a pip is, and I pray that it helped. Head over to Stackmode.net if you want to learn how to trade Forex, crypto, anything. Catch you in the next one. Peace.
What's going on, class? Today we're going to be talking about flash loans in decentralized finance. That's what DeFi stands for, if you're curious. What they are and how they work. Let's jump into a deep dive into decentralized finance's most atomic primitive. So defining the flash loan primitive, the power of atomic transactions. Some key characteristics. So it's based off of atomic execution. The entire process, borrow, use, repay, must happen in one single non-divisible blockchain. Transaction block. If any step fails, the entire transaction is reverted as if it never happened. It's also going to have a zero collateral requirement. And unlike traditional or most decentralized finance loans, no upfront collateral is required, making them accessible to anyone with sufficient gas. And gas is going to stand for fees within the crypto world, if you ever see the term gas. To execute the smart contract is going to be an autonomous contract in which the crypto system works off of. So instead of having middlemen like the bank systems confirming whether or not transactions can approve or decline transactions, the cryptocurrency system runs off of autonomous contracts that work automatically, calculate transactions, and confirm them on the blockchain as well too. An instantaneous repayment. The loan tenor is less than 15 seconds. The time it takes for a block to be mined on Ethereum. Okay, so it's going to take 15 seconds to mine a block of Ethereum. And the borrowed funds must be returned within the same block. And citing the source, flash loans were popularized by protocols like AV, formerly ETHLend, and DIDEX, and the mechanism relies entirely on the deterministic nature on Ethereum's virtual machine, okay, also known as EVM, and transaction automacy. And the mechanics, how a smart contract manages payment and repayment. So the borrow, execute, repay sequence. So the code execution is handled by a sophisticated smart contract deployed by the user. So this is going to be the back end of how certain cryptocurrency structures are going to be ran. This is going to be the code and calculations behind everything, which is called the flash loan pool contract. So the 3 stages within one block. So this is going to be for the borrowing call. The user's contract call is the lending pool, okay, requesting X amount of dollars in assets, okay, for example, DAI, for example. And then the execution phase to get an example, okay. And the lending pool transfers the dollar amount to the user's contract and simultaneously calls the user's contract defined function, okay. For example, execute operation, parentheses, okay. And this is where the user's logic runs, okay. For example, arbitrage swap, okay. And repayment check. Once the user's logic completes, the lending pool is checked its balance, and it must have received the original dollar amount plus a small fee. Okay, typically a 0.9% back. Okay. And the reversion guardrail. If the repayment check in stage 3 fails, aka an insufficient funds return, for example, the entire transaction, including stage 1, 2, and 3, is going to be reverted by the EVM, the Ethereum virtual machine, and the state of the blockchain remains unchanged. And the automaticity is the security feature that prevents lender loss. So a primary use case, decentralized arbitrage, and capitalizing on price inefficiencies across DEXs. Okay.
So DEX is going to stand for decentralized exchanges, if you're curious what DEX stands for. So arbitrage is commonly and one of the most intendedly used things within the decentralized exchange space. And flash loans provide the instantaneous, enormous capital required to exploit tiny temporary price differences across decentralized exchanges. So here's an example of some arbitrage for a single transaction. So let's say you borrow 10 million, okay, in USDC. Okay, USDC is going to be a stable coin based off the fiat currency in the US, okay, and the US uses the US dollar. So that's where USDC is going to be based off of from, okay. And the stable coin's purpose is pretty much to be like the fiat currency's version of cryptocurrency's reserve, okay. So yeah, cryptocurrency is pretty much just trying to make its own stable dollar that doesn't change and fluctuate too much, unlike other cryptocurrencies. So, for example, let's say the pair USDC slash Ethereum, okay, is 3K on Uniswap, okay? So that's DEX A. Then I'm gonna go ahead and say USDC is $3,005 on SushiSwap. All right, so that's gonna be $5 more, okay? And we're here to invest, so we're here to make money. So we wanna be getting the cheapest prices possible, inshallah. So let's say that's DEX B. So execution 1. So you can use 10 million USDC to buy Ethereum on Uniswap, okay? That's gonna be DEX A for $3,000. And then execution 2, you can immediately sell the acquired Ethereum for USDC on SushiSwap, DEX B, netting a profit. Okay, so you want to make sure that you're buying on the cheaper broker, okay, and then you could sell on the most expensive broker, and you could go ahead and make a profit. And if you want to make a certain amount of profit, let's say 10 million, for example, okay, let's say you take 3,000, okay, 5, okay, and then take that by the 3,000, okay, minus the 10 million, and it's going to give you a 16,666 gross profit, okay, and repay the $10 million USDC plus the fee, okay. So for example, $9,000 to have, okay, the original place where you bought the USDC from or borrowed it from in the first place, and the remaining profit, okay. So you have to take whatever you locked in minus the fees. So that's going to be the 16,000 number minus the 9,000. Okay. And then that's going to go ahead and be your net profit. So if successful, the block is mined. And the speed and scale of the flash loan execute the trade so fast that the price gap cannot close before the profit is secured. And it's a feat impossible with traditional capital. So advanced use case, collateral swapping and refinancing. So managing risk and optimizing debt positions. So beyond simple profit making, flash loans are crucial infrastructure tools for managing complex DeFi debt positions and risk. So collateral swapping, risk mitigation. So a certain scenario here. Let's say a user has a loan collateralized by Ethereum, but expects the price of Ethereum to drop sharply. Okay, let's say Ethereum's at 5K. And they think it's gonna drop down to 3K. And the user can flash loan the debt amount, okay? Pay off the original loan, withdraw the Ethereum collateral, swap the Ethereum for a stable collateral like DAI, for example, and then repay the flash loan and recollateralize the loan with the new stable asset. All in one transaction. The user can mitigate liquidation risk by swapping volatile collateral that fluctuates a lot for stable collateral without ever needing to close their debt position entirely, making your profit being able to be there, and then your profit's not going to be moving much afterwards, inshallah, because you're going to be investing in something stable. So refinancing, so rate optimization. So users can use a flash loan to instantaneously repay an existing loan on Protocol A, which has a high interest rate, and immediately take out on an equivalent new loan on Protocol B, which has a lower interest rate, all while preserving the original collateral. And this is known as debt migration. And the dark side, flash loan attacks and exploits, the vulnerability of price oracle manipulation. So while the flash loan contract itself is secure, the lender funds are protected by reversion, and the ability to access massive temporary capital exposed other protocols to sophisticated attack vectors, primarily through price manipulation, and how flash loan attacks work. So target vulnerability. The attack exploits a protocol that relies on a single low liquidity DEX or an easily manipulated on-chain mechanism to determine the price of an asset, okay, the price oracle, and the capital injection. The attacker uses a flash loan to buy or borrow a huge sum of the token. Okay, let's say for example 50 million. Okay, so just like we talked about, you could borrow 10 million of USDC. Let's say they try to get 50 million, okay, for a flash loan, and then price pump. The attacker dumps the 50 million loan worth of the token, okay, into the DEX, dramatically inflating the price of the token, okay, which the vulnerable protocol uses as its price oracle. Okay, so they're gonna go ahead and dump 50 million into token X, and that's gonna inflate the price of token Y. And the attacker then uses the artificially high price of token Y to borrow massive amounts of other assets from the vulnerable protocol, often exceeding the value of their collateral based on the manipulated price. And repayment and profit. The attacker repays the initial flash loan plus fee and keeps the huge surplus borrowed from the now drained victim protocol. And defense. Protocols have largely countered this by adopting robust, time-weighted average price, also known as TWAP, oracles that are resistant to single transaction price swings. So summary and future outlook, okay? Jump into it. So here's a quick summary of flash loans. Flash loans are not inherently good or bad. They're powerful, neutral financial tool built on the unique properties of blockchain automaticity. Some key takeaways for the class. An uncollateralized loan that exists only for the duration of a single atomic block transaction, okay, and has security mechanisms. The lender is protected by the Ethereum virtual machine's atomic transaction reversion if repayment plus the fee fails. And some legitimate uses: arbitrage, debt refinancing, collateral swaps, and self-liquidation mechanisms are all going to be some uses for flash loans. And vulnerability is also going to be subject to play. They expose protocols with weak price oracles to manipulate and exploitation, so be careful. So the future of atomic finance. Flash loans have paved the way for meta transactions and complex financial maneuvers that treat multiple DeFi operations as a single unit. And their continued presence is essential for maintaining liquidity and efficiency in decentralized markets. Stay predator to keep grounding. Head over to Stackmode.net for all trading education. I'll catch you in the next one. Peace.
Quantitative tightening has officially ended, and trust me, this changes everything for investors. For the past few years, the Fed has been draining money out of the system, shrinking its balance sheet and putting pressure on stocks, real estate, and even crypto. But now, that pressure valve just opened, liquidity is flowing back in, and whenever liquidity comes back, asset prices don't just react, they move. But here's the truth that nobody tells you. The end of quantitative tightening doesn't automatically mean a bull run. It does mean volatility though. It means opportunity, and it means that the smart money is already positioning while everyone else is still confused about what quantitative tightening even is. So what does this shift actually signal for you? Expect easier borrowing, potentially higher stock valuations, stronger risk on sentiment, and most importantly, a window of time where early positioning matters more than ever. So let's figure out how we can plant our seeds, what quantitative tightening even is, and how we can learn how to invest. Inshallah. Let's go.
Quantitative tightening has ended. All right, let's go on this breakdown how it's going to affect investors and the future of everything. So what was quantitative tightening in the first place? So quantitative tightening is the reverse money printer. Okay, so you know quantitative easing, right? QE. And that's when the Fed prints money to buy bonds. Quantitative tightening is going to be the exact opposite of that. Okay, for the last few years, the Federal Reserve has been destroying money to fight inflation. Okay, printing more constantly over and over and over and over and over again. Okay, and the mechanism. Okay, so it's when they let bonds that they own expire and don't replace them. Okay, and the result of that is cash disappearing from the economy. Okay, and the goal of it all is to slow the economy down to stop prices from rising. Okay, so quantitative easing is turning the water hose on to fill the pool. Okay, and quantitative tightening is sticking a vacuum in the pool and sucking the water out. Okay, so let's head over to the next slide.
So the Fed cannot suck money out forever, or the system would go ahead and just break completely. Okay. So they're stopping or tapering quantitative tightening because inflation is cooling. Okay. The job is pretty much mostly done. And let's talk about the liquidity risk too. If reserves get too low, then banks will start to fail. Okay, and that cannot happen. The whole United States economy and infrastructure is based off of banks, companies, and money flowing through business owners. Okay, an economic slowdown, okay, they don't want to cause a massive recession for pretty much no reason. Okay, so the danger zone. So imagine braking a car too slow it down. Okay, and if you keep holding the brake after the car stops, you don't move. Okay, but if you brake too hard, you skid and crash. Okay, so right now, the Fed is releasing the brake. Okay, that's all it is. So imagine braking a car to slow it down. Okay, if you keep holding the brake after the car stops, you don't move. Okay, and if you brake too hard, you skid and crash. So right now, all the Fed is doing is releasing the brake. Okay, that's it. All right, into the market. Okay, because money's no longer being deleted pretty much. Okay, so liquidity is the lifeblood of the market. It's easily how money moves around. Okay, and risk on. So historically, the end of tightening is a green light for risk assets. Okay, letting us know that there's going to be more money circulating in the economy, giving us a higher chance for our assets to head in an upwards direction, since A, more people will be investing into something with value, okay, or B, people will have more money to purchase things with value. So valuations. So with less pressure rates on PE ratios, okay, stock prices can expand and head in an upwards direction. Okay, and tech and growth. High growth companies like tech or AI companies usually benefit the most when money becomes easier. Okay, because then they're going to have more money to invest back into their company and circulating instead of having to be tight and restrictive with the advancements and innovations, especially tech and AI companies, because the whole point of tech and AI companies is to profit off of future innovation and psychology involved into it, right? Investors then stop fearing the Fed and start fearing missing out. Okay, they're like, hold on, quantitative tightening is, hold on, let's pause. What we got to do is put some risk on, put some money down on the table before market heads up to all-time highs without us. Okay, so when the Fed was selling, okay, you sold. Okay, so now the Fed is stopping. Okay, so the headwind is gone. Okay, the headwind is gone. Make your decisions. Plant your seeds for your asset classes. Okay, so you don't have to struggle in the future. Okay, the market can do two things: go up and go down. It goes up and it goes down. That's it. Okay, you're not playing an intricate math problem that you have to solve every day. All you have to do, for the most part, is invest in something that has future value and hold and be disciplined with your money. Okay, fight your flesh. You can't be indulging in things that you want to buy every single other day. Okay, stay down. So you're putting majority of your money away into asset classes. Okay, I'm not saying don't enjoy life. We are here only once. You know what I'm saying? Enjoy life, do your little thing. Okay, get you some little food, buy you some little clothes, live your life, do your thing. But it can't be that week after week after week after week after week. A lot of the time, you should just be staying down, planting your seeds for your family. All right, so over to the next slide. Supply and demand. So during quantitative tightening, the Fed was a massive seller or non-buyer of bonds. Okay, and this forced interest rates up. So quantitative tightening ending leads to less supply of bonds flooding the market. Okay, and bond prices should stabilize or go in an upwards direction. Okay, and yields should stabilize or go down. Okay, so the real world effect of everything is that mortgage rates are tied to bond yields. Okay, if quantitative tightening ends and yields drop, then mortgage rates could finally come down, making real estate and real life a lot more affordable. Okay, so the fact that quantitative tightening is being ended is a really, really good sign for the future of the economy. Okay, and this is really going to help the housing market, get a lot of people off the streets, okay, and really just help a lot of people out in the world, making life more affordable again. Okay, because we shouldn't be stressed out every single day, you know, just trying to live our life, especially when we're already grinding hard. So let's go over to the next slide. Okay, the biggest risk of stopping quantitative tightening too early is that inflation has a chance to creep and come back up, God forbid. Okay, so the mistake that happened in the 1970s, for example, right? The Fed stopped fighting inflation too soon, and it came back double the strength, ready to bite everything in the tail. Okay, banks crashed, companies crashed, CEOs crashed. A lot of CEOs and a lot of companies ended up selling their companies to other major companies to make up for the fact that they couldn't keep up with that recession crash. Okay, and the market bubble. So if market ends up going up too fast, okay, it creates a bubble that might pop later, okay? It might pop later super duper hard, and the economy will face its consequences for that. So the currency risk, okay, the dollar might weaken if they print too much, okay? If it's too much of something, it's no longer valuable, okay? If something is everywhere, it's not valuable, okay? So just think of it logically. If something is everywhere, it's not valuable, okay? But if something is scarce, it's rare, okay? It's valuable, okay? So, though we aren't printing, okay? Just stop the shredding, okay? So watch the CPI, Consumer Price Index reports. That's going to be one of the most important reports that come out. That's going to determine how cryptocurrency and the stock market wants to move, okay? And if inflation ticks up, the Fed might have to restart quantitative tightening, and that would be super duper bad for stocks. So cash yields might peak, okay? Try to lock in rates or move your cash to assets, okay? Keeping your cash in that asset river, especially if the dollar weakens, then that means assets are going to become more valuable, okay? Because people have to have some type of value in something, okay? So once again, if cash gets weaker, then assets become more valuable, okay? And the quality growth of everything. So look for companies with low debt that grow regardless of the economy, okay? And it might be a good time to buy bonds before yields drop as well too, if you'd like, okay? So review your cash position too, okay? See how much cash you have and see what you can plant within your asset classes, okay? Don't be scared of the market anymore, and keep an eye on inflation data is ending, okay? Money is back, okay? It's trying to get healthier. It's trying to flow back into the markets properly, okay? And liquidity stabilizes, which is really, really good for the market, letting us know that there's going to be more money available, which means more money could be flowing into asset classes such as the stock market or the crypto market, okay? And this gives us a chance for rates to likely stabilize or drop, okay? And risk shifts from the Fed fear to inflation watch, okay? So stay invested, stay alert, keep up with the reports, stay prayed up to God, keep grinding. Make sure you guys aren't buying any assets at all-time highs, okay? I don't even care if it's real estate, okay? Even if it has nothing to do with the charts. Don't buy any assets at all-time highs, okay? Wait for the dip, buy, and catch the V sweep up, okay? Stay prayed up to God, keep grinding, and head over to Stackmode.net if you guys want to learn how to invest. Peace.
Class, let's get into stack mode. Let's talk about 401ks and Roth IRAs. Let's put that money to the side and let our money grow into more money. Inshallah. Let's jump into it. Let's talk about how. So we're going to be understanding the fundamentals of retirement accounts and how they function. And we're going to talk about the difference between a 401k and a Roth IRA, the difference between their rules, the benefits of them, and the tax implications. And we're going to talk about some real-world strategies to maximize returns and employer benefits, and develop a step-by-step plan to begin investment for retirement with confidence. So what is a 401k in general? Okay. So a 401k is an employer-sponsored plan that allows employees to invest a portion of their paycheck before taxes. So say you're about to get paid $1,000, right, to your bank account. Instead, a portion of that, let's say $200 of it, would go into the 401k, okay, which is going to be a place where your money can turn into more money, okay? So again, a 401k is an employee-sponsored plan that allows employees to invest a portion of their paycheck before taxes, and is designed to grow your wealth until retirement, helping you build financial independence over time. Imagine you earn $50,000 a year and decide to contribute 6% of your income. That's $3,000 annually going towards your future. If an employee matches 50% of that, you're getting an extra $1,500 for free. So understanding the Roth IRA in general. The Roth IRA is a personal retirement account funded with after-tax money, and it gives you the gift of a tax-free growth and tax-free withdrawals and retirement, an extreme advantage. So instead of losing, let's say you had, so taxes go by brackets, right? So taxes go by brackets. So the more money you make, the more you're gonna get taxed, okay? So let's say you're about to withdraw, let's say you have $500,000, right? And your 401k, say you have a really good paying job, right? Say you've been putting a really, really good chunk of your percentage income into the Roth IRA, right? let's just say hypothetically, okay, then, and I know certain things are capped at 8K a year, okay, so a lot of them you can only deposit 8K a year and stuff like that for certain of them. But let's just say, for example, for $500,000, let's say you're about to withdraw that, okay, then you would have to pay 40% on that normally, okay, and that's just 30, I'd say 37%, around 37% of that if you are about to withdraw like 500K, for example, okay. So, but if you make a lower amount and you withdraw a lower amount, then you're gonna pay like taxes. But still, you don't want to pay any taxes at all if possible. You want to try and get as much money as possible, especially if it's from your work check. So yeah. So you can withdraw contributions, not earnings, anytime without penalty. Okay, because from our job we already lose taxes or money from taxes anyways. So building a solid retirement plan. So focus on clarity. Okay. Small, consistent actions lead to major outcomes. Keep stacking up cash. It's the whole reason why I'm Stackmode Chris. I want to teach you guys, one, how to keep God first. Make sure you guys are praying. Make sure you guys are staying humble. And make sure you guys understand that you don't need too much, okay? Especially not right now, okay? There's going to be times where you're going to have time to pop it, okay? If you want to know what popping it is, there's going to be times where you're going to be able to buy the cars you want, okay? You can buy the houses you want. Okay, you can get the clothes you want. Okay, inshallah, if God wills. But we gotta make sure that we're investing first. Put that money to the side. Don't go buy the Jordans and the cars, the houses, and the clothes now. Invest into something that's gonna make your money turn into more money. Okay, so put some money to the side. Okay, instead of getting the whole check from your job, put some more into your 401k. Okay. Put some to your Roth IRA. Put some aside. Stack it up. Let your money turn into more money. Money's a tool. I cannot stress that enough. Money's a tool. Don't be too attached to it. Even if you go flat zero, God got you. All right, keep praying. Stay consistent. You can run it back up again, and don't give up. Promise you, I've gone flat zero plenty of times. Okay, trust that God, stuck to the process, and ran it up. Okay, gone flat broke, in debt, was managed to clear it. Okay, and just keep grinding. Okay, wake up, keep praying to God. Wake up, keep stacking up that cash, okay? And I've learned from those lessons, okay? Learned to live way below my means. Only groceries. I don't eat out anymore. I don't buy clothes every day anymore, okay? I'm not buying steaks like that anymore, okay? I'm in stack mode, okay? I'm praying to God, I'm working out, okay? I'm not going outside if I don't have to, and I'm working hard. I'm mastering my craft. When I'm getting paid, I'm putting most of the money away. I'm investing, okay? Being grateful for the opportunity that God gave us, okay? And our body can only take so much, so let your money turn into more money so you can enjoy life, all right? Take care of your mental health, enjoy a trip with your family, enjoy a trip with your wife, your husband, and do what you need to do. Stay consistent and stay praying up to God and just keep grinding. I'm telling you guys, it's gonna pay off. When you save the money and you put it away, act like you're broke, okay? But have it all invested. Okay, I'm telling you, if you act like you're broke and you just invest, it's gonna be amazing for your mental health. It's gonna make you stay consistent. It's gonna keep you hungry. It's gonna make you a dog, okay? You're gonna keep going hard at your craft. You're gonna want it bad. You're gonna be asking God for help in each and every scenario, okay? Stay consistent. Put the money away, invest it, act like it doesn't even exist. And I promise you, you're gonna be able to run up that big bag. Inshallah, you're gonna be able to take care of your whole family. Inshallah, stay consistent, okay? Stay out the bar. Stay out the club, okay? Don't be doing things you don't need to be doing. Stay away from people who aren't being consistent. And keep going. You got people to take care of, I promise you. You're going to be feeling like the one when it's all said and done. Stay down. It's going to all make sense. Whatever you're doing, stay down with it. And it's going to make sense, and then I promise you it's going to make sense in the end. Stay down with it. So, I don't care if you guys have $50 right now, okay? Put 25 of it away and stay down. Okay, live off the other $25. Stop spending the whole check. When you get paid, put it away. If you make $1,000, right, a check, pay your bills, okay? Take care of your groceries, take care of who needs to be taken care of, your kids, your people, husband, wife, whatever. Do what you need to do, okay? After that, right? Make sure it's straight things you guys need to be taken care of. Nothing but bills. If it's not bills, forget it. If it's not bills, you don't need to be spending money on it. Take care of your bills, take care of your groceries, and then invest. You gotta act like you're broke. Stay down. Okay? Invest right now. If you got $5, invest $4 and stay down with that $1 until you run it back up. Okay? It's the mentality. And even once you start touching 6 figures, 7 figures, 8 figures, 9 figures, you're gonna be in that stack mode mentality. You're gonna wake up, pray, go work out, put that money in the stash. Even if you make 50 grand, they're gonna go ahead and put 45 of it away. Live off the 5 grand, okay? Stay in stack mode. It's gonna make you guys stay consistent. And it's fun, because you can go to the stash and go pull an M out at any time. Stay down. You could wear the same fit every single day. You could drive a beater car if you want. But you know what you have in the stash. Don't let anyone break you guys down. You guys are good. Okay? Wake up, pray to God, and stay humble. Stay humble. Keep grinding. If you're not where you want to be, understand it's a marathon. You're not going to get it overnight. It's not going to happen overnight. There's plenty of times I've been grinding 18-hour days, thinking things weren't going to work out. And I'm telling you guys, if you pray to God and you keep going, there's a great chance that you're going to get what you want. Inshallah. It's good for you. All right? God's the best of planners. Just keep going. Keep going hard. Stay down. Even if you see your portfolio on the reds right now, stay down. Okay? Ask yourself, if this is a good investment, okay? If this is something I want to be invested in, okay? And just don't give up. Okay? Don't give up. Stay consistent. I don't care if it's your 401k, your Roth IRA, or individual portfolio. Stay prayed to God. Keep grinding. Review your portfolio and just don't give up. I'm telling you, it's all going to play out in the end. Stay consistent. Peace.
Okay, this is going to be the lesson on buying dips within the stock market and the crypto markets. So buying dips is going to be pretty simple. And buying a dip is pretty much just going to consist of buying a low whenever the market dips down. Okay, so we know the goal of the stock market and the cryptocurrency market. Okay, if I go ahead and pull up a profitable stock, for example, okay, I can go ahead and see from left to right how chart starts small. Okay, Nvidia stock started at $2 a share, let's say around 6 years ago. Now we're trading at $177 a share. Okay, large percentage increase on our funds. Okay, if you were to go ahead and hold shares for a couple of years. Okay, and same thing with the cryptocurrency markets. Okay, the goal of it is to just hold, and for the company or crypto token creators to keep innovating with the future. That way, it's going to go ahead and bring value to whatever it is, and value is going to equal more people investing, and more people investing is going to equal more money, and more money is going to equal a higher share price, inshallah. Okay, so buying dips at the right time is going to go ahead and be an ample way for us to make money. So let's talk about it. So one, in order for us to buy dips at the right time, we need to be using our higher time frames. So the time frames we're going to need to be using in order to analyze everything is going to be our daily time frame. The daily time frame is going to be our eyeballs. We're going to be able to see everything we need to see on the chart. Okay, and one screen you could see 6 years, 10 years with the price action on one screen. Versus if I get caught up on the 5-minute time frame, I can only see a month worth of price action on one screen. Okay, so it's not nearly as much price action. And the reason why we're using our higher time frames as our guidance is because this is where the whales, okay, and whales are going to be players with large amounts of funds, okay, hedge funds, okay, people collectively putting money together in order to trade in the markets, and banks and institutions. Okay, so people who are pooling large amounts of money together, we want to be trading when they're trading, and they're going to be trading at dips that are visible on the higher time frames. Okay, so this is why we're going to be using our daily time frame. When you're under higher time frames, let's say I'm on the daily, each one of these candlesticks will represent 1 day. If I'm on the 4 hour, each one of these candlesticks will represent 4 hours. So, and also, like we know, just like we talked about, the goal of the stock market and cryptocurrency market is to go in an upwards direction. And only way price can go in an upwards direction is if it breaks what's called an area of resistance. Okay, resistance is an area where sellers come in, causing price to go in a downwards direction. Okay, so once again, resistance logically makes sense because this is a left to right chart. So if someone got in from way over here at $2 a share,
of course they would go ahead and take profit at this resistance up here at $32 a share. Okay, they're going to go ahead and sell some shares. Okay, go take a nice trip, do what they want to do, reinvest their profits, pay off their house, rebuild their kitchen, do whatever you want to do with your profits. Okay, but eventually people are going to take profit. Okay, because they got in way back here. Some people. Okay, so this is why we are understanding why resistances gets created. Okay, people are selling because they're in from way over there to the left. So when you see resistance get created, all it is people selling. Okay, so resistance equals selling. And we know that price cannot continue within an upwards direction until price breaks resistance. Okay, if price is trying to go up and break out and future innovate and be one of the biggest stocks of all time, areas of resistances have to be broken out of, or an area above, an area of support above current price can also be broken too. Okay, for price to go ahead and progress in an upward direction. And sometimes support, prices underneath it, it can turn support into resistance. And then it could potentially try and break through it. Meet up with others, there's areas of resistance. So this is implying that this opposite end bounce is going to be called support. Okay. So support is when buyers step in. Okay. Unlike resistance where there's sellers, support is going to indicate when buyers are stepping in. Okay. So when buyers are stepping in, price is trying to go in an upwards price. People are trying to invest. They're trying to make some money. So buyers are stepping in whenever support gets created. So resistance here gets created whenever sellers are stepping in place. And support can be broken and turned into resistance potentially. And just like the opposite end, resistance can be broken, turn into support potentially. Okay, it doesn't happen every time, but it has a chance to happen. Okay. And price has to break resistances in order to progress in an upwards direction anyways. Okay, price has to break resistances in order to go in an upwards direction. Okay, so price is either going to try and reverse at certain resistances or it's going to try and bounce at certain support points. Okay, or resistance can be broken, turn into support for a continuation to the upside, or support can be broken, turn into resistance and push to the downside. Okay, for a downside continuation. All right, so that's going to go ahead and be those put into perspective. Now let's hop onto the charts. So understanding everything here on the charts, we know that price is always trying to hunt and chase and break areas of resistances above current price. Okay, it's trying to chase, break areas of resistances above current price. Okay, so say NVIDIA, for example, I could see here that price wants to meet up with this all-time highs. Okay, all the way up here. Okay, this is the highest point of resistance on the chart. Okay, and this is when I'm going to be really paying attention to my higher time frames. Okay, so we had a pullback area here. I can already see it. Okay, so I'm going to go to my 4-hour here, and I can go ahead and see something here. Okay, this is what's going to be called a support mirror. Okay, support mirror. Let me go ahead and do this. Okay, support mirror, check it. So we're going to see price mirrored the areas of support, just like we talked about. So if price bounces in an area of support, you're going to know that it's a good time to buy that dip. Okay, so we can see this support get created right here. And I don't ever like to buy the first candlestick. This is when I'll come to my 4-hour candlestick and wait for a close. What a close is I'm not going to buy at the candlestick that touches the blue line. If I'm going to buy a dip and wait for it to sweep back up in an upwards direction, I'm going to wait for a second candlestick above the blue line. It's not going to be later because it's going to be safer to trade that. Instead of buying it as soon as it wakes up on the blue line, price could easily dump right through that. But if a lot of the times if price wants to give you a close above the blue line, give you a second candle and show you it doesn't want to go up all the way just yet, but it wants to maintain above the blue line, that could indicate an entry area for a reversal without getting burned. Okay, so I'm trying to just give you guys the safest way to trade. So I would never enter on that first wick where price bounced directly off the blue line. But if price went 4 hours and then still stayed above the blue line, I would go ahead and enter. And that's what you're waiting for a close for. Each one of these previous candlesticks are called closes. Okay. And I can see that this area is strong. It's because one, I have this area of support right here where people are buying in an upwards direction right here. Okay. People are also buying right here. Okay. So price decided to break and then come back down, test this level, and shoot back up to this area of resistance up here. Okay. So we got R up here for resistance, and then we got S for support. Okay. And even right here, I'm gonna go put this tiny area of support right here too. Let me zoom in all the way. Okay. Even this area of support right here on the blue line. Okay. There we go. Okay, area of support right here, area of support right here, area of support right here. 3 different bounces that I can see on my 4-hour time frame. So I can assume that this area of support wants to go ahead and be decent, especially after getting a close. Okay. And I can see price decided to just fall at this area of resistance right here. Okay, so price is falling from an area of resistance. You're gonna have one area of resistance here on my 30-minute now, and another area that was created off of that. Okay. So as soon as you start seeing price decide to curl in an upwards direction, especially on your 4-hour time frame, you can go ahead and take that for the most part and take it up to the next area of resistance, inshallah. So let me go ahead and cover another example here. So I have some stuff here. Okay, let's go over KOP. Okay, even with KOP here, I can check out here. I can start off on my daily time frame. Always going to be starting off on my daily time frame. Okay, always start off on your daily time frame. It's going to be your bread and butter. Okay, it's going to be your bread and butter. So if you want to eat, let's grind. All right, so we know that on the stock market and the cryptocurrency market, people are putting in work at these companies, working their real life, trying to innovate new technology for the company. So once again, the company can make more money, and this way their valuation can be higher on the stock market. Okay, so then people can be called billionaires, etc. And that's due to stocks. Okay, so price once again is always trying to break resistances or supports above current price to progress in an upwards direction. Okay, it's not trying to stay stagnant. So your take profit a lot of the times and take profit means where you close your trade. Okay, and you close your trade at take profit no matter what. If you tell yourself you're going to close this trade here, you close that trade there. Okay, take profit is where you get your money. So I can go ahead and see here that price wants to chase this area of resistance. And realistically, this could be the trade. I don't really have to do anything else. I can get my ruler here. I can put my ruler down. I can see that there's around 3 points left. Okay. I could also do the trend line if I wanted to too. Okay, but that might give you a little later entry. But personally, once I see like my daily time frame with support curls at a heavy area, so let's say price is supporting at this area, heavy area of support down here. Okay, even down here, one area of support into another area of support. Okay, and then I can easily see price deciding to bounce within an upwards spiral direction. Okay, and then we also another area of support right here. Okay, so all these areas of support lined up let me know that, okay, price is doing the same thing in the same area and it's doing it again. I get on my daily time frame and I have closes. I get on my 4-hour time frame, I for sure have closes. Okay, and I can see that price wants to go up to the next area of resistance. Okay, it's just about making it easy, making it simple. Okay, not making it hard. Okay, buy a good expiration date for these contracts. Buy a good strike price that's relevant, and you'll have the keys to financial freedom, inshallah. So check it out here. Even Amazon here. If I wanted to, I could wait till Amazon goes down to the support. Okay, I could see if it wants to. Go to my 4-hour here. Yep, so I can see if price wants to come down to this area of support. And if it does, then we'll see if it wants to go ahead and bounce in an upwards direction. But as far as this is already pretty bearish. And yeah, price decided to break the trend line. So we had one bounce off the trend line, 2 bounces off of it, but then we had a push down below it. Looks like price wants to go ahead and fill this area of support right here. Okay. also mixed with this area of support here too. So let me go ahead and grab this line, drag it all to the right, and you can go ahead and see this here. Okay. So it's about just taking our time, identifying the right setups. Let me go ahead and show you a crypto example here. So going over the crypto example here, let's go ahead and let's click on Ethereum. Okay. So going over Ethereum here, looks like price wanted to bounce at this area of support and break below it. Okay, let's break it down. Okay. Here we have an area of support. Being broken and turned into support. Okay. So once again, we have an area of support being broken. Okay. And if I get on my 30-minute here, I can see that support got broken all the way over here. Support broken, turned into resistance. Okay, if I zoom in extremely hard here, I can see the resistance was created right here. Okay, price broke underneath it, first 30-minute candle, then ran back up to the black line and decided to short downward. Okay, this is going to be an example of some downwards break and retest. Okay, downwards break and retest. So I still wanted to buy some Ethereum, for example. Okay, this is what I'm getting on my daily time frame though. I don't want to tunnel vision. So I know price could either A, reverse near this area of resistance here, potentially, or I can assume that price might potentially want to reverse at the area of support down here. Okay. Let me get on my 4-hour. It can also be this area of support. There we go. Okay. And you go ahead and see the area of support right here being formed and formulated, and then the next step down below that in case the previous level above doesn't hold. Okay. It's just about marking the levels, making sure we got it until we are clean and crispy with how we're looking at the charts. So even XRP here, okay, I can see 4-hour time frame, price potentially might want to hold this point. Okay, potentially. So XRP decided to go ahead and dump down, supports are holding. Okay, and it looks like price might want to sweep back up, but it did fall back down, and we'll see if there will be a new low or something. Okay, but either way, this will be buying the dip. Resistances are up here. Okay, and if price starts giving you 4-hour daily closes, okay, and you get to think coherently, then you can go ahead and feel the setup. Be like, you know what, this is gonna go ahead and sweep here. Okay, it's lining up with this area of support, it's lining up with this area of resistance. X, Y, and Z are lining up. Let me go ahead and take this. Okay, check right here. So even right here with Doge, for example, right? So we got some break and retest right here. I have this area of support right here on Doge, mixed with this area of support right here. Okay, I can get on my daily time frame. We have the second candlestick being formed. Okay, 4-hour candlestick, second candlestick being formed. Okay, and it looks like price wants to go ahead and go up in an upward direction. Okay, close at resistance, close at resistance, close at resistance, close at resistance. Okay, so you can go ahead and mirror your supports, mirror your trades like that, and really just see like, okay, I know what type of trades I want to get into. I know what I'm going to be looking for within the market. Okay, and buying dips can just be relatively easy. It's just about not overthinking the trades, really taking our time, okay, and then just seeing, you know, inshallah, I can go ahead and do this. Okay, so just wait for either break and retest or wait for an area of support to go ahead and line up with each other. And a lot of the times, especially with you get a daily or 4-hour close supporting it, you can be like, oh yeah, you know what, that's it. Like, that's the one. Okay, so be confident in your trades. Head over to Stackmode.net for all trading education. Say pray to God. Keep grinding.
Whoa! Another episode of Coop Talk. It's cold like Minnesota outside. May God bless y'all. I pray y'all are doing straight. want to talk to y'all about a very sensitive topic. What are you trading for? Are you trading for family? Are you trading to just ball? Are you trading to clear your debt? Because there's different styles of trading and investing for everything. But at the end of the day, you're looking for income, I assume. Okay. We're all in the markets trying to make some income. But the income is not going to be the end all be all. You don't just get the income and ball out and that's life. You know, yes, balling out is amazing. But don't lose your family values. Don't lose yourself as a person. When you start touching the income that you want to be touching, it's really important to stay intact with yourself. Okay. What are you trading for? Are you trying to own a bunch of real estate? Whether it be duplexes, multiplexes, multifamilies. Excuse me. Ask yourself, why? Why are you trying to run up these bands? Why are you trying to run up a surplus amount of income? Because it has to be channeled. It has to be channeled. Okay, right now, for example, right, God forbid, let's say you're a drug addict. If you're a drug addict, right, and you're a heavy drug addict, once you start getting more income, what do you think your money is probably going to be directed towards? More drugs. If you're addicted to buying clothes, what do you think your money is going to be directed towards once you get more money? You're going to start buying more clothes. So if you're an investor, you're going to call yourself an investor, you need to focus on keeping your money in an asset river. Okay, once you touch that big bag from the markets, what are you going to do with it? Do you want to buy real estate? You want to buy yourself a house? Do you want to pay your mom's bills? Pay your loved ones' bills off? So you got to really have a talk with God and talk with yourself. Because I'm telling you, when you start touching the money, it's different. You know, yes, you're going to be able to live in peace, but don't forget you also have to pay taxes. But when you start touching the money, it's really important to not lose yourself. Okay, direct your focus and your income will flow in that direction. Okay, if you're really into fitness, you could potentially build gyms if that's what you want to do, or build yourself your own personal gym in your house. Okay, put a sauna in your house. Don't indulge in sin when you start touching the money. I especially am talking to my younger crowd for sure. I've done it, you know, living the high-rise lifestyle. I did it for a couple of months. And I'm going to tell you right now, if you're a God-fearing person, if you're a grinder, someone who's just focused on their work, you just wake up, pray, you grind, take care of your loved ones, you really hold it down, focus on bettering yourself, improvement, and being a provider. Environments like that where you're around partying, drugs, sin, infidelity, etc., it's not going to be really positive for your mind frame. Okay? So if you touch the big bag, even if, let's say if you're in your hood right now, right? Even if you're in the hood, right, and you're looking on YouTube, you're seeing people in Miami, you're seeing people on the boats do this, whoop-de-whoop. You know, take a vacation, experience it first. But don't overly glorify that lifestyle. You know, take a Lamborghini, for example, seeing the guy with the lamb. You don't see underlying issues. There's tons of stress I go through outside of finances, okay? So you don't see underlying issues when it comes to social media and certain things like that. So when you touch the big bag that you want to touch, when you start making the income that you want to make, it's really important to, one, stay focused on God. I'm not just talking about God for no reason. It's because, one, I've made mistakes in the past, right? And I pray God can forgive me. And I don't want you guys to go through those same mistakes. And I don't want you guys to go through mental spirals of, whoa, this isn't really what I thought it was. You know, you might want to go towards maybe some farm life. Just a calmer, more decent life. You can still go nice car, get you a Porsche, you know, just something chill. But you don't gotta have 10 cars. You don't gotta have 5 Ferraris, 3 SRTs, 2 Bentleys, and the Lamb. Like, you don't have to have that, you know what I'm saying? And then a Benz, and then 5 Maybachs. That's not what you want in your life, ideally, stress-wise. It may look good, but who really cares what people think? You got to stop caring what people think, too. When you touch that big bag, please do not do things to pop it, to flex, because of people. I don't care if it's old people in the past, old friends, whatever. Oh, I'm going to go ahead and run up this money and pop it on them. I did it when I was 18. Okay. I went through it. My first car was an Audi. It was an Audi A4. 2014, something like that. 13 maybe. And someone crashed into it while it was parked. Thank God, that taught me a lesson. But during that time, it made me very arrogant, and I repented to God. But, you know, just after all the years of getting bullied and stuff like that, finally be able to have something and people look towards, you know, me for some type of motivation. But I realized it's not about the materialism. You know, even if you do pop up nice car, try and give some game. You know, try and give some game so they can get one too. Don't put yourself over people because you have more materialistic items. This is a fleeting world, and we'll all be judged as human beings by God. Okay? So just because you cop the lamb, don't start popping it on people that you used to know. Don't start poo-pooing on people. Don't start treating people bad. Don't start putting yourself in a negative mind frame too. Like, oh, this lamb isn't good enough. I've gone through that. You know, even with the coupe I'm in right now, I'm in the Mustang coupe. You know, it's cool. It's cool. It's stay down. After the Audi, I decided, you know what? I'm going to go ahead and downgrade a little bit, pay a little bit less insurance, and not really care what people think. And the kids still smile when they see this car. I think it's pretty cool. My wife thinks it's cool. My family thinks it's cool. So I'm not tripping. But I'm not over here posting every little thing, posting my car all the time. You know, even inshallah, if God wills, if I do cop a better car, like a Benz or a Maybach or something like that, the whole channel is not about to be back about the Maybach. I'm not about to make my whole life about the materialistic item that someone could crash into and it could be gone in 2 seconds. Okay. Is it nice to have? Is it a blessing? Absolutely. All credit to God. Thank God we have the wisdom and the strength to be able to enjoy this world. Okay. Especially as we grind, get more resources, work harder, hit more trades, stack up more income, and invest. We'll be able to do more. Okay. But don't lose yourself when you touch that big bag. Please. 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 It's really important. Keep God first. Okay. Even when you start touching 5 figures a month, 6 figures a month, don't forget about taxes too. But keep yourself mentally focused. Do not lose yourself in sin. Do not start living in a super unrighteous lifestyle. For example, you know, I'm not better than anybody, but I don't drink alcohol, for example. Okay. And just being around people who constantly drink alcohol, it's not for me. It's not for me. And if you're someone who likes to be focused, if you're thinking about moving to a high-rise city type of life, and right now you're maybe in like the suburbs or more of a rural-ish area, what you have is a blessing. Please understand that. I just moved to Las Vegas, and I tried out the city of Atlanta. And I still like living in rural areas more. Okay. I tried the city life, guys. It's not for me. It's not for me. And for a lot of you guys who are just focused, tunnel vision, focused on providing for your family, focused on God, don't think that type of lifestyle is going to be for you guys either. Trying to have 5 cars just to post on social media. Whole time you got 5 insurances. You got 5 different people who could break into 5 different cars, or someone could try and break into all your cars. You got items to keep up with in all your cars. You got people asking to borrow, yo, can I drive this today? Yo, I got this. yo, oh, you're not letting me drive the car today. You could fall out with your family. A lot of this comes with underlying stress. So I just want to keep it real with you guys. Okay, please. Just wake up, pray to God, work out. Working out really helps you channel your energy, your direction, especially so you're not talking to your loved ones or anyone disrespectfully. Let's say you have a bad trading day. Let's say you lose like 5K in a day or something like that. You don't want to be storming around the house grouchy, everything about money all the time. You're treating your family bad because you just lost. Chill. Don't lose yourself. Relax. Okay, you could lose all account. Don't crash out on your family or yourself. Don't put yourself into mental desperation. Please don't commit suicide. Okay. And please just try and keep yourself focused on God. Don't grieve your spirit so you don't go through depression. Because this money stuff can get deep. Especially when you start balling and then whoosh, God takes it all. Okay, because if you fall into sin, you will get the results you deserve. Okay, anytime I fell into sin, God forgive me, I got the results I deserve. Cars taken away from me, luxuries taken away from me. And thank God I was able to be focused and get it back. Okay, all credit to God, alhamdulillah. So, this journey is going to be a long, beautiful one. But I just want you guys to be conscious of what can happen when you do start touching certain levels of income. Don't change yourself. Don't lose yourself. And don't let the income affect your life to the point where you just don't even know. Okay? Got a call there. My fault, guys. But the income, don't let it make you. You make the income. Okay? Take care of your family. Take care of yourself. Okay? Especially if you're a provider. Let me talk to you guys about this too. If you're a provider, let's say you're someone who takes care of your family and yourself, etc. Have some time for you. Do the things that you like to do. Take care of your mental health. Because especially as a provider, you can really lose yourself and everyone else, making sure everyone else is okay. Make sure you're okay. Okay, take care of you. You ball out. Okay? Don't overly pop it and lose all your money. You know what I'm saying? But get yourself a nice meal. Get yourself some new clothes. You know what I'm saying? Cut your hair. Get your hair done. You know what I'm saying? Do your thing. Feel yourself. We're human beings. You know, life is, you know what I'm saying? It's more than just money. So don't lose yourself. Yes, we're getting this income to make sure we're good. Make sure we can chill out, do what we want to do. Thank God. But at the end of the day, take care of yourself. I've lost myself a few times in the grind. I'm not going to lie, guys. I've lost myself a few times in the grind. Was my work always consistent for the most part? Yes. I'll say that. Was my income always consistent and going in an upwards direction? Yes. But was my mental health always in the right place? No. Was my physical health, you know, I was in shape weight-wise, but as far as my other external factors or internal factors, like my kidneys and stuff like that, not drinking enough water, I had to quit soda, a lot of certain things, you know. So just maturing and growing up is really just teaching me a lot of lessons, and I just want to come on here and just give you guys some just warnings and just let you know what I've gone through, just so you guys don't go through any hardships and any hard times. Just stay focused on your family, your loved ones, and most definitely God. And I promise you'll probably have a good life. Yeah. I love you guys so much. Catch you in the next one. Head over to stackmode.net. Peace.
When a company drops its earnings reports, it's like opening the result envelope on award night. Traders, investors, hedge funds, everyone is waiting to see if the company beats expectations, meet them, or completely miss the mark. And depending on that reveal, price action can turn into a calm wave or a full-blown tidal surge. During earnings, companies reveal how much money they made, how much they spent, and what they expect for the future. And here's the twist. Sometimes a company posts great numbers, but the stock still tanks. And here's why. Because Wall Street wasn't impressed, or the expectations could have been higher than reality. And other times the results are just okay, but the stock still shoots up because traders were expecting something a lot worse. In just a few minutes, spreads widen, volume spikes, and algorithms fire off like fireworks. And this is why many traders either love earnings season or avoid it like a thunderstorm. A lot of the times though, in order to avoid gambling, it is better to place your trades after the earnings report has released. So let's go and jump into what earnings is and how it affects the market. Inshallah, God wills.
So we're going to go ahead and cover earnings. So what happens when financial earnings release? Okay, so every quarter, okay, every couple of months, financial earnings are going to be a report that determines the amount of money that a company made, okay, and the amount of expectations that they were trying to arise to. So if a company was projected to make $500 million, but they only made $300 million, then in that case, they would go ahead and lose earnings, okay? But if a company was projected to make $500 million and they made $800 million, then that would go ahead and be a positive earnings beat, okay? So earnings are going to go ahead and determine the price action too. Now, just because earnings gets beat or earnings loses doesn't mean that a stock will head up or down, okay? Stocks will do whatever it wants. Do not try and use the earnings releases to try and gamble and make trades, okay? Try and trade after earnings releases if you're going to put down a brand new position, okay? Wait for the price action to kick in, and then after the earnings release comes, then feel comfortable to make your trade. But never trade like a day or a couple of days before earnings. Wait for earnings if you're a couple of days before earnings, okay? Wait for earnings to come out and then take your setup, okay? Because otherwise it could be gambling. Earnings causes stocks to make giant moves quickly, okay? So the moves that happen during earnings are going to be extremely instant, and it's going to be like a flash move based on the report. So let's jump into it. So the quarterly report, right? 10Q. Okay, every 3 months, public companies are required by law to reveal their financial health to the public to let them know how they're doing. Okay, it's going to go ahead and let investors know if they want to keep throwing money into the company or not. If a company's not beating earnings, then that means that they're not making any type of income. Okay, and a lot of the times we don't want to be invested into something that's not even making income in the first place. So every 3 months, public companies are required by law to reveal their financial health to the public. Okay, and let's talk about the revenue. So revenue is going to be how much money came into the door. Okay, how much money did that company make during that quarter? And the net income, it's going to be the bottom line. It's how much profit is left after expenses. So certain companies might have to pay for building power, warehouse cost, employees cost, etc. And the EPS, it's going to stand for earnings per share. And it's the profit divided by the number of shares that are going to go ahead and be available. Okay, so EPS, net income, and revenue, those are going to be the three factors and the three things that are shown on the quarterly reports. Okay, so let's keep jumping into it. So the expectations game, right? The actual numbers don't matter as much as the expectations. Okay, so once again, let's say a company was projected to make 100 million, right? Expected. But then they actually made 170 million. Okay, that would go ahead and give them a beat result. Okay, so whenever you hear the words beat, that means that the results that actually came out were going to be better than what was projected or speculated in the first place. Okay, so priced in. If everyone expects Apple to make $1 billion and then make $1 billion, the stock might drop. Okay, why? Because the good news was already bought weeks ago. Okay, so to see a stock pop, a company usually needs to beat company earnings, okay, and beat the analyst consensus estimates based on the company's averages is how the estimates come out too. So it's not just going to come out with random numbers. If a company is making around like $50 million a year, okay, the earnings might be around like $60 or $40 million expectations. Okay, it'll be around where the company is performing as of recent years. Okay, so don't just expect the numbers to just be some random inflated numbers. These are all numbers that are going to be based in and baked into averages for a reason. Okay, earnings come into play. But once again, don't try and just hop in a contract the day before earnings trying to trade like that. Please don't do that. Okay, please don't do that. Now, sometimes there's going to be little rumors as well too. You'll see like, oh, this company's going to be earnings. Nobody knows what's going to happen until the earnings report actually comes out. So please do not lose money gambling for no reason. Okay. Wait for the earnings report to come out. Unless you're in a hefty swing already, please wait for the earnings report to come out. Okay. Let's keep going into it. And understand that guidance is going to be king. So stocks trade on the future, not the past. Okay. So guidance. Guidance is going to be the company's prediction for the next quarter, how much money they're going to be making. Okay. It's pretty much going to be giving the company a trail and letting them know how they should be performing in order to get to the next level. So in any scenario, company reported record profits, okay, but let's say next quarter looks slow, okay, then that'll be the future. And results, okay, the stock would go ahead and crash if that's the case. So we're lowering our outlook due to supply chain issues would equal an instant sell-off, since that means they're pretty much letting us know, hey guys, the company can't expand right now because of financial issues. Okay. So guidance in the future of the company is also going to be really, really important too. There might be times where a company might lose or not beat their financial earnings, but then end up making a pretty profitable couple of next quarters. Okay. So one quarter is not going to go ahead and determine a company's entire worth. It's the consistent stream of quarters and reports year after year after year after year. If a company is consistently losing earnings, then that tells you about the company. Okay, so we'll talk about the implied volatility crush. So IV is going to stand for implied volatility. So before earnings, options prices can get very expensive. This is called high implied volatility. So it's like buying insurance right before a hurricane, okay? Or driving your car and then you just put insurance on it, you know? So before the release. So uncertainty is high, so options get more expensive in this case, okay? So if you are going to buy a contract before earnings come out, okay, make sure you sell it before earnings come out too. Don't gamble and sell your contract after earnings comes out, because then the uncertainty would go ahead and vanish, okay? Unless you're playing for a way bigger take profit that's going to be way further out than you think, okay, then try and sell your contract before the earnings comes out, because it's going to be worth the most expensive then. Okay. So buying options right before earnings often loses money, even if you guess the direction right. So if you buy a calls contract and the company beats earnings, and even if price goes in the upwards direction, okay, you might notice that your contract didn't even make you that much money. Okay. That's because price has to get rebaked into what it actually is supposed to be. So do not buy earnings before expecting you to catch the right direction, okay? Because even if you do catch the right direction, you're probably not going to make as much money as you would think, okay? Especially depending on the contract that you buy, okay? The reasons why contracts get expensive like that before earnings is because they don't know what the number is going to go to, okay? That's why. So implied volatility makes things more expensive. So understanding this really helps us. Let's head over to the next slide. And let's go ahead and let's talk about the gap. So earnings are usually released after the market closes. So it's usually after 4 p.m. Eastern Standard Time. Okay. Or it's going to be before market opens. So it's going to be before 9:30 a.m. Eastern Time. So you cannot trade standard stocks during the release unless you have extended hours access. So a lot of the times, once again, just like I talked about earlier, you're going to see that instantaneous price action. So the stock price will teleport, so it instantly gap up or down. Okay, and stop losses do not work against gaps. If you hold overnight, then you're going to be taking the full risk. So just know that even if you have a stop loss placed during the day, if price decides to run through wherever your stop loss is, then what it's going to go ahead and do is decide to not validate and just ignore all of those orders due to the fact that the price action is happening pre-market and after market. Okay, and you can only maneuver your options contracts. If you have shares, you can close a little before or after. Okay, but if you're on options, you gotta only get what you get when you wake up to the contracts. Okay, so even if you see price going in an upwards direction and you had some calls, don't expect money all the time. It really depends on a lot of things such as implied volatility, etc. Okay, so expectations matter. Okay, so beating estimates are required a lot of the time for a stock to go in an upwards direction, okay, in order to start seeing a rally. And guidance is going to be critical. So the future outlook is a lot of times going to go ahead and overshadow the past results. And volatility crush. Options lose value instantly after the news. Okay, so you might notice a contract might be $500 before the news. Okay, and then after the news, it might go down to $200, even if the number were to go ahead and hit. Okay, so options lose value instantly after the news. And the gamble between everything. So holding through earnings has a high risk, okay, just a high risk factor. I'm not even gonna say high reward, okay, because the reward that you were to get is not even worth it, and you wouldn't even get it as properly as you would. Now, if you're holding a super swing, okay, you're trying to hold a trade for months, weeks, some years, etc., okay, then I do understand. Okay, do your thing and hold your trade as you need. But a lot of the times, make sure you're closing your trades before earnings come out, okay, unless you know exactly what type of swing that you're holding. Okay, head over to Stackmode.net to learn more about anything stock related, investing related, or trading related. I'll catch you guys in the next one. Peace.
Future trading can be a little tricky if you let it be. You only want to buy when buyers are buying. Try not to ever buy when sellers are selling. In this video, I'm going to teach you guys exactly how to trade pullbacks and how to buy when the buyers are buying and what to identify and look for. Let's go and let's jump into it, inshallah.
All right, so here's going to be buying at the right time. You want to buy after sellers are done selling. So sellers need to sell first, and you want to buy when buyers are buying. If you buy when sellers are selling, you're going to go ahead and just get destroyed. Okay, if you're looking to buy at the right time, we have to wait for pullback. We have to wait for price to form an area of support. Okay, so playing pullbacks is going to be really, really important. And here's going to be the things we have to look at. Okay, one, you need to make sure that you're trading in a trending market. So if we're going to trade pullbacks, which is just price coming down, lower, and then going back up. That's all it is. So if price goes up, comes down, and then goes back up, that's a pullback. So you want to get on your weekly time frame ideally, or be on your higher time frames, such as your weekly, daily, or your monthly. And then we need to analyze the full chart. So I'm going to start off with my weekly here and get the full bird's eye view of absolutely everything. So I can see here on my weekly that price decides to trend upwards year after year after year after year, no matter what. Okay. We're still ending up at new all-time highs, regardless of how many dips that it's made. Now, the way that price works within a staircase manner. And in order for price to progress, it has to make higher lows. So that means that the new low that price just made is going to go ahead and be higher than the previous low that it made. If that's happening, then that means price is trending within an upwards direction. Okay. And you need to buy when price makes these areas of supports, also known as the higher lows. Okay, so I'm going to break down how we can time and what we're looking for. So you want to buy when market is down, so then you can profit on the sweep up. Once again, buy when market is down, so you can profit on the sweep up. So in order to do that, you have to be trading something that's trending in an upwards direction anyways. Okay, so get on your higher time frame, start off on your weekly, and look at absolutely everything. So my weekly here, I can peep. We have this low starting from 2020. Okay, and I can see here, we have not stepped back here since. And I'm on my weekly here. So I can start marking from the bottom of this low. And I'm going to go through and mark all the higher lows up until current price, just to show you that price is trending. So I can start seeing price trending in the upwards direction after it hit this 21,000 area here. Then price bounced super duper heavy. Okay, made another higher low here near this 26,000 area. Price came up, topped out right here. Okay, when price tops out, all it is making the left side of the V. Then once price makes support, it's making the bottom of the V. Our job is to catch the right side of the V. So even right here, you could see price come up, top out at this area, and then come down. After it come down, stopped right here, then bottomed up. Okay, price stopped up here. Price came down, and then bounced up, stopped right here, came down. Okay, so this is going to be a whole area in itself. Got price coming up here. Looks like price stopped towards this top, bottomed out right here, and then kept going. Right here, came up, stopped at this red candlestick, pulled down, made a low right here. Stopped up here, pulled down, made a new low right here. Okay, then over here, price decided to get underneath the lows. Okay, made a higher low right here. So even though we fell all the way down right here, it's still higher than this low right here. Okay, so that's good. So this higher low is still valid. Price was deciding to come in the cut here. Decided to bounce at the same area twice. We just still see price just trending, doing this thing. Try to make a low here. Kept trending up, kept trending up. Price came down. Okay. And this low is still higher than this low here. So we're still in an uptrend, regardless of how hard we're dipping. We're still in an overall uptrend. This low right here, this low right here, low right here. We can see price heading in upwards direction. Okay. Now, what is price hunting? Price is hunting these areas here. These areas of resistance. These are going to be the areas that price are hunting. Price can't make new all-time highs unless price breaks previous areas of resistances. So after market decides to pull back, okay, your take profit, ideally a lot of the times, is going to be an area of resistance above current price or an area of support above current price. So you want to wait for price to pull back, wait for sellers to stop selling. And once you've identified sellers have stopped selling, which you'll see, and a good indicator to know that sellers have stopped selling is going to be on either your daily or your 4-hour candlestick. After you see a candlestick make an abrupt stop on your daily and 4-hour, pay attention to the next candlesticks. If you're looking for a long trade, if price action decides to randomly stop in the bottom, and then you start seeing multiple green candlesticks going in upwards direction, then you know buyers are going to be buying. And ideally, you're going to be looking for around 2 to 6 daily or 4-hour candlesticks after an area of support was created. If you see 2 to 6 daily or 4-hour candlesticks going in an upwards direction after it makes an area of support, then that's how you know it's going to be true. Okay, and you want to be looking on your daily or your 4-hour. And you're going to be looking for 2 to 6. So even take this low right here, for example. Price decided to make this super low right here. Okay, and so here's the super cool thing. Market does all the work for you. You don't got to do too much. You just got to chill. Be patient. Okay. Pray to God and just live your life. So boom. Market made the left side of the V for us right here. Market came down. Sellers were selling. Boom. Made an abrupt stop. Okay. And here's how you know if it's true. The candlesticks afterward were multiple green candlesticks. So after that abrupt stop, I have 1, 2, 3, 4. Okay. So that went 4 green candlesticks on my 4-hour here. Okay. And then even on my daily, I would have had 2 green candlesticks at the bottom, and then I had 1, and then I could have entered on this candlestick here and caught the rest of the resistance fill. So let market make the left side of the V. Let market make the bottom of the V. And you can see if the bottom of the V is real, knowing and seeing what candlestick come afterward. Okay, take this example. You see price trending in a higher low scenario here. You see this low right here. Okay, price bottomed out. I'm on my daily candlestick right here. Okay, I'm on my daily. After it bottomed out right here, I'm looking for 2 to 6 candlesticks, either on my daily or my 4-hour, So I can see price made the left side of the V up here. It's about patience. It's really about patience. Market decides to come up, top out right here, and then fell all the way down right here. This is how I know that the bottom is real. Okay, I paid attention to the candlesticks afterward. Okay, so after this bottom got created here, and sellers were done selling, you could see 1, 2, 3, 4. Okay, 4 candlesticks, and as soon as we got to like this upwards direction, I would have liked that. So I probably would have entered around like right here. Stop loss below the daily candlestick supports. And then take profit at previous resistance from where price decided to fall down from. Okay. Because I could see price already made the ultimate support, and all I did was catch the higher low entry. So let's go and let's do a fresh example here and see if I could find the setup. So I'm going to pull up the micro Bitcoin. Let me analyze from start to finish. So I'm going to get on my weekly time frame here. Okay, great looking thing I'm looking at here, because we're not at all-time highs. So that's why it's a great looking thing. If you're at all-time highs, you can't long. Okay, you cannot long at all-time highs. Don't do it. Okay, because price always wants to be chasing an area of resistance above current price. That's going to give a reason for buyers to step in. If there's no resistance above current price, there's no reasons for buyers to step in. So only play pullbacks, okay, because then you're going to be buying when buyers step in. It's going to be extremely, extremely simple. So buy after sellers have sold. So I can see here from all-time highs, heavy aggressive selling has been coming into place these last couple of weeks. Okay, extreme selling to the downside. We met up near this area of support here. Okay, met up near this area of support here, and we're gonna go ahead and see what this is gonna entail. So on my weekly here, we have a red candlestick. I'm get on my daily here. So on my daily here, start seeing price try to curl up, but it's a lot of mixed match candlesticks. A lot of green, red, green, red, green, red, not the same color. Okay, if these were just straight green candlesticks for the most part, heading in upwards direction, then it'd be a lot more definitive. But in this case here, it's very, very spotty, not direct big candles. Okay. Right after like this low, for example, okay, heavy green candles, 1, 2, 3, 4 heavy green candles. Even after this one, kind of, we had a heavy green candle here, had to run one. But then after this higher low, straight green candles. This one here, we hit this low, and then a green candle, then a red candle, a green candle, and then kind of a doji, and then a red candle. So this one, I don't believe is fully ready yet. We could see this could be a higher low in the formation, and then we could see if maybe this low wants to hold or something. This low right here, price seems to be trying to find itself some support here. Okay. So this is why we scale down to our smaller time frames, just to see things a little closer. So we're gonna go ahead and have this. We have this super low here. We got a higher low than that. So as you can see from this higher low, the V did get filled in from right here. So that's really good. So we'll see about this V. All right, because we're looking for a setup right now. So on the 4-hour here, I see price. I actually like this a lot, honestly. Even if I don't take it to all the way up there, this area of resistance will be fine. Same thing with this area here. Okay. Even if I wanted to just take it to this one up here, that'd be fine. So I like this a lot, actually. This is what I've analyzed. Is price making higher lows recently? Yes. Bottom, up, pause, down. Okay, and the pause that it made down is higher than the previous pause. So this high is higher than this low. Higher lows mean staircase trending in upwards direction. Okay, and we're buying after sellers sold. We're buying after all-time highs dump. So I like this a lot. Okay, I see higher lows being in place, and I think this is a new low being in place. Why? Because I have one area of support here, And guess what? I also have a whole nother candlestick. Has me so excited right now. Boom. Whole nother candlestick. Boom. And I'm on my 4-hour here. Here we have 1, 2, 3, 4. 4 green candles headed in an upwards direction. So get on my daily here. I could wait for one more daily candlestick to be green. Like if this daily candlestick closes green, then I would feel comfortable for sure taking it up to maybe like at least this resistance up here. Honestly, I won't be scary. Play big, take profits. I would at least take it up to this resistance up here for sure. So I need at least one more. I'm gonna be patient though. Patience is everything. Don't just get in and be like, oh, higher lows, because sometimes your lower time frames could be your worst enemy. So on my 4-hour, do I like it? Yes. But we don't tunnel vision. You know what I'm saying? We need the real thing in life. So boom. Have this super low being made, higher low being made, and then another higher low being made. Okay. So I have 4 green candlesticks on the 4-hour. I like it a lot. Okay. I'm going to close all the way up here at these 2 areas of resistances. Right here. This is where I want to close. Okay. This is the strong area of resistance. You see how price marked it and hit it twice? Definitely not for no reason. So strong area of resistance, price has beef with. So what I'm going to go ahead and do is you can either do this too. But yeah, you can analyze your higher lows. And I can get on my 15-minute here. Four-hour. Okay, so either going to be looking for like a tiny little 4-hour wick. Okay, because right now the 4-hour candlestick is red. So right now selling is in place. Okay, so I only want to buy when it's buying. Okay, so right now it's making a little mini V. So I believe this is the top of the V right here that it's making with these 2 resistances. Let's get on to the 15-minute. You see these 2? Okay. So you want to remember, you do not want to buy when price is selling. So you would not buy right now on the 15-minute and the 4-hour. Price is heading in a downwards direction. But overall, we're in an uptrend. Okay. But you want to be buying at the right time, though, is the thing. You want to be buying at the right time. So right now, sellers are in place. But overall, buyers are in place. Okay. So to get that specific entry, you can scale down to your 15-minute. Be like, okay, I could see these 2 areas of resistances. That's why price is falling down. Once you start seeing green candlesticks, or once you start seeing a green candlestick on your 4-hour or your 15-minute, then a lot of times that's how you know buying will be ready. But right now it's falling down from an area of resistance. I need to wait for these, wait for this candlestick to go from red to green to show me that buying is real again. Okay. I do not want to buy when selling is occurring if I'm trying to buy a pullback. That's just not what I want to do. It's not what you're going to be looking for. It's called a pull back for a reason, because you're expecting it to go back up and it's just pulling down for a second. So right here, sellers are in place. Red candlestick, price is heading down even on the 15-minute. Okay, now if I'm on my 4-hour and I get a red to green candlestick, then I would feel a lot more comfortable going ahead and to enter. Because price might want to honestly fall down a little bit lower. I could get a little bit lower entry and save myself on some drawdown. But if this red candlestick were to go from red to green, that means buyers were to go ahead and be in place. And then from there, I should be able to go ahead and you can have your target all the way up there, for example. And then, you could do your stop loss under here. And this would be, give me about a 1 to 3. Okay. So this would be about a 1 to 3 here. Extremely profitable trade. Really nice trade. So catching your setups is about taking your time, really. It's about just seeing what you need to see. So I'll do one more setup here. So I hit on my weekly. Now mark at all-time highs, because this is going to be the most obvious place that we've recently fell from. So I'm on my weekly. Okay, not quite all-time highs. It's going to be over here. It's exactly what we get on the weekly. You want to zoom all the way out, see all the price action you can. That's going to be all-time highs. Then from there, I'm going to go ahead and put a line down at this new area of resistance here. Okay, the area of resistance where we're recently falling down from. I could see price making higher lows. Price has a super low here. And I could see higher lows being put in over time, which means that we are headed in a upwards direction. Okay, we're trying to get up here to all-time highs. So this is what I analyze here on my weekly. So on my weekly right here, the current candlestick is red. So we would not be buying right now. Okay, we would not be buying right now because we're currently selling at the moment. So we want to see if there's any reason why. Yep, I can see exactly why we are selling. So try and analyze why price is doing it, what it's doing. It's the price doesn't just do stuff randomly a lot of the times. As you can see on the weekly, I have this area of resistance here. You'll be able to see it a little clearly on the daily. This area of resistance is linked to this new area of resistance that just got created. So that's why price is falling in a downwards direction, logically. Now let me head over to my daily here. You're going to be able to see the curl a little bit closer here on the daily. Okay, price at the area of resistance that it matched with over here. Okay, price did some break and retest. Price came down and then wicked back up to the specific black line and then tanked down. Okay, so this is a very, very nice area of resistance that price likes. So we need to get back to this area though. So now this is so simple. It's the easiest way to play pullbacks. Just wait for sellers to sell first. So you can see that's why sellers are selling. Price at an area of resistance. So right now sellers are selling straight red candlesticks on my daily time frame with it right now. I'm waiting for price to bottom out. Okay, and this is the easiest way to not get faked out. So people got faked out on this candlestick, for example. And let me head over my 4-hour. Okay, so this candlestick right here, people bought this. The price decided to wake up and people probably thought they caught the ultimate bottom. You never want to try and catch the ultimate. Okay, you want to catch the high or low entry. So check it out by staircase. You see how this low's here? And then you have this low. Then you have this low. If I zoom in, I have this low. This low. This low. This one. Okay. So we could see price dumping in and making each of the higher lows. Go ahead and start it from all the way over here. Got price all the way down here. Support. Higher low. Another higher low. Price continues to just go in an upwards direction. Okay, we got these areas of support here. Mixed with this one. Mixed with this. Trending. All we're doing is buying the bottom, higher, low entry. Exactly, yes sir. That's all we got to do. Just buy the bottom entry. See how these two supports over here are correlated with each other? Very, very cool. Let's check this out. Check out this higher low right here with the recent higher low that we just did. And then we're still trending in the upwards direction here. I'm on my 4-hour right now with it. You can see we came down a little bit. Still, this low is higher than this low. And then we decided to trend up again and continue the higher lows. As you can see, we're filling in multiple of these. Each one of these pullbacks are a trade. Each one of these pullbacks are a trade. Boom. Pullback. Pullback. And it's the same parameters every time too. No. So boom, pullback. So now we just need price to bottom out at an area. And we need 2 to 6 green candlesticks. And once I start seeing that and price filling in the right side with some green candlesticks going up, I'll catch the right bottom. Okay. But right now, I'm going to wait. I'm going to wait. People probably got burned right here with these candlesticks. Yep. But if you get on your daily here, we only have 1 candlestick. So this is why you need your daily. This is why I say 2 to 6. So that's why your daily and your 4-hour is really important. You can't just tunnel vision on your 4-hour. You need 2 to 6 candlesticks on your daily and or your 4 hour. Okay, so right here, it was only what, one green candlestick on the daily probably, and then another one open red. So if we have one green candlestick on the daily and another one open green and we're heading in an upwards direction, I'm taking that. Stop loss below the lows, taking it to the highs. Gotcha. So a lot of the times I'm overnighting. So I'm always overnighting actually. So each one of the setups I'm overnighting because I can just focus on my higher time frames, which is the real bread and butter. And yeah, and that makes it really, really easy. And that's going to be how you can play pullbacks. Hey, welcome to Stackmode.net. Two things I want to do. I want to put a smile on your face, and I want to help you make some money by trading. Okay, so here's an example of a trade that I gave in my Discord here. So all we're going to do is understand some logical processes here. I teach stocks, Forex, crypto, options, as well as futures. Okay, and trading each of them is going to be fairly similar, but different for each sector. So whatever you specialize in, I can help you. Let's say we're trading the stock market, for example. I know that stocks have an incentive to go in an upwards direction due to the fact that these companies employ people. Okay, these people then pay taxes to the government. Okay, so as long as these companies go upwards in an upwards direction, the richer they're going to get, which means they're going to expand further, which will lead to further opportunities to employ people. So let's say, for instance, I'm trading the stock market. I personally wouldn't short the stock market. I'm looking to play call options or buy shares, catching my V directional fill. So as you can see here, I have an area of resistance above current price here. And as you can see, I have just some empty space here. And price decided to blast straight through it and fill in this area. Let's talk about how I caught this setup here. So here I can identify two things. We're going to have areas of resistance. Areas of resistance are going to be areas where price decides to fall in a downwards direction. Okay, and then we're going to have areas of support. Support are going to be areas where price decides to bounce in a upwards direction. Okay, using support and resistance together can lead to some very nice setups. So as you can see, market can only go in two directions, either up, okay, and once again, if market's going to go from a upwards bounce direction, that's going to be called support, and if market's going to go in a downwards bounce direction, that's going to be called resistance. Okay, so let's understand some things. So resistance can be broken and turn into support. So here I have this area of resistance being created. As I can see, market's falling downward here. And once the area of resistance decided to get broken, it decided to turn into some support. And then price went in the upwards direction. Okay, and I know that price in the stock market at least wants to go to all-time highs. Okay, same thing for cryptocurrency. There's tons of coders behind these tokens, tons of people putting in a lot of effort, wanting to see the token or the stock succeed. So of course the share price or token price wants to go in an upwards direction. So I play until areas of resistances for my take profit. So as you can see, resistance got broken here, turned into support, and then price would have met with the area of resistance and decided to do it again. Resistance got broken, turned into support, and then looks like price wants to keep going in an upwards direction. I try and make trading as easy and simple as possible for you guys. You guys see all the reviews from my students. I try and make it simple for you, and I adapt to your life. Okay, here's how the class system works. So one, I offer 10 classes. Okay, these 10 classes can be stretchable however long that you want. Okay, it could be between 10 weeks, we could do 10 days, or a class every 2 weeks. Whatever your schedule is, we're going to be flexible, and I'm going to maintain a optimal workflow for whatever you trade, your schedule, and what type of person you are. Okay, so I'm going to catch you guys in the free call. Go ahead and book the calendar. Stay prayed up to God. Keep grinding. I'm going to catch you guys in the next one. Peace. So this is going to be the full guide on how to trade options leaps, how to pretty much make options income so you can make a living off of it and just make some great extra income. I'm going to talk about from A to Z what we need to do, the contracts we need to buy, and the type of setups we got to be taking. Okay, so let's go and let's jump into it. So one, okay, we're on the stock market. Okay, so options give you access to pretty much 100 shares. Okay, so once again, options give you access to about 100 shares. So that means
that it's a leverage product, kind of. Okay. And the only thing that we fight against is time. Okay. So it pretty much gives you 100 shares per one contract to play with. So 100 shares with time added to it equals one option. Okay. So a contract is going to give you 100 shares and it's going to have time added to it. Okay. So now that we know this, okay, we're going to go ahead and put everything into perspective. So time is going to be really important. Okay. So let's talk about how we can outplay the time and how we can pretty much progress with options. Let's jump into it. So once again, we're going to be playing the stock market. Options gives you access to play 100 shares worth of value. Okay. Bundled up in one. Okay. But the only thing you're fighting against is time. So I'm going to talk to you guys about how to outplay that. But let's understand the logical process of what we're playing first. So we're playing the stock market. Okay. The goal of the stock market is to go in an upwards direction. And let's talk about why. Okay. Why is it going in an upwards direction in the first place? What's the point of buying options and why do we think price is going to go in an upwards direction? One, okay, I can get on my weekly time frame here and zoom out and I can see this company, for example. Okay, it's a profitable company since the shares go up year after year after year after year after year after year. Okay, so whenever you see year after year after year after year after year progress and chart going in an upwards direction, that generally means that that's a good buy. That's a profitable company and they're doing their thing. Okay, so that's going to be a company that we would ideally want to pay attention to. So after I see market trending like this in an upwards line, I can put into conclusion, okay, why is it going in an upwards direction? One, these stocks aren't just stocks on the internet. Okay, these stocks are real jobs. Okay, real jobs that you might have even worked at in real life. Okay, so these jobs employ people. Okay, so these stocks aren't just random stocks trying to go up for no reason. They employ people. Okay, which helps the economy. Okay, companies like Microsoft, Google, definitely Amazon, okay, creating jobs for people so people can protect and provide for their families. So these stocks, they're doing something big. Okay, they have a big weight attached to them. They help out the economy. They employ people. Okay, and the company investors are competitive. Okay, they're in competition. So if this is a bank stock, they want to outperform every other bank stock by having the higher share value to prove to investors that whatever they're investing in, and that if they invest in their company, they're going to have the most profitable stock, pretty much. Okay, so there's going to be incentives behind it too. It's going to be really competitive. So the competitiveness behind it makes investors invest into certain companies. Okay. A bank wants to be the best bank. A broker wants to be the best broker. Tech company wants to be the best tech company. Okay. And the best way to compete or show competition and show value is going to be via the stock market share price. If one share price is higher than another company's, that just means that one company is just more valuable than the other. And that's just flat out what it means. Okay. So companies are trying to compete. Okay. Because the share value being in an upwards direction shows how much it's actually affecting the economy. Okay. So that's going to go ahead and be that. So let's jump into it. Okay. So options in stocks have a reason to go in an upwards direction. And the reason why I'm focusing on an upwards direction is because that's the goal of it. Okay. Once again, more jobs are going to be created. And the whole reason stocks put themselves on the stock market in general is so they can raise money. Okay. They want our money to put into their company so then they can turn our money into more money by investing into business manufacturers, getting better or more employees, etc., doing whatever they need to do with our money invested into it. Then that's why companies that are profitable pay what's called dividends out. Okay, they pay dividends out since the company's making so much money. Anybody who's holding shares, they're like, you know what? Here's some money back. Thank you. Thank you for participating and helping us grow. So dividends, they're pretty much going to be a big thank you. Okay. So dividends are a thank you. If you see a company paying out dividends and not splitting them, not reducing the dividends, so you can see this dividend amount was 0.30 back here in 2023, and now it's about 0.40. Okay, that means that they increase the amount of money that they're paying out to people. If they can increase the amount of money that they're paying out to people, they're not struggling. Okay. But when you're penny pinching, okay, I'm sure we've all had times where we're penny pinching down bad. Okay. When we're doing that, then you don't have no money to pay people. Okay. But when you have surplus to pay people out extras more than normal, then you know you're in a good position. Okay. So that's what's going to determine if a company's in a good position or not. If their dividends are increasing and what their earnings is going to be looking like. Okay. So keep those two things in mind before we invest into anything. Now, let's talk about the actual chart itself, how we find it set up, and some stuff we need to do. So the time frames we got to focus on, okay, is our higher time frames. So you can look at your weekly time frame. Your weekly time frame, that's really going to help you put everything into perspective. Okay, your weekly time frame is going to help you see absolutely everything. Okay, it's going to be your eyes. It's going to help you see everything you need to see. Okay, and you're going to get all of your price action viewed. Then after the weekly, you can scale down to your daily. And then after the daily, go down to your 4 hour. Okay, when you're on the 4 hour time frame, let's go to the bottom right and make sure extended trading hours is going to be on. Okay, because what you're going to notice when you're on the daily and the weekly, and then you go to something like the 4 hour, which has extended trading hours, you're going to notice a little bit of differences in candles. So to see the exact candlestick wicks you need to see, do all of your higher time frame analysis, and then go down to the 4 hour time frame lastly. Okay, so once again, I'm going to go for my weekly, see the whole overall price action view, and then I'm going to go to my daily, and then I'm going to go to my 4 hour time frame. So let's talk about two things here. So this is going to be current price. Wherever I see the dotted line at is going to be where current price is. Right now, current price is at all-time highs. Okay, so if I'm playing a market that I'm expecting it to go up and it's already at max height, I don't want to buy there. Okay, I don't want to buy at max height. Okay, I can't go any higher than that. Okay, I don't know how high price wants to go up. I want to take a trade where I have resistance above current price, so price has something to travel to, or support needs to be above current price, so price has something to travel to. Okay, so what resistance is, it's an area where price decides to fall in a downwards direction. And this is a left to right chart. Okay, so resistance happens because if people bought way down here, of course they have to sell. So whenever and people bought way back here, so of course we're going to have sharp areas of correction. Okay, whenever we see market big sharp points and then falling in a downwards direction, that's going to signify an area of resistance. Okay, even right here, we're going to see price decide to create this top, and then it fell in a downwards direction. Okay, downwards direction. Same thing up here. Price creating resistance here, and then price fell in a downwards direction. Okay, very simple. Okay, and it's just not making it hard, making it very, very, very simple. So whenever you see market making downwards corrections, that's going to signify resistance. And once again, we want to be looking at resistance, etc., and stuff on our higher time frames. That's all we want to be looking at. Our weekly, daily, and 4 hour. Okay, we don't care about 15-minute resistance, none of that. We're looking at our higher time frames. The higher time frames are the levels that the institutions are playing with. Okay, so whether it be at hedge funds, banks, institutions, okay, everyone is looking at the higher time frames. And trading is not like business where you want to be unique. Okay, in trading, you want to be a sheep. Okay, whatever everyone else is doing, that's what you want to be doing too. That's going to be the right thing. If price is going in upwards direction and blasting, you don't want to be the one selling. Okay. Now, if price made a low and found support, which let's talk about that. If price makes support, which is going to be a low, and then price bounces in an upwards direction, then you can go ahead and purchase there too. So even if price is going down if you see price make a low and then start bouncing in upwards direction, you can go ahead and purchase that too. Okay. So support, once again, it's going to be an area where people are going to be buying at. Okay. It's going to signify demand. So buyers are at the areas of support. And then the opposite of that is going to be resistance. Resistance means there's too much supply. And that's going to signify that sellers are stepping in. Okay. So that's the difference between the two. So we have support, price bouncing in an upwards direction, resistance, price bouncing in a downwards direction. They both correlate with each other. Price can only go two ways, up or down. Okay. So they both work together. Okay. So check it. And this is going to be an area of resistance over here as well too. Okay. And then something like this over here would be an area of support. Okay. See price making this low and then bouncing in a upwards direction. I'm looking at this on my weekly time frame first, okay, just so I can go ahead and see absolutely everything. Now, for this trade, for example, Wells Fargo, okay, I wouldn't not take this trade because one, we are at all-time highs, okay, and just like I spoke about right here, okay, I like to either have resistance above current price, because price always wants to meet up with an area of resistance. So this brings me back to the competitive logic. Okay, so bringing back the market logic into the charts. If the company is trying to be the most competitive and show that they're the best, which is one of the ways they can do that is by having one of the highest share prices compared to the competitors, then price has to break resistances then. Price can't stay at all-time highs. They can't keep dumping down. That means it has to break resistances. So price is always going to be chasing all-time highs. No matter how low we dip down, okay, I don't care if price dips down all the way down here. As you can see, price still broke this area of resistance right here and then bounced in an upwards direction, okay? Price is bouncing up, going up, okay? So it's going in an upwards direction, okay? No matter how low price dips, it always wants to break all-time highs. Not saying it always will, depending on some companies, but it wants to. It wants to go back up. Okay, there's people behind these companies. There's people working behind these companies. They don't just want to be working for a failing company that's not paying any out good dividends. That's not logical. Okay, so that's why I'm going to personally ignore things at all-time highs, because if something's at all-time highs, yes, it could burst a little bit higher up, but for the most part, all it can do is fall down. Okay, so what I like to do is wait for good opportunities. So take this Amazon opportunity here, for example. All right, let's say Amazon wants to actually bounce at this area here, right? Okay. So we have this area here on Amazon, okay? So I have this area of support being reacted off of. We got one candle, two candles here, and then I have one candle here. Okay, let me go to my daily time frame here. Okay, I got a double bottom here at this blue line. Okay, and I can see over here, price made resistance over here too. So might want to break it and retest off of this area here. And then right here too, the support decided to work. Okay, so let's say price decided to bounce up this blue line, right, and go in an upwards direction. So if price wants to find a specific low here, okay, and one thing I like to go do is get on my daily time frame. Okay, look at the low zone. Okay, price is either going to bounce two ways, and we only want to be purchasing call options. Okay, we're going to be purchasing call options only due to the fact that it's a stock market. Okay, there's people working behind these companies. They're way more likely to go up than down. There's also laws in place, such as the short share restriction, to prevent things from dumping to zero. These companies employ people and run the entire economy. They're not just stocks on the internet. So call options are going to be all that we're purchasing. And we want to be purchasing any contract between, honestly, 1 month is too short for certain take profits. So you want to be purchasing a contract between, I'll say 3 months to 2 years out. So you want to buy at least 3 months to 2 years out. Okay, so what that means is on the Amazon contract dates, for example here, if I wanted to trade this is October, as of when I'm recording this, October 2025. So it's going to show me the most recent options contracts here. Okay, what I'm going to do is go all the way over to the right. Okay, and let's say it's 2025. So let's say I want to buy 2027. Okay, I'm going to buy a whole year out. And the reason why I'm buying so far out is because I'm using my higher time frames. I'm using my daily and my weekly. Okay, I know price wants to hunt these areas, inshallah, but we have to give time for our trade to cook. So, and the contract that you're going to buy is really easy. So if current price, like we can see here in the middle for Amazon, is at 215, okay, all you're going to do, the contract that you want to purchase is going to be the one above wherever the current price is. All right, so if your contract is at 215.57 and you buy a year out, whatever the option above the current price number is, okay, the first option above the current price is going to be the best contract to buy. So in this instance, it would be this call 220s, since that's the first option above this 215 here. And I would buy a year out, okay, and then let the whole thing work. And this is also going to be a really good indicator to let me know if a trade is going to be good too. So I can see here all the price action here on the Amazon price chart. Okay. So this is where it was up here at January 2025. Okay, I can see price made this ultimate low here. Okay, and now it's trying to make some progress. Okay, so price is trying to mirror this low over here. Okay, and go in an upwards direction. So we have this support low over here before price bounced, and then we have price trying to mirror it again. Okay, price potentially, especially if I get one more daily close, if I get one more daily candle above the zone, I like to wait for a daily close above the zone too. I never buy whenever price is in the zone. So right now the wick is still in the zone. This candlestick is in the zone. Now, if I get another candlestick up here above the zone, I'm buying that. Okay, that's something I want to buy because it's showing that the zone is holding. So I never buy the first wick in the zone. I never do that. Okay, I just want to see if the zone wants to work out. And how I'm going to do that is get on my daily time frame, and I'm going to look for a candlestick outside of the zone. I should see a candlestick above the zone. If I see a candlestick above the zone, I'm good. Okay. If I see a candlestick above the zone, I'm going to be good. I'm never going to want to buy in the zone. Why? Because price, if it wants to, could dump further. Okay. But if I see price give me another candlestick, it's going to show me that that area of support was valid like I thought. And instead of me getting burned and just losing, okay, by buying at the zone, trying to buy too fast, I'm going to wait for price to confirm itself. Okay, so waiting for confirmation can be really strong. Okay, waiting for confirmation is something that more people just need to do. Okay, so when you wait for confirmation, you can sense out your setup. Okay, you know what type of setup you want to take. Okay, you're like, okay, hold on, this is working out because of X, Y, and Z. Price is holding this area of support here. Okay, so keep that all in mind. All right, keep it all in mind. All of it's going to be very, 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 very useful to keep in mind when it comes to taking your trades. Now, just like I spoke about again too, I like to play trades when there's resistances above current price, just like I talked about. Okay, so I have this area of resistance up here above current price. Okay, so I know price is something to travel to. I could see price reverse here once, reverse here twice. Okay, so price wants to come up here and try and break it. Okay, it doesn't want to keep reversing at the same area over and over again. And if it does reverse at this area 60 times, just the fact that it's trying to break this area, we use that as our profit window. Okay, so the whole gap until the area of the resistance is the money that we're trying to make. Okay, that's a whole bunch of money that we can make right there. So once we see the support being confirmed, we take it up to the heaviest area of resistance. Gotcha, my bad. So yeah, we'll take it up to the next heavy area of resistance. Okay. So it's gonna go ahead and be that. All right. And then from there, let's go and let's jump into another setup here. Okay. So that'll be that. Price doesn't want to keep reversing at this area here. over and over and over and over and over and over again, eventually it's going to want to try and break this area here. Okay. So keeping that in mind at all times, it's going to be really, really, really important and imperative. Okay. So if I go ahead and I pull up another stock, for example, okay, let's say Apple. Okay. Actually, yeah, you know what, let's say Apple. Okay. Even Apple right here, okay. I can see Apple created this area of support down here. Okay. This area of support looks like it wants to be held due to the fact that on my daily time frame, I have some candlesticks that decide to push in upwards direction from there. Okay. So I can assume that price wants to at least fill in this gap up here. So I know price wants to fill in the rest of this gap for resistance here. Okay, since we're going upwards direction, it's not going up for no reason. It wants to go to a certain place. Up. Okay, so we have about 10 points left and it's heading to the resistance. And they'll try and reverse here or break it and maybe retest, continue. So once you see a support area confirmed, I look at it, be like, okay, why does price want to bounce at this area here? Once you see why price is bouncing in a certain place, it's going to be a lot easier to go ahead and take the setup from there. Okay. So let me pull up something like a Google, for example. Okay. Same thing with Google here. I could see price decided to meet up with this area of support once. Okay. And then I also have the area of support being reacted off of twice. So I got two areas of support here being reacted off of. And I can see here, day after day after day after day, price is filling in this gap here to the area of resistance up here. Okay, price is trying to fill up the area of resistance up here. So even if I wanted to get in right here, I'd still have about 5 points of price action left until I hit the resistance. Okay, so even if price were to whiplash all the way down, okay, up here still might take profit. Okay, so this is why on options too, our contract is going to be our stop loss. So if the contract costs $200, we're okay with losing $200. Okay, so your options is your contract that you purchase is going to be your stop loss. So you can start off by playing cheaper stocks too if your portfolio isn't just booted up enough to play certain contracts that are just too short. Okay, so even on a cheaper stock like this, right, I can see price making this ultimate low on this base down here, right? So you have this heavy area of support down here. Price decided to make this area of support start going in an upwards direction. Okay, we can clearly see price curling up. Okay, and I know we're curling up to a certain place. We're not just curling up for no reason. We're trying to break these areas of resistance. It's resistance for a reason, okay, because price is trying to break the last point of fill out. So we could see we got this area one here, and then we have this area right here. So we got two areas where price decided to fall in a downwards direction at, okay, two places. So we know price wants to at least try and touch this area of resistance. So this is all I would do. Okay, I can see that the support area already got confirmed. And even if I just wanted to buy right here, this would still be a good buy. Okay, I can get on my ruler here, and when I close, it's just going to be important. And how much time I have too. Okay, so there's about 6.56 points left. Okay, so from there, I would be able to click on options in the top left. And I could buy a year out or 2 years out if I wanted to. Okay, and my take profit is going to be 17.43. But to make the most money, I'm just going to go ahead and buy the contract one above the current price. So if current price is at 10.85 and I want to buy two years out, for example, then I'm going to go ahead and just buy the contract one above, and I'm going to go ahead and buy that. Okay, and then from there, I can go ahead and just hold the trade for just an extremely long time and just sit on it and set alerts and wait for take profit to get hit. Okay, and we're going to just rinse and repeat until we find good trades. So this is going to be a trade that I marked out here too for students. So I could see here, price decided to do something what's called break retest. So after areas of resistances are broken, they can sometimes turn into support. And that's going to be called break and retest. Whenever you see price doing that, it's also a high conviction that price wants to continue in an upwards direction. So I could see price made this extremely heavy area of resistance right here, fell down, okay, and then price decided to make this ultimate low, okay. So there's going to be two setups you're always going to be playing. You're either going to wait for resistance to be broken and wait for price to come down and turn it into support, just like this. You're going to wait for the resistance to be created and then wait for the resistance to be broken and then wait for price to turn the resistance into support. And then if you start seeing bounce rate action out the zone, you're going to be good. So you're either going to wait for resistance to turn into support, or you're going to wait for an area right here to be reacted off of. You're just going to wait for an area of support to be bounced off. Okay. Even if price doesn't cleanly mirror the supports like this, okay, one level after the other, okay, just like right here, one level of support immediately right after the other. Okay. Sometimes you're going to have an instance like this, though, that still works. Sometimes you're going to have an instance of support like this. Price might break down below the support, and then it might come back above it, and then it might bounce again. Okay. So you could just ignore this, but just the fact that it wants to mirror the original bounce and try it again, okay, is a really, really, really strong and good sign. Okay. So that's what you're going to be looking for. Okay. Either support bounces or prices bouncing in the same area of support, giving you daily closes outside of the zone. Okay. So I would never trade in this gray box. Okay. Because I can see prices wicking here. I would wait for a candlestick to get on the daily above the gray box. And then I'm going to go ahead and take the candlesticks above the gray box. Okay. I want to just use my low as confirmation. Okay. And then even right here, price broke above this area of resistance, turned into support, and then went up to the next area of resistance all the way up here. And guess what? Resistance got broken again and turned into support. So resistance got broken and turned into support again. Okay. Keeping markets simple, playing trendy. Okay. We're just going to be trading with the trend is all we're doing. Focusing on lows and focusing on where we need to close. Okay. So I'm going to always start off on my weekly time frame. It's just personally what I like to do. Let's say this instance here, I'm going to go ahead and put a zone at this all-time highs. Start off on my weekly. Let me go to my daily. Okay. We could see price trying to make a lower here. Okay. And then I'm going to my 4 hour. And this is why we go to our 4 hour time frame, because you can see here on the daily time frame, this is the bottom of the wick. But then I go to my 4 hour time frame, the bottom of the wick is going to be down below down here. Ooh, guess what? Extremely, extremely nice. So I have area support over here being reacted off of with this area of support over here. I love it. Price came all the way back down to this area of support, which I assume came from this area of resistance right here. So break and retest will a lot of the time it'll happen once real quick, create the strong area of resistance, and then price has a chance again to come back all the way down, turn into support and bounce again. And we can see the support areas are mirroring each other. Okay, one area of support, two areas of support. The support areas here are once again mirroring each other. Okay, so if the support areas are mirroring each other, that means that it's a significant place that we want to just be purchasing at. Okay, they're mirroring each other at these places. But price isn't just doing anything, it's playing logically. Okay, so if I see price bouncing at the same place, I would assume that price wants to fill in the rest of this area of resistance up here. Okay, and price will either try and reverse at the resistance, break above it, I don't care. All I know is, even if price wants to reverse at the resistance, it wants to at least touch it. Okay? It wants to at least touch it. So we'll go to my options. And I would go ahead and be able to buy. Let me see. If my take profit was about 2 months ago or about a month ago, then I could easily buy 3 months to 2 years out. The further out, the better. The further out, the better, just because you want to give your trade the most time. So take profit up here is 50. Okay, take profit was there about a month ago. So if I wanted to, I could do like January 2027. Okay, and then I'll be able to purchase this contract very cheap for $240. I could buy a contract that lasts me about a year. Okay, so I have a whole year to go up 3 points. That's extremely likely. It's extremely likely. So what you're doing is you're outplaying the options formula. Okay, you're taking the perspective of option sellers where they're like, you know what, people are going to purchase this contract because they're going to want to be cheap. They're going to not have enough time on this, and price most likely will not do it in a short amount of time. Okay, so when you buy time on your contracts, you give yourself time. Okay, give your contracts time to breathe and do its thing. It's going to be big. Okay, and you can stack up on what's called leaps too. Okay, you can just buy a bunch of good setups that have like 1 to 2 years out and just sit on them. Sit on them. Wait for take profit to get hit. Find your take profit on your weekly and your daily and wait for them to get hit. A lot of the time too, on your price chart, this is not going to be the definitive every time, but a lot of the time on your price chart, if you have resistance above current price, you're in a good area. Okay, resistance above current price is going to be a really good sign. Okay. Once again, resistance above current price on your price chart too is going to be a good sign. You can see the price chart has a place to travel to. Okay. It's about taking our time. Okay. So the weekly here, I would start off, I just go through my pairs. I can see this is at all-time highs. I'm cool off this. Okay. If I wanted to trade this, I would need price to pull back to a certain level. Okay. I could see price here decided to turn this area of resistance into support. Okay, and then it took off. Now, if price decides to come back, hold this area again and bounce, I'm cool. I'll take that. Okay, but buying all the way up here, I'm not gonna do that. That's not something that I want to do. Okay, so let's take this stock for example here. Okay, even right here on this stock. Okay, I could see price trying to make a certain low here. Okay, I always just pay attention. Is price bouncing in an area? If so, I'm gonna check it out. Okay, I can see price made this area of resistance over here. This area of resistance turned into support. And this area of support is now being bounced at again. Okay, and I also have a daily candlestick above the zone. All parameters I like personally. Okay, price bouncing in the same zone. I see some break and retest over there. So if I wanted to, I could easily take my take profit to the area of resistance up here and then all the way up here. Got it. And then you're gonna wait for price to fill in the gap. It might fall down here and then come up, maybe retest, and then back up through here. Okay, so I can see the support here being confirmed. Okay, price really likes the support here. So I'm gonna take my chances here, and you can see the rest of the bars is about 20 points worth of price action. Okay, take profit was hit about a couple months ago. So I would do the same thing on this. I would go options. Okay, I would go like a year out. Okay, I would just make it easy for myself, buy the one right above. I can see on my price chart here, I have resistance above current price. And this is just simple, okay? And I can see price even on the price chart here, kind of wants to confirm. When my price chart reflects my actual chart, that's gonna be a really good sign, okay? So you want the price chart to be reflecting kind of the actual chart, okay? So I can see price bouncing in that same low here, and it looks like it wants to trickle up and fill the rest of this area up here. Okay, so we have about $1,900 worth of profit up here to be made in between here. Okay. In options, it can be kind of hard to calculate every single thing. It's not an indicator, it's just a price chart. So every options contract has its own chart. Even here too, take this stock here. Okay, once again, all I do is just eyeball, okay? I just eyeball. I can see price made a low, and I see a green candle after price dumped, I see green candles looking like it wants to trickle up, okay? So you can just eyeball the chart, and this is why we just buy time. There's millionaires for people who don't even look at the chart, okay? People who forgot about the plays they've been in and opened their broker one day and just closed the position and enjoy their life. Okay, so that just shows that buying and holding is what we're going to be doing. Okay, so even right here, to see price bouncing at that certain low over here. Okay. Price decided to make this low right here based off of the resistance right here. So resistance got broken and price decided to turn it into support. And then price decided to bounce at the same area of support again. Okay. And once again, I have a daily candlestick outside of the zone. I have a daily candlestick way above the zone. So I'm good. I'm never going to buy a candlestick in the zone. I like to see if my zone is created though. Okay. Then from there, I can go ahead and see price wants to try and meet up with this area of resistance. Okay. It'll try and either reverse at this area or break above it or both. Okay. So we'll go ahead and go to options, go a year out, buy the one right above. And guess what? Price chart has resistance above current price. So when your price chart looks like your setup, that's a really good sign. Okay, this is going to be some secret sauce right here. So when your price chart looks like your setup, that's really, 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 really secret sauce. Okay, and then personally, I would just be waiting for market to go ahead and do its thing up there. Okay, I would wait for price to curl up and meet up with the area of resistance up here. Okay, and catch the whole remainder of this price action up here. Okay. So it's about taking our time, making sure we're finding good, profitable setups. Okay, even right here, take Hewlett Packard, all right? We have this area of resistance here. Okay, price decided to just meet up with this area of resistance. Okay. And price decided to make a low. Okay, made a low off of this support right here. And decided to bounce in upwards direction. Now price is meeting up with this area of resistance, and we're going to try and break this area of resistance. Now, if this area of resistance gets broken out of, then I know we want to at least try and meet up with this area of resistance up here. Okay, go to my daily time frame. Okay, I can see this area of resistance created up here. So if price decides to run past this area of resistance, maybe turn into support, I know we want to go ahead and try and trickle up here. Okay. Or even, if I just deleted everything, marked out this area of resistance up here. Okay, I could see price hit this area of resistance this year. Could see price decided to make this recent low. Okay, and I could just wait for price to fill in this gap up here. And then I could go ahead and go to my option contract, buy a year out, 30, and I could see resistance above current price on the price chart. So if I see price already made a certain low on the price chart, that's going to let me know that that's really good. Price already redipped the zone multiple times, even on the price chart. Okay, so price looks like it just wants to curl in an upwards direction now, inshallah. Okay, their setups look like your price chart, and the whole remainder of this gap here is going to be all just money we can get, all money we can make. I'm just buy a year out and just set my alerts at the take profit all the way up here. And I'm going to let the whole trade just ride out. Okay, I'm going to let the trade just do its thing, collect my profit, and just ride it out. And I'm just going to ride out the trade. Okay, and just make it as easy as possible for us. Okay, same thing with Kroger here. Okay, I can see price confirm this low down here already. Okay. You can see price confirm the low down here. Okay, it likes this area. Now I can see price wants to potentially try and meet up with this area up here. Let me go to my daily. Okay, and I can see this whole area of resistance clearly wants to be filled. Okay, filling this whole gap of the area here. Okay, even if I got on my 4 hour here, even if I closed up here. Okay, Kroger. Boom, could go a year out, go one above, and as I can see, resistance above current price on the price chart. Price decided to make a low already on the price chart, and price looks like it wants to fill in the gap to the area of resistance and curl within a upwards manner. Okay, so that's going to be how to trade leaps, how to make income from options, and how to trade.
So what's the difference between major, minor, and exotic forex pairs? Let's go on and jump into it, class.
So an introduction to the Forex market. So the foreign exchange, also known as the Forex market, is the largest financial market in the world, with the daily trading volume exceeding 7.5 trillion as of 2022. So this is a pretty recent study. It operates 24 hours a day, 5 days a week across major financial centers like London, New York, Tokyo, and Sydney. And it's a decentralized market where currencies are traded over the counter. And it involves speculation on currency, and speculation is going to pretty much mean to where traders can get paid based off of directional bias on currency value fluctuations driven by economic, political, and geopolitical events. And participants include banks, corporations, governments, hedge funds, and retail traders, which are just single individuals. So let's go on and jump into the classifications of the currency pairs, their characteristics, and how they impact the trading strategies. Let's go. So what are currency pairs? In forex trading, currencies are always traded in pairs because you're essentially buying one currency while selling another. The first currency is the base. So let's say, for example, USD, okay? And the second one is the quote currency. So the first one here is going to go ahead and be the base. So USD before the slash is going to be the base currency. And the second one, okay, is going to be the quote currency. So let's say Euro. Okay, so let's say you were trading USD Euro. The first term, USD, is going to be your base. And then the second one is going to be your quote. So an example, for example, here in Euro USD, then Euro will be the base and USD would be the quote. And if the pair is at 1.10, it means 1 euro buys 1.10 US dollars. And currency pairs reflect the relative value and are influenced by interest rates, inflation, and economic data releases like GDP and employment reports. And understanding pairs is crucial for risk management and profit potential in trading. So for example, if you believe that the euro will strengthen against the US dollar, you go long on Euro USD. Conversely, if you think it'll weaken, then you'll go short, okay? And long means price is gonna go in an upwards direction that you speculate, and going short means that you think price is gonna go in a downwards direction. So some categories of the currency pairs. Forex pairs are categorized into 3 main types, okay? Based on liquidity, trading volume, and the economics involved. Majors, minors, and exotics. So majors, they're mostly traded and involve the USD and major economies. And minors, play cross pairs without USD and still for major economies. And exotics, involve emerging or smaller economies. And these categories help traders choose pairs based on their risk tolerance and strategy. So major pairs, here's the definition. Major currency pairs are the most liquid and widely traded in the forex market. They always include the US dollar paired with another currency from a major global economy. And majors account for about 85% of the daily forex volume. And the US dollar dominance due to the US economy size and the dollar's role as the world's reserve currency. And high trading volume leads to tighter spreads, okay, which means you're going to be hit with less fees whenever you do close or sell off your trades, and better execution, which means you're going to go ahead and get filled. So when you click buy, you're going to go ahead and be entered in the trade, or sell, you're going to go ahead and be exited out the trade. And major pairs are traded heavily during the overlapping sessions like London session or New York session. And New York session is from like 9:30 a.m. to 4 p.m. Eastern time, okay? And in between that, London session overlaps. So London session ends at 11 a.m. But due to the fact that New York session opens at 9:30 a.m., there's going to be time where New York session and London session are going to go ahead and overlap. And major pairs are going to be ideal for beginners due to their predictability and abundant market analysis available with so much data. And we know this is a left to right chart. That's just how it works. So examples of major pairs. Here are the 7 most common major pairs. Euro USD. So Euro/US dollar is the most traded pair globally, has the most volume, has the most money running through it, and has the most people trading it. So USD JPY stands for US dollar and Japanese yen, and it's known for carry trades. GBP/USD, that stands for British pound. So GBP stands for British pound, okay? /US dollar is volatile due to UK politics. So the United Kingdom politics really affect the pair GBP/USD. And USD/CHF Okay, US dollar slash Swiss franc, it's a safe haven pair. And Australian dollar slash US dollar. Okay, it's commodity driven. And USD slash CAD, US dollar slash Canadian dollar. It's oil influenced. Okay. And New Zealand dollar slash US dollar. It's very agricultural focused. A detailed example. So Euro USD, it's influenced by ECB and Fed policies. And for instance, if the Fed raises rates, USD strengthens, pushing Euro USD downwards. So some characteristics of major pairs. Majors exhibit specific traits that make them attractive. Okay, so high liquidity. Major pairs is really going to be a spot where trades are going to be able to take place quickly. So if you click buy, you click sell. Since there's so much liquidity, aka people trading or money being flowed into it, when you click these buttons, you should be filled pretty quickly. Okay, so high liquidity. They're easy to enter and exit positions without price slippage. Okay, and more stable. Okay, but can spike on news like non-farm payrolls. And tight spreads, often around 0.5 to 2 pips, reducing the trading cost. And there's going to be abundant information on major pairs, extensive coverage, a lot of government information, economic information, etc., affecting the price. And there's going to be extensive coverage from sources like Bloomberg and Reuters, for example, and different correlations. They often move in tandem with the stock markets or bonds. And these characteristics allow for scalping, day trading, or long-term position holding. And advantages of trading the major pairs. The pros include some lower risk due to the stability and liquidity. They can be cost-effective, they have minimal spreads and commissions, diverse strategies are going to be able to play within them. They're suitable for technical and fundamental analysis, so when you put news and charts together and your TA together, technical analysis, then it could be a really good way to make some money, inshallah. But not without risk, be careful. And global impact, you can react to worldwide events, providing opportunities. So for example, during the COVID-19 pandemic, majors like USD JPY saw safe haven flows, creating a predictable trend. And so disadvantages of trading major pairs. So some cons to consider. Lower profit potential. Less volatility means smaller price swings. And high competition. Crowded trades can lead to reversals, and new sensitivity and sudden announcements can cause whipsaws. For example, in 2016, Brexit, okay, which was something that involved the European Union, it caused GBP, okay, which is the British pound, US dollar slash US dollar, to drop 10% in one day, catching many traders off guard. So even if you were in a good position, due to the fact that you're trading something that's based off of economic news, can still be subject to certain drops or certain uprises. So be careful. Make sure you have your stop loss set, and make sure you're trading within your risk parameters. Trade within 1 to 10% of your account. So the definition of minor pairs are going to be known as cross pairs, and they consist of 2 major currencies, but exclude the US dollar. They represent about 10 to 15% of the Forex volume, and are traded between major economies. And they're derived from majors. For example, European slash GBP is influenced by European USD, and GBP slash USD reflects regional economic dynamics without USD influence. And USD stands for, once again, US dollar. That's going to be the fiat currency used in the United States. And they're more active during European or Asian sessions. And miners often offer diversification from USD-centric trades. And some examples of minor pairs. Some common minors include Euro slash GBP. Now remember, minor pairs do not include US. Okay, so minor players are going to be Euro GBP, Euro AUD, which is going to be for Euro Australian dollar, GBP JPY, that's for British pound Japanese yen, AUD JPY, Australian dollar Japanese yen, Euro CHF, that's Euro Swiss franc. Okay, so CHF equals Swiss franc. Okay, and Euro GBP is Euro British pound. And then we're going to have CAD JPY. CAD is Canadian. And JPY is Japanese yen. So for example, GBP slash JPY, known as the guppy, it's volatile due to the carry trade instance rate differentials. So some characteristics of minor pairs. So minor pairs have moderate liquidity, less than majors, but sufficient for most traders. And they have higher volatility. They have more price swings than majors due to the fact of different certain parameters. They also have wider spreads. It can consist of typically 2 to 5 pips. Okay, so low liquidity is also going to lead to wider spreads. So beware of that too. And they have a regional focus, influenced by local news. For example, European data for European pairs and correlations, often inversely related to US dollar strength, and they're suitable for intermediate traders seeking more movement. And pros and cons of minor pairs. Advantages: higher volatility for profits, bigger moves in shorter times, and they're used for diversification too. So you can avoid the USD exposure. Let's say the US economy is going through something, then you can trade minor pairs. Some disadvantages: they have higher cost and wider spreads eat into the profits. So let's say you made $200, okay, on your trade, the spreads would go ahead and make it like 184, for example, okay? So this way you're gonna be down like $16, something like that, okay? So they also have increased risk too. They're more unpredictable during off hours as well. And during 2022 for inflation, for example, Euro/GBP fluctuated wildly on the ECB versus BOE policies. So once again, any big economic news that occurs is going to go ahead and affect the price. So be wary, have your stop loss set. Stop loss is going to be an automatic order that cancels out your trade for you, so you guys don't lose money for no reason. So exotic pairs, here's the definition of that. Exotic pairs are a major currency, usually USD, with a currency from an emerging market or smaller economy. And they normally have low trading volume, making up less than 5% of the market. And emerging economies like Brazil, South Africa, and Turkey are going to be involved. And they have high sensitivity to local events like elections or commodity prices. And they're traded sporadically, with liquidity peaks in specific time zones. And exotics are for experienced traders who are willing to take higher risk, who believe in the future of a certain country, for example, or smaller companies' progression. So some examples of exotic pairs: you're going to have USD/TRY. That's going to be USD/Turkish lira, okay, for Turkey. So USD/MXN, USD/Mexican peso, so the US dollar and the Mexican peso. USD/ZAR, the US dollar/South African rand. Okay, it's going to be South Africa's currency. Euro/Turkish lira, so the European Union currency can be traded with the Turkish currency. And USD/THB, the US dollar, and the Thai currency, the baht. So THB is going to be representing Thai's currency for the baht, and USD SGD, okay? That's going to be for the Singapore dollar, okay? So SGD is going to be Singapore dollar. So for example, USD TRY, it's highly volatile due to the Turkish inflation and constant political instability. And certain other countries too that have not a stable government can be subject to certain volatile price action fluctuations, so be careful. So some characteristics of exotic pairs. So some distinct features, class. They normally have low liquidity and they're prone to slippage and gaps. And they have a high volatility, and large swings can happen depending on the news. And that can be a good thing or a bad thing, because it could throw off your technical analysis depending on just certain events. And they have a huge spread when it comes to fees, and they have up to spreads of around 10 to 50 or more, okay? Which could mean that if you make like $200, you can be getting like $100 back, depending on the certain amount of spreads. So be careful. And local influences, commodity and politics dominate, okay? And certain governments are going to be corrupt. And higher swap rates, overnight costs can be significant. And this requires deep research into an emerging economy and see if they're actually improving. And some pros and cons of exotic pairs. Advantages: they have high profit potential, and volatility allows big gains. And unique opportunities, okay, less crowded markets. And some disadvantages: they have high risk and sudden devaluations possible. They can be expensive, as wide spreads and low liquidity can make certain things not work out. And limited data can be harder to analyze too. And in 2023, USD/ZAR surged hard due to the fact that South Africa decided to invest heavily within energy business, okay? So surge hard due to the South African energy crisis. So if you make a good investment and the economy starts improving, you could potentially make some good profit based off of that. So the key differences. So comparing the three. So liquidity, majors are going to have the most, then minors, and then exotics are going to have the least. And volatility, exotics are going to have the most due to the fact that they're going to be the most unstable, then minors, and then majors are going to be the most stable. And spreads, majors are going to have tight spreads, so you're going to get most of your money. Minors and exotics have wide spreads. And trading volume is high for majors, low for exotics, due to the fact that majors are more trusted, more news, more data. and risk levels are low for majors and high for exotics. And you could choose based on your experience and goals. And once again, I'm not saying one is better than the other. Just do your research before you trade. And liquidity explained. Liquidity refers to how easily you can buy and sell without affecting the price. And majors have extreme liquidity with minimal slippage. And miners can be good but thin out after off hours. And exotics can be poor, leading to higher costs due to the fact that slippages can be destroying you. So if I would think different about trying to swing trade or trying to day trade exotics, I would maybe swing trade. And during the liquidity, exotic pairs like USD Try can gap up like 100 pips on news. So be careful. And volatility explained. Volatility measures price fluctuations in the magnitude. So majors have an average daily range of around 50 to 100 pips. Miners move around 100 to 200 pips with more opportunities, and exotics can move 200 plus pips with high risk to reward. Not saying one is better than the other, do your research. And use tools like ATR, average true range, to measure if you want. And here's what spreads are. Spreads are going to be the difference between the bid and the ask prices. A lot of the time, the ask prices is what you're going to be buying at, and the bid prices is what you're going to be selling at. And majors have a 0.1 to 1 pip on average. Miners have 1 to 3 pips, and exotics have 5 to 20 pips or more. And a 10 pip spread on exotics means you start 10 pips in the red. And trading strategies for each. Tailoring strategies. Majors, okay? You trend and follow. Following the trend is really going to depict what you want to do on the majors, okay? And news trading. And miners, they can carry the trades and have different range bound systems. And exotics, okay? They have fundamental analysis and different long-term holding. And always use stop losses and position sizing. And some real-world examples. Applying concepts. So major, European/USD. During the 2022 Fed hikes, the USD strengthened. And minor, GBP/JPY in 2023, volatility from BOJ, policy shifts. And for exotic, USD/MXN during the US-Mexico trade talks, swings on tariffs. Okay, so different examples like that can be used. So for example, for a major pair, in this scenario, let's say you're trading USD/JPY during a risk-off event. Japan's yen is a safe haven, and in 2022 market crash, the USD/JPY dropped from 1112 to 101 as the yen strengthened. And the strategy, short USD/JPY on the stock market decline, and you ended up outcome with profitable low spreads, since it's a major pair. And exotic pairs risk. Let's say you're trading USD Try during a Turkish lira crisis. Okay, may God bless. Okay, in 2018, let's say Try depreciated 40% against USD due to inflation and politics going on. And strategy, then you could long USD Try if you wanted to, but wide spreads cost extra. And with high rewards but overnight swaps, eroded the gains. Okay, so exotic pairs, even if you make a really good trade, fees, spreads, and stuff like that could just wipe away the money that you make. And the whole purpose of putting on good trade. So in conclusion, major, minor, and exotic pairs is the key to successful forex trading. And it starts with majors, you can graduate to minors, and appropriate exotics cost sheets. You can practice on demo accounts and stay informed with economic calendars. Stay prayed up to God, keep grinding. Put any comments below. I'll catch you guys in the next one. Head over to Stackmode Network if you want to trade forex or anything trading related. Peace. Hey class, today we're going to be talking about exactly what a hard fork is within the decentralized finance space. Let's go and let's jump into it. So, code, consensus, and chains. And at its simplest, a fork in the blockchain technology refers to a change in the network protocol. This change usually involves updating the software used by nodes to validate transactions and blocks. A key distinction must be made between a simple software fork, and that's copying open source code, and a protocol fork, which changes the consensus rules. So, a software fork, code-based copy. So the definition of a software fork is it copies an open source code base, for example, Bitcoin Core, to start a new, often compatible project. And the impact of it, it does not affect the original blockchain's history or consensus rules. It creates a new, independent project. And for an example, Litecoin. It was originally a fork of the Bitcoin code base, but now it operates on its own chain. Let's talk about a protocol fork. Consensus change. And the definitions of a protocol fork is it modifies the rules that govern which blocks and transactions are considered valid on a single blockchain, and the impact of it. They directly affect the chain's integrity, leading to a split in the network's block history. And the outcome of it is it requires all participating nodes to update their software to maintain network harmony. And the core difference lies in the shared history. A protocol fork shares the entire history up to the point of divergence. So, the critical distinction. Let's talk about soft forks versus hard forks. So, understanding the difference in compatibility is paramount to grasping blockchain evolution. And this dictates whether the upgrade creates one chain or two chains. So, a hard fork, non-backward compatible. So, as far as a rule change, it introduces new rules that are incompatible with the old software. And the mandate of it: all nodes must upgrade, and old nodes will reject blocks created by new nodes. Okay, so all nodes must upgrade. The old nodes will reject blocks created by any new nodes. And the outcome: if the community is divided, which is going to be caused by lack of 100% adoption, the chain will then split permanently into two separate blockchain, A and B, each with its own currency. And as far as the hard fork, the non-backward compatible system, both chains share this same history up until the block of the fork. And let's talk about soft fork. Soft forks are going to be backwards compatible. And the rule change implemented into it is that it tightens existing rules, making a previously valid block invalid under the new rules. And mandate: only a majority of nodes need to upgrade, and old nodes will still accept blocks from new nodes because the new blocks satisfy the old and stricter new rules. And the outcome of it: the network effectively remains one chain, and the old chain slowly dies out as the new blocks are not recognized by the majority, forcing compliance into it. For an example, Bitcoin's SegWit, and SegWit stands for Segregated Witness, and that was a classic soft fork implementation. So a lot of these things that we do know were actually fork implementations that just stuck around. So let's talk about this case study here. Bitcoin Cash, for example. Bitcoin Cash, also known as BCH, okay, the scaling schism. So the split that created Bitcoin Cash, BCH, on August 1st, 2017, it's the most famous example of a contentious hard fork rooted entirely in a debate over scalability. And the problem is Bitcoin block size. The original Bitcoin protocol restricted the block size to 1 megabyte, limiting transaction throughput to about 7 transactions per second. Okay, transaction per second can also be abbreviated as TPS, which led to high fees, also known as gas. So the term gas equals fees, leading to high fees and slow confirmation times. So that was way too slow. Okay, it wasn't quick enough, and it had to get quicker. So the division, the two scaling philosophies, so core devs at Bitcoin preferred off-chain solutions like SegWit, also known as the soft fork system, and Lightning Network. Okay, BCH proponents preferred on-chain scaling via an immediate increase in the block size limit. And the outcome, a permanent split occurred. Since changing the 1 megabyte limit was non-backwards compatible, the minority group implemented a hard fork to increase the limit to 8 megabytes, later to 32 megabytes. Okay, so as technology increases and technology gets more powerful, the whole decentralized space changes. And it results in two chains: Bitcoin, also known as BTC, and Bitcoin Cash, which is going to stand for BCH, and the technical impact between the two. The hard fork ensured that any node running old Bitcoin software would consider BCH blocks, which were greater than 1 megabyte and invalid, physically separating the two chains and their histories post-fork. So let's talk about case study number 2, the Ethereum classic, the ETC, the ethical split. So the Ethereum fork that created Ethereum Classic, ETC, on July 20th, that occurred in 2016, it was not about scaling, but about philosophy and dealing with an economic exploit. So let's talk about the DAO incident here. So the DAO incident, which occurred in June 2016, and a decentralized autonomous organization, also known as a DAO, is built on Ethereum, and it suffered a hack slash exploit. So people got into it, breached the database, and it drained roughly $50 million worth of Ethereum at the time, okay, worth of Ether, due to a vulnerability in its smart contract code. So the smart contracts are going to be the autonomous system that controls the whole decentralized system. So in a centralized system, banks control everything. They can confirm whether or not transactions go through or not, and they control the reserves. Within the whole smart contract decentralized blockchain system, everything is done autonomously on a smart contract system, kind of like a vending machine. So, but hackers were able to get into that due to the fact that the security system was a lot weaker about 10 years ago from these videos dropping, and it's only increasing as developers, AI, and coders notice more exploits and prevent them. Alhamdulillah, God is good. So, proposed solutions. The Ethereum community largely voted to implement a hard fork to roll back the chain history and return the stolen funds to their original owners. Okay, so they were able to roll back the history and roll back people's funds back to them. So extremely nice. God is good. So the principle of it, code is law. A minority group of community members rejected the fork on the basis of immutability and the code is law principle, arguing that interfering with the chain, even due to undo a theft, set a dangerous precedent. And we'll talk about the split. The majority moved to the chain, called Ethereum, ETH, and the minority remained on the original unforked chain, which was renamed Ethereum Classic, also known as ETC, preserving the hack history. So, this case illustrates that hard forks are not just technical. They often involve deep ethical and philosophical debates about decentralized governance and immutability. And once again, the decentralized space is going to involve no superpowers. Everything's going to be done by pretty much AI, computers, and smart contracts. So why hard fork? Let's talk about the rationale and objectives of it. So while often continuous, hard forks are sometimes necessary for the survival or significant evolution of a decentralized protocol. They're generally triggered by three main factors. Let's talk about the first one. So they introduce new incompatible features, okay? And when major changes are needed that fundamentally alter the way transactions or blocks are structured, for example, changing the hashing algorithm, introducing a new scripting language, or integrating privacy features, the old software simply cannot interpret the new data structure. So number two, fixing critical security bugs, extremely important to keep our money safe, okay? Inshallah. So if a critical vulnerability is found that could compromise the entire network, causing a catastrophic bug, a scheduled hard fork might be the fastest way to implement a necessary fix that prevents further exploitation, often involving a protocol reset so people can get their money back if anything was lost in the first place. And they reverse malicious transactions. Controversial, okay, but could be necessary in certain cases where, once again, people are trying to take people's money unfairly. And as seen with the Ethereum ETC, Ethereum Classic, a fork can be used to bail out a network after a significant loss of funds, effectively rewriting the history of the chain to reverse the malicious transfer. And this always raises governance questions because, you know, people can just reset and roll back transactions. But if it's used in a responsible way, I can see how it could be safe. But then again, would this be centralized? Let me know in the comments below. So hard forks that are planned and implemented with full community backing, like Monaro's regular updates, are often called non-contentious hard forks. So implications for users, exchanges, and developers. A contentious hard fork like Bitcoin or Bitcoin Cash, it has massive downstream effects on the ecosystem, requiring coordination across various entities. And the user impact of it, free coins and confusion. So coin duplication. Holders of the original coin automatically receive an equal amount of the new coin on the new chain. So for example, Bitcoin holders got BCH. And wallet management. Users must ensure their wallets support coin splitting and replay protection to safely access the new coins without losing the old ones. And market volatility can also be a factor. The value of both coins often experiences extreme volatility immediately post-fork as markets decide which chain to support. And the impact of the ecosystem, let's talk about the exchanges and developers. So exchange listing. Exchanges, which is pretty much places where crypto tokens and stocks can be listed, exchanges must decide whether to list a new coin, requiring significant technical work to ensure stability and implement deposit, also known as withdrawal infrastructure, okay? And replay protection. Developers must implement measures to prevent a transaction validated on one chain from being replayed and validated on the other, and it's crucial for security purposes. And development resources. The talent pool is going to be split, potentially weakening the development resources and future progress of the original chain in the first place. So, hard forks, while disruptive, they represent the ultimate form of decentralized governance, and they're the mechanism by which communities can execute fundamental disagreement, allowing different ideological and technical visions to coexist. So, some key takeaways. A hard fork is a non-backwards compatible protocol that change based on the results, and it results in a permanent chain split unless 100% of the community upgrades. And they're often driven by three factors. 1, feature upgrades. 2, security fixes. And philosophical disagreements. Okay, for example, scaling or immutability. And some key examples of a hard fork are Bitcoin Cash, okay, over scalability, and Ethereum Classic over immutability, following the decentralized autonomous organizational hack. And they force the entire ecosystem, users, developers, miners, exchanges to make a binary choice and adapt to a new reality and choose what's best for them. Stay prayed up to God, keep grinding, head over to stackmode.net for all trading education. I'll teach you how to trade cryptocurrency. Peace. Class, let's learn. Today we're going to be talking about Mono Zero, Zcash, and the evolution of the unlinkable value, and the quest for digital anomaly. And this class is going to explore cryptographic foundations and real-world implications of the leading privacy-focused cryptocurrencies. Let's jump into it. So the transparency trade-off in cryptography. Traditional cryptocurrencies like Bitcoin operate on a transparent public ledger, also known as the blockchain. And while this offers unprecedented security and verification, it fundamentally compromises financial privacy. So let's talk about anonymity versus pseudo-anonymity. Bitcoin transactions are pseudo-anonymous, meaning that they're linked to public wallet addresses. With enough data, these addresses can be de-anonymized and linked back to real-world identities, especially when funds move through centralized exchanges, which have know your customer rules, also known as the KYC laws. So this is how big scammers get caught and things like that too. So when people get off and finesse millions of dollars worth of Bitcoin, etc., and stuff like that, especially if they do any type of withdrawal to any type of bank account or Cash App or anything like that, it can be traced. Okay, so as far as the whole decentralized section and the space to where everything is anonymous, things with enough tracking, and since everything is on the blockchain, which is pretty much going to be the history of every single transaction that happens on the cryptocurrency market, things can definitely be tracked back. So keep that in mind. So sophisticated chain analysis firms can map the flow of the funds, inferring balances, spending habits, and commercial relationships. And this compromises business secrets and personal financial health. So if certain coins can be tainted or flagged due to their history, for example, association of illicit activity, for example, then their value and acceptance can be diminished, which is a key failure of fungibility. And fungibility is where all units of a currency should be perfectly interchangeable. So let's say for analogy purposes, right, let's talk about the glass vault. So imagine a Bitcoin has a glass vault, right, the blockchain, and it's where everyone can see exactly how many coins are in every single box. All right, and let's say the box refers to the addresses. And one of the most routine boxes, even if they don't know the owner's name initially. So that's kind of just how it is. Things can still be traced and tracked with enough data, but for the most part, it's not going to be as vulnerable as far as the sensitive information exposed. Like you're not going to see your last 4 digits of your card number and stuff like that. It'll be your Bitcoin address, which can't really do anything for you. If somebody gets it, if they see the address of the transaction that was done, it'll just show how much the transaction was for, the fees in the transaction, etc., stuff like that. But it can't really trace you back to your own personal wallet, but it will have an address for the transaction. So mandatory privacy by default, the Monero protocol. So Monero launched in 2014, and its design is to completely fungible and private by default, which makes all the transactions appear the same to external observers, and it achieves this trio of mandatory privacy features. So we'll talk about it. Let's start off with the ring signatures. So this hides the sender, and the actual spender is mixed with several non-spenders, and that's the ring. making it computational and feasible to determine which key is actually signed to the transaction. And the transaction is proven valid, but the source is going to be obfuscated. Okay, so keep that in mind as well too. So ring signatures hide the sender. Now let's jump into stealth addresses. Stealth addresses hide the receiver for every single transaction, and for every transaction, the sender generates a unique one-time destination address on the blockchain for the receiver. And the receiver can scan the blockchain and identify the funds belonging to them without revealing their true public address. And let's jump into ring confidential transactions, right? Referring to ring CT. And this hides the amount. And ring CT uses the Pedersen commitments and zero knowledge proofs to cryptographically verify that the inputs and outputs of a transaction balance, right? Which is going to refer to the fact that no new coins were created without revealing the actual value of a transaction. And Monero's core philosophy is that privacy shouldn't be optional, all right? Should be secure, and people should be having high conviction between sending money from one person to another. They shouldn't feel like they are vulnerable within sending information. And Monero's core philosophy not only thinks that privacy shouldn't be an optional factor, but it should be non-negotiable. And it's a feature that's baked into the protocol, guaranteeing a high level of fungibility for all DEX and arguments. So let's talk about selective disclosure via ZK snarks. So Zcash, it introduced a groundbreaking cryptographic tool called ZK snarks. And that stands for zero knowledge, succinct, non-interactive argument of knowledge to the mainstream. And this allows a user to prove that they know a piece of information, like ownership of funds, without revealing the information itself. So what is a ZK snark in the first place? I know it's a crazy name. So it's a proof system that verifies the validity of a transaction without needing to see the addresses, the amounts, or any other identifying data. And this allows for shielded transactions where the public blockchain only records that a valid transfer occurred, just to make sure that, if someone says, yeah, I sent you your million, and they can actually go check to see if it happened, so you can't get robbed and finesse. You can actually see if the transaction occurred. So don't be foolish. And let's talk about optional privacy. Unlike Monero, Zcash offers both transparent T addresses like Bitcoin and shielded Z addresses. Okay. So it offers both of those type of transactions. And this optionality is often cited for compliance purposes. And compliance is pretty much going to be government laws, things having to be in place so people can send, buy, and sell cryptocurrency. And it's often cited for, once again, compliance and law purposes, which allows users to selectively disclose information if required by a regulator or auditor. So companies, a lot of the times, have to have privacy laws, so all your information can't just be exposed. So viewing keys and memos. Zcash provides mechanisms like viewing keys that allows the Z address owner to reveal the transaction data to an authorized third party. And this controlled transparency is a key differentiator from Monero's absolute privacy. So let's jump to an example here, guys. So using ZK snarks, a company could prove to an auditor that it holds a minimum balance, let's say for over $1 million in a ZEC wallet, without revealing the exact balance or any other transaction history. And they prove to meet the condition, but nothing more. So comparing Monero's mixing versus the Zcash zero knowledge. So Monero's approach, let's talk about the mixing here. Okay, so the mechanism involved in Monero's approach. Okay, it's using rig signatures, and rig signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, and they're going to be in the ring. And the pros of it, it's simpler to implement, and it relies on time-tested cryptography. So once again, ring signatures obfuscate the sender by creating plausible deniability among a group of signers, okay? Making it a hidden circle. Okay? It's a lot simpler to implement, relies on time-tested cryptography, and it's absolutely mandatory for all users, ensuring network-wide privacy, so everyone could be safe who's trading within the circle. So, and some cons of it. Transaction sizes become larger, and that could also lead onto the blockchain network and make people have potentially slower transaction verification times due to the complexity of ring verification. So it would just take a little longer for you to receive your money within your wallet if you were to receive money, or if you send somebody to somebody, it would take a little longer for the funds to actually be spendable in their wallet. And that's okay. So Zcash's approach, right? This is going to be a different approach to it. So Zcash, the mechanism of it. So ZK snarks prove the validity of a transaction script without revealing any of the underlying inputs or outputs. So the pro of this, it's a higher level of cryptographic anonymity, okay, and it's zero knowledge, okay, so it's pretty much when the transactions are done, can't be tracked as easily, okay, so that's going to be a big pro of it, especially for people who want to use cryptocurrency for just certain other purposes, okay? Smaller transaction sizes compared to Monero, so it's going to mean faster processing, okay, so you're going to get your money faster, good thing. And let's talk about the cons though. So it requires a complex initial setup known as the trusted setup, and though newer versions aim to minimize this, privacy is going to be optional, leading to less adoption of shielded transactions, okay. So Zcash's original trusted setup was controversial, and the initial parameters, if compromised, could allow someone to counterfeit ZC. And Monero's design avoids the centralized point of trust because privacy is not optional within the Monero world. So yes, it's a little slower, a little clunkier, not as quick, but safer. So beyond Monero and Zcash, let's talk about the layer 2 protocol innovation. So the quest for digital privacy is not limited to the coins. New innovations are integrated privacy into existing chains and layer 2 solutions. Let's talk about layer 2 privacy solutions. So Tornado Cash Mixers, they use smart contracts and ZK snarks on Ethereum to break the on-chain link between source and destination addresses. And CoinJoin and CoinSwap. And there are going to be protocols where multiple users combine their transaction inputs and outputs into a single large transaction, making it impossible to map individual transfers deterministically. And advanced zero knowledge, ZK snarks, right? It's a newer version of ZKPs that removes the need for a trusted setup. It's trustless, making them more decentralized and mathematically pure, though computationally more intensive. But we got to remember, just like I just talked about on the last slide, security is going to be optional. So the encryption, right? So the homomorphic encryption, right, also known as the HE, it allows computation to be performed on encrypted data without decrypting it first. And this is still highly theoretical for fast decentralized currency. So ZK snarks, once again, a lot quicker, but still raises a lot of concerns due to the fact that privacy is going to be optional. Keep that in mind. So regulatory focuses, right? Laws, governments got to have their piece of the pie and got to make sure things are safe too. Anti-money laundering companies and governments, the SEC, etc., got to make sure cryptocurrencies are being managed within a safe way so people aren't just getting rug pulled on, getting scammed and getting their money duplicated, etc. So regulators globally are increasing scrutinizing protocols that offer strong privacy, viewing them as potential tools for money laundering, right? And the future balance will be between innovation and compliance, likely favoring optional, audible private solutions like Zcash's viewing keys, okay? So as long as certain government entities get behind it, the anti-money laundering entity, SEC, etc., are all monitoring it, then we could have a pretty safe, decentralized world. Although, even though it's being monitored by regulators, it's truly decentralized, okay? Let me know in the comments below. So let's talk about adoption, compliance, and the fungibility imperative. So primary use cases. So journalism and activism, right? Used to protect donations to whistleblowers or political dissidents from oppressive regimes, okay? So journalism is being implemented, trying to spread the worldwide spread of cryptocurrency, okay? Spreading how people can do their transactions and just making it more known to the government. And the government itself has been buying cryptocurrency recently as of 2025, and TradingView has now implemented as of October 10th, 2025. You can actually start seeing some cryptocurrency news being linked. So government's really adapting it. Its future's looking strong as far as the cryptocurrency space. So let's talk about some privacy, all right? So e-commerce privacy. Preventing competitors or data miners from tracking suppliers, sales volume, or customer bases. Extremely important for privacy, and know your customer laws are going to be extremely important to implement on brokers where we put our cards in order to buy some cryptocurrency. And salary protection. Individuals who don't want their employer's treasury balance or personal wages publicly visible. Super duper important for anyone who wants to stay safe or stay anonymous. Okay? You don't got to flex and pop it on everyone if you don't want to. So corporate secrets, hiding internal fund transfers and merger acquisition activity until legally required disclosures. Okay. So pretty much not exposing deals until things are fully done. So some key challenges: exchange delisting. Many major regulated exchanges, let's say Coinbase or Binance, for example, refuse to list privacy coins due to compliance pressures, limited liquidity, and adoption. And there's going to be some regulatory classification. The lack of transparency often leads to classification as high risk by financial authorities, creating friction with traditional banking rails. And when things are classified as high risk, people aren't going to feel as safe to invest into it, and leading to less liquidity, since now it's going to be, once again, investing into it. And let's talk about the scalability and computation. The advanced cryptographically required, especially for ZK snarks, can increase transaction processing time and costs, though this is actively improving as laws get passed, governments start to analyze cryptocurrencies, regulate things, consumer sentiments start coming out, and things just start getting talked about. And the ultimate success of privacy coins depends on their ability to prove that the financial privacy is a fundamental human right necessary for a free society, and while demonstrating that the tools exist to meet legitimate law enforcement needs. So they're trying to keep everything safe because, once again, a lot of big scammers and stuff like that within the cryptocurrency world, but able to get caught, people are able to return money and stuff like that too. And the cryptocurrency world just really progresses over time. There's been some things I've talked about in previous other lessons too, where there's been instances where, let's say, like a certain amount of Bitcoin Cash, right, got hacked, and people were able to reverse the transactions, giving all their money back, right? And certain things like that just being implemented just to keep the safety protocol of everyone's money flow. Things just get better as people start to, one, come up with more scams, and as people come up with more scams, people can come up with a stronger defense in order to fight it. So thank God for everything getting more secure, locked down, so we can have a safe crypto trading environment. And privacy isn't about hiding that bad deeds, right? It's about protecting individuals' autonomy in a financial system where every transaction can be linked and analyzed. So Monero, XMR, it's absolute, and it forces mandatory privacy rights through the ring signatures, stealth addresses, and ring sign. And it favors fungibility above absolutely everything, regardless of the transaction time. So it doesn't care about that. It doesn't care how slow a transaction time is, as long as it's safe, making sure that it's locked down, and it's mandating privacy. Let's talk about Zcash, right? The SECC. So optional privacy using ZK snarks, offering the highest cryptographical guarantee with control disclosure, right? Viewing the keys and the future of everything. Moving toward layer 2 and modular privacy solutions that integrate ZKPs across multiple blockchains. All right, guys. So let me know what you guys think about the future of cryptocurrency. Stay prayed up to God, keep grinding. Head over to stackmode.net to learn how to trade, how to invest, and how to grow your business. Peace.
I'm going to be teaching you guys how we can use support and resistance in order to get some profitable setups. Let's jump straight into it.
The downward areas here where price decides to make a V and bounce in the upwards direction, that's going to indicate an area of support. And opposite to the area of support, we're going to have resistance. All right, resistance is going to be an area like this one, for example, where price decides to fall within a downwards direction. Okay, so that's it. So let's talk about logistics. Let's talk about why each of them occur. Let's talk about what support and resistance is on the charts. So one, support occurs on the charts because price isn't going to continuously dip down to zero for the most part. So even if the price dump happens, a lot of the times stocks, they have something called a short sale restriction, and cryptocurrencies most of the time, especially if it's not a meme coin, they're not about to dump down to zero like a good chunk of the time. So price will go ahead and try to find itself a certain low, okay? And people will like to go ahead and buy at a certain discount and go ahead and sell from there. And we also have to put it in perspective too. So the left to right chart. So price started way back over here, okay? Even further from that. So people have shares from way over here. Of course, they're going to sell and take profit. So whenever selling occurs, whenever take profit occurs, then resistance is going to get put into place. Okay, all it is people selling. Okay, if people got in way over here, of course they're going to take profit. Okay, they're going to go buy their boat. They're going to go put a down payment on their house, do what they need to do. Okay, so whenever you see market correcting, making sharp tops and falling in a downwards direction, that's going to legitimately mean that there's too much supply. There's too much supply and there's not enough demand, causing the price to go in a downwards direction. Okay. But then you're going to see price make a certain bottom, just like here, for example. So whenever we see price make a bottom and bounce in an upwards direction, that's going to go ahead and classify as support. Okay. And support is going to be important because that's going to be where demand is going to be put into place. That's going to be like, hold on, prices, it's done selling off. It's been selling off way too much. People are starting to find out that price might want to buy it at a certain area, create a certain low at an area. And then once everyone agrees that price wants to make the low there, price will go ahead and start sweeping back up in an upwards direction. Okay. Causing it as a verified level of support. So chatting about it again, resistance is going to be areas where sellers step in. Okay, it's a left to right chart. So the goal of the stock market, cryptocurrency market, etc., is to go in an upwards direction. There's coders behind it, people with jobs in it, heavy investors in it, millions of dollars invested into these cryptocurrency tokens and companies. So of course, people are trying to make some money by having their stock go up in an upwards direction too, especially when it comes to stocks. People are definitely wanting their share price of their stocks to go in an upwards direction because that's more money in their hands. Once again, say billionaires, for example, right? It's not $1 billion in fiat currency laying in their account. Okay, it's not a lot of bank accounts in the world that can even hold more than like 50 million, for example. Okay, so a lot of the core value is going to be in assets. So what makes billionaires billionaires for the most part is going to be their assets. Okay, so whether, and a lot of the times it's going to be shares, okay, because most of the time it's business owners. So if Tesla is valued at 500 billion, okay, then Elon Musk being the company owner and he holds most of the shares or a large majority of shares, he would then be a billionaire too. So this is what makes stocks so important. So the proof is in the pudding right in your face. So billionaires are billionaires not by certain amounts of revenue made, but how much the company is valued on the stock market based on their shares. Okay, or take an artist, for example. There's an artist and he painted something for Facebook. Okay, he painted something for Facebook in 2006, 2007 or something like that. And instead of Facebook giving him actual money, Facebook gave him shares. Okay, he was then able to retire a multimillionaire based off of just doing one mural or doing one painting for the company. Okay, so shares are going to be an important part to just becoming rich. Okay, so a lot of the times shares or even getting paid in cryptocurrency is going to be a longer term, smarter option to get paid. Okay, so he was able to go in there, paint what he needed to paint, and Facebook paid him his shares, and he was able to get wealthy and retire for the rest of his life based off of that. Okay, so that's the legitimate reasons between the two. So we have to understand that, okay, that's why resistance occurs and that's why support occurs. So now that we understand them legitimately, let's put everything in perspective. So let's talk about the two things that market will try to do before a market can go in an upwards direction. So if I'm trading cryptocurrency and if I'm trading stocks, a majority of the time, I'm going to be looking to play to the upside direction. Okay, I'm not interested in shorting for the most part. I rather personally buy a dip. Okay, but shorting is going to come for something more like Forex, but we'll talk about shorting as well too. Okay, so the stock chart for the most part, as you can see, if I check out Microsoft, it does nothing but go up in a straight line. If you dollar cost average into Microsoft, you can see you're almost guaranteed to make some money. Okay, so year after year after year after year, the stock does nothing but go up in a straight place. Okay, so while people are spending money on anything on the block, okay, you can go ahead and be investing, keep dollar cost averaging, and he's going to infinitely make you more money. You'll retire quicker than everyone. You won't be stressing about bills as much as everybody. And you'll also be getting paid some dividends too, depending on how many shares you have. So it's a lot of advantages to being invested in the stock market. And dividends that are going to go ahead and be quarterly money that the stock owners give you because they're like, hey, thank you for making us money by investing into us. We're going to give you some money back. So it's infinite money to be made as long as you know what you're doing. That's why education is going to be extremely imperative. And you could just see your portfolio year after year after year on the max long-term gain. You know, forget certain small, just day trade gains. Okay, we want to see our portfolio all time when we pass away be positive. Okay, substantially. That's the goal here. Okay, so don't think so short term. Too many people are thinking short term, thinking now, thinking too quick, and that's really going to ruin your long-term perspective. Okay, so even when you are putting these support and resistance setups into play, okay, we need to be trying to make sure that we're holding trades for at least some time. We don't want to be closing like instantly. We don't want to be trading like that. We want to be making sure that we're sitting on our trades, making sure we're really having our money make us money. Okay, so let's go and let's talk about support and resistance setups and how we can put all this information into finding profitable setups. So, one, we always know that cryptocurrencies and stock market companies are trying to go in an upwards direction. Why? Because there's benefits to them. Okay, the higher the cryptocurrency, whoever coded the cryptocurrency, whoever runs it, whoever created the whole idea, signed the white paper, etc., is going to benefit from them. So they definitely want it to go in an upward direction. They want people to be investing in their token. Okay, what pros does it bring? Okay, Bitcoin lets you send money, or cryptocurrency in general lets you send money to anywhere across the world instantaneously. So it already has some baked in value. And then it might do some other cool stuff as well too, like, you know, throw on Solana. It lets you trade meme coins, create your own cryptocurrency coin. Okay, so bringing more power back to the people, making people feel even more involved. So certain cryptocurrencies expand on the fact that it just lets you send currency from one person to another at a quick rate, but it actually lets you put some power back into the economy. So this is why charts are going up and down. They're not just going up and down for no reason. I'm not going to give you guys fake mentorship, fake courses, just fake information. Like, it's not just about wicks. It's not just about candlesticks, and it's not just about logistical formations. We have to understand the true logical fundamentals of why the whole chart is even going up and down in the first place, because then we can understand things from a really big long-term perspective, and it's really going to help your anxiety too. Okay, if you're feeling emotional, like, man, I don't know if this is going to go up, you have to understand that the goal of it is to go up. No matter how low something dips down, the goal of it is to go up. Check out this Amazon example here. Okay, Amazon, it was at $188 a share in 2021. Okay, dipped all the way down to $82 a share. I'm sure people thought, oh man, that's it, Amazon's going to zero. But guess what, guys? As you can see here, and we'll jump into the technical basis of it here, all it did was bounce at the same area of support to the left. All it did was retest. Okay, all it did was retest. So instead of trying to predict the exact tops and bottoms, just understand that the goal and the basis of the market, okay, even Forex, for example, okay, the goal of the basis of the market, every single market, is to go in an upwards direction. I don't care if you're trading gold, stocks, crypto, understand that it's the basis of it is to go in an upwards direction. Now, that doesn't mean that you can't short when the opportunities arise, but understand that the whole reason price is dipping down is to find a new low and go back in an upwards direction. Okay, especially when it comes to stocks and cryptocurrency. So you can see here, and we'll jump into the technical understanding of this here. All market did was bounce at this area of support and then come over here and do it again at the same place. Market is not difficult. Okay, the real reason people don't make money is because they sell too early. They're playing with too tight of stop loss. Okay, so that brings me back to the point again too. If you're trying to be perfect within the market, you're going to struggle. Okay, don't be perfect within the market. Only God is perfect. Just get your money, understand how your levels operate and work, and make the best play that you can. Okay, now when it comes to something like options, futures, and Forex, you do have to be a lot more precise, but understand what type of directional bias that you're playing when you're getting into a trade in the first place. Okay, so if I'm trading Amazon here, right? Let's say I didn't catch this ultimate low, right? So price decided to bounce up this area of support once here in 2020, came down a whole 3 years later, bounced up the same place. All right, cool. Let's say I didn't even catch that certain low. You're fine. There's still going to be plenty of opportunity you can catch, okay? Because one, you know, price is always going to try and chase the resistances above current price, okay? Because they're trying to break into all-time highs. Investors are trying to make some money. Company holders aren't just slaving, busting tail for no reason. They want their company to be the biggest, the most profitable, okay? So share price is trying to increase for an incentivization. Okay, there's a reason why it's trying to increase. So say I didn't catch this ultimate support low here, okay? And speaking of this, market will try and do one of two things. A, market's gonna try and bounce at an area of support, okay? Or it's gonna try and bounce at an area of resistance. Okay, just simply cleanly. Okay, so market will duplicate itself. Either just like this example here, you'll see two areas of support being bounced upon on the same exact line, same exact tick, same exact level. Okay, it's extremely simple once you start realizing what you're looking at. Okay, so market will either bounce at the same areas of support or bounce at the same area of resistance. I personally call that a mirror. So in the Stackmode community, this is what I call the mirror. Okay, so I'm either going to see a support mirror or I'm going to see a resistance mirror. Okay, this is going to be a really, really just clean way to look at the market. Very, very simple. And the market's going to do this over and over again a lot of the times. Okay, so that's criteria number A. Let's talk about criteria number B. So A, say resistance can be broken and turn into support. Okay. So these two examples here, a support mirror and resistance being broken and turn into support, those are going to be examples that you take in order to long. So if you think or you speculate whatever you're trading is going to go in an upwards direction, these are the only two setups you should ever take. You shouldn't be taking anything else. Either you're looking for two areas of support to mirror each other, just like the blue line right here, or you're going to be waiting for an area of resistance to be broken and turn into support. Okay, and that's going to let you know that, inshallah, for the most part, price wants to make a structural continuation. Okay. And if you're going to take a downside trade, okay? So let's say you think price is going to go in a downwards direction. You're either going to take this setup where you're looking for two areas of resistances to mirror each other and then fall down, or you're going to be waiting for support to be broken and turn into resistance. So the opposite of resistance being broken and turn into support, you'd be waiting for support to be broken and turn into resistance. Okay. And this is going to let me know if I'm going to take a short setup. Okay, so these setups over here, two areas of support bouncing on each other at the same line. Okay, and then bouncing in an upwards direction. Okay, boom. That's going to give me a support mirror. That's going to let me know that price wants to go in an upwards direction. Or I can wait for support to be formed after an area of resistance is broken. And that's going to be break and retest. And if I'm going to take a short setup, which means I'm speculating that market's going to go in a downwards direction, I'm going to wait for two areas of resistances to mirror each other and fall in a downwards direction. Or I'm going to wait for an area of support to be broken and turn into resistance and wait for price to fall in a downwards direction. Okay, giving me a downward staircase, or if I'm looking for an uptrend play, I'm looking for an upward staircase. So I'm going to go ahead and show you some examples here. So we're going to go ahead and scan the stock market, cryptocurrency market, and let's go and let's talk about how we can analyze plays. Okay, so first thing I like to go ahead and do, start off on my higher time frames. We're going to always start off on our daily. Okay, we're going to be on our daily time frame due to the fact that we see everything. Okay, we got to see the whole chart from left to right. We're not about to be tunnel vision on the smaller time frames. That can be really frustrating, misleading, okay? And it could really just make you look at something that you don't even need to be looking at in the first place, okay? It's giving you a whole different story, something that's just not true. So we're gonna be looking at the daily, okay? Zoom out, see everything, and get the bigger picture of everything. And after the daily time frame, you can go down to your 4 hour, especially on the stock market too, since it's not 24/7. You got to go down to your 4 hour time frame to see certain wicks. Since extending trading hours is going to be a thing. So on whatever broker you're on, make sure you have your extended trading hours. If you're on TradingView, go to the bottom right, turn on ETH, extended trading hours. Go. So your daily time frame is going to help you see everything. So one, don't trade anything that's going to be at all-time highs. Okay. Don't short at all-time highs because that's gambling, in my opinion. Wait for support to be broken and turn into resistance. Okay, or if price goes below and gives you a resistance mirror, then you could take a short. But even if price is at all-time highs, don't just short because it could really keep going in an upwards direction. But that's the thing. you don't really know how high it's going to keep going because there's no resistance above current price that's made up here or up here or up here, up here. Okay. So something's at all-time highs. A lot of the times I like to wait for a pull back. Okay. I'm not going to trade it way up here. I'm going to wait for something that's either below, okay, and then catch a sweep in an upwards direction, okay, or I'm just not going to trade it at all. So I'm not going to force myself to trade something at all-time highs. I'm going to go to the big, giant, mighty stock list that I have, okay, and I'm going to be able to choose something else, okay. So one, I want resistances above current price. So I can see here on Amazon. Amazon will be a great investment in my opinion. One, I got resistances above current price here, okay. Tons of resistances above current price. So that's letting me know that one, price has somewhere to lead to, okay? Price has space to fill. When I can see space that needs to be filled, okay? This is just money I'm looking at. All I'm looking at here is money, okay? I know the stock market is trying to continuously break areas of resistance because price needs to keep making new all-time highs. So after price decides to make its own little base, make its own little low, like here, for example, okay? You can clearly see this is the most easy setup of all time. God is good. Okay. So when you just study, you have the eyeballs, okay, of just a warrior trader, things become easy. Okay. So check it out. You got support being created right here. And then you got an area of resistance being created over here. Okay. I'm going to go to my 4-hour time frame. Okay. I'm just super duper excited about this. Okay. Because check it out. I'm excited right here. So I'm going to let me know. Resistance being created right here. Okay. I can see the breakout happen. I'm not a breakout trader. Okay. So I'm going to let them have that. They can take the breakout. I'm cool off that. Okay. What I'm going to wait for is the area of resistance to come back down and turn into support. And I can see price decided to do that. So price decided to turn the resistance over there into support, letting me know that, okay, price wants to continue this staircase, doesn't want to push down any lower. This is going to be a pretty safe phase for me to go ahead and buy. Not only that, I see price making what's called higher lows. So I can see that. Let's go ahead and let's methodically map this out here. So I can go ahead and see that this low right here, right? This low is higher than this low. And this low up here is higher than this low. So not only do I see break and retest, I see price moving within a staircase direction. So I can go on my daily time frame, put everything into perspective, be like, hold on, okay, cool. So I can go ahead and use these two areas as stop loss if I wanted to, okay? And take profit and catch this whole area up here to the upside. Okay, I still got 15 points of price action I can go ahead and catch. So much money for me to go ahead and make up there. Okay, it's super duper exciting. It's exhilarating once you see the market structure like this. So putting everything in perspective, you can see that, okay, there's so much money for me to be made. Even though I didn't get in at the pixel perfect entry, a lot of the time you don't want to get in at the pixel perfect entry. You don't want to be getting in at the first wick of the blue. Okay, I'd rather get in on the second candle. I'm personally waiting for a candlestick close. Okay, you want to wait for candlesticks to be above the certain entry because you don't want to buy at the wick and then get dumped down on because then you're going to be upset. And then you might just be really in a situation where you're just praying it goes up. Okay, so play logically. I would personally wait for a candlestick close. I can see the area of support got tapped. Okay, price decided to try the zone multiple times. Buyer stepped in multiple times, held the same area. And I can go ahead and take this whole upside and catch the whole remainder of this amount of profit. It's crazy amount of money to be made. Okay. So this is how I'm going to be able to use support and resistance and put that into a logistical setup. Okay. So I'm looking personally for gaps. I'm looking for these gaps to be filled. I know that price is trying to chase the resistance. So I can use the whole gap as my profit window. Okay. Break it down logically. I'm going to go ahead and show you another example here. So class, it's about making it simple. Mark your levels, okay? No indicator is gonna help you more than horizontal lines. That's one thing I'm gonna go ahead and tell you, okay? I don't use any indicators and most decent traders don't need indicators, okay? Don't rely on something that's late, okay? Your eyeballs and the way that you're reading your technical analysis is gonna be a lot safer and a lot more reliable than an indicator that's gonna be late, okay? Take this area right here. It's easy. You can see price breaking here, okay? Price decided to break through this area, okay? And this area seems to be important. And if you don't see everything you need to see on your 4-hour, don't feel afraid to go down to your 30-minute in your 15-minute. Okay. So I can see supports being created at this area right here. All right. The price broke out right here. Let me scale down. Let me see what happened here. Okay. I'm going to scale down a little further. Okay. So it looks like price just wants to hold some support here. Okay. So price wants to just create its own structure. Okay. The support seems to want to hold. It could potentially break down. But we'll go ahead and we'll see. Okay. If it does break down, we can go unprepared though. So just like we talked about certain models, I'm personally looking for resistance below current price to turn into support, or just like you see right here, supports to be mirrored upon each other. All right. So say the support gets broken. I'm cooling. I'm not going to be tripping. I'm going to go and put the next entry right here. Okay. I'm going to try again right there. Okay. You can go ahead and try an entry right there. Okay. Try a zone right here. And personally, if I see price come down to these areas of resistance, turn into support, then I know it's going to be a pretty safe place for me to go ahead and continue the staircase. Okay, so even if this area of support gets broken, I can go ahead and re-add or try again at these certain areas right here too. Okay. So putting everything into logical perspective, once again, is really just going to help you understand how the market works. And it's really just about patience too. So patience, 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 patience. So waiting for the setup to happen, reading everything on the higher time frame, and just letting the market do its thing. Okay. And you could really just eyeball certain curls too. Okay. Even if you get on the line chart, for example, and I'm on my daily, if I'm on the line chart here, for example, I could use no candlesticks if I wanted to. Okay. I can just look at this pure line chart, see price curling up in an upwards direction here. Okay. And I can clearly see, okay, if I have a daily curve, like bottom on the line chart, for the most part, I'm good. I'm just going to be honest. Okay. That's just what I'm going to be looking for sometimes too. Okay. So I can clearly see that price wants to try and chase these areas of resistances up here and this area of resistance up here. Okay. So if I got on my line chart here, I can see price decides to create area of support right here. Okay. Look at how simple this is. So you have the area of resistance right here. Okay. Being created. Price broke out. Then price decided to turn this resistance into support. And then price is looking to fill the whole rest of the gap. It's extremely simple. It's over and over and over again. It's every pair. Okay. You can make money every single day. Every single day. Okay. So even if I check it out on the candlestick chart here, it's going to show me a little bit different information, but I can see on my line chart here, everything plays out how I need it to. And it's confirming the fact that the rest of the space does actually want to be filled on the candlestick chart and the line chart, inshallah. Okay. And then from here, I would go ahead and just buy a contract a couple weeks out and just take the whole rest of the gap fill. So let's jump into some crypto. All right. Stocks are easy. All right. Crypto can be a little bit more sideways. Stocks, for the most part, they just go in a straight line. So if it's a decent stock, it's going to be really easy to read. Crypto is really easy to read though too. So it's just about trading what you want or trading both. Okay, because take this example right here. So I marked out this all-time highs a couple days ago, and we decided to break it. Looks like today or yesterday. So mark this out here, and looks like price decided to break out. As you can see, I had the line there before we even got into the recording. So I know that price is always looking to break areas of resistance. What I tell you guys. So no matter if it's all-time highs, price is looking to break it, and we're going to keep breaking it over and over and over and over and over and over, inshallah. Okay. Even if we sweep all the way down, it'll still try and come back up one day and go right back up. Okay. We can sweep all the way down there. Okay. If price wanted to, price can sweep all the way down there and then still break all-time highs one day again. Okay. That's just purely how market works. When market decides to go down and find certain lows, all it's doing is collecting ammunition, pretty much collecting more money, okay, from anybody who's still trying along. And all of this is people selling who got in from way over here. Okay. Let them sell, let them sell, let them sell. You know, it's going to whipsaw back up, inshallah. So all-time highs getting smashed. So boom, all-time highs got broken today and yesterday. So extremely exciting here. So I had these lines placed a couple days ago, and price decided to just meet with them. Okay. So You guys know I'm not lying here. Okay, price is always going to be looking to break all-time highs, certain areas of resistance here. Okay, so let's make it simple. So even if you didn't get in at the super Goku low all the way down here, okay, you could still see market doing its thing. Okay, so market bounced at this area of support here twice. We had one little area. Okay, if you would have missed it, it just was what it was. Okay, nothing to cry over. Plenty more entries. Okay, plenty of more entries. So we had this entry, for example, here. See, we had this area of resistance. Price decided to break above it. And then turn it into some support. And then price decided to go in a upwards direction. Go. So very, very simple. Just clean area. And we're looking for a break and retest, waiting for price to go ahead and continue over and over and over again. Okay. Even here too. So just like I told you, support can be broken and turned into resistance. I like to call this support and validation in the Stackmode community. So you got this area of support here, and you can see resistance got created off of it. So support turned into resistance, and then price invalidated the support, met up with that area, right? And then, yeah, filled in that gap. So support and validation. If you see an area of support above current price, and price just runs through it, all right, then that's going to be a pretty safe area to go ahead and momentum trade as well too. Okay. Because an area of support above current price, if the resistance doesn't hold and price runs through it, then it just wasn't a strong area. Okay. So let me get on my daily time frame here. So I'm going to go ahead and put a line on the top of all-time highs here. Got this area of resistance all the way up here. Very cool. And let me go ahead and go to my 4-hour time frame here. All right, on our 4-hour time frame, and I can see we know where price is heading to break this all-time highs here. Okay, Ethereum's not about to reject here forever. Even if it created resistance on the blue line a million times, inshallah, and dipped all the way down to like 1K, inshallah, one day it was still trying to get broken. Still, it's just how the market works. Okay, because you have to remember there's still investors in from way back to the left. Way back here, people are invested, so they want it to go up too. So price is trying to reach this all-time highs area up here and fill in the rest of this gap here. Okay. So when you close, well, no, I won't say that, but when you close and when you buy are both extremely important. When you buy, I'll say it's less important than when you close, because you could buy at a pretty bad area, but if you close at the right time, like, you'll still make money. Or you could just buy pretty late, but if you close at the right place, you'll still make money. Now, if you try and hold past an area where you should be closed, that's where things could get scary. And you bought a bad area, that's where things could get really, really bad. So yeah, it really depends. Like if you were to buy right here and you just profit at the all-time highs up here, that's fine. But if price hit this all-time highs and then dumps down, okay, you bought up here. So anything less than up here would be negative profit. Okay, so it really just depends how you play it too. So even here too on Ethereum, I could see this area of support got created here. And that's because this area of support bounced off of this area of resistance over here. Okay, resistance got broken through. As you can see, we even had another tap right here too. And then price decided to go in an upwards direction. And price came back down into the zone. Okay, turn the resistance here into support. Okay, it's really this wick right here. Turn the resistance here into support and bounce in the upwards direction. And as you can see, the whole area decided to stay and fill in. Okay. And then price decided to continue to just break and retest and do its thing. Okay, and it even spammed it again right here too. If I go ahead and put this line here, check out this area of resistance. And you can go ahead and see this area of support being created off of this area here too. And then price decides to go in an upwards direction. And no coincidence as well too, it's also going to be a support mirror. So once again, you could see price deciding to make this area of support over here because there's support over here. Okay, so support decided to mirror itself and bounce in an upwards direction. Okay, you can also see over here, price decided to create resistance here because of the resistance over here. Okay, then price broke that too and continued to go in an upwards direction. Okay, so all price is going to do is just mirror each other. Now, as you can see, whenever it does short, it's not lasting. It's not falling down to zero. That's because it's not time. Okay, it takes a whole market wave in order to have that happen. Okay, it takes a lot of traders, a lot of liquidity, and a lot of money in order to have that happen. Okay. So we'll jump into some Doge here. So this example here I marked out yesterday, and looks like we're getting some positive price action from here. Okay, pretty good trade. Very, very simple. So all I did was mark out this area of resistance here. I have this strong area of resistance right here, and even way to the left over here. This whole area is just letting me know that, okay, price keeps shorting here, and I could see that price decides to break the area of resistance, turn it into support. Okay, and now price is going in an upwards direction. Okay, so I can go ahead and see price wants to try and fill in this whole gap all the way up here. Okay, so even a Doge gap here would be pretty simple to go ahead and take and play. Okay. So just take your time. Okay, whenever you're analyzing your setups, take your time, and you're looking for support and resistance in just certain key areas. Okay, you want these key areas to be reacted upon off of, and you want gaps to be filled. So yeah, so you're just looking for gaps to be filled. That's all you're looking for, essentially. That's it. That's it. Okay, you know resistances have to be filled because price is trying to break new highs. Okay, and that's it. You're just taking advantage of knowledge. Okay, so take this example. I can see price wants to go ahead and breach this areas of resistance up here. Okay, so I can go already and see price wants to fill this whole gap right here. Okay, so I go to my 4-hour time frame. Check out the area of resistance, super duper clean area right here that reacted off of twice, once and then twice, simple. Okay, and I can see that price wants to at least try and gap this area here. Okay, so how can we catch a setup? One, I already know price decides to create some support over here. Okay, once you see some support created like that with multiple daily closes, a lot of the times, you know, price wants to go ahead and sweep. Okay, so sometimes too, it's just about just buying. Okay, so if you see price starting to curl like that, or if I get on my line chart here and I start seeing a daily curve like that, okay, and I start seeing a sharp bottom with the V formation, and everything looks how it should, then ideally I can be like, okay, you know what, I think price wants to actually go in an upwards direction. Okay, and you can go ahead and you take your chance and you mark out your trade. Okay, so let me go ahead and check this out here. So I can see this area of resistance here on the line chart. And sometimes you can bust out the line chart just to see everything a little bit clearer. You can also see these areas of support over here too on the line chart. So I'm like, okay, is this area of support pretty decent? Okay, it's being reacted off of once, and we had a large area of support being reacted off of over there. Let me go back to my candlestick chart. Can see the support a little cleaner. So if you notice the candlestick chart's a little too jamboree or too much, feel free to turn on your line chart sometimes too. Verify your levels, look for curls, and get your gap fills. Okay, it's going to be really, really simple to make some profitable trades. Okay, so I can see from way to the left over there, the support level. It's not just any level on the block. It's actually a pretty good level. Okay, that price wants to react off of. So let me go ahead and let's do another example here. So let's pull out some BNB. Yeah, BNB is normally always at all-time highs. It's a really good crypto. So it's at all-time highs. How would I play this? So personally, I would wait for a pullback. Okay. If I'm going to short it, okay, well, let's talk about that, for example. If I'm going to short it, I would take this area of support here, wait for it to turn into resistance, and then take it to the downside. And my take profit would either be the area of resistance below it or area of support. And the reason why I'm not too keen on shorting, honestly, is because my take profits are going to be smaller. Okay, you don't know how badly people want to just buy the dips. Okay, people could be fiending and hounding to buy the dips instantly. Okay, as soon as these things dip, people buy the sweep up. Okay, let's check out Bitcoin, for example. Okay, that second Bitcoin dips, it recovers instantly. Okay, Bitcoin can have an extremely heavy dip, and it's not people thinking, oh, it's going to zero. No, it's people loading up their pockets in stack mode, ready to unload. Okay, so boom. Price dip down to 100K. Okay, we dipped down to about 100K, and the dip instantly ripped up and recovered. Okay, instantly decided to just capitulate that whole reversal and just reverse the reversal. Right. And as you can see, continuously breaking new all-time highs or making higher lows constantly. And higher lows is always going to be a great sign here. Okay, I can go ahead and see here. Price decided to make this area of support here too, or make it higher lows. Okay, higher lows. It's going to let us know that we're trending. Okay, we're trending in an upwards direction. And that's what we're going to be wanting to just take advantage off of. So just keep dollar cost averaging, looking at the areas of support, be like, okay, you know what, if this area of support gets broken, I can look for the next area of support. Okay, so you could use this for your short or your long end. Okay, or you can wait for price to come down, maybe bounce at this area of resistance here. Okay, and if you see price come down to any of these areas, give you a daily close with a sweep up, feel free to go ahead and buy any of these lows. Okay, they're already verified. So if price wants to retest these lows, all it is confirming that price wants to trend even harder. Okay, could potentially be this low right here from this support. Okay, it could either be an area of support below current price or an area of resistance below current price. It's going to choose. Okay, and then from there, we're going to go in this direction. All right, so that's going to be the support and resistance masterclass. Head over to Stackmode.net for all trading education. Stay productive, God. Keep grinding. I'm going to go ahead and break it down and make it easy. So what exactly is trading volume in the first place? So volume is pretty much going to be the amount of people and the amount of money being flowed into a cryptocurrency token, stock, or whatever. So whenever you hear the term volume, just think about the amount of money that's being flowed into or out of something, as well as the amount of people that's trading it. So it's a fundamental metric that represents the total number of units of a cryptocurrency, for example, in this case, that have been traded over a specific period. And it's a simple yet profound measure of market activity and liquidity. And think of it as the heartbeat of the market. And a high volume indicates a strong, healthy pulse, while low volume can signal a weakening or stagnant market. And encompasses both buy and sell orders that have been executed, reflecting the total flow of capital into and out of a particular asset. So let's talk about the total transacted value. So volume is often reported in both the base currency, for example, Bitcoin, Ethereum, for example, and the quote currency, aka USD, USDT. A volume of 10,000 Ethereum on a given day means that 10,000 Ethereum coins were exchanged between buyers and sellers. There's also going to be time-specific measurements involved too, and volume is always measured over a defined time frame, such as 24 hours, 1 week, or even a single minute. And this temporal context is vital for analysis, as a sudden spike in a 15-minute period can signify certain sudden movements within price, even if the daily volume remains average. So if you see a bunch of volume coming in within like a 15-minute time period, then you know lots of flow coming in. Maybe a whale might be purchasing, okay, somebody putting in a large amount of orders, okay, or a large amount of orders being flowed into a specific direction. Okay, that's going to be volume. Whenever you see price action being flowed into, whether be it on the flow chart or via the order book, okay, you're going to be able to see all the transactions happening. And the more transactions you see, the higher the volume. So let's talk about liquidity indicator. So a high trading volume is a direct proxy for liquidity. An asset with high liquidity is easy to buy or sell without causing significant change in its price. And this is crucial for large-scale traders and institutions who need to enter or exit positions without a large price impact, also known as slippage. So slippage is pretty much where you're not going to be getting all the money that you're intending to receive. So say you sell for a profit of $500, okay, you're expecting to get all that $500. But depending on your broker, depending on the fees, also known as gas, etc., stuff like that, okay, then you're going to be able to calculate the amount of slippage that you may have to pay for. Okay, and slippage is pretty much going to associate itself with fees. So slippage, say you make $500, okay, you might withdraw $480, okay, due to the fact that the other $20 would have to go to the slippage. Okay, so that's slippage, for example. So why is volume crucial in the first place? So for crypto traders, volume isn't just a number. It's a validation signal that confirms the strength of a price move. So for instance, if you see on the order flow chart or the flow chart in general, and you're intending to play within a bullish direction, right? You're intending to long the market, and you start seeing a bunch of buying coming in, then you could kind of put together with your technical analysis along with the flow chart. Okay, if you start seeing volume, especially buying volume coming in, then you can go ahead and be like, all right, you know what, I might be right, and go ahead and take a trade based off of that. So it can be some good validation to come in because you're going to see other people making trades. Okay, so it's going to be a level maybe everyone might be waiting for. And if you see a bunch of volume price coming in your intended direction, then it could mean that that's a good level and you're most likely right. So price increase or decrease is far more meaningful when it's accompanied by high volume. Without this confirmation, a price change could be fluke or the result of a single large transaction, also known as a pump. So that can be unsustainable, and certain high volume tokens grow year after year after year after year. But if you just see a bunch of selling coming in, for example, on like a meme coin stock, then that's what certain coins, like such as the pump and dump or rug pull coins, that's where those terms come from. Okay, so volume gives us a window into the market consensus and what's going on. So give us an example here. So the bull trap. So imagine Bitcoin price rises 5% in 1 hour, but the trading volume was unusually low for that time of day. A savvy trader would be cautious, and this low volume price surge could be a bull trap, and a false signal is designed to lure buyers before the price collapses. The lack of the significant volume indicates that not many people are participating in this price move, suggesting it lacks genuine market support. So volume can help you with confirming certain price trends. Okay, so a strong upward trend is going to be confirmed by increasing volume on up days and decreasing volume on down days. And this shows that the buying pressure is strong and consistent. Conversely, a downtrend is confirmed by high volume during price drops, indicating strong selling pressure, for example. So volume can also help you identify reversals. So when a market has been in a long downtrend, a sudden spike in volume as the price starts to rise can signal a potential reversal. And this is often the first sign of institutional or smart money entering the market, absorbing all of the selling pressure. And it can help you validate breakouts too. This is also going to be something I've talked about quite a bit on my channel as well too. When it comes to breakouts or certain levels, confirming it with volume, confirming it using the order flow chart is really going to go ahead and help you out. Okay, you can also look at your order book, tape, whatever you want to look at. And volume can help you validate breakouts. And a breakout is going to be when price moves outside of a defined resistance or support level, and a breakout with high volume, which means a bunch of people are intending to trade in that place too. So a breakout with high volume is considered a genuine sustainable move, while a low volume breakout is often considered a fake out or a false breakout likely to reverse quickly. So if you don't see tape going crazy, order flow going crazy, whenever price hits a certain breakout level, it's most likely not going to happen. Okay, so that's one of the main things that people use in order to trade breakout levels. So analyzing volume in practice. So understanding trading volume isn't just looking at a single number. It's about interpreting its relationship with price and other technical indicators. And traders often use visual tools like volume bars on a chart to identify patterns and anomalies. And this allows them to see how volume is distributed across different price levels and time frames. So volume profile. Volume profile is an advanced tool that shows the total volume traded at each specific price level rather than over a period. And it helps identify areas of strong support and resistance where a lot of trading activity has occurred. Okay, so it's going to be a bunch of lines, and it's going to be showing you longer lines, okay, and short lines where there's low volumes. Okay, so on the volume profile, if you turn it on, trading view, wherever you want to turn it on, it doesn't matter. Okay, the shorter lines that you see, it's going to indicate low volume. When you see those long giant lines on the volume profile, that's going to indicate high volume. A lot of people are trying to get it right there. Okay, it's a very probable area, and it's a successful area. So on balance volume, OBV, the technical indicator that adds or subtracts daily volume based on whether the price has moved up or down. And a rising OBV alongside a stagnant price can signal hidden accumulation by large players, and that's a bullish sign. And volume price divergence. This is a powerful signal. If an asset's price is making new highs but the volume is declining, it's a bearish divergence, suggesting that the uptrend is losing steam, people are selling off, and a reversal may be near. The opposite is true for a bullish divergence. So, for example, here's how to use divergence to predict a reversal in hindsight, inshallah. So a trader notices that Ethereum's price has been steadily climbing for weeks, right? Or, we'll say Stackmode stock. So a trader notices that the Stackmode stock has been steadily climbing for weeks, reaching new all-time highs. Let's say the Stackmode stock is at $800 a share, okay? However, they observe that the daily trading volume has been consistently lower with each new high, okay? So investors are starting to sell off. So the trader then recognizes this volume price divergence, okay, and anticipates that the upward momentum is weakening and that they might decide to reduce their position as well, okay? Just like the big investors, they're starting to slow down their positions, trim off, okay, sell off. No one's about to hold infinitely, okay, take off some money. And they also might decide to reduce their position or set a tight stop loss order or trailing stop loss order, correctly anticipating a potential price correction. Okay, so if you're anticipating that Stackmode stock has hit the top and that volume is deciding to slow down, aka meaning that buying is slowing down, okay, so volume could increase to the selling side, okay, and then you could go ahead and trim off your stock, trail your stop, and do what you need to do depending on your certain parameters. You should know your entry, exit, take profit, and stop loss before you put a single dime into the market. Don't do anything related to gambling. Make sure you're extremely informed of what you're doing. So the dangers of playing things with low volume. One, slippage, okay? Trading things with low volume, you could potentially buy all the crypto coins. If you have enough money, you could definitely buy like all of a meme coin or something like that. And if people aren't investing to it, it's going to be hard to sell off their remaining shares, and it's going to be a lot of slippage involved in that too. So low volume, you might not get your orders filled. And trading in a low volume market carries significant risk. And a lack of liquidity can make it difficult to enter as well too. So not only can it make it difficult to exit, like I just spoke about, but even to enter. So you might be like, why am I not getting filled? AKA, like, why am I putting my money in and I'm not getting my asset? Okay, that's because there's not a lot of orders available. So volume is going to be a good thing to look at before we throw our money at something, okay? Because you might buy all of something and you might not be able to trade. Say stock options, for example. You can buy all of a stock options contract, and if there's not enough volume, there's going to be almost no one to sell it to, okay? And you're going to be stuck with contracts. So something that I've gone through before, okay? And I then had to understand that's why people buy shares. So there's going to be times where you buy shares, and there's going to be time where you trade options, for example, okay? So try to trade things with high and decent volume. So let's talk about slippage in the first place. Let me break it down. So slippage in a low volume environment, placing a large market can eat up all the available orders on the order book at a certain price level, forcing your trade to be executed at a worse, higher price, okay? And this difference is slippage, okay? So pretty much you're gonna be paying more money for something. So you're gonna be losing money at the end of the day, and that's not what we want. So slippage is gonna be a frustrating thing, and to avoid it, try to play things with decent or high volume. So price manipulation. A single large buy order in a low volume market can cause a massive price spike. So once again, the rug pull scam, for example, or pump and dumps, okay? People have Discord chats, okay? They run ads, they do whatever. And then from there, they own a large majority of the meme coin, for example. Okay, let's say they own 70% of it. And these are things you can go and check on certain brokers as well too, where you can see who owns a percentage of a lot of the meme coins. So let's say they got it at the bottom, okay? And they own 70% of it. So they own majority of the volume. It's already not worth anything. So they own majority of the volume. So they start posting ads, they start paying influencers, maybe hacking influencers, doing what they need to do. Okay, it starts getting some popularity. People start investing into it, thinking that they're about to make some big money in something that has no future context, isn't helping anybody, isn't putting a smile on anyone's face. But for some people, they want to come into the market thinking that it's a get rich quick scheme and you're going to go ahead and get your bread snatched just like that. So while people are fiending, excited, thinking that they're about to make some money, the people who created the meme coin are in at the bottom, hold 70% of the share. And by the time it starts getting popular, by the time people start investing in, it starts going in an upwards direction, they're going to go ahead and take that profit. Their profit's going to be disgusting because they already have a large majority of it. And it's kind of like a reversal IPO. So if this is like how the stock market works, let me go ahead and break it down. So before the stock market can even hit the public, someone has to buy all of the shares in private. And crypto is subject to a lot of manipulation because you don't have to do that. Okay, so the creator can be a participant. And same thing for the normal stock market too, but it's a lot less manipulation involved because someone has to buy all the shares prior to it being available to the public. So you can't get robbed as easily as you can someone just creating a meme coin and saying it's going to be the best thing of all time. So be careful following anybody too. All right, be careful following anybody. We're all human beings. Okay, a lot of people are flawed. I'm flawed. Okay, so whenever people are trying to prospect something, study it. Okay, see if it's putting a smile on people's face, see if it's making money. Okay, if it's not something that's going to be here for decade after decade, something that's bringing future value, something that's progressing the world, whether it be at a human level or at a physical level, okay, or transactional level, just forget it. It's not worth it. Okay, investing in Pepe, the fraud coin, is not going to make you a billionaire. Okay, there are billionaires from people who trade United States stock market, who trade consistently, who trade at a disciplined high level. Okay, so when you're trading sheep coin on Phantom, expecting to make some M's, and then you come to me saying, Chris, I'm trying to make some M's trading meme coins, I'm gonna yell at you. Okay, there's no billionaires trading meme coins. You invest in things that have value. Okay, even when I was horrible, I was still able to make money due to the fact that I was investing with things that have value. Okay, there's millionaires who don't even look at the chart due to the fact that they plant their money into things that have value. Okay, instead of spending it at the store, okay, spending it on unnecessary things, you invest, stay down, let your money make your money, and then you can live in overly leisure. Okay, making money in your sleep, making it when you're waking up, making it while you're eating, making it while you're making money. Okay, so put all this together into your trading plan. So technical analysis, right? Technical analysis relies on a broad market participation. In low volume assets, chart patterns and indicators can often be unreliable because the chart is going to be so skewed. A lot of the time in a low volume environment, the market's not even going to look how a high volume market would look. Okay, the candlesticks are going to be all skewed, it's going to be all over the place, and it's going to be something you just don't even really want to be touching for the most part. And they can easily be distorted by a few individuals, which is why sometimes you'll see huge, giant, like 1 minute candles, or candles that just don't really make sense, for example, especially with something that has no earnings involved. So stay away from certain manipulation, don't get robbed. Okay. And it's a general rule of thumb to avoid trading assets with extremely low volume. And unless you have a deep understanding of the market and its participants, then high volume is going to really provide a more stable and predictable environment for trading. You could still try to catch something at its lows if it has future value. Okay, I'm not saying you can't catch something at the low and catch the whole sweep up. Okay, I really pray you catch that move, but don't be buying sheep coin and thinking that it's going to be the best thing of all time and be profitable. Okay, don't try to compare it to something like Bitcoin or Ethereum that has real world uses. Okay. So trading volume is not just an extra data point, it's a critical component of any comprehensive data strategy, and it acts as a powerful confirmation tool, helping to distinguish between the genuine market trends and false signals. And by incorporating volume analysis into your decision making, you can enhance your ability to identify strong trends, spot reversals, and avoid risky low liquidity assets and taking unnecessary trades you don't need to be taking. I don't want you guys to be losing money unnecessarily like I went through for a long time. Okay, I want you guys to just start off profitable. And it's really refreshing. It's a real blessing to start off my students and they don't even lose money. Okay, my students, they start off, instantly start making money, alhamdulillah. Okay, so do your research, get educated before you put a dime into the market. Okay, and you're gonna save yourself from a lot of struggle. So always check your volume alongside your price action. Okay, look for high volume to confirm breakouts and strong trends. Be wary of low volume price surges. Okay, that can indicate certain things like rug pulls, for example. If you just see like one giant order coming out of nowhere and then the whole market moves, be careful about stuff like that. Okay, low volume stuff can be subject to manipulation. Say for futures, for example, if you're trading crude oil, let me tell you guys about a story. Okay, on my futures account, okay, was growing it very consistently. And I've always been good at making money within the market, but one thing I was horrible at was keeping the money within the market. Okay, my first couple of trades I've ever taken were $600 trades and stuff like that. Didn't withdraw, didn't know what I was doing. Always been good at making bands within the market. Was always horrible at keeping the money or consistently growing it. Okay, and that's what I realized. I had to humble myself, really had to turn to God. I had a lot of ego problems. Okay, I never thought it was enough. Even when I would make $100, $1,000, anything like that, didn't think it was enough. Was always just chasing that M, always chasing the billion, always thinking of the next thing instead of just being focused on my discipline, my process, my consistency. Okay, and then starting 2025, 2024 as well too, just had an extremely consistent year. Focused on a lot of day trading and once again, just making really good money. Okay, but then really had to just think about something. There's people who are once again millionaires without even looking at the charts. So I had to understand that trading is really about a long-term perspective. It's about planning in the future. It's about holding these trades for years and years and years on ends. And there's a reason why there's tax benefits for holding trades for years and years on ends too. Now, day trading is still amazing. I still love day trading. I still love taking like a couple week swings and stuff like that. Still give signals for that. Okay, but instead of me taking that bread, right? Instead of me taking that money and going on vacation like I was doing, instead of me taking that money and stupidly going to LV instead of it buying shoes, stupid things like that, right? I could have been reinvesting. Okay, and by this time, could have easily been a millionaire. Okay, so this is the whole point of why I created Stackmode. Okay, because I realized if you don't stay down, if you don't hold yourself back from certain things, put yourself in position to be a boss. Okay, and a boss is really staying down and grinding. You don't get that bag and go blow it. You get that bag, you stay down. You don't even think about it. Keep it in the stash and you keep working. You keep praying, you keep working. Okay, I was a kid, was very foolish. Okay, and God humbled me many times, and I'm very thankful because I got to come back stronger and I was able to make the money back 10x. Okay, and was able to keep my account healthy. And now that I know how to grow my account, it's really nice to see my students growing their account, coming back to me with results. Okay, so I just know that my struggle is not for nothing. So thank God. And avoid assets that have consistently low volume, guys. Okay, don't want you guys losing your money. Okay, I know you guys work hard. Okay, frustrating days, frustrating nights. Okay, just keep going, keep pushing, keep investing, keep staying down. I promise you, you're gonna catch the right play. Okay, stay prayed up to God, keep grinding. Head over to Stackmode Network for all trading education. I'll catch you in the next one. Thank God. Let's go and let's talk about what this means for the future of trading and how new traders can go ahead and jump into the market a lot easier now. So let's understand what the PD2 rule even is. The pattern day trading rule, as defined by the Financial Industry Regulatory Authority, the FINRA, it was a crucial regulation that governed day trading in the United States. Instituted in 2001, it was created to protect inexperienced investors from the substantial risk of frequent leverage trading during the dot-com bubble. So they didn't want people just throwing in all their bread and losing it all for no reason. Okay, when a bunch of new companies were hitting the stock market. Okay, so the pattern day trading rule was pretty much created in order to protect people. So the $25,000 equity requirement. So to be classified as a pattern day trader, okay, PDT, you need to execute 4 or more day trades in a margin account within a 5 business day period. Nowadays, there's 2 types of accounts. You have cash accounts, okay, which lets you trade strictly with your own money. And then there's margin accounts, okay, which lets you trade with some borrowed funds when it comes to the broker. Okay. And once flagged, your account was required to maintain a minimum equity of at least $25,000. And if the balance dropped below this, day trading was then restricted. And what's a day trade in the first place? A day trade was defined as the purchase and sale, or sale and purchase of the same security within the same trading day. So let's say, for instance, I purchased Stackmode stock for $30 a share, and I sold it for $34 a share within the same day. Let's say I did that all on Monday. Okay, that is a day trade. If I bought Stackmode stock for $60 a share and sold it for $80 a share, okay, and I bought $60 a share on Monday and I sold $80 a share on Friday, okay, then that's not going to be a day trade because that was days later I sold. I bought on Monday, sold on Friday, not a day trade. But if I buy on Monday, sell on Monday, that's a day trade, okay? So if you buy and sell within the same trading day, that's a day trade. And this rule applies to stocks, options, and ETFs. And the purpose of this rule: the primary goal was investor protection, and the rule ensured that traders engaging in high-risk strategies had sufficient capital to absorb potential losses, thereby protecting both the individual and their brokerage firm from financial instability. So the historic regulatory shift of 2025. So as of September 2025, FINRA's Board of Governors has officially approved amendments to replace the pattern day trading rule. Exciting. This is one of the most significant changes to day trading regulations in over 2 decades. And the move comes as a response to the rapid advancements in trading technology and real-time risk management capabilities of modern brokerage firms. So the fixed threshold is now gone. The rigid 25,000 equity requirement for day traders has been completely eliminated. This removes a major barrier for entry for retail traders. And retail traders, if you ever hear that term, it's just people who just want to get into the market. Okay, not like hedge funds, banks, or anything like that. Just individual investors a lot of the time is what retail means. So individual investors and individual traders with smaller accounts who were previously unable to engage in frequent trading can now do it. So replaced by intraday margin framework. So the old rule is replaced by a more dynamic and flexible intraday margin framework. This new system applies existing maintenance margin rules to a trader's real-time intraday exposure, making it a risk-based approach rather than a capital-based one. And pending SEC approval. While FINRA has approved the change and must still be filed with and formally approved by the U.S. Securities and Exchange Commission, SEC, before it can fully be implemented. So traders should continue to operate under the existing PDT rule until a final effective date is announced. Okay. So FINRA approved the change, and we're still waiting for it to get approved. Implications for traders: a new era. The removal of the PDT rule represents a seismic shift for retail traders, particularly those with smaller capital bases. It promises a more accessible, albeit more complex trading environment. So lower barriers for new traders. So the most immediate and profound impact is the ability for new traders with accounts under $25,000 to execute frequent day trades without restrictions. This democratizes active day trading and opens the door for a new generation of market participants. More dynamic buying power. Under the new framework, buying power will be directly tied to the risk of positions a trader takes, and highly volatile securities or concentrated positions will consume more margin quickly, while stable assets will allow for more leverage. This requires traders to have a better understanding of margin mechanics before you lose all your money and blow your account. An increased importance of risk management. Since the fixed capital floor is now removed, risk management becomes paramount. If you don't follow your rules, if you're not disciplined, if you don't humble yourself, okay, if you don't wake up, pray to God, study the charts, work out, have a strict routine, journal all your trades, you won't be successful. Okay, you have to be extremely, extremely disciplined when it comes to this game. And it's about keeping up this bread, keeping up getting this money year after year after year. It's not about just making 7 figures in 1 year. It's about doing it again the next year, maybe scaling to 8 figures, 9 figures, and pushing yourself further based off the discipline consistency. Risk management is going to become paramount. Okay, the more power that you have, the more power you're going to have to control. And traders need to be vigilant about their intraday exposure to avoid margin calls or forced liquidations. Forced liquidations is where the market is going to pretty much automatically close your position for you. And if you don't pay the money back that you owe the broker because you're paying with leverage, which means they're giving you capital, then you could be subject to court fees and they could owe you money, or you have to owe them money. Okay. So diving deeper into the intraday margin rule. The intraday margin framework is a sophisticated replacement for the outdated PDT rule. Instead of a blanket restriction, it uses real-time metrics to determine a trader's capacity for risk. And here's how it works. So real-time calculations. Brokerage firms will now calculate and enforce maintenance margin requires throughout the day. This provides a more accurate and responsive measure of a trader's risk level. So position-driven leverage. Your trading leverage will no longer be static. It will fluctuate based on the specific positions you hold, their volatility, and the concentration of your portfolio. So for example, a highly volatile tech stock will consume more margin than a blue chip utility stock. And the impact on different strategies. This can make strategies like scalping or fast-paced equity trading more viable for smaller accounts. However, it also introduces a new layer of complexity, requiring traders to understand the specific margin impact of each security they trade. So here's an example scenario, trading under the new rules. So let's consider a practical example of how the new intraday margin framework might work for a trader with a small account. So let's say, for example, Alex, right? Okay, let's use that name for example. Let's say Alex has a trading account with a balance of $5,000. He wants to execute more than 3 day trades in a week, which was previously impossible under the PDT rule. So in the old rule, Alex would only be restricted to 3 day trades. He could not execute a 4th one, regardless of the quality of the signal or his risk management, okay? Because it's 3 trades in a week. Now with this new rule, Alex can now make a 4th, 5th, or even 10th day trade, and his ability is no longer limited by a number of trades, but by the intraday margin available in his account. And his broker monitors his risk in real time. And if he takes a position that's too large or too volatile for his account size, the broker system will simply prevent the trade. So risk and key considerations for traders. While the new framework offers unprecedented freedom, it's not without its own set of risk. Traders must be prepared to adapt their strategies and mindset. You can be subject to intraday margin calls, where unlike the old rule where you were protected by a fixed floor, you may now face intraday margin calls. If your positions move against you, this requires immediate action and could lead to forced liquidations. And education is going to be paramount. Understanding concepts like maintenance, margin, concentration limits, and intraday exposure is now a non-negotiable part of a day trader's playbook, and a lack of knowledge could lead to significant losses. And firm-specific rules. While FINRA sets the regulatory minimums, individual brokerage firms are free to impose stricter rules, and traders must be aware of their broker's specific policies, as these can vary significantly. And the removal of the 25,000 PDT rule, it's really just a monumental step towards monetizing day trading for brokers so they can make more money. And it's a monumental step towards modernizing day trade regulations, making it more accessible for everybody. Okay, so God is good. It's an opportunity for you to come on the charts and make some money just by being disciplined. Make sure you get informed, head over to Stackmode Network for all trading education. And this rule is going to make trading more accessible. Okay, it's going to bring more volume to the market. More people are going to start trading, inshallah. Okay, and it's also going to come with an increased amount of responsibility. With more power comes more responsibility. Okay, love you guys so much. Stay prayed up with God. I'll catch you next one. Keep grinding. Peace. Class, we're going to be talking about value investing versus growth investing. We're investing for a reason. It's time to stop being broke. Being broke isn't cool. Late bills isn't cool. Debt isn't cool. And suffering isn't cool. If you want to start being broke, all right, start being lazy. Start not believing in your view. Start closing your trades early. Okay, start doing things like that if you want to stay broke. So let's talk about value investing versus growth investing and how we can actually have our money make some money. Let's jump into it. So an investment philosophy is a consistent overarching set of principles and beliefs that guide an investor's decision-making process, and it dictates what to buy, and when to sell. Without a coherent philosophy, decisions become emotional and reactive. And the core tension in equity investing lies between intrinsic value, which is what a company is worth today, and future potential, which is what a company could be worth tomorrow. And by the end of this module, you guys are going to be able to understand how to articulate the foundational theories of value and growth investing, how to identify key financial metrics using each philosophy, and assess which approach aligns best with your personal financial goals and risk tolerance. And value investing is rooted in the principles laid out by Benjamin Graham. And it's often called just someone who's pretty good at investing. Okay, and it's popularized by one of his most famous students, Warren Buffett. And the core of the idea is simple, and it's buying $1 for 50 cents. So intrinsic value, right, IV. This is the estimated actual worth of a company, and it's calculated through fundamental analysis, which is analyzing assets, earnings, and cash flow. And value investors believe that the market price often deviates from this implied volatility and intrinsic value due to irrational investor behavior. Let's talk about margin of safety, MOS, the most critical concept. This is the difference between the stock's current market price and its estimated intrinsic value. And a high MOS provides a cushion against calculation errors, business downturns, and market volatility. And the business owner mentality. Value investors think of themselves as buying a part of a business, not just trading a stock ticket. And this leads to a long-term patient holding period. So, Graham introduced the concept of Mr. Market, and it's a manic depressive business parser who shows up every day offering to buy or sell his shares at a wildly different price. A smart investor does not let Mr. Market's daily mood swings dictate their decisions. Don't let them come up to you and be like, you know what, I want to go ahead and just get into this because X, Y, and Z decisions. Make sure it's logical, okay? Don't just hop into it because of a FOMO candle, because of emotions. And remember, the compounding effect is what's going to get you guys to the profit that you want to be getting into. You got to stack up the cash, stack up the wins, keep investing in certain shares. Okay, so a smart investor, once again, does not let Mr. Market's daily mood swings dictate their decisions. They trade based off of logical and fundamental parameters, and instead use rationality to their advantage. And when buying, they're pessimistic. So buying when prices are low and selling when euphoria is in and the supply is super duper low. Okay. And that's gonna mean the demand is in, which is gonna make the prices high. So buy low, sell high. And the value of a buy. If a company has an intrinsic value estimated at $100 per share, a value investor will only consider buying if the market price is $60 or less, creating a margin of safety of over 40%. And the investor must be confident in the IV calculation in general. So formula, market price divided by the earnings per share, EPS. So the PE shows how much an investor is willing to pay for every dollar of a company's earnings. And value investors generally see stocks with a low PE ratio compared to historical averages and industry peers or the S&P 500. And a low PE suggests that the stock is currently cheap relative to its profitability. So for example, a PE of 8 means that it's going to take 8 years for the company to earn back your initial investment, assuming constant earnings, meaning that it's constantly making profit. So the price to book ratio, the PB, and the formula is going to be the market price per share divided by the book value per share. And the book value, which represents the shareholder equity, it represents the theoretical value left over if the company sold all its assets and paid all its liabilities. And the PB ratio is less than 1.0, and it indicates that the stock is selling for less than the liquidation value of its net assets, which is considered a classic deep value signal. While less common today, it's essential for financial and industrial sectors. And DE, debt to equity, measures a company's leverage, and value investors prefer a low DE ratio, as high debt is going to be a major source of risk and can erode the margin of safety. So free cash flow, right? FCF. Free cash flow is the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. Strong, consistent, and FCF is vital as it fuels dividends, stock buybacks, debt repayment, and the things that ultimately justify intrinsic value and the things that are going to cause a stock to go in an upwards direction. So pay attention to all these things, okay? Look at the ratios, see what's going to be worth investing into, and scan each of the fundamentals and know each of them things mean before you invest, okay? You can see quality companies that are temporarily mispriced and not companies that are structurally flawed, okay? Because over time, that'll lead into a downward decline of money for the most part, okay? They're not helping anybody. They're not putting any value into society. They're not making people smile. So it's not going to be a worthwhile company. It's not going to be something that is going to put some future value, okay? So there's no point in investing into things like that. We're here to make some cash. We're here to stack some cash. We got people to take care of, houses to buy, land to get, okay? We got to be stacking this cash and getting to it, inshallah. So there's some pros. There's the lower downside risk. The margin of safety acts as a buffer. And by buying below the intrinsic value, the potential for further significant losses is theoretically reduced. And psychological calm. Value investing encourages patience and detachment from daily market noise, reducing emotional trading errors. So in dividend income, value stocks are often mature and profitable companies return capital to shareholders via constant dividend payment. Why? Because the company's making so much money. They're going to be like, you know what? You guys can go and have some money back. Here you go. And that's what a dividend is. And patience is going to be required, all right? It can take years for the market to realize the stock's true value. And that's okay, okay? Be patient. Keep stacking cash. Keep grinding hard. Keep waking up, praying to God, and putting your full force into whatever, your business, your work. Keep stacking cash, okay? Keep going hard, trying to protect and provide for yourself and your family, okay? Keep stacking cash. Stay down. Get into stack mode. Don't buy that whip just yet. Don't buy those clothes just yet, okay? You don't got to fill up the cologne cabinet full of X, Y, and Z right now. Stay down, okay? Take your time. Build real wealth, okay? So you can take care of your family whenever it's time, okay? You're going to be the one who can handle the hard times, Okay, why? Because you were in stack mode, you didn't give up, and you were staying down. And the value trap. This is the greatest risk. And a stock looks cheap, right? Low P and low PV, but it's cheap for a valid reason, such as a fatally flawed business model, disruptive technology, or poor management. And the value never materializes. And missing out on innovation. By focusing on established, mature businesses, value investors often overlook high growth companies that are changing the world. And the ideal value investor is patient, contrarian, analytical, and possesses strong emotional discipline. They thrive deep on research and are comfortable standing alone against popular market sentiments. So, foundation principles. Growth investing focuses on companies that exhibit above average rates of expansion and revenue and earnings, often driven by new technology, market expansion, or innovative business models. And the philosophy was fossilized by investors like T. Rowe Price and Philip Fisher. Okay? It has a focus on momentum. Growth investors prioritize future earnings and potential over current valuation metrics. They are willing to pay a high price today for the promise of massive earnings tomorrow. And disruptive innovation. Some key characteristics include a high rate of sales growth, a strong competitive advantage, a moat, and a rapidly expanding industry, and a focus on reinvesting all profits back into the business for continued scaling. Okay, and ignore current profitability. It's common for high growth companies to report low or negative earnings, okay, just because they're getting their feet off the ground. Okay, they're letting the sales come in, letting the customers come in. Doesn't mean that the company is not worth nothing. And thus a high PE ratio is going to be involved into that as they invest heavily into R&D, marketing, infrastructure, and trying to make the company bigger. So then their profit margin is going to be a lot bigger. Okay. Then while a value investor seeks a stock trading at $60, that should be $100. A growth investor seeks a stock trading at $100 that they believe will be worth $500 in 5 years. Okay. They're concerned with the trajectory of the business, not its current snapshot. Is it going to be putting smile on people's faces? Okay. That's going to be the number one telltale sign to know if a business is going to be successful or not. How much is it affecting people's lives? Okay. And a growth buy, let's talk about it. So let's say a software company is losing money today, has a negative EPS, but its recurring revenue is growing by 50% annually. A growth investor buys based on the expectation that once the company achieves critical mass and stops aggressively spending, the profits will be enormous and the stock price will multiply several times over. So focus. Investors primarily look at year-over-year revenue, growth, and earnings per share, the EPS growth. And consistent growth above 15 to 20% is often the benchmark for a true growth stock. And quarterly acceleration in these metrics is a major bullish signal. So let's talk about the law of large numbers. Growth investors must always assess how long a company can sustain high growth rates, as it becomes exponential harder as the company scales. And that's the law of large numbers. And we'll talk about the PE ratio. Okay, divided by the annual EPS growth rate. That's a percentage. The PEG ratio attempts to harmonize PE and growth rate. And a PEG ratio of 1.0 or less is often considered a fair value for a growth stock. And it suggests that the price being paid is reasonable and relative to the expected growth. And if a stock has a PE of 30 and is growing earnings at 30%, then it has a PEG of 1.0. So high growth, recurring revenue. High growth software and subscription companies are highly valued for their predictable recurring revenue streams. Okay, for example, software as service or SaaS. And TAM. TAM is going to be the total potential size of the market and that the company is targeting. The bigger the TAM, the longer the company can maintain hyper growth, and investors seek companies with small current market penetration but colossal TAM. Okay, and TAM stands for total addressable market. It's a principle. Growth investors are fundamental, betting on future performance and disruptive power in an expanding market, looking to make money constantly. So, advantages: potential for explosive returns. The possibility of 5 or 10x returns in a shorter time frame is the primary draw, and compound growth is exponential. And exposure to innovation. Investors gain exposure to the companies driving technological change and societal evolution. And the simplicity of thesis. The core thesis is often easier to articulate, and this company is winning in a massive growing market. Okay. And the cons: extreme volatility. High expectations lead to steep sell-offs, and if the company misses even minor earnings targets, these stocks are vulnerable to economic downturns and interest rate hikes. And valuation risk. Paying a premium for growth means the investor must be right about both the growth rate and the sustainability. If growth slows, the stock can fall dramatically. And the lack of dividends. Growth companies typically reinvest all the cash flow, meaning that the investor receives no current income at all. So the ideal growth investor is risk tolerant, technological savvy, forward-looking, and comfortable with volatility. They seek to capitalize on the long-term trends and accept the risk that many investments will fail, provided the successful ones generate outsized returns. So, bridging the gap, the GARP philosophy, famously employed by Peter Lynch, it seeks to combine the best aspects of both disciplines. And a GARP investor looks for companies that are exhibiting consistent above average growth, but are not trading at exorbitant, speculative valuations are going to be involved in them. And a GARP criteria, it's really the best of both worlds. Okay. GARP, it stands for growth at reasonable price. A growth at reasonable price stock often has a PE ratio that is only slightly higher than the overall market, but its EPS growth rate is slightly higher, and it blends the safety of a modest valuation with the upside of strong business expansion. And the PEG ratio is the primary tool used by GARP investors. And the GARP investor profile, all right, consistent growth. It seeks stable, sustainable growth, for example, 10 to 20% per year, rather than volatile exponential growth. And the focus on quality. It prefers companies with strong balance sheets, high returns on equity, right, and strong free cash flow. And it's hallmarks of a fundamentally sound business. And risk mitigation. Okay, you can see things like the PE and PEG metrics, which you can use to evaluate and to avoid grossly overpriced stocks, thereby mitigating the risk inherent in pure growth investing. So you don't be buying things at all-time highs, stuff like that too. So insight. GARP is perhaps the most practical strategy, once again, growth at reasonable price for the average long-term investor, providing a path to the market and beating returns without taking on undue speculative risk for no reason at all. So choosing the right approach is less about what's right and what's wrong, and what about aligns with your personal goals. Are you a family? Are you a guy with someone with kids? Okay. Are you a woman with someone with kids? Are you by yourself? Okay. You just have a partner. Can you go a little bit more heavy with your investments? Are you trying to play it safer with maybe dividends? Okay. So let me know what you guys are doing in the comments below. So your time horizon, right? It's going to be 10 years if you're value investing, but you prioritize capital preservation. Your risk tolerance is going to be low to moderate, and you dislike volatility. And your goal is going to be to generate current income via dividends and stable compounded returns, investing in things like SPY, QQQ, and things like that, slow movers that are very consistent. And you enjoy deep analytical research into financial statements to figure out the best ratios to see what's going to pay you guys the most out. And consider growth investing if your time horizon is long and you're seeking to maximize capital appreciation. And then maybe you might want to go ahead and invest into some value stuff, dividends, after you get some day trading, futures profit, swing trading profit, whatever. And your risk tolerance is going to be higher in this scenario. And if you're comfortable with significant drawdowns, and your goal is to capture exponential returns from market disrupting businesses, and you're technological informed and enjoy following market trends and innovation. So have a diversified portfolio. Okay. I recommend you guys having a long-term portfolio and then you guys having a short-term portfolio. Okay. Also, because the taxes are going to be different too. If you're holding a trade for over 1 year, taxes are going to be subject to some long-term tax benefits versus the short-term tax benefits if you sell before a year. Okay. So decide what's best for you. Okay. Invest in a smart way. Keep this capital. We're building wealth for ourselves, our families, our loved ones, making sure everyone can be taken care of, making sure everyone can be protected and we're riding for, because we're being disciplined, because we're going hard, because we're pushing forward. All right. Don't be in your head. Don't let anything stop you guys. Stay prayed up to God. Keep grinding and head over to Stackmode.net if you want to learn how to be disciplined and how to invest. Catch you in the next one.
It's 2026. What's going on? We're back in the Stackmode community, and first week, I just wanted to go ahead and recap and let you guys know what the business is. So we're up about 6% so far in the first week of 2026. I'm going to start doing a recap kind of once a month, just updating you guys on my P&L. Sometimes twice a month, showing you guys like the first week what my plan is, and then showing you guys like the end of the month result and showing you guys progression on how to start an account from nothing and grow it into something. So here, focusing a lot on AI stocks, tech stocks, and stocks that really have stuff to do with the future is really what I'm going to be going forward with this year. So a lot of people like to invest in stocks that have been around for decades and years and stuff like that. Me personally, I like to invest aggressively. This year, I'm going to be really focused on shares as well too, pretty heavily compared to options and futures like I have in the past. I'm really going to be just trying to go hard on shares this year, scouting out good companies, finding good buys, purchasing them, and just holding and sitting on my trades. That's noticing it's been working out for me really, really well. Been able to grow my account at a relatively fast pace. Been really, really happy with the profit. And one thing I really like about swing trading shares compared to options trading or futures trading is whenever you're swing trading shares, you can just sit back and chill on your trades. You don't have to worry about time, no expirations, no getting margin called. You could just buy your shares, sit and hold, and that's it. That's all you absolutely have to do. And taking your time on shares, trades, and scouting out the companies that are going to be making the most ample progression within our societies, getting rewarded for that, getting rewarded for your research, for your knowledge, for knowing to not buy at all-time highs and to buy at certain low areas. The reward that you get from shares compiled with the risk factor that's pretty much taken off, because say options, for example, I've changed my whole mental mindset. When it comes to options, people can pretty much sign a death contract. Your contract is pretty much locked in. It has to hit or it's going to miss. Okay, that's 100% just what it is with options. With shares, as soon as you buy, your money will fluctuate over time. But one thing about it is that you 100% do own. If your options is not going towards your directions, you're going to be losing. Okay, even with shares, if it's sideways or moving slowly towards your direction, you're still going to have all your capital. If you put down an options trade with not enough time and it's moving slowly towards your price direction, but it's still moving, okay, either A, your price is going to go negative on the contract due to theta and time decay, or your profit's going to be moving extremely slow and not how you want it. Also, another reason why I'm focusing on shares instead of options this year too is that at a certain point when you get too rich, you can buy all the options contracts for most stocks that you're looking at. Okay, so that's why billionaires have to play shares. So I'm trying to get to the financial point to where I'm one of the best traders. Okay, so personally this year, I'm going to be focusing really, really heavily on shares. Got Bitcoin, of course, and in order to generate income, maybe later down the line towards this year, first couple months within the year, I look forward to playing some futures as well too. Okay, so I look forward to playing some futures within that. And I'm just going to be fully transparent with you guys at all times. I want to just show you guys stats, show you guys what I'm holding, and show you guys how I plan to continue to go forward. So let's go and let's jump into some performance, inshallah. So jumping into the stats here. So compiling an account, guys. Okay, I want to show you guys what it looks like starting an account from 0 to 4 to 5, 6, 7 figures. I want to just be fully transparent with you guys and show you guys how it's done. So starting here, you could see just have this account here, kind of restarted it in July 2025-ish. Okay, started growing it throughout this time, just reinvesting income from business, winning trades, adding over a single time. Okay, and as you can see, P&L is just heading in an upwards direction month after month after month after month. Okay, so your work income, your business income, or even your options and futures income should be funneled back into your account. Funnel it back into your account. Say your business, for example, if you're doing 5K a month in your business, okay, try and take 4K a month of that, okay, and invest it. Okay, you could put maybe 2K in the crypto, 2K in the stocks. Just try and break it down and invest what you're making. So your P&L is always going in an upwards curve. Okay, every time you guys get some money, try and invest. And then as you win trades, okay, there's going to be times where you may lose, okay, but then you're going to win more trades, get in different seasons, and continue to uptrend. Okay, if you feel like you have to invest every single time you get some money, then do that. Do that. Okay, I'm absolutely addicted to investing. I'm going to keep it 100%. Okay, shares is not something that I played past 2-3 years. Yeah, shares is not something that I've played or really looked at. It's really just been a lot of options in futures. I played options on Robinhood, TradeStation as well too. So I have some stats just spread across everywhere. But as far as Webull, I want to just use it for my shares portfolio. And I just want to be just fully transparent with my portfolio and how I plan to upscale it. Okay. So when you guys are growing your account, right, patience is going to be the number one thing. Okay. It's going to take time for you to know how to identify the setups you need to take. I recommend you guys go to stackmode.net so you guys can get with my trading mentorship, so it doesn't have to take you a long time in order for you to understand what a decent setup looks like. But I went through a lot of unnecessary losses early on within my trading career due to the fact that I was just being uneducated and being impatient and being stubborn. Okay. So completely my fault while I was struggling in the beginning, but once I started getting my foot, I was able to go ahead and progressively increase my P&L year after year after year after year. Okay. So all your business income, all your work income, okay, after your bills are paid, of course, and make sure you guys are reinvesting the profits from the trades that you win. So your income vehicle generating skills are going to either be your options or your futures. Personally, I'm going to go with futures this year. I've played options for a few years and I like just the stability of futures and how you can just turn dirt into diamonds. Same thing on options too, but the time decay factor and stuff. But I don't know. I'll see even this year if I'll even touch futures or options at all, honestly. I might just stick 100% on shares, find little small caps, and just really try and turn up like that. And just continuously do my research on these stocks and these companies and try and catch some stuff at the lows. I'm really having fun doing that, finding the best companies and playing shares. Just really been having a blast. Options, it's really funky with options. Options has a lot of derivatives built into it. Price could be going in your direction and you could still be down due to multiple factors, due to like how much volume a contract has, etc. And all that stuff is just really ghetto, especially when I'm trying to protect and provide for my family. I don't really want little random factors determining whether or not I'm going to get paid. So I like shares a lot, even when if I, inshallah, if God wills, if I cross into like the 10 million plus range, 50 million plus range, I can comfortably trade shares even as a 100 millionaire into billions of dollars. Okay, due to the fact that shares are going to be pretty much always available for the most part. So shares are really just my favorite instrument. This year, I'm focusing completely on shares. 2023, I played a lot of futures. 2024 was a lot of options. Same with 2025, was a lot of options as well too. 2026, let's swap up the game. Going to be focusing on shares. I've been finding some success recently in just investing in little tech stocks and stuff like that. And just, I want to just break down and give you guys full guides on what I do to find the stock that I want to play, why I'm getting in said stock, and what I see in said stock within their future, right? So is this stock even going to be half decent in the first place? And as you guys can see, this is completely live. P&L, you can see it moving up here. Market is closed right now though. So yeah, that's going to go ahead and be that. So keep all of that in mind. And let me head over to the positions here. So this is what I'm currently holding. Okay. We got some Path right here. Path is a stock that is been in the works in the limelight recently. I bought some more at like 16, but I sold some a couple of days ago. So we got Path. That's one thing that I am holding. Once again, bought it at around 17.75. Let me get on my higher time frames here. So on my higher time frame, I could see we IPO'd all the way up here at around 90. So I liked that a lot. So I can see a lot of upside room, at least to this 30 area here. They've been getting a lot of funding. I see higher lows being put in. So Path, really, 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 really happy there. Excited to go ahead and take that up as well. Let me go ahead and open up NVTS. So we got NVTS here as well too. NVTS, this is one I'm really, really excited for. So we're currently at 10.31 right now. We got price trying to head up. I bought around 9.89 right here. Okay, and once again, we got price heading in upwards direction. We IPO'd. IPO stands for initial public offering. which is where the stock decided to open at. So we IPO'd at around 22.19, and it looks like price just made this high resistance at around 17.82. So yeah, we're gonna go ahead and wait here and wait for price to go ahead and catch up, do its thing, and then we should be able to make some good profit on this as well too. So I like this a lot. Big fan of NVTS here. They collabed with NVIDIA, and that NVIDIA collaboration, of course, helped it a whole bunch. Whenever we're collabing with NVIDIA on certain things, of course, that's going to be, pretty successful for us to be looking forward for the most part. So NVIDIA is going to be one of the biggest stocks, and I personally sometimes like to look at stocks that NVIDIA is collaborating with, or say Apple or something like that. Any big world-leading stock, if they're making collaborations with other stocks, I like to look into those too, and then I like to see if profit can be made. So EOS as well too. This is an energy enterprise stock, about around 14.22. Price is trying to push up here. Let me get on my monthly time frame here. So I could see price decided to IPO at this 31 area up here, 0.95. And we just recently created this area of resistance here at this 19.91 area up there. Okay. So just waiting for price to go ahead and go up. Feeling this area here. And I could see here, even on the weekly, I could see higher lows being put in constantly. Okay, constantly. We got constant higher lows being put in. Okay. And it's really just taking heed, noticing price how it goes up, goes down, goes up, goes down, and continues to just spam that. Goes up, goes down, comes up, comes down, and it'll just continue to spam that over and over and over again. Inshallah, especially since this seems like a half decent stock that people care about. And once again, this is an energy enterprise stock, so I like this one a lot too. Price looking to swoop up. Let me head over to IONQ. Big dog right here. So IONQ, one of the leading quantum stocks. We just had a burst to this area of resistance at this 84 here. So as soon as I saw this higher low get put in, I was like, oh yeah, let me go ahead and hop in those. So that higher low, I loved it a lot. Was a big fan that it put in right here at this area. So as soon as I saw that, I was like, okay, price is looking to progress. And even after that, it came up, made new resistance, it came down, and then made some new support. So I like that a lot. Even if I head over to my 4-hour here, let me turn off the poo-poo time frames. Get on my 4-hour here. So even if I hop on the 4-hour here, boom. Could see price decided to come all the way up here, fall all the way down here, bounce up, create a new resistance wall here. As you guys can see, we have one push down here, another push down here, and then we got price falling down, making a higher low here. So this low is higher than this low. I like that a lot. Super big fan. And then from there, we can go ahead and wait for price to come up, smash past this area of resistance, and then after that, inshallah, we should be able to go ahead and catch price upwards right after that. Okay. So it's really just about taking your time, being patient, and waiting for the setup. Okay. Remember, you want your gap to be filled to the right. You want market to make the left side of the V, let it fall down, let market make the bottom of the V, and then we catch the right side of the V. Okay. We catch the empty right side of the V. Okay. That's what I want you guys to be doing. Catching the empty right side of the V, okay, like this. Okay, this is what we're catching. All of this whole empty space between this resistance and this area of support, right? This whole area is nothing but profit. Right? Nothing but profit. All up here, okay? So 40, plus 40 points left between this area of support
and this area of resistance up here. So a very, 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 very long way to go. Intel, check this out, up crazy on this one here. All right, Intel, I got it at around this 35 area. I'm going to go ahead and hop up on my higher time frame here just to show you guys why I got in here on Intel. So Intel, I decided to get in this area. Kind of the same reason, even if I'm on monthly here. I could still see price making upwards progression for the most part. Yes, we did fall down and make this low here. Although after this low, I put that into combination with some fundamentals. Since all the tariff stuff was going on, the United States needed their own AI chip making company to make AI chips for them, and Intel decided to partner up with other companies. I believe NVIDIA is included. And as you can see, we're starting to get a lot of bullish reaction looking to fill in this V. So we first had price falling down from this resistance here on the weekly. And then we could see price deciding to come up and fill in this gap area up here. Okay, so just go ahead and let price do its thing. Let it fill up. Okay, and just give it its space, give it its time. Okay, let market do its thing. So that's going to go ahead and be that as far as Intel. This trade was super duper simple here, and I bought after this little higher low area here too. After I analyzed this higher low area, I was like, okay, cool, yeah, super duper bullish after this. Check on the daily here too. Even after this resistance, we came down, made another higher low. After this higher low here, saw 1, 2, 3, 4 green candlesticks, bought in. So you can see you're getting a nice V fill here. And on my monthly time frame, we can go ahead and head up to this resistance up here and head up to this 40 area up here to all-time highs. I'm praying. Okay, so that's gonna go ahead and be a flip from, let's see, I opened here, so it's about 28 points here. Very great flip. And then Webull here, you know what I'm saying, Webull, they're hating on Webull. We're waiting on this, I'm not gonna lie, waiting on some Webull here. I just keep adding into this. This is gonna be a huge play. Webull is my favorite broker. I'm using this right now. If you guys are wondering what I'm looking at to look at the charts and do all this at once and see the price right here, Webull is going to be my favorite thing to analyze my stocks on. Well, I use TradingView, but honestly, I might just use Webull itself from now on because I think it's a cooler interface and you guys can actually see some specifics of everything too, which I really like. So yeah, that's going to go ahead and be that. I pray it helped. That's how I'm opening this year. All the stocks I'm watching, that's the profit I'm up. And yeah, I'm just going to be fully transparent going forward. Just want to show you guys absolutely everything. Not going to be one of these mentors being cringe, making things uncomfortable, and just not trying to be truthful. I always want to show you guys the truth. All right, love you guys so much. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace.
Let's go and let's jump straight into the lesson. This is going to be the differences between stocks, shares, and options. Let's go. And at their core, stocks and shares refer to the same thing, a unit of ownership in a corporation or a company. And the terms are often used interchangeably, and though shares typically refers to the number of individual units held by an investor, and while stock is more of a general term used for the entire collection of shares. Okay, so for example, I own 10 shares. 10 shares is going to be the amount, the percentage of the company that you want to be a hold of. Okay, the amount of shares equals the amount of percentage ownership that you have in the company. Okay, so if you want to own 10 shares of Apple stock, okay, and Apple is going to be the primary stock. Okay, shares is the percentage amount that you own, and the stock is going to be the name. And here's what they represent. Owning a share means that you're a partial owner of a company, and as an owner, you have to represent. Okay, and you also have a claim on a portion of the company's assets and earnings. And this ownership gives you a right to the company's profits. And it's distributed as what's called dividends. Okay, and dividends, especially if you have enough shares invested into, then dividends will go ahead and be paid out to you. And this way you can be able to make money just by being an investor. And in saying the corporate matters though, it's also going to give you some voting rights depending on the amount of share that you have. And for every share that you own, you typically get one vote. Okay, so the more shares that you have, the more votes that you're going to have. Okay, so you're going to have one vote per share, for example. Okay, and that allows you to influence key decisions like electing the board of directors and who's going to be controlling the future of the company's growth. And why do companies issue them in the first place? Companies sell shares to the public to raise capital, and this money can be used for expansion. So whenever you guys see millionaires, billionaires, stuff like that, and they're company owners, a lot of the time it's not in raw dollar currency, okay, sitting in a bank account. A lot of the time they're rich through the company they own, and a lot of times it's on the stock market, okay, and then that company generates money. And since they're associated with it, or the leader, they get the money associated with the tag, so then they get to be a billionaire. For example, any creator of, like, say, company.com, okay, say they have $500 a share worth, okay, the owner of it, let's say the company does $10 million a year, okay, the owner of it would be classified as a billionaire because he's the owner of it. So that's normally how that works. So they sell shares to the public to raise capital and raise money, and this money can be used for future building expansion on the company, research, paying off your debt, and other business goals. And this process is known as an initial public offering, also known as an IPO. And this transforms a private company into a public one. And this is when shareholders, okay, can invest like me and you if we wanted to. And for a company like Google, for example, a public offering allows them to raise billions of dollars to fund new ventures. And when you buy shares directly from a company during an IPO, you're participating in the primary market. And after the IPO, shares are bought and sold among investors on exchanges like the New York Stock Exchange or NASDAQ, then that's going to be the secondary market, okay? So when you're buying shares directly from the company from IPO, okay, that's a primary market. And after the IPO shares are bought and sold among the investors, okay, on exchanges like your New York Stock Exchange, that is the secondary market. So let's talk about equities. The broader view is ownership. So the term equities is a broader financial concept, and it encompasses all ownership interests in a business, which includes common stock, preferred stock, and retained earnings. And it represents the value that would be returned to a company's shareholders if all assets were liquidated and all debts were paid off. And on a company's balance sheet, it's often referred to as shareholders' equity or owner's equity. Let's talk about shareholders' equity. This is a fundamental metric used by analysts to assess a company's financial health, okay? So, and it calculates it by calculating the assets minus the liabilities, okay? So what assets are things that a company needs. Let's say like the light bill, okay? A company might need a light bill in order to run a factory, for example. That's assets, something that's needed. And a liability is something that's not needed, okay? Any business expenses that's just gonna be extra, okay? Like giving all your employees a vacation or something like that, for example, okay? And then that's gonna equal shareholders' equity, okay? So, common versus preferred stock. Common stock. This is what most people mean by stock, and it comes with voting rights in corporate matters, but it's secondary to preferred stock in claims on a company's assets during liquidation. When you're a true owner, sharing in both the upsides and the risk. And let's talk about preferred stock. These shares typically do not come with voting rights, but have a higher claim on a company's assets and earnings than a common stock. And holders of preferred stock receive dividends before common shareholders. And this makes them a hybrid security. And it's often seen as less risky than common stock, but without the same growth potential, okay? So, stock options, my favorite, okay? One of my favorite things I like to trade, and it's pretty much when you get paid based off of the direction of a stock. Okay, if you think the stock is gonna go up, then ideally you would purchase what's called a call contract, which we'll talk about here. Okay, and if you think the stock is gonna go in a downwards direction, okay, then you would buy a puts contract. You can also have expiration dates on your contracts too, to choose how long you wanna hold the trade for. And when the contract expires, it's gonna automatically close on its own. So you either sell the contract before it expires, or it'll go ahead and just close on its own. Yeah. So stock option is a contract that gives the holders the right, but not the obligation to buy or sell an underlying stock at a predetermined price. Okay. And that's also going to be known as the strike price. So let's say a stock is at $32 a share currently. Okay. Let's say a stock is at $32 a share. You think it's going to go to $34 a share. Okay. Then you could buy a strike price contract of $34, okay, or even $33, since that's above $32. Okay, so you can buy any number above your prediction but below your take profit. Okay, and that's going to be a good strike price in order to purchase, inshallah. Okay, so when you do that, you're going to go ahead and get paid based off of your prediction. Okay, say for a put example, let's say share price is going to be at 20, for example, right? And you think price is going to go down to 15. Okay, so if price goes down to 15, you could buy a 19, 18, 16, or $15 strike price contract. Okay, because you're going to get paid based off of your prediction. So just focus on what you're doing. All right, just focus on what you're doing. You're going to get paid based off of your prediction. Okay, and it's also going to be within a specified time frame that you purchase. Okay, and the higher the expiration date that you go, the more expensive that it's going to be. And it's a derivative instrument, meaning that its value is derived from the performance of the underlying asset, and they're a popular form of compensation for employees and a powerful tool for investors to leverage their positions. So a call option, it's the right to buy stock at the strike price, okay, which is going to be the pretty much price that you're wanting price to go to. And an investor would buy a call option if they believe the stock price is going to rise above the strike price, and you're betting on the stock's upward movement. Let's talk about a put option. And it's the right to sell a stock at the strike price, and an investor would buy a put option if they believe the stock's price will fall below the strike price. And this is betting on the stock's downward movement, often used for hedging. Yeah. And also sometimes companies often grant stock options to employees as a form of non-cash compensation. Okay. So incentivizing them to work towards the company's increasing value, because as the company keeps innovating, putting smiles on people's faces, okay, creating more product, generating more revenue, then inshallah the share price is going to increase, making their options worth more. And most of the time, inshallah, they're going to be getting paid in like some long-term cost contracts, I assume. So risk, reward, or purpose. So while all these terms are related to company ownership, they serve different purposes. Okay, so stocks. Okay, stocks are going to be the name. Okay, stocks are going to equal the name. Okay, stocks are the name. So let's say I open Stackmode. Okay, let's say I open Stackmode on the market. Okay, if I put Stackmode Network on the market, okay, inshallah will happen one day. If I put Stackmode Network on the stock market, that's going to be the name. So if you just hear the term stocks, that's going to be talking about the name. Shares, the term shares is going to be talking about the percentage ownership that you're trying to purchase within the company. So you can own 1 share, okay, or you can own 50 shares. And the share price is going to be determined on the current price. So if the current price of a stock, okay, remember the stock is the name. So if the current price of Stackmode is $32 a share, for example, okay, and I think it's going to go to $600 a share, okay, or $700 a share, okay, then whatever the current price is going to determine what the share cost is. So if price is at $32 a share, 1 share will cost $32. If price is at $700 a share, 1 share will cost $700. Okay. So inshallah, try your best to get in at a dip or a low and then catch the sweep up. And that's how money is made. Okay. That's how growth equity is created, by trading shares. Okay. And stocks and equities. Okay. The primary goal of these are going to be long investment. Okay. There's going to be also a lot of tax benefits when you hold your trades for over a year. And the primary goal is going to be long-term investments when it comes to shares and equities as well too. And the reward comes from dividends as well too, which is going to be quarterly money that's going to be spread out to everyone who has a decent amount of shares. Okay, so you'll get paid by dividends and capital appreciation. And the risk is that the company's value could decline, leading to a loss of your initial investment. But no risk, no reward. We're only here one life. Okay, just trust God, take a risk, keep going. Let's talk about some options. The primary purpose is speculation or compensation, and the reward can be much higher due to the leverage they provide. And it makes you control a large number of shares for a small upfront cost. And this risk is that if the stock price does not move in your direction that you purchase, then the stock price could tank on the contract. Okay, but it's going to be fine. If it expires worthless, you just try again. Don't lose hope. Trust God. Keep going. Okay, and you can potentially lose your entire investment, but you could also play into that. Okay, whatever your stock option cost is, you could use that as your stop loss. So if it costs you $70 to open a contract, that could be your stop loss. Okay. Instead of buying a $500 contract, trying to play with a $70 stop loss, that might not always work in stock options as cleanly as you might want. Let's explain leverage. And with the call option, you might only pay a few dollars for the right to control 100 shares with leverage and the time expiration. And if the stock price goes up by just $1, you've made a significant percentage gain on your small initial investment, far greater than you would have buying the shares outright. Okay. But it also has time expirations on it. Okay. So this is why the longer the time you're going to buy on a certain play, it's going to be the better. Okay. Give your trade time to work out. Okay. But the longer that you go trying to buy out, the more expensive that the contract is going to be. Okay. So for practicality, for example, if an investor wants to build a retirement portfolio, okay, you could buy stocks. Okay. So you'd be buying shares of those stocks for long-term growth, for long-term tax benefits, and just holding trades year after year, keeping money in the stash, keeping stack mode, okay, implemented into your portfolio. Staying down, not touching the bread, okay, staying down. And if a trader is looking to profit from a short-term market movement, then stock options would be able to amplify your return. So you can use the stock options profit to buy some more shares, but stock options in general is just going to be better to go ahead and generate some more income. Okay, so it's going to be time to just start going harder, get more education, and really understand what we're doing before we put money into the market. All right. Market capitalization, valuation, how a company's priced in general. So understanding that a company's market cap, okay, also known as the market capitalization, is pretty much how much a company is worth. And the valuation is crucial for making informed investment decisions. Now, market cap's not going to be everything. You could do your research and catch a good trade at the low, and then the market cap turns huge later. Okay, but market cap is just going to be a good decision to see if something's going to be a strong value play. And market cap is going to be the total value of all the company's shares, and it's a key metric used to determine a company's size. So here's the market cap formula. The calculation is pretty simple, but does a lot, and it's quite advanced. So market cap, okay, the calculation concurs of, it's the current stock price, okay, so Stackmode is worth $700 a share, okay, then it's worth $700 a share. Okay, so you take the current stock price, $700 a share, times the number of total outstanding shares, so whatever that would be, and that's going to give you the market capitalization. Okay, so this tells you what the market currently values the entire company, and it changes every minute as the stock price fluctuates. People are always going to be putting in orders, selling and buying, and especially something that has a high market cap, is always going to be more orders flowing in due to the fact that it's popular. So there's some different market cap categories. Companies are often categorized by the market cap, which influences their risk growth and their potential. Once again, it's not going to be everything, but something to look for. So a mega cap, it's going to be something worth over 200 billion in market cap. So for example, big giants at the time, like Apple, Microsoft, for example, they're generally seen as stable, mature companies. And let's talk about large caps. It's going to be 10 billion to 200 billion. Okay. And they're established leaders in their industries. You got mid caps, 2 billion to 10 billion. That's companies with solid growth prospects. And small caps, 300 million to 200 billion market cap. There could be a bit higher risk if they don't decide to grow and have some future innovation, but with the potential, they have a bunch of high expectations, certain companies, and they could explode super duper hard. Okay, like for example, Palantir, and microcap and nanocap, and below $300 million. And they're the riskiest category once again, because it's fresh, new startups, new ventures. Sometimes it could be people with a bunch of money investing into it, and then it doesn't go anywhere. So make sure it has some future value. So let's talk about valuation versus price. So it's important to distinguish between a company's price and its market cap and its intrinsic valuation. Valuation is a more complex process that attempts to determine a company's true worth based on its assets, earnings, future cash flows, and growth prospects. And a savvy investor is going to be looking for stocks where the price is lower than the company's estimated intrinsic value in the first place. So we'll talk about valuation methods. There are many methods for valuation, including the discounted cash flow, the DCF model, and a company's price to earnings ratio. Comparing that to its others ratios of other companies is going to be a good way to determine if what company is making more money than others. Okay. And these are essential tools for a fundamental analyst if you want to be an investor. So let's say, for example, let's say company A has 10 million shares outstanding. Okay. Let's say Stackmode has 10 million shares outstanding. Okay. And its stock is trading at $50 a share. okay? And its market cap is going to be $50, okay? Because that would be the current price, okay? You're going to be multiplying the current price times the number of outstanding shares. So let's say Stackmode has 10 million outstanding shares. You're going to multiply that by the amount of outstanding shares. So 10 million. So $50, the current share price times the number of outstanding shares, 10 million. And that's going to equal 500 million, okay? And that's how the math is done. That's how you find out market cap. Let's say company B, for example. Let's say it has 5 million shares outstanding and its stock is trading at $150 a share. And its market cap is 750 million. And even though company B's stock price is higher, company A might have a higher intrinsic valuation based on future growth projections and its expectations. So the differences at a glance. So to summarize, it's essential to recognize the distinct roles of each of them. So shares and stocks. Stocks represent actual ownership in a company, and they're tangible assets that can be fractional and traded on exchanges, okay? Any stock exchange is going to be a broker where you can put in your bank account, your card, and buy some stock for yourself, okay? That's what an exchange is, also known as a broker. So let's talk about equities. Equities are a broad term for the total ownership of a value of a company. It's an accounting term that includes all forms of ownership interest, and equities is the larger category, which includes stocks and stock options. They're a contract and a right to buy and sell shares, not the shares themselves. Okay, and you get paid based off of the direction that you think price is going to go into. And they're a tool for speculation or compensation and are not an ownership stake until they are exercised, until someone's to fill in the contract. So think of the company as a pie, okay, also known as the stock. A fraction of the pie, okay, is going to be known as a share. And let's say you're about to deliver pie. Let's say you project to sell 4 slices of pie. If you think that, you could buy an option based off of that, okay? So put all of that into retrospective and understand, okay? So you buy an option, but okay? And the store name, let's say it's Stackmode Pies, is the stock, okay? So that's how it all works. So by understanding these core concepts, you're just not a spectator anymore. You're getting informed, understanding the market, not a gambler, and you're becoming an active participant with the knowledge to navigate the complex world of finance. Alhamdulillah. So while the terms may seem confusing initially, their distinct definitions and functions are critical to building a robust financial vocabulary. And remember, stocks and shares equal ownership, okay? They equal ownership. You can hold them for however long that you want. So use that money. Don't go buy clothes, stay down. Don't go buy drip. Don't go buy the best whip right now of paying the high monthly payments. Stay down, invest, and go ball out later. Let your money make infinite money and then go buy what you want. And equities are going to be a broad ownership value. And stock options are going to be the directional bias that you can get paid based off of. You can use all of these to create future value, provide for your family, and provide for yourself. Stay prayerful to God. Head over to Stackmode.net for all trading education and business education. Love you so much. I'll catch you in the next one.
Trading without discipline, you might as well go take yourself to the slot machine. And God says not to do that for a reason. You can be extremely disciplined and you can grow your account to 5, 6, 7 figures just by staying consistent. I want to teach you guys about being disciplined and about taking accountability because I want you to get to the next level. Let's go and let's jump into it, inshallah.
So the accountability hierarchy. So not all accountability is created equal. You must construct layers of defense against your impulses. So level 1. So system accountability. So the hard stop. Automated rules that are physically set on your chart, okay, and set in your brain that prevents you from trading, such as a broker daily loss limit. You can go into your broker settings as well too, and have a certain amount that you can lose per day and per trade. Especially on that futures, you're gonna want to set your loss limit, especially if you're struggling with over trading, struggling with yourself, okay? And peer accountability as well too, or mentorship. Head over to Stackmode.net if you're looking for mentorship. A trading buddy on the same journey really helps you, okay? It helps you share plans, not just P&L, because I really care about getting you guys better. And a coach, okay, such as myself, someone with more experience who can spot behavioral leaks that you might miss normally.